My dear CMA final students, the much awaited CFR marathon revision for June and December 2026 attempts now arrived. I welcome every one of you to this CFR marathon revision for June and December 2026 attempts. Don't skip this introduction. Don't directly jump into the marathon part. Listen to me. Next 2 to 3 minutes, very important. First thing, the duration. Sir, the duration of this marathon revision is 18 hours approximately. And the attempt, for which attempt students, sir? The students who are writing June 2026 and also planning to write December 2026, they can use this marathon. Of course, those students who are writing June 2027, they can also use it, provided there are no changes in the syllabus. Next, the coverage, which is the most important thing, sir. Sir, in this marathon, I have covered both the concepts as well as the problems, sir. For every concept, at least one question is solved, sir. In fact, in this marathon, I have solved more number of questions than the usual marathons. And definitely, I can say with 100% confidence, you are going to get never before clarity on the subject, and your confidence levels will be boosted, and you are going to write the CFR paper very well. And you can cover all the concepts with clarity in a quick time, and also you can solve the questions so in a quick time and with 100% clarity. And the sources, sir, throughout this marathon I have used 3 sources: the concept book, the power notes, nothing but the question bank, and also the class notes. First, the concept book, power notes. This is color book, sir. This book I have used for the marathon revision. This book I have used, and also I used CFR question bank. This question bank is also a color question bank. From this question bank only I have solved the questions. This question bank is a compilation of the study material questions, MQP model question papers questions, and also previous exam questions, and also the workbook questions which is given by the CMA Institute. So all the CMA sources questions are covered in this question bank, and I can say this concept book and question bank is the best books you can have in respect of CFR paper. And of course, next I have used my class notes also for the marathon revision. These are the basic details, sir. And one more important thing, sir, how many marks you covered, sir? Approximately 70 marks I have covered in this marathon revision video, sir. And all the links will be provided in the description. You can download these concepts book, question banks. All the very best. I hope this marathon revision makes things easy for you and bring back your confidence in the CFR paper, and give me your feedback to me how you felt about this marathon revision. All the very best. Happy learning. Thank you so much. So first we are going to start Ind AS 36, sir. One of the very important Ind AS from examination point of view. If you see the past examination questions, definitely one question is a possibility from this Ind AS 36, and also they are testing MCQs also from this Ind AS 36. Very important. So let's revise Ind AS 36. See, before Ind AS 36 there is one standard relating to PP, Ind AS 16. That standard you should have a basic idea. After that you have to cover Ind AS 36. Okay, that Ind AS 16 already we have uploaded. Full video of mine is available in YouTube. You can check it. Now let's start Ind AS 36, impairment of assets. Sir, what is this impairment of assets concept? Let us discuss it. See, in any organization, if you take, we have tangible assets, we have intangible assets. Tangible assets is called property, plant, equipment. Now, what is the most common way an asset may lose its value? Depreciation. By time asset will lose its value, we are calling it as depreciation. At the end of the year we calculate depreciation. Apart from depreciation, there could be other reasons also why an asset may lose its value. At the end of the year we need to check, is there any indicators of impairment. What is impairment generally? Generally we use the word impairment now. He is physically impaired. So impairment basically means reduction in value. Loss of value is called impairment. So we have assets in the organization. At the end of every year, in respect of each asset, we need to check, is there any indicators of impairment? Is there any indicators of impairment? Like for example, every year we are going for a medical checkup, BP, sugar, everything we will check up now. So if anything is there, that will be come through reports. Similarly, every organization at the end of every year, they will check whether there are any indicators of impairment. For example, take this building. This building, is there are any indicators of impairment? These indicators can be two times. Ind AS 36 says there are two types of indicators. One is internal, another one is external indicators. We are going to see these indicators. So at the end of the year, in respect of each asset, we need to check, is there any indicators of impairment? What is the possible answer we will get? Either yes or no. Suppose there are no indicators of impairment, then the standard says ignore, no impairment. Suppose there are indicators, then the standard says important. This is where Ind AS 36 coming to the picture and says, if you find there are any indicators of impairment in respect of any asset, then you need to calculate recoverable amount of that asset and compare that recoverable amount with the carrying amount of the asset. Suppose as long as the carrying amount of the asset is equal to or below the recoverable value, there is no problem. But the moment the carrying amount is above the recoverable value, the standard says whatever the excess is there, this excess is called impairment loss. And so this loss has to be reduced from the asset. So asset must be brought to its recoverable value. So the standard basic idea is no asset anytime if you see the value cannot exceed recoverable value. So what is the basic idea you got in Ind AS 36? What is the basic idea? At the end of every year, we need to check, is there any indicators of impairment? If answer is no, there is no impairment. If answer is yes, what we need to do? We need to calculate recoverable amount and compare this recoverable amount with the carrying amount. Suppose if the recoverable amount, carrying amount, both are, carrying amount is equal to recoverable value or below that, no problem, no impairment, no impairment loss. Suppose if the carrying amount is more than the recoverable value, that excess is called impairment loss. So therefore, what are the important things here? Carrying amount, recoverable amount. If you know these two things how to calculate, then you can obviously easily calculate impairment loss. You understand this? So let us first decide. So what is the impairment loss formula? Impairment loss is equal to carrying amount minus recoverable amount. Sir, how to determine this carrying amount? Important. See, generally carrying amount is ascertained from the books. How the carrying amount of the asset will be determined? Suppose take this building. How to determine the carrying amount of this building? That depends upon the model you are following for valuation of that asset. Ind AS 16 says there are two ways, two models, cost model, revaluation model. Suppose if you are following cost model for valuation of that asset, take the original cost of the asset, from that any depreciation, accumulated depreciation till now accumulated in respect of that asset minus, till now any accumulated impairment loss is there minus, then whatever the amount you will get now, that is called carrying amount. If you follow cost model. So if you follow cost model, how to determine the carrying amount? Cost minus accumulated depreciation minus accumulated impairment loss. Suppose if you follow revaluation model, Ind AS 16 says if you follow revaluation model, generally asset will be shown at fair value. So from the fair value of that asset minus subsequent accumulated depreciation minus subsequent accumulated impairment loss, you deduct it. Then whatever the amount you will get, that is called carrying amount. So first determine the carrying amount of the asset. So this is how the carrying amount of the asset will be determined, sir. Now what is the most important thing? Recoverable amount. This is important, everybody remember this. How to determine the recoverable amount of an asset? The standard says recoverable amount is higher of the following. Higher of the following. What are the higher? First one, fair value less cost of disposal. Second, value in use of that asset. Whichever is higher, take that as recoverable amount. So tell me how to determine the recoverable amount. Recoverable amount is equal to fair value less cost of disposal, value in use, whichever is higher. Sir, what is this fair value less cost of disposal? Fair value means nothing but net realizable value. If I sell this asset in the market, how much I am going to get it? And to sell this asset, how much cost I am going to incur? Cost of disposal. You reduce it. Then you will get what? Fair value less cost of disposal. For example, there is an asset, I can sell it for 140 lakhs and the cost of disposal is, suppose I can sell it for 40 lakhs, cost of disposal is 3 lakhs. So 37 lakhs is what? Fair value less cost of disposal. How to determine the value in use? Important. Value in use is equal to present value of the future cash flows of this that asset. What is that? Present value of the future cash flows of the asset. From that asset, what are the cash flows I am going to get it in future? Convert them into present value. You will get one value, that is called value in use. So value in use is equal to present value of the future cash flows of the asset. So there are two key items here. I want the future cash flows. I want the discounting factor to convert into present value. For example, so here you see discounting factor, they will give you 10%, 9% like that. By using this discounting factor, this cash flows from the asset you convert into present value. You will get what? Value in use. This value in use, fair value less cost of disposal. Compare. Whichever is higher you take it. You will get recoverable amount. Compare this recoverable amount with the carrying amount. See, the basic standard is over. This is the main theme. So this standard is nothing but at the end of every year, we need to check in respect of each asset, is there any indicators of impairment? Answer no, no indicators sir, ignore, no impairment loss. Yes sir, there are indicators. Then calculate recoverable value, compare with the carrying amount. So now I need to decide carrying amount, recoverable value. How to determine the carrying amount? Cost model, revaluation model. Cost model, suppose if I am following cost of the asset minus accumulated depreciation minus accumulated impairment loss. Revaluation model I am following fair value of the PPE minus subsequent accumulated depreciation minus subsequent accumulated impairment loss. Then recoverable value. How to determine the recoverable value? Recoverable value is higher of the following. What are those? Fair value less cost of disposal. Second, value in use, whichever is higher. What is fair value? Net realizable value. If I sell this asset in the market, how much I am going to get it? Minus cost of disposal. What is the cost I am going to incur to sell this asset? Second thing, value in use. What is value in use? Present value of the future cash flows from that asset. So I want the cash flows from that asset and also discounting factor. So important point here is when I am determining the, say this, value in use, expected future cash flows from this asset includes cash inflows from continuing use of the asset, cash outflows incurred to generate the cash inflows, and also the net cash inflow on disposal at the end of the useful life. See, when you are considering the cash flows from the asset at the end of the life of the asset, if I sell this asset, how much I am going to get? That disposal proceeds also should be included as a part of cash inflows, cash flows of the asset. So expected inflow on disposal at the end of the useful life should also be considered. That nothing but the residual value of the asset should also be included as a part of cash flows when you are calculating the present value of the future cash future cash inflows of the cash flows of the asset. See, some inflows you should not consider, some cash flows you should not consider. What are those? Any cash inflows or outflows from financing activity, like borrowing kind of financing activities, you should not consider. And also any income tax receipts and payments, any tax receipts and payments, you should not consider as a part of cash flows of the asset. And also any cash flows expected to arise from future restructuring plan not yet committed. If you want to do any kind of restructuring activities in future, okay, in respect of this asset, so relating to that any cash flows are there, you should not consider them. And also any cost you are incurring for improving or enhancing the asset performance, that cost also you should not consider. And when you are considering the discount rate, consider always pre-tax. Before tax, whatever the rate is there, that rate only you take it. Okay, important. And sometimes suppose if the cash flows of the asset are in foreign currency, how you are going to do it? Don't convert this foreign currency cash flows into Indian rupees immediately. First discount this foreign currency cash flows using foreign currency discount rate only. For example, my cash flows are in dollars, okay, like this. Don't immediately convert them into Indian rupees. Take dollars and using discount rate, convert them into present value. So the present value is also in foreign currency. Then the single amount, the present value, convert into Indian rupees by using that date spot exchange rate. Like converting resulting PV into functional currency using spot exchange rate. You understand what I am saying? The cash flows of the asset, suppose if it is in foreign currency, don't immediately convert them into Indian rupees. First convert into the present value. That present value single amount you convert into Indian rupees. See, the most important thing. So conclusion you tell me now, very, very important. Tell me, sir, if I want to determine the impairment loss, two things I want, right? What are the two things I want? Carrying amount, recoverable amount or recoverable value, right? If I want to determine the recoverable value, I need to take two things. What are those? Fair value less cost of sale or cost of disposal. Second, value in use. What is value in use? Present value of the future cash flows. When you are considering the future cash flows of the asset, even the disposal value at the end of the asset, at the end of the life of the asset will also be considered. Correct? Now, the most important point, listen to me. Whichever is higher I will take, right? Suppose, sir, out of these two, this is available, value in use is available, but this is not available. Fair value less cost of disposal not available, but value in use available. So what is recoverable value? Recoverable value is equal to value in use only. Take it. Suppose sometimes what happens now, value in use is not available, but fair value less cost of sales available. Then you should not consider this as recoverable amount of the asset. Very, very important. So if you want to determine the recoverable amount, you are comparing two things and whichever is higher you are taking. Suppose out of these two, if value in use is available, take it directly, if even though fair value less cost of disposal is not available. But if value in use is not available, but fair value less cost of sales is available, don't consider this as recoverable amount. The standard says you are unable to determine recoverable value. When you are unable to determine the recoverable value of an asset, what we need to do? We cannot test the impairment at individual level. Then there is a concept of CGU, cash generating unit. See, suppose this building is there. This building carrying amount I know. Recoverable value I need to determine. To determine the recoverable value, this building value in use I know. Fair value less cost of disposal I know. Whichever is higher I will take it. Suppose this building value in use I know, but fair value not available. No problem. The value in use itself is recoverable amount, and I will compare with the carrying amount. If the carrying amount is above the recoverable value, that excess is called impairment loss. Correct? But if the value in use of any asset is not available, even though fair value is available, cannot consider fair value as the recoverable amount. That means when you are unable to determine the recoverable value of an asset at individual level, you cannot test the asset impairment at individual level. Then what we need to do is, we need to test the impairment at a CGU level. What is CGU? Cash generating unit. Next I am going to explain it is what is the purpose of this CGU and all. So basic things you need to understand first. So that is the important point, sir. See it. If FLCTS is not available, fair value less cost of sales is not available, value in use is recoverable amount. Suppose if the value in use is not available, recoverable amount cannot be determined for the individual asset. Impairment is tested at what level? CGU level, cash generating unit level. Then I need to see what are the smallest group of assets which are generating cash flows together. See, when I am unable to determine value in use means what, sir? Value in use, suppose this building is there, I am unable to determine the value in use of this building. That means I am unable to determine the future cash flows of this asset, right? When you are unable to determine the future cash flows of the asset, you are unable to, that asset maybe is not able to generate the cash flows independently. That's why you are unable to determine. For example, this laptop right now I am using for my classes. This laptop is independently generating cash flows? No. This laptop, this camera, everything together I am using to provide services for you. Therefore, this laptop maybe I cannot determine the cash flows, value in use independently. I can't determine it. But maybe together with all these assets I can determine the cash flows. That's why this is called CGU. Because some assets you can determine the cash flows at individual level, but some assets you cannot determine the cash flows independently. For example, you go to Reliance showroom, Reliance Smart. You know Reliance Smart, you have ACs, you have, different generator is there, cash counters are there. Whether they are generating cash flows independently or together? Together as a store. So centralized AC system, is it generating cash flows independently? Therefore, how can I determine the cash flows of the asset? Sometimes it is not possible to determine the cash flows independently. Then you test the impairment at a CGU level. Together with these assets, what are the smallest group of possible assets are there, you identify it, call them as CGU, and find out the value in use, recoverable amount of the CGU, find out the carrying amount of the CGU, and then find out the impairment loss for the CGU. That impairment loss you distribute to the assets in that CGU. Next I am going to explain it. You understand this basic structure of Ind AS 36? Okay. Sir, okay sir. So we calculated the recoverable value, we calculated the carrying amount, we compared it. So if the carrying amount is above the recoverable value, that excess is called impairment loss. That impairment loss will be charged to P&L account. So what is the entry we will write for impairment loss? Impairment loss account debit to asset account, correct? Impairment loss account debit to asset account. For example, asset is there, plant and machinery is there. This plant and machinery carrying amount 100 lakhs. Recoverable value suppose 80 lakhs. So tell me, how much is the impairment loss? 20. So this impairment loss, what I need to do? I need to reduce from the carrying amount. So therefore, the asset value came to 80, which is nothing but recoverable amount. So this 20 is my loss. This will be transferred to P&L account. So what is the entry? P&L to asset. Nothing but this P&L means impairment loss. Later on it will be transferred to P&L account. One more important thing, sir, most important thing. So basically impairment loss will be transferred to P&L account. So impairment loss, that loss will be reduced from the cost of the asset and it will be debited to P&L account. But suppose the standard says this asset in respect of which you are booking impairment loss, it is already done revaluation is already there, revaluation happened, there is a revaluation surplus is there in respect of that asset. Whenever you are booking impairment loss in respect of any asset, if that asset is having revaluation surplus, that asset is already done revaluation previously. When you done the revaluation, there is a revaluation surplus, upward revaluation surplus is there. Whenever you have a revaluation surplus, to the extent of that revaluation surplus, the impairment loss first will be adjusted to revaluation surplus. Only the balance amount will be transferred to P&L account. For example, here the impairment loss is 20, right? So in respect of this plant and machinery, there is a revaluation surplus is there 10. So first this impairment loss, revaluation surplus will be adjusted 10, remaining will be transferred to P&L account 10. You understanding what I am saying? So basically what is the treatment of impairment loss? Transferred to P&L account. What is the entry? Impairment loss to asset, P&L to impairment loss. But the asset in respect of which I am booking impairment loss, if there is a revaluation surplus, first adjust to revaluation surplus. Balance, if any, will be transferred to P&L account. That means in this case, what is the entry I will write? Suppose impairment loss is there, na? This impairment loss, P&L account I will transfer 10, revaluation surplus, that is nothing but OCI, other comprehensive income, will be 10 to PP 20. This is what I am going to do it. Most important. So this is what they have given here. So this is one part of the Ind AS 36, sir. Ind AS 36, one part, sir, this is. Now relating to this basics, let's see some questions, sir. For example, you see this question, sir, problem number 1 from the study material. The same question is there in MQPs also. See this question. A Limited, there is a company, sir, which has a mission whose original cost is 45,000. Accumulated depreciation 15,000. Similar mission has recently been sold in the same locality at 25,000 with a selling expenses of 2,000. Management determined the entity specific present value of the future cash flows of the mission is 28,000. Find out fair value less cost to sell. Tell me what is the fair value less cost to sell here? Fair value means, I told you NRV. If this asset is sold in the market, how much I am going to get it? Tell me. This asset, the similar mission can be sold at 25,000. What is the cost of sales? 2,000. So therefore, what is the fair value less cost to sales? 25 minus 2, correct? 2,000. 23,000. Tell me recoverable amount. How to determine recoverable amount? Higher of the following. What are those? Fair value less cost of sales, value in use, whichever is higher. Here fair value less cost of sales, I know, 23,000. What is value in use? Present value of the future cash flows. Given a? Yes, see this. Present value of the future cash flows, 28. Whichever is higher means 28,000. That's it. What is impairment loss here? Tell me. Impairment loss. What is the carrying amount of the asset? 45 cost minus 15. What is the carrying amount? 30,000 is the carrying amount of the asset, sir. What is the recoverable value? 28. So carrying amount is excess of recoverable value by how much? 2,000. That 2,000 is impairment loss. Guys, are you understanding? Because the original cost 45, sir. Accumulated depreciation 15, sir. 45 minus 15, 30,000 is the carrying amount. Recoverable value 28. So Carrying amount in excess of recoverable value is how much? 2000. That is impairment loss. Now the after impairment loss, what is the revised carrying amount? 28,000, which is nothing but recoverable value. This impairment loss I will deduct it from the carrying amount of the asset. So now the carrying amount, the revised carrying amount is equal to the recoverable amount of the asset. What is the carrying amount of the machine after impairment? 28,000. That's it. Let me solve one examination question, sir. I will show you. Previous exam question. How easy it is once you know this concept. Yeah, December 2024 attempt, sir. 7 marks. There is a question from impairment loss. December 2024 attempt. See this question. Important question this is. A major depreciable asset of Padma Limited was purchased at a cost of 45,000 million on 1st July 2021. So this company purchased one depreciable asset, sir. When they purchased it, sir? 1st July 2021. What is the cost? 45,000 million. Okay. The asset has a useful life till 31st March 2029. So asset useful life is 31st March 2029. When we purchased? 1st July 2021. So the useful life is till 31st March 2029. The estimated residual value is 650 million. The selling price of the asset on 31st March 2024 is expected to bet 25,000 million and the cost of disposal on this date is expected to be 500 million. So on 31st March 2024, sir, if I sell this asset, I am going to get 25,000. Cost of disposal is 500 million. So what is this? Fair value less cost of sales. The expected cash flows from the asset given. The expected cash flows. These expected cash flows will be useful to determine the value in use. Correct? The company expected discount rate of 9%. This discount rate is used to determine the value in use, present value of the future cash flows. The company provides depreciation on which basis? Straight line. You are required to determine the following as on 31st March 2024. First, carrying amount of the asset. See, whenever you are solving impairment sum, dates are very, very important. Okay, dates important. When asset purchased, at what year ending I am calculating, all these things very, very important. First of all, tell me, in this case, they are asking all these figures to calculate at the end of which year? 31st March 2024. So I am checking on 31st March 2024. So on 31st March 2024, what is my carrying amount of the asset I need to determine? Now you tell me first how to determine the carrying amount. Cost minus accumulated depreciation. What is the cost of the asset? 45,000 million. When this cost? 1st July 2021. From that I need to reduce accumulated depreciation. That means 21, 22, 22, 23, 23, 24. And in 21, 22, I need to take depreciation from 1st July. From 1st July onwards, I have to take the depreciation. Correct? So therefore, if I calculate this, see this. My cost is on 1/7/2021, 45,000 million. From that, I need to reduce the depreciation. Right? How to calculate depreciation? Cost of the asset minus residual value. Residual value. You will get the depreciable amount divided by life. Then you will get the depreciation per annum. So here 45,000 is what, sir? Cost. Any residual value of the asset? Yes. Estimated residual value given. How much? 650. Deduct it. This is depreciable amount. Divided by how many years is the life? Actually, if you see, 21, 22 we purchased. Exactly we purchased on 1st July. That means this year we need to consider only 9 months. 9 months only we need to consider. Remaining years, full years. It is useful up to 31st March 2029. Therefore, 7.75 years is the total life of the asset. From 1st July 2021 to 31st March 2029. That's why reading of the question is very, very important. So if you see, the question clearly said that this asset is purchased on 1st July 2021. See, in examination, they are going to test these small things. They know the student psychology. So 1st July 2021 is the date of purchase. It is useful up to 31st March 2029. So therefore, you should not consider total 8 years. No. First year only 9 months you need to take. Remaining full years. Therefore, 7.75 years is the total life of the asset. Correct? This is 9 by 12. If you take, you will get it percentage 7.75%. So 7.75 into 2.75. What is this 2.75? Life up to 31st March 2024. 2.75 years. Depreciation you reduce it. So you will get the carrying amount of the asset. So first bit, okay. What is the second bit they are asking, sir? Value in use of the asset. How to determine the value in use? Present value of the future cash flows. So these are the future cash flows. 7,500, 7,000, 6,500, 6,000, 5,000. Convert them into present value by using discount rate of. Here one important thing is, when you are considering the cash flows, you should consider disposal proceeds also. At the end of the life, if you sell the asset, how much you are going to get it, that will also be considered. That means the residual value. What is the residual value? 650. So therefore, at the end of the year, this 650 will be added. This will also be considered. This is where most of the students are doing mistakes. When they consider the cash flows, they don't consider this residual value. But you should consider the residual value of the asset also. I told you in theory also, when you are considering the cash flows of the asset, you should consider the cash flows from disposal proceeds of the asset at the end of the life. That will also be considered. So this 650 should also be considered. So convert them into present value by using discount rate of 9%. See, they have given the discount rate present values also. Use these present values. Most of the times in examination, they will give you. So don't calculate on your own when they have given the discount factors. Use these rates, convert them into present value. So if I convert them into present value, see this. 7,500, 7,000. Last year you see how much I have taken? 5,650. What is the 650? Disposal proceeds, residual value. Convert. You will get 25,710. So this is what? Present value of the future cash flows. Nothing but value in use. So second bit also done. Tell me what is impairment loss here. Come on, tell me. What is impairment loss? Impairment loss means I need to consider carrying amount, I need to consider recoverable value. Carrying amount already I determined, first bit. How much? 29,263. Now I need to determine the recoverable amount. How to determine the recoverable amount? Higher of the following. What are those? Fair value less cost of sales. What is fair value less cost of sales? See, look at the question. If I sell this asset, how much I am going to get it? 25,000 minus cost of sales 500. So 24,500 is the fair value less cost of disposals. Value in use, just now I calculated. How much? 25,710. Whichever is higher means 25,710. So my carrying amount is 29,263. My recoverable amount is 25,710. So carrying amount is excess of recoverable value. So therefore impairment loss. How much is the impairment loss? 3,553 million. See this. Recoverable amount A, fair value less cost of sales, B, value in use, whichever is higher. See, once you know the formulas very well, I think this is one of the easiest accounting standard. Now, what is the last bit they are asking, sir? What is the revised carrying amount after impairment? Tell me. Revised carrying amount, nothing but the recoverable value. Nothing but recoverable value. What is the recoverable value here? 25,710. So therefore the carrying amount 29,263 minus impairment loss. So this is the revised carrying amount 25,710. Okay. One more important thing, sir. See here, one question, examination question. December 2023, there is a 7 marks question is there from December 2023. See, what happened in this question, you see here. Yeah, see this question, sir. There is a company Coel Limited which acquired a mission, sir. When this mission is acquired? 1st April 2017 for 14 crores. That had an estimated useful life of 7 years life is there. The mission is depreciated on straight line basis and does not carry any residual value. Residual value is 0. So dates important. 1st April 2017 is the date of purchase. Next on 1st April 2021, 1st April 2021, that means 17, 18, 18, 19, 19, 20, 20, 21. So this is the current year, 1st April 2021. So almost 4 years already done. On 1st April 2021, the carrying value of the mission is reassessed at how much? 10.2 crores. And the surplus arising out of the revaluation being created to revaluation reserve. Now you tell me, 14 crores is the cost of the asset, sir. Life is 7 years, sir. Can you tell me the depreciation per annum? 14 divided by 7, that means 2 crores is depreciation per annum. How many years completed? 4 years. 4 into 2? 8. So 14 minus 8? 6 is the carrying amount. But they revalued it to 10.2. So that means what is the revaluation surplus? 4.2 crores. 4.2, 10.2 minus 6. So 4.2 crores is the revaluation surplus. That means this asset is already done revaluation. 4.2 crores is charged to revaluation surplus. Now next what happened, you see. For the year ending 31st March 2023. Now at the end of 2023, conditions indicating impairment of the mission existed and the amount recoverable ascertained to only 1.58 crores. Now at the end of 31st March 2023, impairment loss, there are conditions of impairment, so we calculated the recoverable value. What is the recoverable value of the asset? 1.58 crores. So you check it. This is a very good question actually. So see this question actually, you know, First April 2017 we purchased a asset, sir. What is the asset? Cost 14. So depreciation if I reduce for 17, 18, 18, 19, 19, 20, 20, 21. 4 years already done. Each year 2 crores depreciation. Total 8. So it will be 6 on 31st March 2021. Right? Now exactly on 31st March 2021 what they have done? Revaluation they have done. So this is the carrying amount of the asset. What is the revalued amount? 10.2. So what is the revaluation surplus? 4.2 is the revaluation surplus. This revaluation surplus we transfer to OCI according to Ind AS 16. Other comprehensive income revaluation surplus will show. So this 4.2 is there. Next what happened? Next year if I provide depreciation 21-22, I will provide depreciation on revised carrying amount. What is the revised carrying amount? 10.2. There is no residual value. Divided by what is the remaining useful life? Out of 7 years already 4 done. Remaining 3. So 10.2 divided by 3. How much? 3.4. Correct? So what will be the carrying amount? 6.8. When? 31st March 2022. Right? Next for the year ending 31st March 2023 they are saying. So next year also if I provide depreciation, how much is the depreciation? Same. 3.4. So what is the balance? 3.4 is what, sir? Carrying amount as on 31st March 2023. Carrying amount. What is the recoverable value? 1.58 they calculated. So carrying amount 3.4, recoverable amount they have given directly. How much? 1.58. So impairment loss is there or not? There. Because carrying amount is in excess of recoverable value. How much? 1.82 is the impairment loss. Now important thing, this 1.82 impairment loss, tell me what you are going to do. How much you charge to P&L, how much you charge to revaluation surplus. Because I already told you, if there is a revaluation surplus in respect of that asset, if you are booking impairment loss, at the time of booking of impairment loss, if there is any balance revaluation surplus is there, first you need to adjust against it. Now here what is the revaluation surplus? 4.2. But 4.2 balance is not available now. This is on 31st March 2021, already 2 years done. So therefore from this 4.2 I need to reduce the balance which I charged. Ind AS 16, if you see the standard says, you tell me now, what is the revaluation surplus? 4.2. This 4.2, if I depreciate over the remaining life is 3 years. So 4.2 divided by 3 means 1.4. 1.4 for the year 21-22, 22-23, 1.4. How much? 2.8 already over. Already charged in the form of depreciation. What is the balance left? 1.4. Therefore, from this 1.8 to 1.4 will be adjusted to revaluation surplus. Balance will be transferred to P&L account. What is the balance? 0.4. So you see here, impairment loss 1.82. How much is the impairment loss adjusted against revaluation reserve? 1.4. What is the balance will be transferred to P&L? 0.4. See, look at this. 7 marks they asked this. But if you see the suggested answer, they have given direct answers. They have not given elaborate answers. That's why classes are very, very important. I have solved elaborate. You understood the concept now? So what is the most important thing? If you are booking impairment loss in respect of an asset which is already done revaluation. Now, out of this impairment loss, how much you will adjust to revaluation surplus? Whatever the balance left at the date of impairment loss booking. Here in this question, don't say your impairment loss is 4.2. No, this 4.2 already 2 years depreciated. So balance only 1.4. That will be adjusted. Remaining will be transferred to P&L. That's the important thing. So that is a treatment you need to do, sir. Okay. So this is the basic impairment of assets concept, sir. Now next, let us discuss CGU concept. Now let us understand CGU. What I told about CGU, tell me. For an asset, if it is not possible to test the impairment at individual level, then we need to try to test the impairment at CGU level. I told the, tell me when for an asset it is not possible to test the impairment at individual asset level. When value in use is unable to determine. What is value in use? Present value of the future cash flows. When you are unable to determine the future cash flows of an asset, obviously you are unable to determine value in use. The standard says when you are unable to determine the value in use, you cannot determine the recoverable value. When you cannot decide the recoverable value of an asset at individual level, how can you test the impairment? Because the basic impairment is what? Compare recoverable value with carrying amount. If the carrying amount is in excess of recoverable value, we are saying impairment loss. Here I am struggling to determine recoverable value itself. Therefore, individually it is not possible for an asset to test the impairment. Then how I can determine the impairment loss? Maybe at CGU level. That's why they brought this concept of cash generating unit. Sir, first of all, what is this cash generating unit? Simple. Smallest possible group of assets that are generating cash flows together is called CGU. So CGU is nothing but smallest identifiable group of assets that generate cash flows together as a group. Okay. Let me give you one simple example, sir. I will. Yeah. Sir, see this, sir. For example, you take me. Suppose I have SB online classes. Imagine, assume I have online classes. Now tell me right now I am taking class. In front of me, what are the assets? I am using laptop, I am using iPad, I am using camera, mic. Okay, all these I am using now. All of them together generating cash flows to me. Individually, this laptop is generating cash flow now. No. iPad, no. Camera, no. So therefore, I cannot determine the recoverable value of each of these individual assets. Camera, cash inflows, how much? Laptop, how much? Not possible. So my SB online classes. In this online classes, I am having all this MacBook, camera, iPad, lighting equipment, all these things. So all of them together is generating cash flows for me. That's why it is called one CGU. For example, I have another CGU, that is content creation. For example, I am creating a content. For content creation, I am using different equipments. All of them together, I am generating the cash flows. Individually, they are not generating. Individually, I am unable to determine the cash flows of an asset. Then I need to identify this asset belongs to which smallest group of possible assets. You can take DMart, Reliance Smart examples also. For example, you take one, for example, Reliance Smart Point. That supermarket, they are having so many assets there. All those assets like ACs, refrigerators, cash counters, furniture, all these things, they are individually, they are unable to determine the cash flows. But they can say entire showroom how much cash flows they can generate. So therefore, individually it may not be possible sometimes. Then you need to identify the group to which this asset belongs and try to test the impairment at group level. That concept is called CGU, cash generating unit. Now I will tell you, see, for example, you take my online classes. This is one CGU for me. Okay. See here, MacBook, camera, iPad, lighting equipment. These are the assets I have. All of them I am using to give you classes. I can say the carrying amount of these assets individually. Because in my books, MacBook, how much carrying amount, camera, iPad, lighting equipment, so total. But recoverable amount, can I say individually? That's why when I am unable to determine the recoverable amount individually, that's why I am testing it at a group level, CGU level. I can say the recoverable amount of entire group 480. Because I can say what are the cash inflows I am getting from my SB online classes. Each individually I cannot determine, but I can say overall. Suppose overall assume 480. Now you tell me what is my carrying amount? 600. Group of assets. What is my recoverable amount? 480. So impairment loss is there or not there? There. How much? 120. So this 120 is for one asset or group of assets? Group of assets. The standard says this 120 now you allocate to all the assets based on their carrying amount. For example, this 120 is there. Allocate it, MacBook. Suppose 120 into 180 divided by 600. Based on the carrying amount of these assets, you allocate it. Therefore, from this 120, 36, 54, 12, 18 impairment loss has been distributed. After impairment loss, what is the revised carrying amount? 144, 216, 48, 72. Now you see, individually shall I able to determine the carrying amount, recoverable value of the MacBook? Can I able to test it? No. But group I can able to test it. And therefore I recognize the impairment loss also. You understand the CGU concept? So individual, if it is not possible, try to test the impairment at group level. When you are unable to determine the impairment loss at individual level, when you are unable to determine the recoverable value of the asset individually. When you are unable to determine the recoverable value, when you are unable to determine the value in use. When you are unable to determine the value in use, when you are unable to find the cash flows of the asset. Link, look at that. Now, in CGU, the most important concepts are two. One is goodwill, another one is corporate assets. Listen to me very carefully, there is a possibility of a question. Goodwill. Sir, tell me, definitely every organization will have a goodwill. Is goodwill individually can able to generate cash flows? Can I say these are the cash flows I am going to get from goodwill? Goodwill is an asset, no doubt. Can I able to tell the cash inflows, the cash flows of the goodwill? No. Because I know in my business there is a goodwill, but goodwill alone cannot generate cash flows. Therefore, I cannot test the impairment of goodwill individually. Therefore, I need to test the impairment of goodwill at CGU. So there are two cases here in case of goodwill. What are the two cases? First case is goodwill is there, it is giving benefits to multiple CGUs and I can able to allocate the goodwill also. For example, in my example, how many CGUs I have? 2. SB online classes, SB content creation. Now, I know my business has goodwill and I know out of this goodwill how much I can allocate for CGU1, how much I can allocate for CGU2. See this, goodwill benefits more than one CGU and allocation basis given. They will give you allocation basis also. Like for example, you see here, my SB online classes is there. So my goodwill is there 1 lakh. Allocation basis 30%, 70%. That means out of this goodwill 30% is given to CGU1, 70% is given to CGU2. So you see here, laptop, camera, iPad, these are my assets in CGU1. Now goodwill is also added. Because in my organization goodwill is there. Goodwill cannot be tested for impairment individually. Therefore, I need to test the goodwill impairment at CGU level. Therefore, goodwill also I have considered. Sir, goodwill you have considered. How much value you will take? 30%. 1 lakh into 30%, 0.3 lakhs. So carrying amount they will give you laptop, camera, iPad, goodwill they are given. Recoverable value 14.3. Assume. Important, please listen. So tell me what is the carrying amount of all the assets? 16.3. What is the recoverable value? 14.3. Impairment loss is there or not? There. How much? 2 lakhs. 2. Now the standard says whenever there is an impairment loss at CGU level, if there is a goodwill, first they adjust it to goodwill. Balance will be adjusted to other assets. That means from this 2 lakhs, what is the goodwill amount? 0.3. First adjust to 0.3. Balance how much is there? 1.7. That 1.7 you allocate to other assets based on their carrying amount. Important. What is the logic, sir, here? Why first adjust to goodwill? Sir, you are telling goodwill. Goodwill means always a profitable position. Here you are getting loss means what is the use of goodwill? That's why first you adjust it to goodwill in the organization. Balance loss only will be allocated to other assets. You understand? So they will ask a question. They will give you one CGU. They will give you assets, including goodwill they will give you. And they will give you the carrying amounts. They will give you recoverable value. You find the impairment loss. First that impairment loss will be adjusted to goodwill. Suppose for example, goodwill, let us imagine 2 lakhs is there. Then entire will be adjusted here. There is no impairment loss to be adjusted to other assets. Correct? Now come to CGU2. SB content creation. How much goodwill will be allocated to CGU2? 70%, because 30-70 na. Hello. So 0.7 lakhs I allocated to CGU2 goodwill. MacBook, mic, projector, these are the assets in CGU2. What is the carrying amount? 15.7. What is the recoverable value? Impairment loss is there or not? No impairment loss, because carrying amount is below the recoverable value. There is no impairment loss. Ignore it. I told you na. So you need to calculate the recoverable value, compare with carrying amount. As long as carrying amount is equal or below the recoverable value, no problem. This is case number 1, sir. What is this case, sir? Goodwill can be allocable. Suppose goodwill cannot be allocable. Important case this is. Sir, suppose goodwill cannot be allocated, sir. In the last example, how goodwill is allocated? 30-70. 30:70. But suppose sometimes I can't say how much goodwill belongs to each CGU. CGU1 how much goodwill, CGU2 how much goodwill. I cannot enable to determine. Then the standard says impairment will be tested in 2 stages. Guys, learn this very simple trick I will tell you. Impairment will be tested in 2 stages. First stage, without goodwill, test the impairment. For example, you take individual CGUs without goodwill. For example, CGU 1 you take it. Laptop, camera, tablet. Goodwill I have taken, not taken. Even though there is a goodwill, but I have not taken. Why? Because first I am testing the impairment without goodwill. So these are the carrying amounts they will give you. How much carrying amount is there? 24. Recoverable value they will give you. How much? 21. What is the impairment loss? 3. These 3 will be allocated to assets based on their carrying amount. Now this is the revised carrying amount of the assets. This is one thing. Come to CGU2. Same, CGU2 without goodwill test the impairment. Carrying amounts they will give you 9, 5, 4, 18. Suppose recoverable value 19. Impairment loss is there or not? No. So therefore as it is, carrying amounts will be the revised carrying amount after impairment loss. This is stage 1, sir. You understand stage 1? When this approach will be followed? When goodwill cannot be allocated to the CGUs. What we need to do first stage? Without goodwill test the impairment of CGUs. Then stage 2, what you are going to do is test the impairment for CGU levels. That means CGU 1, take CGU 2, including goodwill, take it. Here I am not taking individual assets. CGU 1, CGU 2, goodwill I am taking now, including goodwill. Now you tell me CGU 1, what is the carrying amount after stage 1? 21, revised carrying amount you take it. CGU 2, same, 18, nothing changed, 18. Goodwill 4, suppose they given goodwill is 4, they have given. How much is there? 43. Guys, you understood stage 2? In stage 2 what we are doing? CGUs including goodwill I am taking the after stage 1 balances, recoverable carrying amounts. Recoverable value given how much? 40. Suppose recoverable value 40, carrying amount 43. So impairment loss 3. Tell me what we need to do. First adjust to goodwill. Adjusted to goodwill. How much balance is there? Any balance is there after adjustment to goodwill? Nothing. So therefore nothing will be adjusted. But here important thing. Suppose for example here 5 is there instead of 3. Suppose impairment loss 5 is there. Tell me what to do. First goodwill will be adjusted with 4. Remaining 1? No, wrong. Remaining impairment loss will not be allocated to the CGUs because those CGUs, whatever the assets are there in those CGUs, already impairment is done in stage 1. Therefore, no need to do any kind of impairment loss adjustment for these CGUs. You understand? Because the logic is very simple. Here already the CGUs balances 2118 already individually impairment done. Impairment done, impairment already adjusted impairment loss for these assets. So here whatever the final loss came, this loss will be adjusted entirely to goodwill. The balance will be ignored. You cannot allocate it to the CGUs available. Everybody, this is goodwill concept. So tell me overall what is the goodwill concept? CGU concept you understood? First of all, what is CGU? What is CGU? Group of assets generating cash flows together is CGU. Okay. Now how to test the impairment of CGU? Each individual asset carrying amount, total recoverable value. You will get the total impairment loss. This impairment loss will be allocated to all the assets based on the carrying amount. This is simple. Without goodwill, suppose goodwill is there. In goodwill, how many cases are there? 2. Goodwill is allocable, not allocable. Suppose goodwill is allocable means this goodwill will be allocated to CGUs and impairment loss whatever is you got first adjusted to goodwill. Balance will be adjusted to other assets based on their carrying amount. Suppose goodwill cannot be allocated, what you need to do? 2 stages impairment will be tested. Without goodwill, first test the impairment. Then stage 2, take the CGUs along with the goodwill, calculate the impairment loss, adjust it to the goodwill. Suppose similar to this one, there is one concept, sir, corporate assets. What is that? Corporate assets. Same concept like goodwill, sir. Corporate asset means, for example, head office building is there, for example, head office R&D facilities. You know, some assets are common for the entire organization, like goodwill. So corporate asset, for example, head office is providing services to all the branches, na? So therefore it is giving benefits to all the CGUs. You cannot restrict the head office services to one particular thing. So if there is any corporate assets in the organization, for example, you see here, corporate assets like head office building do not generate independent cash flows. Hence, they cannot be tested for impairment individually. Like these assets also, they cannot generate cash inflows individually. So we need to test the impairment at CGU level, like how we have done it for goodwill. Same here also, two cases will come, sir. Corporate assets also two cases will come. One is corporate assets are allocable, another one is not allocable, like how we done it for goodwill. If corporate assets is allocable, then allocate it. Like for example, in this case you take laptop, iPad, camera, corporate asset. Suppose 10 lakhs is their corporate assets, 30% to CGU1, 70% to CGU2. So 30% we allocate it. Total carrying amount 23, recoverable amount 20 they have given. So what is the impairment loss? 3. Correct? Suppose instead of corporate asset, if it is a goodwill, what we have done? This impairment loss first adjusted to goodwill balance. But in case of corporate asset, we cannot do like that. Whatever the impairment loss is there, that will be allocated to all the assets, including corporate assets based on their carrying amount. Important. Sir, whenever in CGU there is a goodwill, impairment loss come na, first we will adjust to the balance of goodwill. If there is a goodwill, balance loss only will be adjusted to other assets. But in case of corporate asset, you cannot do that. So this will be adjusted to all assets, including corporate assets, based on their carrying amount. Correct? Suppose if I am unable to allocate it, corporate assets cannot be allocated. So two-stage approach we followed na? Same here also, two-stage approach. First, excluding corporate assets, we test the impairment. Excluding corporate assets, see this. Without corporate assets, if I test, I got impairment loss of 2. That I allocated to the assets. This is the revised carrying amount. CGU2, for example, there is no impairment loss. So therefore, stage number 2, CGU1, what is the revised carrying amount? 18. This is same, 16. Now I taken the corporate asset. And I got impairment loss of how much? 3. Now, this 3 will be first adjusted to corporate asset. And that's it. So we have to close like that. So what's the difference between goodwill and corporate assets? In case of goodwill, if goodwill is allocable, impairment loss first adjusted to goodwill balance. Balance will be to other assets. If goodwill cannot be allocated, stage 1 without goodwill, calculate the impairment loss. Revised carrying amount. Stage 2, CGUs along with the goodwill you take it, impairment loss will be adjusted to goodwill. That's it. But in case of corporate assets, allocable, non-allocable. Corporate assets allocable, impairment loss will be adjusted to all the assets, including corporate assets, based on their carrying amount. Suppose corporate assets not allocable. Without corporate asset, first calculate the impairment loss for the CGUs. Then stage number 2, including corporate assets, you calculate the impairment loss, and that impairment loss, whatever you got, first adjusted to corporate assets. Because these assets are already subjected to, these CGUs are already subjected to impairment. Already done it. So that's why for corporate assets, now I am doing the impairment. So understand the logic here. Stage 1 already I tested impairment of the assets in the CGU. So now which asset is not subjected to impairment? Corporate assets. So therefore this impairment loss first I adjusted to corporate asset. That's why. You understood the logic? That's it. So this is the concept of CGUs. Whenever we have CGUs, this is how we need to do it. And see, relating to this, I will tell you one good question is there. Yeah. Sir, come to problem number 2, sir. In study material, problem number 2 is there. See this question. An entity has the following assets with relevant data on the reporting date. Important question, rupees in lakhs. What are the assets they have, sir? A, B, C, D, E. Carrying amount given, fair value less cost to sell given, value in use given. Everything is given except for E. Assets C and D were revalued before. Which assets are already done revaluation? C and D. Carrying amount of the revaluation surplus are 40 lakhs, 30 lakhs surplus, respectively. Now, important thing you see. Asset E falls in which? Asset E. This asset falls into CGU. Consisting of goodwill 50 lakhs, intangible assets 90 lakhs. That means this asset belongs to CGU. It is not tested for impairment individually. Because see, value in use not given. That's why. You understood the logic? Value in use not given. Why it is not given? Because cash flows we don't know. That's why we are unable to determine the value in use. When you are unable to determine the value in use, you cannot test the asset impairment individually. Therefore, you need to test the impairment at CGU level. That's why you understood the logic. See how depth is there in the subject. 90% of the student doesn't know why value. No, that's why he is not given. He's mad fellow. That's why he is not given. Like that they will think. They don't understand the subject. Okay. So this asset E belongs to CGU. In that CGU, what are the other assets? Goodwill, intangible assets. Now, fair value less cost to sell of the CGU is how much? 180. Value in use, 170. This CGU, fair value less cost to sell, how much given? 180. Value in use given? 170. Whichever is higher means 180 we will take it. So 180 is what? Recoverable value. Now, determine the impairment loss. I want impairment loss and revised carrying amount of all assets stated above. Show the accounting treatment. Now come on, tell me one by one. First, come to asset A. Asset A. Tell me. Carrying amount how much given? 280. I want recoverable value. Correct? How to get recoverable value? Fair value less cost to sell. Value in use. Whichever is higher means 300. Recoverable value 300. Carrying amount 280. Impairment loss is there or not? Not there. So there is no impairment loss here for the first case. Hello? So therefore what will be the revised carrying amount? Same 280. Come to B. What is the recoverable value? 400, 390. Whichever is higher means 400. Carrying amount? So impairment loss is there or not? Yes. Carrying amount is more than the recoverable value. How much? 60. So impairment loss is 60. So what is the revised carrying amount? 460 minus 60. 400. Come to C. What is the carrying amount? 220. What is the recoverable value? 270. So 270 recoverable value, carrying amount 220. No impairment. Because carrying amount is within the recoverable value only. So no impairment. So revised carrying amount is 220. Guys, are you understanding? Now come to D. 150, 170, whichever is higher means 170. Carrying amount 180. So how much excess? 10. So impairment loss 10. So what is the revised carrying amount? 170. 180 minus this one. Now this is the most important part. Come to this part. CGU. How to test the impairment for CGU. Now you tell me, what are the assets we had in that CGU? Goodwill, how much? Carrying amounts. Goodwill carrying amount given, na? Hello? How much is the carrying amount, sir? 50 lakhs. 50. What are the other assets? ITA, intangible asset is there. How much? 90. One more asset is there. What is that? This asset. Asset E. How much? 100. 100. What is the total carrying amount? 240. What is the recoverable value? Recoverable value they given. For the CGU, the recoverable value, how to get it? fair value less cost of disposal, value in use, whichever is higher. So 180, 170, whichever is higher means 180. Tell me what is the impairment loss? 60. Hello. What I told you, tell me. Here goodwill allocable or not allocable? Allocable. Given. 60, what we need to do? First adjust it to goodwill. Adjust it. What is the balance? 10. Out of the 60, 50 adjusted, sir. 10 is there, na, sir. This 10 will be allocated to remaining assets based on their carrying amount. Here goodwill is allocable, sir. So therefore tell me 10 into 90 divided by 190. How much? 4.7. 10 into 100 divided by 190. 5.3. That's it. So 4.7, 5.3. So you see here. Here 4.47, actually it was 4.7. So I think intangible asset, intangible asset 4.7. E 5.3. See, E 5.3. 5.26 means 5.3. So impairment loss of asset E 5.26. Impairment loss of intangible asset 4.74. Impairment loss of goodwill total 50. So therefore, what is the revised carrying amount, sir? 90 minus 4.7, 85.3. 100 minus 5.3, 7. This is nil. That's it. You look at this question, you understand this, how we are going to solve it? Important. So CGU consists of goodwill, intangible asset, asset. Carrying amount 240, total recoverable amount 180. So there is an impairment loss of 60. That impairment loss first will be adjusted to goodwill 50. Remaining will be allocated to other assets based on their carrying amounts. Hello? See, you see here, question number 3. I think workbook, sir. This question is taken from CMA workbook. You know, this question you see, A Limited, there is a company which acquired a business consisting of 2 CGUs. There are 2 CGUs, sir. X, Y, along with goodwill. So there are 2 CGUs along with the goodwill. However, it is not feasible to allocate the goodwill to the individual CGUs. Is it possible to allocate the goodwill? No, goodwill is not allocable. After 2 years, the carrying amounts and the recoverable amount of the net assets within the CGUs and the purchased goodwill given. After 2 years, CGU X carrying amount recoverable value, CGU Y carrying amount recoverable value given, goodwill given, total. Find from the data above, calculate the impairment loss to be booked against each CGU, goodwill and total impairment for the business. Now tell me, if goodwill cannot be allocable, what we need to do? 2 stages. First stage, we need to test the impairment without goodwill. Second stage, we will test the impairment for the CGUs along with the goodwill. But here in this case, you see, in CGU X, what is the total carrying amount they given? 540. Recoverable amount? 700. So carrying amount is below the, so therefore there is no impairment for CGU X. Come to CGU Y. What is the recoverable value? What is the carrying amount? How much excess? 60. There is impairment loss, 60. This 60 will be adjusted to goodwill. So here you see here, so when corporate assets or goodwill cannot be allocated to individual CGUs, the impairment test must be conducted at group level, comprising the CGUs in 2-step process. First, carrying amount of each CGU is compared with the recoverable value. It is determined that CGU Y is impaired, resulting in a loss of 60. CGU Y only impairment loss is there, 60, which reduces the carrying amount to 3 lakhs. Next, the carrying amount of the business as a whole, including goodwill, is compared with its recoverable amount. Total carrying amount of the business is 10 lakh 90. since the recoverable amount of the business is 10 lakhs, the additional impairment loss of 90,000 is recognized against goodwill. So here one important thing, sir, individually if I check it, so two-step process I told now. For example, first individual level if I check it, there is an impairment loss for CGUY. Next to group level, including this one. Sir, stage 1, sir, first CGU X, CGU Y. CGU X, no impairment loss. But CGU Y, if you check it, 360, 300, correct? So there is an impairment loss of 60. So what is the revised carrying amount? 300. Now including goodwill, if I test this is individually. Now CGU X, CGU Y, goodwill. If you see the carrying amounts, CGU X remains same na? How much? 540. CGU Y 300. Goodwill same. How much? 250. Total 1090. What is the recoverable value? Total 1000. So how much impairment loss came? 90. I told you first will be adjusted to goodwill. Adjusted. So what is the goodwill balance? 250 minus 90 means 160. This they remain same, correct? That's it. Two-step process. So this is example, sir. If you want, you can write here. This is the third case. I mean, what is that? Goodwill unallocable. Goodwill unallocable concept. You understand goodwill allocable, unallocable? Yeah. Now one important concept, sir. Reversal of impairment loss. Important, sir. Last concept of this standard. Reversal of impairment loss. Very good concept. Please concentrate here. Sir, what is this reversal of impairment loss? See, you are booking impairment loss. When you are booking impairment loss? When the carrying amount is in excess of recoverable value. And why you calculating recoverable value? If there are any indicators of impairment. I told you, there are two types of indicators. One is internal, another one is external. Internal indicators, external indicators will be there. Those indicators also given in the standard. So, not that, I mean, generally, what will be the indicators that an asset may be subject to impairment? Significant decline in asset value, adverse changes in the technology market, increase in market interest rate, like this. Internal sources, maybe asset physically damaged, asset becoming idle, restructuring, discontinuing plan, early disposal plan, like that. Some reasons are there. Internal, external reasons is there. Suppose, sir, at the end of the year, in respect of each asset, you checked and there are indicators of impairment. Okay. So you calculated the recoverable value, you compared with carrying amount, so there is an impairment loss, you booked it. If the carrying amount is in excess of recoverable value. Suppose in future, these indicators may improve. Na? So there is a chance that your recoverable value may increase. Therefore, this impairment loss will be reversed. For example, you see here, my carrying amount 10. Recoverable value is only 8. So how much is the impairment loss? 2. Suppose in future, this 8 has become 10. Imagine, this recoverable value has become 10. Therefore, this impairment loss no more required. Na? So we need to reverse the impairment loss already booked when the conditions improve. Previously, when you tested for impairment, there are indicators of impairment. So you calculated the recoverable value and the carrying amount is in excess of recoverable value. So you booked impairment loss. But in future, any of these indicators may not be there. So the recoverable value of the asset increased. So therefore, whatever the impairment loss you booked, that has to be reversed. But the question is, how much I need to reverse, sir? That's the important, beautiful point is there. They can test a question. Now, I will tell you, I will explain you with this one small example. You take it, you see this. Suppose there is an asset, sir. On 1/4/2022, there is an asset. How much is the value of the asset? 200 lakhs. Life 10 years, sir. See this example carefully. There is one question, I am going to solve it. On 1/4/2022, 200 lakhs is there. Life 10 years, sir. So I am providing depreciation for the year 22, 23, 23, 24. What will be the depreciation amount? Tell me. 200 divided by 10. Suppose residual value is not there. So 200 divided by 10 means every year 20. So for 2 years 40. So after 2 years, what is the carrying amount? 160. So now there are indicators of impairment. So I calculated the recoverable value. How much is the recoverable value? 120. What is the carrying amount? So what is the impairment loss? 40. That impairment loss I booked. So what is the revised carrying amount? 120. Because from this 160 I reduced this 40. So now it will become 120. Now onwards I need to provide depreciation on this revised carrying amount for the remaining life. Out of 10 years, how many years already over? 2. How much balance? So 120 divided by 8. 15. So next year 15 I provided 105. 24, 25. 25, 26 also same 15. Now what is the carrying amount at the end of 31st March 2026? 90. Now what happened? Situations improved. Indicators of impairment not there. So I calculated again the recoverable value. The recoverable value is 140 now. Previously how much is the recoverable value 2 years back? 120. Hello. On 31st March 2024 when I checked the impairment, I got a recoverable value of 120. Now after 2 years, I calculated the recoverable value. It is now, that means recoverable value improved. Increased and recoverable value increased. 140. So recoverable value now become how much, sir? That means there are no indicators of impairment. So previously whatever the impairment loss I booked, what is the impairment loss previously recognized? Maybe I need to reverse it. Can I reverse entire 40? How much is the impairment loss I booked? 40. Now recoverable value, what is my carrying amount? What is the recoverable value? How much I can increase? I mean, how much is the gap? 50. So can I reverse entire 40? The standard says whenever there is a reversal of impairment loss, what is the actual reversal happened? That means how much is the recoverable value in excess of carrying amount? How much actual reversal? 50. Maximum reversal, whichever is lower you need to take. What is this maximum reversal? Suppose if there is no impairment, 2 years back there is an impairment loss. If it is not there, what is the carrying amount of this asset now? For example, see this. Suppose if there is no impairment, 4 years now, till now done. Same 2020, 2020 na depreciation. Sir, suppose if there is no impairment at the end of this year, depreciation will be normally 2020, 2020. So therefore 80 is the total depreciation. So carrying amount is 120. But what is the carrying amount now? 90 because of impairment. So if there is no impairment, 120. So therefore the carrying amount existed 90. If there is no impairment, 120. So how much? 30. This 30 or actual reversal, whichever is lower. That means how much? 30. Only 30 I need to reverse it. Without impairment, what will be the actual, what will be the carrying amount of that asset? Now, how much? 120. But what is the actual, now carrying amount in the books? 90. So how much? 30. If there is no impairment, 30 I can increase it. And actually 50, whichever is lower. So 30 I need to reverse it. When you do reversal, what happens? Tell me. When there is a impairment loss, asset value decreases na. When there is a reversal, increase. So 30 I need to increase. So 90 plus 30 it will be 120. That is the carrying amount, revised carrying. So you understand what is the maximum amount we can reverse? Tell me the concept. What is the maximum amount I can reverse? Actual reversal or maximum reversal, whichever is lower. What is maximum reversal? Suppose if there is no impairment, what will be the carrying amount of the asset? What is the book carrying amount? What is the existing carrying amount? If there is no impairment, what is the carrying amount? Compare. Maximum that much I can. See, this is reversal of impairment loss of individual assets. See, when it comes to reversal of impairment loss of CGU, you cannot reverse the goodwill. See, in CGU, suppose if there is an impairment loss, we adjust it to goodwill na. Once goodwill is impaired, later it cannot be reversed. That point you remember. Okay, reversal of goodwill cannot be done. Other assets in the CGU can be reversed, but goodwill cannot be. Okay. Same concept, sir. For CGU also same. The formula you should not forget. The actual reversal, the maximum reversal, whichever is lower, I have to do it. So that's it. This is Ind AS 36 concept, sir. So this is the major concept, sir. From this you can expect one practical question, sir. Don't expect a theory question, because it's a practical standard. They will ask a question, practical question. We have still solved the questions now. Either they will ask you basic questions like determine the carrying amount, impairment loss, revised carrying amount, basic calculations, or they will ask you that impairment loss treatment. Like if the asset is already subject to revaluation, if there is a revaluation surplus, this impairment loss first will be adjusted to the balance of revaluation surplus, then will be transferred to P&L account. We solved one question now, that one. Or CGU. CGU maximum they are not testing, but maybe they can test this time. But CGU is very easy, you know, we have done it. Okay, this is Ind AS 36 impairment of assets. Okay, next Ind AS we are going to cover is Ind AS 12, sir, income taxes. This is also one of the very important Ind AS, sir. Actually, if you look at the previous exam papers, most repeatedly this standard is also going to be tested. Impairment of assets, which we already completed that standard, and Ind AS 12 also one of the important standard and repeatedly testing in the examination. So Ind AS 12 talks about income taxes. See, one disclaimer is you should have the basic knowledge of income tax provisions, Income Tax Act provisions before studying Ind AS 12, especially PGBP provisions, profits and gains of business or profession head is there na. In that some sections deductions is there na. You should have little bit of knowledge of income tax also, then you will understand the standard better. Okay, now Ind AS 12 you follow what I am covering here. I am going to explain one of the easiest way to understand this standard, and this standard, most important thing, cover only the required part. What is necessary you cover it, that is more than sufficient from Ind AS 12. Actually Ind AS 12 is linking up with consolidation, business combination, so many other areas are also there, share based payments, but the basic, the core part of Ind AS 12 they are going to test it, so that I am going to cover it. Okay, listen to me carefully. First of all, sir, this standard says tax expense is equal to current tax plus or minus deferred tax. You know, when you are preparing P&L account of a company, when you are preparing P&L account of a company as per schedule 3, what is schedule 3, sir? Generally for companies, how we are going to prepare the P&L balance sheet, there is a format. In that P&L account, if you see, in P&L account we have incomes, expenses, incomes minus expenses, you will get profit before taxes. From that I need to reduce tax expenses. So this tax expenses word you can find in schedule 3 also. When you see the company P&L account, tax expenses head is there. In the tax expenses there are two types of tax expenses are there. One is current tax, another one is deferred tax. So if you want to understand this standard, you need to start with this tax expenses. What is tax expenses? Current tax plus or minus deferred tax. See here the major focus is what? Deferred tax. Because current tax is very easy. What is current tax? Every year at the end of the year, by following income tax provisions, we will compute the tax liability. So we will compute the taxable income, all 5 heads: salaries, house property, PCBP, income from other sources, deductions. Then you will get the taxable income. On that you apply tax rate, you will get tax liability. So according to Income Tax Act, by following the provisions of Income Tax Act, you will calculate the tax liability every year. That is called nothing but current tax. So what is current tax? Tax payable on profit calculated as per Income Tax Act. So there is a Income Tax Act, sir. That Income Tax Act is going to give us some provisions. By following those provisions, we will compute the tax liability. That is called current tax. Very simple. So there is a Income Tax Act, sir. According to Income Tax Act, by following the provisions of Income Tax Act, we will calculate the taxable income. On the taxable income, we will apply tax rate. Then you will get tax liability. That liability is called current tax. So you understand what is current tax? Very simple. What is current tax? Tax payable as per the Income Tax Act. By following the provisions of income tax, we will calculate it. And you know, this deferred tax can be deferred tax asset or can be deferred tax liability. When I said deferred tax, this deferred tax can be an asset, can be a liability. Generally, these deferred tax assets and liabilities will come in balance sheet. Any asset and liability will come in balance sheet. You know, balance sheet where they will come? Suppose if it is a deferred tax asset, it will come in non-current assets. If it is a deferred tax liability, it will come in non-current liability. If you see the balance sheet of a company, non-current assets, non-current liabilities, category is there, head is there. In that, if at all, if our company is having a deferred tax asset or deferred tax liability, we will show it. So that means I told you deferred tax coming in P&L account as well as in balance sheet. P&L account, tax expenses, deferred tax is there. This deferred tax can be in the form of asset, can be in the form of liability. It will come in balance sheet. So in the tax expenses definition, we understood current tax very simple. Major focus is on this deferred tax. Okay. Sir, what is this deferred tax, sir? Listen to me very carefully. Sir, deferred tax means either the tax liability, additional tax liability, or there is a tax saving. Your tax will be saved, or you will get additional tax liability. In future, not now, in future. Deferred means future, it indicating future. In future, there is a tax saving, or there is a additional tax liability. Why? Because of temporary differences. There is a temporary difference concept, temporary differences. Sir, temporary differences between? Temporary differences between the carrying amount of assets and liabilities, the tax base of assets and liabilities. So here two words, carrying amount, tax base. Asset to liability, very simple. You follow my approach. This is one of the most difficult standard they say, but I am going to give you a guarantee that if you listen to me next 30-40 minutes, this is one of the easiest standard. You know there is an asset, there is a liability. The carrying amount of this asset and liability, the tax base of this asset and liability. Between them, between the carrying amount and the tax base of the assets and liabilities, there is a difference. That difference is a temporary difference. Because of the temporary difference, in future you are going to get either some tax saving or some additional tax liability. That tax saving or additional tax liability you are going to get in future is called deferred tax. So what is deferred tax? temporary saving in tax or payment of additional tax. When I said savings in tax, it is a asset. When I said additional tax, it is a liability. Deferred tax asset, deferred tax liability. So temporary saving in tax, payment of additional tax due to which differences? Temporary differences. Differences can be two types, temporary, permanent. If the difference is permanent, ignore, no deferred tax. The difference should be temporary. Temporary differences between what, sir? Between the carrying amount, tax base of assets and liabilities. Sir, what is this carrying? Carrying amount means value of asset and liability as per books. Tax base of asset and liability means as per the Income Tax Act provisions, asset and liability balance. As per the income tax, by following the provisions of Income Tax Act, if I value the asset value, liability value, what is that? That is called tax base. What is the value of asset and liability as per books? That is called carrying amount. Suppose this building is there right now. If I calculate the value of this building as per Income Tax Act, this is called tax base of the asset. As per my books, what is the carrying amount of this building? This is called carrying amount as per books. So the difference between the carrying amount of assets and liabilities as per books and the assets and liabilities value as per income tax, that is called tax base. That difference, if that difference is a temporary difference, on that temporary difference you will get either savings or payment of additional tax, that is called deferred tax. One beautiful point is, there is one standard called Normal Accounting Standard 22. You might have covered in CMA Inter, or if you have done CA Inter, AS 22 one standard is there. Accounting for taxes on income, same. But AS 22 follows income approach. But Ind AS 12 is following balance sheet approach. And trust me, balance sheet approach is one of the easiest approach to calculate deferred tax. Thanks to Ind AS. So it is very easy to learn Ind AS 12. So tell me, we are following which approach? Balance sheet approach. Why we are calling this as a balance sheet approach? Because in assets and liabilities will be there in balance sheet, na? And we are comparing what? Carrying amount of assets and liabilities, tax base of the assets and liabilities. That means as per books, as per income tax. We are comparing assets and liabilities. And on this comparison, we are getting some differences. If the difference is temporary difference, we are calculating deferred tax. That's why this approach is called balance sheet approach. So tell me, Ind AS 12 following income approach or balance sheet approach? Balance sheet approach. So see this. Assets are there. As per books, what is the asset value? That is called carrying amount. Liabilities, as per books, what is the carrying amount? As per Income Tax Act provisions, what is the asset value? That is called tax base of the asset. As per income tax provisions, what is the liability value? That is called tax base. So understand the word tax base. Ind AS 12 uses the word tax base. So tax base means what is the value of the assets and liability as per the provisions of income tax. Carrying amount means as per books. Now tell me, I am asking you one question. Assets and liabilities balances as per income tax, as per books, will they be same or will they be different? Different. Why? Because of Income Tax Act provisions. Income Tax Act will not accept normal accounting rules. For example, when I am preparing books, I will follow accrual basis, double entry system, but Income Tax Act will not allow them. Best example, for example, depreciation you take. As per books, I will calculate depreciation straight line method, but as per income tax, WDV method, block of assets concept we will follow. Similarly, for example, interest on loan, we will recognize in P&L account on accrual basis. But Income Tax Act says only when you pay we will allow it, cash basis. So majority of the provisions you create, we will debit to P&L account. That means provision we will recognize in the books, normal books. But Income Tax Act, they don't allow it. Provision is not allowed. Only when the actual loss came, they will allow it. If you read the provisions of Income Tax Act, you will understand that majority of the cases Income Tax Act prohibits accrual basis. They only follow cash basis. Interest, only when you pay we will allow it. Just creating provision, we will not allow it. So therefore, obviously there is a difference between the assets and liabilities when I calculate it as per the normal accounting provisions, when I calculate as per the tax provisions. See, when I am preparing normal books, I don't follow income tax provisions. Income tax provisions I will follow only to calculate tax liability at the end of the year. How much I need to pay to the government, for that I need to calculate. I will follow Income Tax Act. But as per books, I will follow accounting standards. I will follow accounting standard Ind AS, normal, generally accepted accounting principles I will follow. So therefore, because of the Income Tax Act provisions, there are differences. But these differences are which differences? Temporary differences. That's why you need to anticipate and you need to recognize this temporary differences effect. That effect is in the form of deferred tax asset or liability. Beautiful concept. I will explain why they brought this deferred tax concept. I will explain. You understand first? I think the basic crux of the standard is comparing two things. What are those? Carrying amount of assets and liabilities, tax base of the assets and liabilities. And if there is a difference, that difference is a temporary difference. On that you calculate deferred tax. Deferred tax can be asset or liability. When there is an asset, savings in tax. When there is a liability, additional tax. When there is a liability. Okay. Yeah. Let me explain this concept with one simple example I have framed. So see this example, sir. There is a company, Trigun Limited. Okay. Now this company purchased one PPE asset. Cost of the asset is 50,000. Depreciation 20% per annum on SLM basis as per books. That means as per normal accounting. 20% is my depreciation on SLM. What is profit before depreciation and tax per annum for years 1 to 5? 1 lakh. Profit before depreciation and tax given, sir. PBDT. Profit before depreciation and tax. Before deducting depreciation and tax, my profit is, assume 1 lakh for the 5 years. Depreciation as per income tax 25% per annum. Sir, as per books depreciation 20. As per income tax 25. On which basis? SLM basis. For example, tax rate 30%, sir. Now you see here, let me explain the concept to you. Sir, suppose if I calculate tax liability as per books, if I calculate the tax liability, what will be my tax liability? What is my profit? 1 lakh. So first year 1 lakh. From this I need to reduce depreciation. As per books, depreciation rate 20%. So 1 lakh into 20%. Sorry, 50,000 into 20% because cost of the asset minus into 20%. How much? 10,000 is the depreciation. Accepted? What is my PBT? 90. Tax rate? So what is the tax liability? But is this the amount you are going to pay to the government? Will government accept this? No. Why? Because you have not followed income tax provisions. This is as per books you calculated. We don't allow. We don't accept this. Sir, I will pay 27,000. Income tax department says no. We are not going to allow this 27,000 because you need to calculate your tax liability based on the provisions of Income Tax Act. Here you have not followed it. So therefore, if I calculate the tax liability as per Income Tax Act, what will be the situation? Profit same 1 lakh PBDT. From that I need to reduce depreciation. As per Income Tax Act, what is the depreciation rate? 25%. As per books it is 20. But as per income tax 25. I need to follow 25 here. 12,500 depreciation. So what is my profit? 87,500. On the tax liability 26,250. So look at the difference, guys. Here depreciation allowed 10,000. Here depreciation allowed 500. But overall if you see all the 5 years, what is the total depreciation here? 50. Here also 50. So the difference is only in the years, temporary difference. You see, here 10,000 allowed as per books, but as per income tax 12,500, 2,500 extra allowed. Second year also 2,500, third year 2,500, fourth year 2,500. But fifth year you see, Fifth year as per books 10,000 depreciation is there, but as per income tax nothing is there. Na? That means entire 4 years 10,000 has been reversed in the fifth year. Overall the depreciation allowed is same, but the difference is only in the years. This is called temporary difference. Now, so if you see here, if I calculate the tax liability, what is the total tax liability? 1,35,000. Here also. That means if I follow normal books or if I follow income tax, overall it will be same only. But the difference is coming only in the years. Temporary difference. Here 27,000, here 26,250. So therefore you see, if I prepare P&L account of a company, see this. If I prepare first year, what is my PBT? PBT means I need to take this 1 lakh minus depreciation as per books, so 90,000. I told you from this I need to reduce tax expenses. Tax expenses are two categories. What are those? Current tax, deferred tax. First current tax, how much? Tell me. Current tax means what I told you. Tax calculated as per the provisions of income tax. As per income tax, what is the tax? 26,250. Now I want every one of you to focus here. As per P&L account, your PBT is 90, but your current tax 26,250. Is these two are matching? Not matching, because 90,000 into suppose 30% is the tax rate. It will be 27, but I am showing how much? Matching is not happening. That's why they brought this standard. Matching of incomes with the taxes is not happening. Sir, why not happening? Because in P&L account, you arrive net profit by following the normal accounting rules, but tax liability you are calculating as per the income tax provisions. So how these two will be matched? They will not be matched. Now why difference is coming? Only temporary difference. That's why on the temporary difference, if you can anticipate the deferred tax and if you can able to recognize it now, matching can be done. Now see, 90,000 into 30% means 27,000. Therefore, already 26,250 recognized. So what is the difference? 750. That is deferred tax. So this 750 is the deferred tax. Is it a liability or is it asset? Is it asset or liability? 750. Liability or asset? I will tell you simple trick where most of the students will not understand. Sir, deferred tax asset, liability, asset, liability. I will tell you one small trick also, but you try to understand the concept. Here, why they have brought this standard is matching of incomes with taxes. Here matching is not happening. Why? Because you are recognizing current tax as per the provisions of Income Tax Act. You are not calculating based on this accounting profit. You are calculating based on the taxable profit. So that's why matching is not happening. To match with it, I need to anticipate deferred tax. To match with it, I need to anticipate what? Deferred tax. So you see every year, second year also same, third year also same, fourth year also. But fifth year you see, fifth year, minus 3,000 I reversed it. Why? Because first year 750, second year 750, third year 750, fourth year 750. First 4 years there is a difference. Last year it was reversed. When there is a reversal happened, whatever the deferred tax you recognize now, that is will be reversed. 750, 750, 750, 750, total 3,000 sir. 4 years you anticipated. Fifth year, that temporary difference is reversed. When there is a reversal happened, you also reverse the deferred tax. Okay. So, sir, okay. Let me tell you here what I followed. Simple. There is a asset, PP, correct? Tell me, what is the cost of the asset? 50. As per income tax also 50. Tell me first year depreciation as per books, as per income tax. Tell me the carrying amount as per books. Tax base. What I told, deferred tax is nothing but either additional tax liability or tax savings on what? Temporary differences between carrying amount of the asset, tax base of the asset. Here PP is an asset. What is the carrying amount of the asset? What is the tax base? Difference, how much? Tell me, is this difference temporary difference or permanent difference? Temporary. Because either as per books or as income tax, your total 50,000 is allowed as depreciation. But the difference is only depreciation amounts. Here every year 12/5, 12/5, 12/5, 4 years allowed. Here 10, 10, 10, 5 years allowed. So overall it is same, but the difference is only temporary. So first year you compare these two. What is the difference? See now, if I compare these two, as per books my asset value 40, as per income tax 37,500. So 2,500 is the difference. It's a temporary difference. On this temporary difference I need to apply tax rate. How much I got? 750. This is called deferred tax. Sir, it is a asset or liability? Simple trick I will tell you. Listen. As per books, what is the asset value? What is the carrying amount? As per income tax. This is as per books, this is as per income tax. Now from this books 40,000, if I brought it to 37,500, asset must be reduced or increased? Reduced. 40,000 must be brought to 37,500. Right? So you need to reduce. In order to reduce the asset, what you are going to do? Either asset must be reduced or a liability will be created. Here liability is created. That's why DTL. So 40,000 asset as per books, but as per income tax 37,500. So to match with the tax base, I need to reduce the asset 2,500 na? So that's why 2,500 into 30%. DTL. L. If I create a liability, obviously I am reducing asset only na? Sir, net assets means assets minus liabilities. If I reduce asset or if I create a liability, both will have same impact. Are you understanding, guys? Suppose asset value I must reduce, sir. Instead I create a liability. Both are same only, na? That's what I am saying. So therefore here 2,500 is a temporary difference. On that I created what? DTL. Tell me what is the entry? DTL. Liability means credit. Debit will be given to P&L. So P&L to DT. Deferred tax. P&L to deferred tax. That is the entry for the first year. So if I write an entry here, so what is the entry I will write? Very simple. See this. If it is a deferred tax liability, so P&L account debit to deferred tax liability or simply deferred tax. The deferred tax is nothing but deferred tax liability. What is the entry for current tax? Current tax. Current tax to provision for tax. This current tax will be debited to P&L or OCI. Depending upon the temporary difference on which you are creating. If you are creating current tax or deferred tax on the temporary difference, if it is part of OCI, then you debit OCI. If it is not part of OCI, then P&L, normal temporary difference. Okay, simple. Current tax, you calculated 26,250, you calculated na? What is the entry? Current tax to provision for tax. That current tax will be debited to P&L account. That's why it is part of P&L account here. Current tax to provision for tax. P&L to current tax. This is current tax. Come to deferred tax. What is the entry for deferred tax? Liability. P&L to deferred tax. That's it. P&L to deferred tax. That's why deferred tax is debited to P&L. Deferred tax liability. If it is an asset, deferred tax to P&L. Deferred tax to P&L because asset will be debited. Asset will have a debit balance, na? That's why. So this is first year. Now come to second year, everybody. What is the second year depreciation? As per books, as per income tax. Now tell me what is the carrying amount of the asset? After 2 years, 30. As per tax, what is the difference? Into 30%. How much? 1,500. So this is DTL again. DTL. Deferred tax liability. Why? I told you the logic. Because as per books 30. If I reduce 30 to 25, why I need to create liability? Deferred tax liability. Sir, 30,000 is there, sir. As per income tax 25 is there. So I need to reduce the asset by 5,000. So 5,000 into 30, I will create a deferred tax liability. If I reduce the asset, so I need to create a deferred tax liability. So I created. Now my important thing. This 1,500 is what? Deferred tax liability at the end of second year. This is cumulative. Already first year 750 you created. Only remaining 750 will be created at the end of the second year. In balance sheet, the total deferred tax liability is 1500. But to P&L account only 750 will go. Because already first year 750 recognized na. This is total 1500. Already 750 opening balance. This 750 I need to recognize at the end of the second year. What is the entry? P&L to deferred tax. That's it. So now at the end of the second year, what is deferred tax? Liability 1500. How much increased? 750. You understood? Come to third year. Again 10, 12,500. So 20,000, 12,500. Now what's the difference? 7,500 into 30%. How much? 2,250. Deferred tax liability. How much increase? 750. So cumulative to 2,250. Fourth year, 10,000 nil. So what is the difference? 3,000. Deferred tax liability. So total DTL at the end of the fourth year, 3,000. Now come to fifth year, guys. See this. Last year what happened? You see, till this year, if you compare carrying amount with the income tax provisions, there is a difference. Now you see last year nil nil. There is no differences. So that means whatever DTL you recognized so far, that DTL has now become actual liability. Therefore, you need to convert this as you need to reverse this. This DTL now you anticipated and you need to reverse this because the differences have been erased. As long as there is a difference, you anticipated the liability. But now the difference has been over now. What is the total difference? For all these years, 2,500, 2,500, 2,500, 2,500, total 10,000. Now all this 10,000 has been reversed. There is no difference now. Entire difference has been wiped off. When there is no difference, you don't create any DTL. Already whatever the DTL is there, reverse it. So what is the entry? Deferred tax to P&L. DTL to P&L. Nothing but whatever liability is there, cancel it. That's it, sir. This is the concept. Like this, what you are going to do, sir? For every asset, every liability, as per books, as per income tax. Compare. Difference. Calculate deferred tax. Okay? So first identify the difference. Then this difference will give you additional tax liability or savings. If it is giving additional tax liability, DTL. Here in this case, this is giving additional tax liability. Why, sir? Why it is giving additional tax liability? Simple, sir. As per income tax, every year how much depreciation you are enjoying, sir? 12,500. But as per books it is only. That means how much excess 2,500 depreciation you are enjoying, sir? 2,500 into 30% means 750 rupees. You are saving tax. But this will become a tax liability in future. Because in fifth year, you are not going to be allowed anything as per Income Tax Act. So in the first 4 years, you are enjoying 2,500 excess depreciation. Because of that, you are temporarily saving a tax liability of 750. But you know, in fifth year, you are not going to be allowed anything as per Income Tax Act. So therefore, this 750, 750, 750, 750 total 3,000 will become a liability. That's why I anticipated every year I recognized it 750, 750 like that 3,000 DTL recognized, and at the end of the fifth year entire deferred tax liability has been reversed. Because the timing difference is not there now. See, that's why deferred tax is what? It is the tax effect of timing difference. So I think you understood the basic crux of Ind AS 12. So in brief, what are the steps you are going to follow to calculate deferred tax? Tell me. First step. First, determine the carrying amount as per books, as per accounts. Assets and liabilities, carrying amount, how much as per books, by following the normal provisions. Then calculate what? Tax base, by following income tax provisions, assets and liabilities value at the end. Calculate the difference. That difference should be what? Temporary. If it is a permanent difference, ignore. Permanent difference, ignore. Temporary difference only deferred tax will come. Sir, what is permanent difference? See, there are certain cases in Income Tax Act, at any cost, they won't be allowed. Like for example, if I pay any penalty, for example, income tax penalty, for example, any penalties, fines I paid, I may allow it as per the books. So as per books it is my liability, but as per Income Tax Act never it is allowed. So if the difference is not there, or the difference is a permanent difference between these two, deferred tax will not come. Deferred tax will come only if there is a difference between the assets and liabilities values. Now, important sir, when I calculate the temporary difference, sir, these temporary differences will give me what? Either they will give you additional tax liability, then those differences are called taxable temporary differences. Suppose sometimes these temporary differences will give me savings, they are called deductible temporary differences. So temporary differences are two types: taxable temporary differences, deductible temporary differences. When we call taxable temporary differences, if the difference is going to give me additional tax liability in future, like in this case depreciation has giving me additional tax liability in future, so that's why it is called what? Taxable temporary differences. Sometimes I am going to save some tax savings in future, that is called deductible temporary differences. Tell me, if it is a taxable temporary differences, DTL or DTA na? DTL, because liability na. In future, if I am going to get additional tax liability, means it's a liability, so I have to create DTL. Suppose if there is a tax savings, DTA has to be created. Okay, now to be particular, important, concentrate everybody. When DTL is created, DTL liability will be created when DTL will be created. When the carrying amount of the asset, when it comes to asset, as per books, if the asset value, carrying amount of the asset is greater than the tax base of the asset, you create DTL. Accepted or not? Which asset is more? Carrying amount is more than the tax base of the asset. Then you create DTL. Why? I told you the logic also. For example, as per books, suppose 10 lakhs. As per Income Tax Act, 5 lakhs. Tell me. Carrying amount of the asset is more than the tax base of the asset. How much? 5 lakhs. So I need to brought it to the tax level. How much I need to reduce? So to reduce the asset, what I need to create? Liability. That's why DTL. Logically also I can explain. Logically also you see, as per books your asset value 10 lakhs, but as per income tax it is only 5 lakhs. That means this 5 lakhs difference is there. This difference is a temporary difference which is going to give you tax liability in future. DTL you create. Similarly, liability you come. Suppose as per books the carrying amount of the liability is there which is less than the tax base of the liability. Suppose as per books the liability is 10, as per income tax 8. So to brought liability to tax, how much I need to reduce? Correct, a liability has to be reduced. 10 has to be brought to 8. To reduce a liability, what I need to do? Asset has to be created. See here, reverse I am telling. Here carrying amount of the liability is 8 lakhs. Tax base of the liability 10 lakhs. For example, in order to match with the tax, I need to increase the liability. How much? 2 lakhs. To increase the liability, I need to create a liability. DTL. For assets, opposite effect. For liability, same effect. In order to increase the liability only created. DTL. Guys, are you understanding? Now come to DTA. When DTA is created, simple. If the carrying amount of the asset is less than the tax base of the asset. For example, carrying amount of the asset 10 lakhs. Tax base of the asset 12 lakhs. Tell me now. Asset value should be increased or should be decreased? Increased. How much to increase? 2 lakhs. Create DTA. As per books 10 sir. As per income tax 12. So to match with the income tax I need to increase the asset na. So DTA. Suppose come to liability. Carrying amount of the liability is greater than the tax base of the liability. For example, the carrying amount of the liability is 10 lakhs sir. Tax base of the liability suppose 8 lakhs. So I need to reduce the liability by 2 lakhs. So create a asset, DTA. So the conclusion is very simple, sir. You remember this. If I need to increase the asset I need to increase, asset create. Asset I need to decrease, DTL, reverse. Liability I need to increase, DTL. Liability I need to reduce, DTA. This increase decrease I am talking to match with what? Tax base of the asset from the carrying amount. Carrying amount of the asset as per books to income tax. When I my books asset I need to increase to the tax base, DTA. I need to decrease the asset value, DTL. Liability I need to increase, DTL. Liability I need to decrease, DTA. You understanding what I am saying? So logically this is a simple way to remember, but in examination you know in examination what happens now, how much ever logic you understand in the classroom, examination it won't strike. DTL or DTA, what, then these tricks will help you. That's why I'm explaining this, okay? Because at the end of the day you are going to remember this, and at the end of the day we want marks, we want to pass the exams. That's the primary agenda, okay? Whether you understand or not, that's a different thing, whether you have a knowledge or not, because your knowledge will be assessed only through examination, na? So passing examination is the first thing. Whatever anybody says, that is the fact. Qualification is very, very important at the first thing. That you need to remember. With the knowledge, it is a super combination, obviously. But passing the examination, you should be the primary objective for you, getting the qualification. So you understand this? The temporary differences are divided into two. What are those? Taxable temporary differences, deductible temporary differences. Correct? Taxable temporary differences will give you additional tax liability. Deductible temporary difference will give you tax savings. So in order to create a additional tax liability, you create DTL. In order to save some tax, you create a DTA. When you are going to create DTL, for example, asset, tell me, I want to increase the asset, DTL. If I want to increase the asset, if I want to increase the asset, I need to create DTA. If I want to decrease the asset, DTL. Liability I want to increase, liability I want to decrease, DTA. That means, if you understand, sir, basically asset means positive. So if I increase asset, create asset. Liability increase, liability I need to create. But opposite I need to create na opposite effect. For example, asset I need to decrease, DTL. Liability I need to decrease, create a deferred tax asset. Should not forget it. And on this temporary difference, apply the tax rate. Which tax rate you will apply when you are calculating deferred tax? If in the question, if they given any enacted rates or substantial enacted rates, take those tax rates. In income tax, every budget future advanced tax rates will be given. Na? For example, right now suppose 30% tax rate is there, income tax. Suppose government introduced 35%, which is already enacted by the time you are calculating deferred tax, because this deferred tax is relating to future. That's why you take that enacted rate. And or suppose when we call a rate is enacted rate, if it is approved in both the houses of parliament, sometimes substantial enacted, that means it is approved, but approved in the parliament, maybe president approval is required pending, that is called substantively enacted. So always remember, when you are calculating deferred tax, on temporary difference you are going to apply tax rate. Which tax rate you need to take? Enacted rate you need to take. Enacted rate means if government has brought any change in the tax rate, that changed tax rate you need to take. Suppose if we is silent, we will take the rate given. For example, 30% given, take 30%. Suppose he said in the question that at present the tax rate is 30, the enacted rate is 35%. Take 35 to calculate deferred tax. Because obviously deferred tax is relating to future. Obviously you need to take the future rates only. That's why enacted rate you can. And calculate deferred tax. temporary difference, either taxable or deductible into tax rate. And finally you write the entries. If it is a deferred tax asset, what is the entry? Deferred tax asset to deferred tax. This deferred tax will go to P&L account, nothing but. If it is a deferred tax liability, deferred tax to DTL. This deferred tax will go to P&L account, or directly you can write P&L to deferred tax liability. Hello? And I can reverse it. Same entry. If I want to reverse timing differences reverse, I can also reverse these things. So this is the concept of income taxes, deferred tax. You understand? So can you tell me the steps? First, carrying amount of the asset and liability. Second, tax base. Third, temporary difference. Temporary differences are divided into two. What are those? Taxable, deductible. Taxable means additional, DTL. Taxable, deductible means DTA. Asset, I need to increase. Asset, DTA. Asset, I need to decrease. DTL. Liability, I need to increase. DTL. Liability, I need to decrease. DTA. Create it. Entries, you write it. And which rate you take? Enacted rate, always you have to take it. Okay? Now look at these examples, sir. Some examples. Suppose A Limited is there, sir. There is a company A Limited which purchased a PP, cost 5,000, sir. Depreciation 20% SLM as per books. As per income tax 25%, tax rate 30. Tell me the deferred tax here. First you are going to calculate what? Carrying amount. What is the carrying amount? 5,000 minus depreciation as per books 20%. So 4,000 is the carrying amount of the asset as per books. As per income tax, 5,000 minus 25%, 3,750. So say this. What is the difference? 250. This is which difference? Temporary difference. Why temporary difference? Because I know as per books or as per income tax, ultimately depreciation to be allowed is 5,000. Cost of the asset is entirely allowed now, but as per books first year 1,000, but as per income tax 1,250. So difference is how much? 250. Sir, 250 only na sir. So this 250 is temporary difference. So I need to calculate deferred tax into 30%. Now tell me, is it deferred tax asset or liability? What is the trick I told? Carrying amount of the asset 4,000. As per income tax 3,000. So I need to increase or decrease? Decrease to match with the tax. So to decrease asset, what I need to do? DTL I need to create. So create DTL. What is the entry? Deferred tax to DTL. This deferred tax will go to P&L account. That's it. Over. Like that you need to do. One more example I will do. Suppose there is a company X Limited. Interest receivable income. As per books, there is an interest receivable. Interest receivable is what? Asset. We will recognize in books as per accrual concept. Even though we don't receive it, accrual basis says when the income is accrued, we can recognize it. So we recognize. So as per my books, what is the carrying amount of the asset? 1,000. But as per income tax, interest income is taxable on which basis? Cash basis. That means income tax is, we will allow this as income only when you receive. That means as per income tax, what is the asset value? 0. As per income tax, it is 0. But as per books, 1,000. So what is the difference? 1,000. This is which difference? Temporary. Why temporary difference? Because Income Tax Act, even though right now they are taking 0, but next year when I receive interest, as per Income Tax Act, that is my asset. That will be recognized. Hello. So the difference as per books, as per income tax is now only temporary. 1,000. So 1,000 into 30%. 300. Is the deferred tax asset or liability? Liability. Because as per books 1,000, as per income tax 0. So if I match with tax, I need to reduce. To reduce asset, I need to create liability. DTL, I need to create. Like that I have to do. That's it. You understand the logics? Okay. So let me solve some questions relating to this deferred tax. Come to study material, question number 1, sir. This question is there in model question paper set 1, June 2024. See, I have prepared exclusively the question bank, the concept book, which is freely available. Whenever you want, you can check it online. It is freely available. One of the best question banks, one of the best concept book I have prepared for CMA final students. Because what happens in CMA final is that discrimination, what to study, how much to study, what to learn, how much to learn is very, very important. There should be a restriction on learning for CMA final. If you learn unnecessary things, unnecessarily you burden yourself. So that's why that discrimination should be there. There is always a difference between CA and CMA. So for us, CMA is important. How the CMA board is framing the questions, what they are expecting from me, that you need to learn first. So CMA sources is the primary sources for us. First we need to complete CMA study material, CMA workbook, CMA MQPs, model question papers, CMA exam questions. Trust me, in my question bank, all these 4 things are there. If you complete these 4 things, that is more than sufficient. No need to see any other source. If you want to see other sources, first complete these 4. Then go and see other sources also. But majority of the students leaving these sources and checking other sources, no use at all. Because you are writing exam which is conducted by CMA board. What material they have given, what MQPs they given, what is the previous exam questions they tested, that is important, na? So that first you complete. You will understand what is the expectation of the board, what type of questions they are asking in the examination. CMA questions, they are testing all the concepts, but they are testing reasonable depth. Here the depth is reasonable and overall knowledge is required. Comprehensive knowledge with average depth is sufficient to finish the exams, CMA exams. That's what with my experience I can say. If you see this question bank, all questions, examination questions are repeated questions mostly. Okay. So first always study material questions. See, and I can say CMA board materials, the problems especially, finest problems are there in CMA books. I can tell you. Beautiful questions are there. Some of the beautiful questions are there in CMA materials. So if you solve those questions, definitely you are going to enjoy the subject. Okay. See this question number 1, sir. First, there is a company, sir, measured accounting profit 80,000. What is accounting profit means? As per books, 80,000 profit after charging depreciation of 12,000. That means as per books, what is the depreciation? 12,000. Interest receivable income tax is levied on cash basis. Included in the accounting profit is interest accrued 5,000, which is not included in the taxable profit of 67,000. So this company is also having interest accrued, but this interest income is as per income tax we will allow only on which basis? Cash basis. But it is so therefore it is not included in the taxable profit, because income tax act will not allow now the interest income, but it is included in the accounting profit. As per books I can include it. The tax rate is how much, sir? 30%. For tax purpose, depreciation admissible is how much? 20,000. The carrying amount of the fixed asset was 68,000. The tax base of the fixed assets is 60,000 before charging depreciation for the current year. Before charging depreciation for the current year, what is the carrying amount of the fixed assets, sir? 68,000. Tax base of the assets 60,000. What they are asking, find carrying amount and tax base of the fixed assets, tax base of the interest accrued at the end of the year. First of all, understand the question carefully. In examination, first understand, whenever you see these questions called these words, tax base, carrying amount, obviously you have to understand this is question from AS 12, income taxes. And see the facts carefully. In this question, what assets, what liabilities they have given. They are asking the carrying amount and the tax base of the assets. First of all, tell me what are the assets we have here. We have here one fixed asset, no doubt. See the given, the carrying amount of the fixed asset is 68, tax base of the fixed asset 60. This is before charging depreciation. And another thing is interest. So there are 2 assets given in the question. So carrying amount of the fixed asset, if you see, fixed asset carrying amount. Carrying amount means as per books. So carrying amount, fixed asset. So tell me 60 minus depreciation. This is before depreciation, right? As per books, what is the depreciation? 12,000. So what is the carrying amount of the asset? 56. Very simple. Now same way tax base of the asset, fixed asset you see. Tell me, before depreciation, what is the tax base of the fixed asset? 60. Minus depreciation. See, given, yeah, the tax rate, tax purpose depreciation is 20. Given, what you need to read the question, that's it. So 40,000. So these are what? Carrying amount as well as tax base of what? Fixed asset. Now come to one more asset, interest. Interest receivable. Tell me, as per books, what is the carrying amount? 5,000. See this given. Interest receivable income, including accounting profit, 5,000. As per tax, 0, nil. First bit over. Imagine these type of questions they are asking in the examination. If you know the concept little bit, these questions you can easily answer. Okay, so I taught you this accounting for taxes just for 40 minutes and you can able to solve them. I hope. Yes. Now you are only telling the answers. So first bit answer is this. Temporary difference, how much they are asking? Tell me how much is the difference? 16,000, 56, 40. This is 5,000. Temporary difference or permanent difference? Temporary differences. Because we know overall it is same as per books, as per income tax. What is the current tax expenses and deferred tax expenses? I need to calculate current tax as well as deferred tax. First deferred tax I can easily calculate now because I know the timing difference into rate. What is the rate? 30%. Apply it. Tell me. 4,000. This one. Total 6,000. This is deferred tax asset or liability? Liability, DTL. So DTL 6,300. Correct? So this deferred tax liability 6,300. Fixed asset 4,100, interest 1,500. How simple it is. Done na? One more thing they are asking is what? Liabilities, assets. Only liability is there. How much deferred tax liability? 6,300. 6,300 is a deferred tax liability. What is the entry? Deferred tax to deferred tax liability. How much? 6,300. They are asking current tax also. Sir, tell me how to calculate current tax. What I told, current tax is tax calculated as per the normal income tax provisions. So, how to calculate current tax? Simple. As per income tax, what is my profit? Tell me. Income tax I need to calculate because I need to calculate current tax. See this. Yeah. Which is not included in taxable profit of how much? 67,000. So taxable profit 67,000. On the 67,000 tax rate. This is before depreciation, after depreciation. It is not included in the tax. 67,000. Okay. After charging only. So 67,000 into 30%. How much? 20,100. 20,100. See this is the current tax. Presentation you do whatever manner you want. It is not that you need to follow this only. Even if you do like normal, for example, like this also, computation of tax, current tax expenses, taxable profit. This first take taxable profit, tax rate, then current tax. This is also correct. They will give you marks. No need that you have to follow only this table. So tell me here, what is your current tax? 20,100. What is the entry? Current tax to provision for tax. this current tax will go to P&L. P&L to current tax. So current tax 20,100, deferred tax 6,300. Two tax expenses. So this is question number 1. You understand this? Come to problem number 2. See this question. A company creates a provision for gratuity and leave encashment. There is a company, sir, that company has created one provision for gratuity, leave encashment, and recognize a liability of 50,000. Provision is basically a liability. Provision is a liability. This is the only difference between taxable profit and accounting profit. The company measures the current tax 48,000 at the rate of 25%. Compute tax expenses. So they are asking what? Tax expense. What is tax expenses? Current tax plus deferred tax. Current tax they are given. How much? 48,000. I need to calculate deferred tax. Here in this question, asset given a, liability given a? Liability. What is the liability here? Provision for gratuity is a liability. Correct? Provision for gratuity and leave encashment. Now, here, as per books, what is the liability? Given, see this. Company created a liability of 50. As per tax, nil. Why? Because Income Tax Act will not allow provisions when you create. They will allow only when the actual loss happens. Sir, I covered this point. Basically, in Income Tax Act, they won't allow any provision when you create. They will allow only when the actual loss happens. Otherwise, everybody will create provisions and they will escape tax liability. Na? They know that. That's why they say, no, boss. You create whatever provisions you want in books. But as per Income Tax Act, we don't allow. We will allow only when the actual loss happens. So you created a provision as per books, 50,000, it's your liability. But as per tax, it is 0. So therefore, what's the temporary difference? 50,000. On this temporary difference, I need to create deferred tax. How much is the tax rate? 25%. Yeah. 50,000 into 25%? 12,000? Can you tell me DTL or DTA na? Liability I need to reduce. In order to reduce a liability, DTA. So create DTA. What is the entry? DTA to deferred tax. Correct? This deferred tax will go to P&L. So here I need to create DTA. See this. So here if you see deferred tax asset 12,500. Current tax 48. So total tax expenses. Important, sir. Sir, current tax 60,000, sir. How much current tax? 48. Important. Listen to me. One simple point here. Here, current tax 48. Deferred tax asset came. How much? 12,500. This is debited to P&L. This is credited to P&L. So net, we need to reduce this. Then you will get the tax expenses. Sometimes some students, they will add both wrong. That's why I said tax expense is equal to current tax plus or minus deferred tax, I told. When plus, if it is a deferred tax, liability. Asset means obviously it is credited to P&L means expenses will reduce. So here deferred tax asset na. So 48 minus 12,500. How much? 35,000. See this. This question may ask in examination for 3 marks, 4 marks. If they ask na, calculate properly. You understand this? Yes. So this is one question, sir. This is one more important question is there in this. Come to MQP question, sir. MQP question number 1. One beautiful question. Possible that it may come in examination. Model question paper question this is. This question you see. See, there is a company Y. They follows which model? Revaluation model to measure its PPE. The company acquired an item of PPE for a cost of 20 lakhs. When on April 1st, 2022. So April 1st, 2022, they purchased one PPE, sir. Dates important, sir. What is the useful life of the PPE? 10 years. Residual value? Nil. On March 31st, 2023, that means at the end of the year, The PP is revalued to 28 lakhs 80,000. No change in residual value, remaining useful life. As per Ind AS 16, property, plant, equipment, if an asset's carrying amount is increased as a result of revaluation, increase shall be recognized in OCI. I told you, other comprehensive income, and accumulated in equity under the heading of revaluation surplus. See, Ind AS 16 says whenever you do revaluation, that amount will be transferred to revaluation surplus. Revaluation surplus where we will show? As per schedule 3. If you follow Ind AS, OCI, other comprehensive income, one head is there. There we will show it. Okay. For tax purpose, the value of the PP is cost, that is 20,000. For tax purpose, what is the value of the asset? 20,000. The useful life for tax purpose is how many years? 8 years. Nil residual value. Examine the amount of temporary difference and deferred tax as per Ind AS 12 as on 31st March 2023, 31st March 2024. Now I want every one of you to focus on the facts of the question. First of all, tell me, in this question they are talking about what? Fixed asset, PB. When they purchased it? 1st April 2022. Now they are asking at the end of which year deferred taxes? 31st March 2023, 31st March 2024. So if you see PP, carrying amount to tax, as per books on 1st April 2022, what is the asset value? Cost? At what cost I purchased? 20 lakhs. Correct? Income tax also same, na? There is no difference, because in the question also they clearly given for tax purpose the value of the PP is cost 20,000. Less first year depreciation I need to reduce 22-23 depreciation because I want carrying amounts. As per books, what is the depreciation? Useful life is 10 years, residual value nil. So 20 lakhs divided by 10. 2 lakhs is the depreciation as per books. So what is the carrying amount? 18 lakhs. Now come to income tax. Income tax X says the life is 8 years. So therefore 20 lakhs divided by 8. 2 lakhs 50,000. So what is the amount? 17 lakh 50,000. 17 lakh 50. So this is the carrying amount. What is the timing difference? Temporary difference? 50,000. You see, at the end of the year, you see, as per books 18 lakhs, as per income tax 17,500. 17 lakh 50,000. So what is the temporary difference? 50. On this 50,000 I need to calculate deferred tax. Asset or liability? Liability, because asset value I need to reduce. So therefore I create a liability. So DTL I will create. How much? 50,000 into what is the tax rate? 30%. How much? 15,000 DTL I will create. Now here the most important thing is on 31st March 2023 revaluation happened. Asset was revalued. What is the revalued amount? 28 lakhs. That means after revaluation, what is the carrying amount as per books? 28 lakhs 80,000. How much increase? 10 lakhs 80,000 is the revaluation surplus. Revaluation surplus. But as per income tax, sir, is there any revaluation will applicable? No. So it will be 17 lakh 50 only. So please understand, sir, revaluation happened in the books. As per income tax, no. So 28 lakh 80, 17 lakh 50. So what is the temporary? Again difference is there. How much? 11 lakh 30,000. Yes, 11 lakh 30,000 difference is there. On this 11 lakh 30,000, 30%. How much? 3 lakhs 39,000. Deferred tax liability. So DTL 3 lakh 39,000. So therefore overall my deferred tax liability is how much, sir? 3 lakh 39,000. Already 15,000 is there. Now it becomes 3 lakh 39. So this is the total 3 lakh 39,000. Correct? You understand? So what is the DTL at the end of the first year? 3 lakh 39,000. What about this 15? Shall I add this 15? No, already it is there. Cumulatively 3 lakh 39. See, for your understanding I calculated this. Or else you directly take these two. 11 lakh 30. This is the timing difference and on that you calculate it. Now interesting part, can I tell you? Here 3 lakh 39,000 is there now. what is the entry we are going to write generally? Deferred tax to deferred tax liability. That deferred tax will go to P&L. But here, in this 3,39,000, 10,80,000 because of revaluation surplus, that is transferred to OCI. Therefore, in this 3,39,000, the proportionate tax will go to OCI, not to P&L. Because when revaluation surplus will go to OCI, na, obviously whatever the deferred tax you recognized on the timing differences, temporary difference arising from the revaluation surplus because of that will also go to OCI. That's why when you are writing entries, if you see my notes carefully, so many places I have written. I'll show you. Yeah, you see here why I written either P&L or OCI, because I know that temporary differences arises because of the items originally they will be transferred to OCI. Now in this question, if you see here, in this question, sir, actually if you carefully follow this question, this revaluation surplus will go to OCI, na sir. So therefore, $10,80,000 into 30% you do. Tell me how much came? 3,24,000. 3,24,000 deferred tax liability because of revaluation surplus. Revaluation surplus originally transferred to OCI. So this is also transferred to OCI. So therefore, what is the entry? Deferred tax to DTL, OCI to deferred tax. That 3,24,000 will go to OCI. You don't understand, huh? See here, simple here, at the end of the first year, as per books, what is the asset value? 28,80,000. As per income tax, what is the timing difference? 11,30,000 into 30%, 3,39,000. Correct? This is deferred tax liability. Now what I am saying is, your timing difference is 11,30,000, temporary difference. How this difference came? Revaluation 10,80,000, normal difference 50, depreciation. So on this 30%, that is 15,000, this will go to P&L. On this 10,80,000 into 30%, 3,24,000 will go to OCI. Because your total temporary difference of 11,30,000, depreciation 50,000, 10,80,000 because of revaluation. Revaluation Ind AS 16 says it will go to OCI. Therefore, deferred tax will also be, when you create deferred tax liability, that will also go to OCI. That's what here given. Deferred tax liability of 15,000 arising on 31st March 2023 will be recognized in P&L. Deferred tax liability of 3,24,000 arising on revaluation during the year will be recognized where? Other component, OCI. That's it. This is, I think you understand. Next year you tell me what happens. They are asking 31st March 2024 also. You need to reduce depreciation for the year 23-24. So now what is the revalued figure? 28,80,000. This will be depreciated over the remaining life. As per books, what is the remaining life, sir? 9 years. So 28,80,000 divided by 9. 3,20,000. As per income tax, 17,50,000 normal. As per income tax, it is 2,50,000. So what is the 25,60,000, 15 lakhs. So what is the timing difference? 10,60,000 into 30%. How much? 3,18,000. So overall deferred tax liability increased or decreased? Decrease. Last year 3,39,000. Now it is 3 lakh. How much decrease? 21,000. Hello. So reverses 21,000. Because sir, timing difference reduced, sir, temporary difference. Last year 11,30,000, this year 10,60,000. Obviously your overall liability will decrease, na? That's why it came to 3,18,000. Last year it is 3,39,000. So 21,000 you will reverse it. Deferred tax liability to deferred tax. Deferred tax will go to P&L. You understand this? Okay. This is one question, mark it, important question. This is possible that it may come in examination. There is one more question, sir. Workbook question number 2, sir. See here in workbook question number 2, if you see, they are asking an entity is there, ABC Limited, sir. It provides the following information regarding assets and liabilities on 31st March 2024. So assets and liabilities details they are giving. Based on the given data, they are asking carrying amount to tax base temporary difference for each of the assets and liabilities they are asking. Total 6 cases they given, sir. Okay. So all the 6 cases if you see here, first a machine was purchased for 2 lakhs. Depreciation 24,000 charged. Tax allowance 60,000 has been claimed on it. So what is the cost of the machine? 2 lakhs. Depreciation. So what is the carrying amount? 2 lakhs minus 24. 1 lakh 76. This is the carrying amount of the asset. As per books. As per income tax, how much claimed? 60. So 2 lakhs minus 60. 1 lakh 40 is the tax base. Correct? So as per books 1 lakh 76. As per tax 1 lakh 40. So what is the temporary difference? 36. On that we create deferred tax liability. Liability asset? Liability, because asset has to be reduced here. So create a DTL. They are not asked. They are asking only carrying amount to tax base temporary difference. Next one you have to tell. Interest receivable as shown in the statement of balance sheet amounting to 12. As per books 12,000 interest. But this interest will be taxable only when it is received as per income tax. So as per books 12,000. As per income tax 0. This already I told you. Because income tax will follow cash basis. So as per books 12. As per income tax 0. So 12,000 is the temporary difference. You understand, guys? See, trade receivables are recorded at a carrying amount of 28,000. The revenue related to these receivables already included in the taxable profit. That means there is no difference. As per books 28. Income tax also already considered 28. So temporary difference is 0. 28, 28. 0 is the difference. Because already both the books they considered na. Next, inventory has been written down by 1200 on account of slow moving, non-moving, which is resulted in reduction of the carrying value from 9,800 to 8,600 in the financial statements. So some stock has become slow moving item, non-moving item. So we created a provision. So inventory value has been reduced by 1200. For tax purpose, this reduction is not considered until the inventory is sold. So tell me, as per books, what is the asset value? 8,600. As per income tax, 9,800. Because we don't allow that reduction, 1200. We will allow only when the inventory is sold. As per books, we create a provision now. When we create a provision on the tax income stock, our tax stock value will fall down to 8,600. So as per books, it is 8,600. But in Income Tax Act says we don't allow when you create a provision. We will allow only when the inventory is sold. So as per income tax, the inventory value is 9,800 only. Correct? So what is the difference? 1,200. Tell me here, asset or liability? 8,600, you need to increase to 9,800. So asset increase means DTA. So on this 1,200, DTA will be created. Hello? Next, the current liabilities section included accrued expenses of 21,000. Current liabilities, there is a accrued expenses of 21,000 which will be deductible for tax only when the cash payment is made. So as per books, what is the liability? 21. As per income tax, 0. Because income tax says only when you pay we will allow. So therefore difference of 21,000. DTA. Last one, accrued expenses have a carrying value of 7,500 and the corresponding expenses already been deducted. That means there is no difference. Because already in my books 7,500 accrued expense is there. Income tax also we recognized it, already allowed. So 0. So this is how we need to understand the differences and we need to solve, sir. So I think all the important questions, I think all questions I solved except one or two questions I missed it, but majority I have solved it, sir. So this much if you learn in Ind AS 12, I think it is more than sufficient, sir. Okay. Okay. The next Ind AS we are going to cover is Ind AS 113 sir, fair value measurement. So this is also one of the important standard, and easily you can prepare sir. Content wise very small, and I can tell you, if you follow this next 30 to 40 minutes, I can assure you that this standard will be done. Easily you can revise and you can write in the examinations. Okay. First of all, what is this fair value measurement? Let us try to understand. Sir, if you see Ind AS, majority of CFR syllabus is what, sir? Ind AS. If you see Ind AS in general, Ind AS somehow loves fair value. Wherever you go, wherever you see, whichever standard you see, they use the word fair value. Fair value is one concept almost every Indian accounting standard will based upon, or will give you fair value, fair value, fair value. So they have given a separate standard for it, how to determine this fair value, because we are using this fair value in so many places. How we are going to decide the fair value? There should be a standard required, because every time they are using the word fair value, fair value, fair value. So what is this fair value? How we are going to determine it? For that they brought one standard. That standard is Ind AS 113. See, generally assets, liabilities will be there for a company. These assets and liabilities generally will be recognized at fair value in most of the places. Like for example, PP, if you see, in PP standard Ind AS 16, fair value is used. Intangible assets, SBP, share based payment, biological assets in Ind AS 16, fair value, assets held for sale, fair value, financial instruments, one chapter is there, accounting for financial instruments, they also use the word fair value. Business combination chapter, we use the word fair value. So in so many places, in different situations, the measurement will happen at a fair value. So that's why we need to understand what is this fair value. Since this many times the standard uses in different places, so we require a separate standard to understand how to determine this fair value. That's why they brought this. So what is the basic objective of this Ind AS 113? See, the core idea is this Ind AS provides the principles for measuring the fair value of assets and liabilities. But you need to understand, sir, this standard is not applicable for all fair values. There are some exceptions. For example, you cannot apply the standard for SBP. SBP means share based payment. There is one standard called Ind AS 102. We will discuss it. Ind AS 102, share based payment. In that share based payment, whatever the fair value concept is there, for that you cannot apply this standard. And also leases, there is one standard Ind AS 116 in your syllabus. Actually you have leases also, Ind AS 116. In Ind AS 116 also they have the measurement will happen at fair value. That fair value we cannot apply this standard. Similarly, for example, Ind AS 36 we discussed value in use. How to determine recoverable value, sir? Fair value, yes. So similar to fair value, like for example value in use in Ind AS 36 or NRV in Ind AS 2, these are similar to fair value only. For them also you cannot apply this standard. But in remaining cases, except these three exceptions, in remaining cases wherever they use the fair value concept, just now I studied now, for example you see here PP valued at fair value, biological assets valued at fair value, assets held for sale valued at fair value, financial instruments valued at fair value, business combination chapter fair value of the assets. Next time I'm going to discuss business combination chapter, very important chapter. So business combination, fair value concept is there. So in so many places we use this fair value concept now. That determination of that fair value is determined as per the standard by the principles which is given in the standard. You understand now why they have drafted a separate standard for this, because in so many other accounting standards, measurement is happening at fair value. Therefore, we require a provisions, principles to determine that fair value. Now, let us try to understand what is fair value as per Ind AS 113. What is fair value first of all? Sir, the standard says, very simple sir, fair value means, listen, fair value means the amount I am going to receive when I sell the asset. Generally, when I sell the asset, I am going to receive the amount, or the amount I am going to pay to settle a liability. If there is a liability, I am going to pay the amount, settle it. So, the price I am going to receive to sell the asset, or the amount I am going to pay settle a liability in a perfect market conditions. In a perfect market conditions. Perfect market conditions means fair conditions between the buyer and seller, market participants. At what price I am going to, the price I am going to receive, the price I am going to pay to settle a liability, the amount I am going to receive to sell the asset. If in the perfect market conditions, that amount is called fair value. So fair value means, see this, at measurement date, on what date you are measuring fair value? On that date, the price I am going to receive to sell the asset, or the price to be paid to settle a liability. Orderly transaction. What is orderly transaction? Orderly transaction means fair conditions without any pressure or force. For example, I am seller, you are buyer. Okay, I am selling my asset to you. I am selling this calculator to you. In the perfect market conditions, without any force, in the fair conditions, how much amount you are going to pay me to this, that will be the fair value. There should not be any influence, there should not be any pressure. Fair conditions between the market participants. These market participant means independent buyer and seller. You are independent, I am independent. So between the buyers and sellers in perfect market conditions, at what price the transactions will happen, that price is called fair value. You understand what is fair value? So that is what the definition they given, sir. Very, very important, sir. So the fair value is the amount I am going to receive to sell an asset, or the paid to transfer a liability. We can call this as exit price. Which price? Exit price. In an orderly transaction means fair conditions without any coercion, force. Between whom? Market participants. Who is market participant? Independent buyers and sellers. At what date? Measurement date. That is called fair value. Now, important. Okay, sir, I understood fair value. Simply fair value means between independent buyers and sellers, at what price the transaction happens. That price is fair value. Okay. Sir, how I am going to know this fair value? The standard says to measure the fair value, you have two choices, or you have two options we are giving you. Not options, two preferences. First preference is principal market. Important. They may ask this. For measurement of fair value, price reference should be taken from where I can get this fair value. First preference will be given to which market? Principal market. Go to the principal market. Check the value, check the price. That is the fair value. Suppose principal market not available, then go to most advantageous market. Principal market, first preference. Only if principal market exists, if principal market not exist, most advantageous market. Important. Okay? Okay. Sir, what is this principal market? What is this most advantageous market? Important, sir. Sir, principal market means the market where highest volume of transactions happens. What is that? Highest volume. See, the market in which the asset and liability is transacted at highest volume, not highest price, highest volume. In which market highest volume of that particular asset or liability will be transacted? For example, shares. What is the principal market for shares? Stock exchange. because the highest volume of transactions will happen. For example, NSE, BSE. BSE, highest volume of transactions are happening. So BSE is the principal market. Now you need to take reference from that market to determine the fair value of this shares. Like that, any asset or liability, if you want to know the fair value, go and find the principal market. How can I say which is principal market? Simple. Where highest volume of transactions are happening, that is the principal market. For example, gold. Where is the principal market? Where highest volume of gold transactions, buying and selling is happening, that is the principal market. Sir, if principal market is not there, sir, go for most advantageous market. What is most advantageous market? Simple. Most advantageous market means where you are getting maximum price for the asset, or if it is the liability, where you are paying minimum amount to settle a liability. Most advantage means what, sir? If it is an asset, I will get the maximum amount. If it is a liability, minimum amount I need to pay to settle it. So a market in which net amount received on sale of asset is maximum. Net amount I am going to receive on sale of the asset is what, sir? Maximum. Or the net amount I am going to pay to transfer a liability is what, sir? Minimum. That market is most advantageous market. So you understand both principal market, most advantageous market. First choice will be given to principal market. Okay. Now listen. Principal market. Suppose principal market is there. Highest volume of transactions are happen. How to determine the fair value? Simple. Price of the asset and liability, you take it from that market, minus transportation cost, you reduce it. Take the price. At what price that asset, that liability is trading, highest volume in that market, minus transportation cost. What is transportation cost? Simple, sir. To carry these assets and liabilities to that place, I have to incur some cost, na? So to bring the asset from its current location to the market, from this place to that place. So if transportation is required, the transportation cost you reduce it, then you will get the fair value. If it is a principal market. So in principal market, how to determine the fair value? Price of the asset or liability minus transportation cost. Okay, now important. Most advantageous market, how to determine the fair value? Most advantageous. For example, you see, sir, principal market, see this example. For example, investment in shares. I want to determine the fair value of my investment in shares. Investment in shares is my asset. What is the principal market for the shares? Stock exchange, because that is where the highest volume happens. Suppose NSE is there, BSE is there. In NSE, fair value is 110. In BSE, fair value is 105. Tell me, NSE, BSE, which one is principal market? BSE, because higher volume. See, NSE also my share, these shares are there. BSE also there. But where highest volume is happening? BSE. So this is the principal market. In this market, what is the price? 105. That will be the fair value. Don't take 110, whichever is higher, don't take it. Because first preference always given to principal market. Principal market means highest volume. Even though price is less, this will be given the priority, higher volume. Because this is the principal market. So principal market where the highest volume is happening is BSE. So therefore fair value is 105. Now next important example, most advantageous market. Suppose there are two markets, market X, market Y. Okay. For example, in my godown, or for example, I have one asset with me. Okay. I have one huge plant and machinery. There are two markets, market X, market Y. See this. There is no principal market. There is no principal market. When there is no principal market, second choice, most advantageous. Market X, market Y. Market X, selling price 105. Okay. Now the standard says, sir, when you want to determine which is the most advantageous market, first take the price, selling price, if it is an asset. From that, you need to reduce first transportation cost. Transportation cost, you deduct it. Then transaction cost, you deduct it. Transportation cost is different. Transaction cost is different. What is transaction cost? To make this sales, we need to incur some cost. Commission paid, sales agent commission expenses which is incurred to make the sale, that is called transaction cost. Brokerage commission. Transportation cost means to bring the goods from the place to the location, marketplace. So transportation cost, transaction cost, you reduce it. Suppose you see here market X 105 selling price, transportation cost to brought to the market X 4 rupees, transportation cost 1 rupee. Transaction cost 1 rupee. So what is the price? 100. Market Y you take it 104 minus 2 minus 3. How much? 99. Now which one is most advantageous for me? Market X. So this is the advantageous market. How to determine the advantageous market, sir? Where I will get the maximum amount. If it is a liability, where I am paying minimum amount. Now here where I am paying maximum, where I am getting the maximum amount? X. But understand guys, when you are determining the maximum amount from the selling price, you need to deduct two things. Transportation cost, transaction cost also you need to deduct. Now which one is most advantageous? Market X. Now I need to determine the fair value. Tell me fair value of market X. Don't take 100. This is to determine which one is advantageous. Once you determine which one is advantageous, market X is advantageous, then you need to determine the fair value based on market X. In market X, what is the selling price? 105. What is the transportation cost? So 105 minus 4. How much? 101 is the fair value. Don't deduct transaction cost. So here fair value is 101. Guys, this is where most of the students doing mistake. I am telling you, transaction cost will be deducted only to determine which market is advantageous. But to determine the fair value, sale price minus transport. Why transaction cost is not deducted to determine the fair value? You want to know the logic or not? No need, sir. You want? Why? Come on, tell me. Why we are not deducting this transaction cost from the fair value? Because see, logically if you speak, sir, this transaction cost we won't deduct it because the accounting treatment for this transaction cost is covered in the respective Indian accounting standards. What to do this transaction cost? Sometimes this transaction cost will be, this transaction cost, whatever happens, will be added to the asset. Sometimes it will be treated as normal expenses. What is the treatment of it depends upon the respective accounting standard. That's why this standard is not saying anything. You understand, guys? What I am telling is transaction cost we don't deduct to arrive the fair value. Why? Because transaction cost accounting treatment is covered in other standards. That's why this standard is not telling anything. This standard simply saying when you want to determine the fair value, selling price minus transportation cost. That's it. You will get the fair value. Hello? Because see here. Okay. So tell me now. Come on. So far what we discussed, you understood? Tell me how to determine the fair value. First preference. First preference. Come on. Systematic. First preference. Principal market. What is the principal market? Highest volume, not price. Highest volume. In principal market, how to determine the fair value? Price minus transportation cost. Transportation cost we have to deduct. Next, suppose principal market not there, then most advantageous market. Which is most advantageous? Maximum. Maximum amount for the asset, minimum amount for the liability. That is the advantage. How to determine? Selling price minus transportation cost, transaction cost. Then you will see, compare most advantageous. Once you determine the most advantageous market, how to determine the fair value? Sale price minus transportation. Will you deduct transaction cost? No, because it is covered in other standards. Your aim is only to determine fair value, not give the accounting treatment for transaction cost, because when there is a specific Indian accounting standard is there, don't apply this standard. See, in accounting standards, always follow the rule. When there is a specific accounting standard, we need to follow that. Don't follow general standard. This transaction cost accounting treatment is covered in the respective Ind AS. So therefore, this standard does not bother about it. So that's why here I have written, see this, in classroom, two-step procedure. First, find the most advantageous market. How to find out? Sale price minus transaction cost minus, sorry, transportation cost minus transaction cost. How to find out the fair value? Sale price minus transportation cost. Don't deduct transaction cost, because the transaction cost is covered in the respective Ind AS. Can I tell you one thing? Crux of the standard is done. Over. Crux is over. If at all they will ask a question, I will tell you the last examination question. I think June 2024 they have asked one question, sir. See how easy, once you know these concepts, if you listen to me carefully, I think yeah, come to June 2024 examination question, sir. See this question, everybody. 7 marks they tested this question, sir. Focus. A machinery is sold in 2 different active markets at 2 different prices. You have to tell me answer. I think you easily will tell. I am very confident about my concept. So there is a machinery, sir. This machinery is sold in 2 different active markets. RAM Limited enters into a transaction in both the markets and can access the prices in those markets for the machinery at the measurement date. The details are given. Market X, price that could be received is 26. If they sell this asset, they are going to receive 26,000. Transaction cost in the market 3,000. Transaction cost to transport the machinery to the market 2,000. Transportation cost 2,000. This is market X, sir. Market Y, the price that could be received is 25 if I sell. Transaction cost 1,000 and transportation cost 2,000. Based on the above details, you are required to calculate the fair value of machinery if market X is the principal market. Tell me, here how many markets are there? 2 markets. I am selling an asset, machinery. Suppose in this market X is principal market. If there is a principal market, how to determine what is the fair value? Selling price minus transportation cost. In market X, what is the 26,000 sale value minus transportation cost? You need to deduct 2,000. 26 minus 2. That's it, sir. 24,000 is the answer. You have to write in examination that as per Ind AS 113, if principal market is there, principal market is the place where highest volume of transactions happen. In case of principal market, the fair value is sale price minus transportation cost. So in the given case, X is the principal market, so sale price is 26 minus transportation cost 2, 24,000. You will get full marks. Next, this is the first. Once they given principal market, will you see market Y? No need to see. If there is a principal market, no need to go for advantageous market. So that's it, answer is over. Now come to second bit. Fair value of the machinery if neither of the markets is principal market. So that means X is not a principal market, Y is also not principal market. So when principal market is not there, what we need to do? Advantageous market. Most advantageous market. Which one is most advantageous? Tell me, X or Y. How to determine? So I told you, for example, you take X. Tell me X. First sale price in X 26 minus transportation cost. How much? XX 3,000 minus transaction cost. Transaction cost. X transportation cost 3,000, transaction cost 2,000. Correct. Right. 21,000. This is the amount. Come to Y. What is the sale price of Y? 25. What is the transaction cost? Transportation cost. Transportation 2,000 is the transportation. transportation cost 2000. Transaction cost, how much? See, both are looking transportation, transaction, don't confuse it. So here most of the students will confuse that. Correct only. No. This is transaction cost. This is transportation cost. First I reduce transportation only. Because theory, that is what we discussed. Na? In my theory also, first I have given what a transportation. That's why I have taken transportation. Okay. Okay. Either one, not a problem. Because amount will not change. Na? Whichever one you reduce. But when you are finding the fair value, don't reduce transaction cost. Reduce only transportation cost. That one you do correctly. Okay. This one 20. Tell me which one is Y is advantageous for me. So advantageous market is Y. How to determine the fair value? Simple. In Y, what is the sale price? 25. Minus which cost? Transportation. Transportation cost is 2000. So 20. That's it. 23,000 is the fair value. So the second bit answer is 23,000. See this. Compared first. So we got 23,000. So this question they tested for 7 marks. Tell me, is there any difficulty? No, only common sense. If you know the provisions of 113, I think this will be over. Hello, are you following? Now, important thing, sir. So, to determine the fair value, principal market, most advantageous market, in these two markets, how we are going to decide, determine, I explained. Now, one more important concept, sir. Fair value of non-financial assets. Important, listen to me very carefully. There is a question relating to this also, possible. Sir, here you look at this, fair value of which assets? Non-financial assets. Financial assets, non-financial assets. Non-financial assets means normal, tangible, fixed assets. Like for example, PP, intangible assets, investment property, all these things. Investment property means investment in land, buildings, all those things. For example, this building is there, sir, PP. This is non-financial assets. When you are determining the fair value of this non-financial assets, the standard is telling some extra criteria. What the standard is telling is, whenever you want to determine the fair value of this kind of non-financial assets, you need to follow highest and best use approach. What is that? Highest and best use approach. While measuring the fair value of non-financial assets like PP, intangibles and investment property, the entity shall consider the highest and best use. This building, highest and best use. What is meaning of highest and best use? Highest and best use means the possibility which will give me highest value for this asset. So when I am finding the highest and best possible use of the asset, three things I need to consider. Important, sir. Highest and best use means the use that results in highest value of the asset. And the highest and best use takes into account the use of the asset, that is physically possible, legally permissible, financially feasible. You remember these three words. Physically possible. Second one, legally permissible, financially feasible. These three things. So, after considering these three possibilities, physically possible, financially possible, feasible, legally allowed, permissible. If after considering these three things, what is the best use I am going to do? What is the highest possible value I am going to get it? That will be the fair value of that asset. For example, this building is there. Now I want to convert this building into a restaurant. That is my option. First I need to see physically possible. Possible, sir. Legally permissible to convert this into restaurant. Government will give permission or not. Financially feasibility are there. So after converting this into restaurant, is it financially feasible? I need to consider all these things. After considering all these things, okay, what is the best use? Shall I keep this like this asset only, or shall I convert this into restaurant? Or for example, here I need to construct an apartment, or some people suggested you convert this into a restaurant. Some people suggested you construct a apartment, sell it as a residential flats. Which one is advantageous for me? I need to see all these things: physical feasibility, financial feasibility, legal permissibility. After considering all these things, which one is better for me? That is the fair value. Okay, after getting permission, for example, I will give you one beautiful example, sir. I framed this example. Say this: suppose there is a piece of land located near an upcoming metro corridor in Hyderabad. Suppose Hyderabad, upcoming to near metro project, there is one piece of land is there for our company. Legal permissible. See this: the land is currently classified as industrial land. What is the present status of the land? Industrial land. But local authorities permit conversion to residential mixed use development. If you apply, you can convert this industrial land into residential also. Government will give you permission. That means legally permission allowed to convert into residential complex. Hello. Physically, you see, the land is very large, level and well connected to highways and metro stations, making it suitable for high-rise residential apartments, IT offices or shopping complex. So physically possible, yes, the land is big, level, well connected. Therefore, I can construct residential complex or IT office. I can construct. So that means physically also possible. Financially feasible. See this: developing an IT office park may generate steady rental income. However, high construction cost and long vacancy periods may reduce overall returns. Maximally profitable. After evaluating all alternatives, industrial use, IT offices, residential apartments, it is found that residential apartments provide the highest net value due to strong housing demand and comparatively low development cost. See, you see, legally permission given to convert into residential flats, and physically also possible, financially feasible. But financially, what they are saying, if you construct IT parks, it will take a lot of time to construct, and high construction cost will be there, long vacancy periods will be there. So better you go for what? Residential, because that will give the highest possible use for that land. Therefore, we need to determine fair value based on that. How much value I am going to get if I convert into residential projects? That will be the fair value of this land. Beautiful point. Actually, this is one of the very, very important things. So whenever you are determining the fair value of what? Fair value of the non-financial assets like PPs, intangible assets, industrial investment properties. Tell me what we are going to see: highest and best use. What is highest and best use? Which use will give the highest value? So when you are considering the highest value, you need to take into account three things: legal, financial, physical. All these three things you should consider, and whichever way workouts, based on that you decide. That is the best possible use. Okay. Relating to this, sir, one beautiful question there, sir, in the study material. Important question. Maybe this question not tested it. Maybe there is a possibility that they can test it. See this question, sir. Sir, there is a company Dawn Limited, sir. This company has 1 acre of land with an old building beside a river. So there is a river, sir. Beside the river, this company is having 1 acre land with one old building is also there. Currently the property is used as holiday resort, and the market value of the property is 2 crores for land, 0.5 crores for the building. So that means there is a vacant land, there is a old building. Presently they are using it for resort. What is the market value of the land? 2 crores. What is the market value of the building? 0.5 crores. However, Dawn Limited has also contemplated the idea of converting the property into an amusement park, for which the existing building has to be demolished and many new small instructions and other developments to the above to the land have to be made. See, they want to convert these holiday resorts into amusement park. If they want to convert this into amusement park, first of all the existing building has to be demolished and number of small buildings has to be constructed. Okay. The management found this alternative use of the property to be physically possible. Physical possibility is there. Legally permissible is there. Financially more viable. So highest and best possible use. How to find out? Physical, financial, legal. All possible to convert into amusement park. Okay. But you see, the market value of the land for its potential use as an amusement park is estimated at 4 crores. See this. Actually, what is the market value of the land as a holiday resort? 2 crores. But if I convert this into amusement park, the market value will become 4 crores for the land. Cost of demolition of the old building, erecting other constructions and making other developments for converting the holiday resort into amusement park are determined at 80 lakhs in total. So to demolish the old building, to construct the small constructions to convert into amusement park, how much cost I am going to incur? 80. Okay. The management is confused about the fair value of the property. They are confused about determining the fair value of the property. They asked for opinion of the professional accountant. You are the professional accountant in regarding to the following alternative propositions. So they are giving you alternative propositions here. Now you tell me which alternative is correct. So first one, here the main thing is what's the determination of fair value of which asset? Non-financial assets, land, old building, two things. See the first one, the property fair value under its current use as a holiday resort should be the market value of 2.5 crores. So they want to determine the fair value of this property. They are saying first choice, at present what is the market value of the land? 2 crores. Building 0.5. So total 2.5. So they are saying fair value is 2.5 crores. Is it correct? 2.5 crores is the fair value of this thing. Is it correct? What I told, highest and best possible use. Suppose right now it's a holiday resort. Suppose if I convert into amusement park, legally permissible, financially permissible, everything is there. So whatever the existing values are there, they are not fair values now. What is the highest use? If I convert this into amusement park, what is the value? 4 crores. 4 crores is what? Land value. And development cost 80. So 4 crores minus 80. So therefore 3.2 should be the value. But they are saying 2.5. So it is not correct now. Because this is not the highest possible use. Highest and best use. You understanding guys? Highest and best use only, based on that you need to determine the fair value. What is the highest and best use of this property? Converting into amusement park. If I convert into amusement park, my land value will be 4 crores now. And legally, fees, financially, everything is allowed. Hello? First proposition, we are not allowing it. So current use of the property is not the highest and best use. Hence, based on current use, the market value of 2.5 crores is not acceptable as fair value. Second choice, they are telling the property fair value should be the market value of 4 crores for the land's potential use as amusement park. They are saying fair value is only 4 crores. That means if I consider fair value 4 crores, which is I am forgetting? That 0.8 crores. 80 lakhs development cost. That also I should consider, na? But they are forgetting it. So therefore 4 crores is not a fair value. Because the market value of 4 crores for the land's potential use as amusement park is not acceptable as fair value at the reporting date, as redevelopment conversion cost is not adjusted. Sir, to convert this holiday resort into amusement park, 0.8 crores I need to incur, na, sir, 80 lakhs. That cost you are not adjusting, na? Therefore, you are not saying highest and best use of the asset. So 4 crores is also not correct. Next, third choice. The property's fair value should be 4.5 crores, being the market value of 4 crores for the land's potential use as amusement park plus the market value of the building. Is it correct? 4 crores land value if they convert in amusement park. Old building 0.5, which is correct. Now see, to convert into amusement park, that old building has to be demolished. So therefore that 0.5 crores is not a value for us. So therefore this is also not correct. This choice is also not acceptable. Next, fair value of the land is 3.2, being the market value for the land's potential use as amusement park 4 crores less the total conversion cost of 80 lakhs, and the fair value of the building should be 0.5. No. 3.2 plus 0.5 they want to consider. Is it possible? No. Because they have to demolish this. So this is not a value. This is also not acceptable. And last one, the fair value of the land should be 3.2 and the fair value of the building should be nil. So last one is correct. Correct, sir? Building value will become 0 because you destroy it. And what is the fair value of the land? Is it 4 or 3.2? 4 minus development cost adjusted. So I think the fair value of the land is 3.2, being the market value of the land's potential use as amusement park less the conversion cost. So the adjusted market value of the potential use of the property being the greater than the market value under the current use. Based on the best and highest use, the adjusted market value of the potential use has been recognized as fair value. So this is the important thing. So this type of questions they will ask you. So you understand this? Highest and best use. Highest and best possible use you need to consider when you are determining the fair value of the assets. Okay. So this is the maximum, this is the main crux of this Ind AS 113, sir. Now apart from this, one more important question is there. Let's solve that question directly, sir. This question, sir. See this question. Problem number 2 from study material, sir. Very good question. There is a company, Dust Limited, sir, has an equity investment in Dark Limited shares. This company has invested in shares of Dark Limited. Asset nothing but investment in shares. And accounts for the shares at fair value through P&L account. Dark Limited shares are quoted where, sir? BSE, Bombay Stock Exchange, and in Japanese exchange group. This company where we invested, these company shares are trading in BSE as well as Japan Stock Exchange. On 31st March 2022, Dark Limited shares is closed at 780 in BSE and at equivalent to 875 in Japan Exchange Group. However, significant activities on the shares being done in BSE only. Now, can you tell me here? Dust Limited is having what? Investment in Dark Limited shares. So, here the asset is shares. How to determine the fair value of these shares? First, principal market. What is the principal market here? BSE. Because principal market means highest volume. Here significant activities are going on where? BSE. So therefore I need to consider principal market. The accountant of Dust Limited argues that fair value of the share in Dark Limited should be measured based on the market approach, and the quoted price in Japan Exchange Group being higher is considered as level 1 input. Accordingly, fair value is determined at 875. Our accountant says in Japan Stock Exchange it is 875. So we need to follow market approach. Which one is most advantageous? So the fair value is 875 is saying. Is he correct? No, wrong. Because the standard says principal market, first preference. Principal market means highest volume. Where highest volume is happening? BSE. In BSE what is the price? 780. So fair value is 780. Second, after market closed on 31st March 2022, Dark Limited announced news of some bad events that occurred during the day, and in the next morning Dark Limited shares opened in BSE at 645 and equivalent to 713 Japan Stock Exchange. Sir, immediately after 31st March 2022 some bad news happened, sir, in the company, and because of that bad news the share price decreased. In BSE the share price is 645. In Japan Stock Exchange it is 730. The accountant of Dust Limited sticks to the fair value of 875 per share on the argument that it is based on the input level 1 quoted price in the active market on the measurement date of 31st March 2022. But accountant is saying that irrespective of the bad news, decrease in assets, we will stick to only 875. That is the price in the Japan Stock Exchange. Examine the validity of the arguments of the accountant of Dust Limited and determine the fair value of the share in Dark Limited with reference. First of all, argument of accountant. First argument correct or wrong? Wrong. So the argument of the accountant that higher of the quoted price shall be taken as the fair value is not tenable as the most advantageous market can be considered only in the absence of principal market. So therefore, since the significant activities on the shares are being done only in BSE, BSE is the principal market and the quoted price of BSE is what? Level 1 input for fair value measurement. That 780 should be the fair value. Hello? Second argument. Sir, actually this company has some bad news, because of that share price decreased. But he is saying 875 should be considered. Again, the accountant argument is not tenable, as the quoted price does not faithfully represent the fair value on the measurement date due to the bad news announced after the sale of the close of the trading. Dust Limited should adjust the quoted price for the news information and measure the fair value at 645, which is the price in the BSE. How much? 645 after the bad news. Only this one should be considered, and disclose the measurement as level 2 input. Actually, Ind AS 113 says, sir, always level 1 input. What is level 1 input? Price from the market, principal market. If that input is not available, or what, sometimes the modifications will happen to that input. What happens is, we considered price in BSE, but immediately after that day closing, trading closing, bad news happened, share price decreased to the next morning. Therefore, we need to consider that information and adjust the level 1 input. Then the information will become level 2 input. Therefore, now the fair value will become 645. So 780 will become 645. Don't consider Japan, because principal market BSE, that price is 780. Now the level of input changed to level 2. No problem. We need to make an adjustment to the original fair value. That's it. So you cannot change it. So this is one question, sir. If at all they ask, I think you can write it now. So both the cases he's wrong. So you have to remember, the principal market is the most important market. Only in the absence of principal market you go for most advantageous market. This is Ind AS 113. So that theory only I have given here. Fair value hierarchy, level 1, level 2 inputs, level 3 valuation techniques like this is there. But crux of the standard is this. And if you learn this much, I think it is sufficient. Okay. The next Ind AS we are going to cover is Ind AS 23, sir. Ind AS 23 talks about borrowing cost. Sir, what is this Ind AS 23 is all about? See, generally any organization you will take, when they want to acquire assets or when they want to build assets, they require funds. Now obviously they will collect funds through borrowings. Most of the cases borrowings. Of course they will issue shares, they will issue debentures. Debentures is also part of borrowings. They will take bank loans. So different ways a company will collect the amount, business will collect the amount to build assets, to acquire assets, because assets requires huge amount. So definitely own funds may not be available. So we need to depend upon the borrowings like debentures, bank loans, public deposits, bonds, cash credits, bank overdraft, working capital loan. Like that, for different ways we will source the amount from the borrowings for assets. Now the question arises, sir, tell me whether any borrowings will come freely. When you take, suppose for example, bank loan, will bank give loans freely? No, you have to pay interest. And also some borrowing cost will be incurred at the time of borrowing, like processing phase, application phase, commitment phase, like that. So similarly debentures, suppose if a company issued debentures, we have to pay interest to the debenture holders. Like that, when you take any borrowings from outside, definitely you have to incur some cost. Now the question arises, these cost, what we are going to do? These interest cost, what you are going to do? Will you add to the assets, because you are using these borrowings for acquisition of assets or construction of assets? Will you add them to the assets, or will you treat them as normal revenue expenses and charge it to P&L account? Actually, this standard is going to address that. So the main crux of Ind AS 23 is whether the borrowing cost is capitalized or is it charged to P&L account. Generally interest we will treat it as normal revenue expenses and we will debit to P&L account. But is there any case this interest borrowing cost will be capitalized? Yes. So this standard says the borrowing cost doesn't mean only interest. Any other expenses you are incurring in connection with borrowing of funds is also borrowing cost. Generally, when you take any loan from a bank, application fees, processing fees, commitment fees, different kind of fees you pay, that is also borrowing cost according to this standard. So this borrowing cost, if it is directly related to acquisition, construction, production of which asset? Qualifying asset, then you capitalize it. If it is not a qualifying asset, then you treat it as a revenue expenditure and charge it to P&L account. Therefore, when interest expenses will be capitalized, if the borrowing costs are directly related, they must be directly related. Related to what? Acquisition or construction or production of qualifying asset. So if you are producing, if you are acquiring, if you are constructing a qualifying asset with the borrowed funds, whatever the borrowing cost you are incurring on those borrowed funds, they will be capitalized to that asset only. Now when it comes to the capitalization, sir, when you are going to start capitalization, when you are going to stop capitalization, how much amount you are going to capitalize? These questions will arise. So this standard is going to address all these things. So you understand? So borrowing cost directly related to acquisition, construction, production of which assets will be capitalized. Now here they use the word production also. That means they are indirectly referring even inventory can also become your qualifying asset. Because generally the word production is used for inventory. We produce. That means whatever the inventory we are producing, if that inventory is a qualifying asset, then for inventory also we will add interest cost. Generally for inventory cost, interest will not be added. But if the inventory will become a qualifying asset, then interest cost will also be capitalized to the, if the interest cost relating to the inventory will also be capitalized. But remember guys, there should be borrowings, and on those borrowings, borrowing cost incurred, those borrowing cost is directly related to this qualifying asset. Then only it will be capitalized. Sir, I have taken a bank loan, sir, but I have not utilized it for this asset. Can I capitalize? No. There should be a connection, direct connection between the borrowing cost and the qualifying asset. If this cost is directly relating to this asset, if this asset is a qualifying asset, then only you will capitalize. So therefore here, what is the main crux here? When an asset will become a qualifying asset? Because I am saying if it is a qualifying asset, you capitalize. But the question is when an asset will become a qualifying asset? Actually, if you look at the standards, sir, very, very important. The standard says what is qualifying asset? Ind AS 23 says qualifying asset is an asset which takes substantial period of time to get ready for intended use or sale. Substantial period of time. Any asset that necessarily takes substantial period of time to get ready for intended use or sale, that is a qualifying asset. Necessarily it should take. You should not prolong it. Necessarily it should take. How much period it should take? Substantial period of time. What is substantial period of time? Not given in the standard. AS 23 does not provide any guidance on what constitutes a substantial period of time. They said that the substantial period of time depends upon the facts and circumstances of each case. Why, sir? Why? Now you understand the beauty of the standard. They are saying borrowing cost directly related to acquisition, construction, production of a qualifying asset is capitalized. They are saying what is qualifying asset? Asset will take substantial period of time, but they are not defining what is substantial period of time. Why? It depends on facts and circumstances, because they know if they define any time limit, every businessman will try to drag the construction of that asset, will try to get that asset into use. Definitely he will take that much period of time, because capitalization is allowed now. If it is a qualifying asset, we can capitalize. Instead of charging it to P&L account, if I capitalize, what happens? Asset value will increase. My profits will also increase. Na? Instead of charging to P&L account, I am adding to the asset. That's why they don't want to give that choice to you. They are saying that's why it depends on facts and circumstances. So what is substantial period of time? Standard is silent. Depends on facts and circumstances of each case. Sir, this is even more dangerous, sir. Facts and circumstances. No, this is only correct. Because suppose, for example, imagine if standard says 12 months is a substantial period of time. What everybody will do? Even though it is not necessary, they will take 12 months time to ready this asset, just to make it as a qualifying asset and to capitalize. Suppose for example there is a plant and machinery. Okay, it taken 9 months only. But suppose if the standard has given 12 months time, that means they lose the benefit of capitalization. Why they are losing it? Because they have done this installation within 9 months. They made the asset ready for use within 9 months. Why? Because of the latest technology, because of using of more number of labor, they do it 9 months. But the standard, if it says 12 months, they are losing the benefit now. Because what? They have done nothing wrong now. They used more labor, latest technology. Instead of 12 months, they completed in 9 months. For that purpose, they cannot lose the benefit of capitalization. So that's why the standard has not defined anything. They said depends on facts and circumstances. That means even if you completed within 9 months, no problem. Still it is a substantial bit of time, you can capitalize. So don't take the disadvantage of these wordings. Hello? And can you give me examples of qualifying assets, sir? Any manufacturing plants, power generation facilities, any intangible assets, investment properties, bearer plants, inventories, anything which takes substantial period of time. Even wine, sir, wine will take substantial period of time to get ready, na, sir. 10 years wine, 12 years wine, 15 years wine, they say. So that is also, wine is also become qualifying asset. Suppose if I'm a manufacturer of wine, so wine is a qualifying asset for me because it will take substantial period of time to get ready for intended use or sale. So therefore, whatever the borrowing cost directly related to the production of the wine, I can capitalize instead of charging it to P&L account. So therefore, any asset, for example, my company is constructing this building. So this building is a qualifying asset because it is taking substantial period of time to get ready for intended use or sale. But what is substantial period of time? They have not depend on facts and circumstances. So there is no fixed limit. This much time taken, it is called substantial period of time. But in general, in the market, they say, the expert says 12 months is the substantial period of time. The 12 months is just a, just a benchmark. It is not a conclusive yardstick. Please understand. And which are not become qualifying assets, sir? Any asset by nature it is ready for use is not a qualifying asset. For example, I purchased a car. Is car will take substantial period of time to get ready for use? No. Immediately I can use it now. So car is not a qualifying asset. So any asset which is already ready for use is not a qualifying asset. Like for example, any financial assets, investment. I invested in shares. Shares is what? Is it taking substantial period of time to get ready for use? No. So today I purchased shares. I can sell tomorrow also, na? So shares are readily available asset, easily transferable from one person to another person. Hello? Inventory is produced over a short period of time. Suppose I am manufacturing calculators. Every day I am going to manufacture 10,000 calculators. That means these calculators are ready for use immediately. Large quantities I can manufacture. They are not qualifying assets. Assets ready for intended use or sale when acquired. When the asset is by nature ready. For example, our company purchased one crane. Readily available now, I can use the crane immediately. So that is not a qualifying asset. So qualifying asset character means it is not ready for use. It will take substantial period of time to get ready for use. Then it will become what? Qualifying asset. If it is a qualifying asset, the borrowing cost directly related to qualifying asset is capitalized. Otherwise charged to P&L account. Now the question arises, sir, what is borrowing cost? I told you, interest. Only interest, sir. No, any other cost which is incurred in connection with borrowing of funds. Hello? Incurred in connection with borrowing of funds is also borrowing cost. Not only interest, sir. Any other cost which is incurred in connection with borrowing of funds is also borrowing cost. Like I told you, application fees, processing fees, all those things. Okay? Like for example, interest expenses calculated using effective interest rate method, finance charges on finance leases. Whenever we take any asset on lease basis, we pay interest. Lease rentals includes interest also. Those are called finance charges. They are also borrowing cost. Especially if the lease is which lease? Finance lease. And also this is important. Any exchange difference from foreign currency borrowings, to the extent they are treated as adjustment to interest cost, they may ask this in examination. I'm going to explain this. Wait. Any exchange difference arising from which borrowings? Foreign currency borrowings. To the extent they are recorded as adjustment to interest cost. Remind me, I'm going to explain this at the end. Okay. So I explained qualifying asset. I explained borrowing cost. What is borrowing cost? Interest or any other cost incurred in connection with borrowing of funds. Okay. And this standard is applicable for borrowing cost, sir. But one important thing, sir, This standard does not deal with the actual or imputed cost of equity, including preference share capital not classified as a liability. See, any cost you are incurring on the equity shares, preference shares, either actual cost or imputed cost. Imputed cost means opportunity cost. You are going to incur on equity, including preference share capital, is not considered as borrowing cost. For example, you issued equity shares. At the time of issue of equity shares, any cost you incurred, cost of issue, that is not a borrowing cost. And also, for example, dividend paid on equity shares. When you pay any dividend on equity shares, that is not a borrowing cost. Any cost of preference share capital not classified as a liability. For example, there is a preference share capital. Generally, preference share capital, where we will show in balance sheet? Equity. I mean, as a part of share capital, we don't show it as liability. But if you have done preference share capital as a liability, if you classify preference share capital as a liability, then even preference share capital is also borrowings, and on that preference share capital you pay any preference dividend, that will become borrowing cost. Important, because the standard clearly says including preference share capital not classified as a liability. Okay, and this Ind AS is not required to apply on borrowing cost for qualifying asset measured at fair value. Suppose if any qualifying asset is measured at fair value, example biological assets, generally as per Ind AS 41 we will measure at fair value. When you measure any asset at fair value, so we don't apply this standard, cannot apply this standard, because already it is measuring at a fair value. And also important, any inventory is manufactured in large quantities on repetitive basis. See, when you produce inventories in large quantities in repetitive basis, so they will not take substantial, even if they take substantial period of time, that you cannot apply this standard. Why? Because you are manufacturing in large quantities, number of items you are manufacturing in a repetitive basis, so it is very difficult to apply this standard, so don't apply this standard. Okay, but main crux, you remember this principle. So can you repeat what is the main principle of Ind AS 23? Borrowing cost directly related to acquisition, construction, production of which asset? Qualifying asset is capitalized, otherwise charged to what is qualifying asset? It takes substantial period of time to get ready for intended use or sale. What is borrowing cost? Interest, any other cost incurred in connection with borrowing of funds. Which are not borrowing cost? Any actual or imputed cost on equity, including preference share capital, not classified as a liability. Any expenses you incurred at the time of issue of shares, any dividend paid on equity shares, any dividend you paid on preference share capital, if it is not classified as a liability, don't consider them as a part of borrowing cost. Now, okay, so there is a borrowing cost, there is a qualifying asset. So we want to capitalize it. From which day onwards you start capitalizing? Commencement of capitalization. So three things here important: commencement of capitalization, suspension of capitalization, cessation of capitalization. That means when you are going to start the capitalization, when you are going to suspend the capitalization, when you are going to stop the capitalization, because there should be an end point for capitalization of interest cost. Now you cannot keep on capitalizing, because generally borrowings will be taken for 10 years, 20 years. For 20 years you will capitalize to asset, because asset will have a limited life. So therefore there should be a stop, ending point for capitalization. So there should be a starting point, there should be an ending point. In between sometimes we will suspend capitalization. When we suspend capitalization means during that period whatever the borrowing cost is there, we will charge it to P&L account. So therefore we have only two options: either borrowing cost will be capitalized to the qualifying asset, if it is not possible, charge it to P&L account. Okay, now sir, when you are going to commence capitalization, important sir, listen to me. Sir, the standard says three conditions must be satisfied to start capitalizing of borrowing cost. What are the three conditions, sir? First condition, expenditure being incurred on qualifying asset. You need to incur expenditure on qualifying asset. For example, I am constructing this building. I started incurring expenditure on this construction of this building. First condition satisfied. Second, borrowing cost being incurred. Already I have taken borrowings from the banks, loan from the bank, or I issued debentures, whatever. Borrowing cost is incurred, already incurred. Next, activities must be in progress. Already the activities are in progress. Sir, here activities means important, sir. Either physical construction of the asset must be going on, or substantial technical and administrative work is going on. Important. Activities in progress. Activities must be in progress means either physical construction is going on or substantial technical and administrative work is going on. For example, I am constructing this building, sir. See this. First thing I need to say, whether I incurred any expenditure on construction of this qualifying asset, building. Yes, first condition satisfied. Whether I have incurred borrowing cost, any borrowings I have taken on that, because when you take borrowings from day one, interest started accrue, borrowing cost being incurred. Third, whether activities are in progress, that is very, very important. Activities in progress means either this building physical construction is going on or technical and administrative work is going on. Important. Suppose physical construction not started, but technical work is going on. Designing, survey, administrative work. For example, we applied for local municipal government, municipal authority for construction, for permission. Already we applied. It is under process. That is also called technical and administrative work. So even though you have not started physical construction, still we can say activities are in progress if substantial technical and administrative work is going on. Important. So therefore these three conditions satisfied, then you can start capitalization of borrowing cost. Hello? So can you tell me when borrowing cost will be started? Capitalization will be started? Expenditure incurred on qualifying asset. Second, borrowing cost being incurred. Third one, activities must be in progress. Which activities? Either physical construction or technical and administrative work. What is technical and administrative work? Even without physical construction, some technical and administrative work means like survey, designing, or applying for approval, waiting for the approval. All these are called technical and administrative work. So they are also part of activities in progress. It is not just physical construction. So if following three conditions are said, all three must be satisfied. Then you can start calculation of borrowing cost. For example, you see here one example I have given. There is a company X Limited. They are starting one new construction project. 15th May 2021, loan interest relating to the project started incurring. That means borrowing cost incurred. Okay. 2nd June 2011, technical site planning commenced. What is technical site planning? Nothing but activities in progress. Activities in progress. Okay. 19 June 2011, expenditure on the project started incurring. So first condition, expenditure is incurred on qualifying asset. 18 July 21, construction work commenced. Identify the commencement date. So tell me, what is the commencement date here? First, when expenditure incurred on qualifying asset? 19 June 2011. Second, when borrowing cost being incurred? 15th May 2011. Correct? And when administrative technical work started? 2nd June. Physical construction started 18 July. All three conditions satisfied. When satisfied all three? Whichever is later we need to take. Correct? For example, first expenditure incurred on qualifying asset 19 June. Second, borrowing cost incurred 15th May. And last one you see activities in progress. Technical site planning started 2nd June. Actual construction started from 18 July. Whichever is, we need to consider 2nd June. Sir, activities in progress means either physical construction or technical and administrative work. Physical construction started 18 July. But even physical construction not started, technical sites commenced on 2nd June. So 2nd June, third condition satisfied. So therefore, all three conditions when satisfied, sir? 19th June. So 19th June will be the commencement date. Guys, three, whichever is later you have to take care. Simple. All three must be satisfied, na? You understand this one? Fourth and second. You understand the difference? Fourth is physical construction. Second is technical. Any one is sufficient. Which is started early? Technical, 2nd June. So that 2nd June, third condition satisfied. So you see all three when satisfied, dates you write, whichever is later will be the commencement date. Now, okay, suspension of capitalization. Okay, so you started capitalizing the borrowing cost. Is there any period you are going to suspend capitalization of borrowing cost? Yes, when the active development is interrupted. Sir, when the active development is interrupted, you are going to suspend the capitalization of borrowing cost. For example, labor strike happened, sir. You are constructing one building, labor strike happened, 15 days strike happened. Now within these 15 days, there is no activity going on. There is no construction going on. Activities are not in progress. Therefore, the standard says for these 15 days, whatever the borrowing cost is there, interest cost is there, that you cannot capitalize, you charge it to P&L account. But remember guys, suppose if there is a interruption in active development, interruption happened. But if that interruption is necessary, if that interruption is unavoidable, then the standard says you need not suspend, you can continue the calculation of borrowing cost. If that interruption is necessary, if that interruption is important for the next stage, then you need not require to stop the calculation, you can continue the calculation of borrowing cost. One beautiful example is there. Suppose we are constructing one bridge. Generally bridge is what, sir? Qualifying asset, because it will take substantial period of time to get ready. Bridge. Suppose because of high water levels, see there is a heavy rains happened in the monsoon season, heavy rains came. Because of the heavy rains, water levels increased. In the water levels increase, it is very difficult to construct the bridge. So therefore 3 months we stopped construction. Now you tell me, within these 3 months, whatever the interest accrued on the borrowings, will you capitalize to the building? Will you capitalize to the bridge, or will you charge it to P&L account? Capitalize. Why? Because here is the delay is unnecessary? No, delay is necessary. Because of high water levels, we stopped construction, which is absolutely necessary to stop the construction project for the next stage. So therefore, you can continue the calculation of borrowing cost. So therefore, when we are going to suspend the calculation of borrowing cost? When active development is interrupted. But if the active development interrupted because of reasons, unavoidable reasons, or if the delay is necessary part of the process, then you need not require to stop calculation, you can continue the calculation of borrowing cost. And this one, suspension of OPI. Now last one, cessation, important. Sir, okay, how long you capitalize this borrowing cost to the asset? Because if you keep on capitalizing interest cost to the asset, one day asset physically will not be there, but asset value will be there in the books now. Because if you keep on capitalizing, hello, that's why the standard says the end point is simple. When substantially all necessary activities to make the asset ready for intended use or sale are completed, you stop the capitalization. For example, take this building. Substantially all necessary activities are completed to make this building ready for intended use. Stop it, capitalization over. For example, plant and machinery is there. The substantially all necessary activities to make the use of this plant and machinery is over. Stop the calculation of borrowing cost. So substantially all necessary activities to make the qualifying asset ready for intended use or sale completed, then you can stop the calculation of borrowing cost. Okay. Suppose some routine administrative work is pending, no problem. Still it is considered substantially completed. Therefore, you can continue the you can stop the calculation of borrowing cost. You understand, guys? So 3 things I explained: commencement, suspension, cessation. Commencement, 3 conditions: expenditure incurred on qualifying asset, borrowing cost being incurred, activities are in progress, physical construction or technical administration work. Suspension, as when the active development is interrupted, suspend. But if the interruption is because of unavoidable reasons, which is necessary for part of the making the qualifying asset, then you can continue, no need to stop. Next, cessation, when substantially all necessary activities to make the asset ready for intended use or sale are completed, stop the calculation. But here one important thing, sir. Sometimes, sir, some qualifying asset we will construct in parts, and each constructed part can be used separately. Then the standard says you can cease calculation of borrowing cost part wise also. For example, we are constructing one building, sir. 5 floors building we are constructing. 5 floors. First 4 completed. And this completed 4 I can use separately. For example, 5 floors building, sir. First floor over. Second floor construction going on. But first floor I can use it. Separately I can use it. Therefore, the standard says the moment this first floor is completed, any borrowing cost relating to this first floor from the borrowed funds, whatever you used for this, so on that whatever the borrowing cost generated, na sir, you stop capitalization. You now onwards you charge it to P&L account because the capitalization condition is done. Remaining floors you can continue the capitalization. For example, second floor completed. The moment second floor completed, if it can be used separately, then capitalization will also be ceased. So therefore, if you can able to construct the qualifying asset parts, each completed part can be used separately, then you can cease the calculation of borrowing cost also part wise. Hello? But there are some assets, sir, even though you can able to construct it in parts, but you cannot use them separately. Then in that situation, don't cease the capitalization part wise. Continue till the entire asset is completed. For example, cement mill, steel mill are the best example. For example, you are constructing one steel mill or cement mill. Suppose this is the plant and machinery you are constructing. This is plant 1, plant 2, plant 3, like this. Each plant is connected with each other. Because in case of cement plant, all this input, output, output of this will be input for the second process. Like that it will go. It is a process manufacturing, processing. One input, one plant and machinery will give you one output. That output will be input for the second plant and machinery. Like that they will generate. So here you can complete part wise. Suppose I'm constructing this plant and machinery. This is first part, this is second part, this is third part. But the problem is, once you complete this plant and machinery, can you use separately? No. But this building I can use separately. So therefore the standard says, if it is a qualifying asset, you can able to construct it in parts, and the completed part can be used separately. Then you can cease capitalization also part wise. But if you construct part wise, but you cannot use it separately, then don't cease capitalization part wise. Continue till the entire asset is completed. That's it. So that's it, sir. I think we have completed all the three. So you understand? Hello? So commencement, suspension, cessation. When we are going to cease the capitalization part wise, tell me. You can complete part wise, use also part wise separately. When part wise but you cannot use it separately, then entire asset should be completed to cease the calculation of borrowing cost. So tell me in one line, when you are going to commence, three conditions. When you are going to stop of borrowing cost calculation. When the substantially necessary activities are completed. Look at the wordings. Those wordings are very important. In exams you have to write exactly like this. Substantially all necessary activities are completed, then you can cease the calculation of borrowing cost. Now the most important thing is, sir, okay, you told when we are going to capitalize. You told commencement, suspension, ceasing. But how much amount of borrowing cost we are going to capitalize? Next we are going to discuss the amount of capitalization. Very, very important. This is where the questions will come. Sir, important. Amount of capitalization. Sir, to determine the amount of capitalization of borrowing cost, how much amount of borrowing cost I am going to capitalize, borrowings are basically divided into two categories. Borrowings are divided into two. What are those? Specific borrowings, general borrowings. Important guys, listen to me. Specific, general. What is specific borrowing? The specific borrowings means exclusively borrowed for that particular qualifying asset. Suppose general borrowings means they are not borrowed for that particular qualifying asset, they borrowed in general but used for the qualifying asset other than specific borrowings. Okay, so specific borrowings, general borrowings. So specific borrowings exclusively made for that qualifying asset. General borrowings means other than specific borrowings. Okay, in case of specific borrowings, what will be the borrowing cost eligible for capitalization? Important, listen. Sir, if you are using specific borrowings for a qualifying asset, on that specific borrowings, whatever the interest cost, borrowing cost you incurring, that will be capitalized. Like for example, you see, here interest is computed on the entire amount of specific borrowings. Entire amount of specific borrowings from the date capitalization begins until the date of capitalization stops, without considering the different dates on which expenditure is incurred. Important. Sir, suppose I am constructing one building. Important guys. Suppose I am constructing one building. Company is constructing a building. Suppose 100 lakhs. Okay. We taken a bank loan. Okay. 1/4/2025 we taken a bank loan. 1/4/2024 we taken a bank loan. Suppose capitalization starts from 1st July 2025. So tell me what will be the borrowing cost? 100 lakhs into, suppose rate of interest 10%, into how many months you will take? You borrowed on 1st April, but commencement started on 1st July. So we will take from 1st July, not the date on which you taken the borrowings, because commencement of capitalization, three conditions must be satisfied, na? So it is satisfied on 1st July. So for 1st July we need to consider. So 9 months interest only we need to consider. Now here the interesting point is, listen, important. Sir, how much loan you taken? Suppose, will you use this 100 loans, 100 lakhs on the building on the same day? No, it is not possible. No? So this 100 lakhs you will use on different dates. So will you calculate interest every time you use the amount separately, or will you calculate the interest on the specific borrowings entirely? Entirely. Because these borrowings are exclusively made for qualifying asset. Therefore, no need to see out of these 100 lakhs how much amount I spend on the qualifying asset. Take 100 lakhs starting from the capitalization date, commencement date, till the asset completed, construction, cessation happened. You calculate the interest. Suppose 9 months this year. This year how much amount I need to capitalize means 9 months interest I need to capitalize. Because commencement started on 1st July. You understand the crux, important. So if it is a specific borrowings, what is important? Date of borrowing or date of commencement? Date of commencement. And is it important to see every time how much amount you spend from specific borrowings? No. Entire amount you take it and you calculate the interest. And sometimes what happens, sir, important, sir. This specific borrowings 100 lakhs you taken, sir. Will you use these 100 lakhs for the building at a time? No. Therefore, whatever the idle funds is there, this idle funds you will invest outside. You will get some income. Na? That income you deduct from the borrowing cost, only remaining amount will be capitalized. For example, here in this example I calculated the interest on 100 lakhs. How much came, tell me? 100 lakhs into 10%, 10 lakhs. 10 lakhs into 9 by 12. How much? 7.5 came. Suppose the idle funds are invested outside securities. We got 2 lakhs revenue. So 7.5 minus 2. 5.5 lakhs will be capitalized as a borrowing cost. This is possible only in case of. So in case of specific borrowings, the borrowing cost to be capitalized is actual borrowing cost incurred less investment income on temporary investment funds from the borrowings. Now, the most important, you understand specific borrowings? So tell me, in case of specific borrowings, how to calculate the borrowing cost? Specific borrowings into rate of interest into number of months. How many months you will take? Commencement date to the year end, generally divided by 12. Don't see when the borrowings made. See only commencement date. And don't see different dates when you are spending the amount. Take the amount and you calculate. And any income from specific borrowings you invested outside will be deducted. Next come to general borrowings. Important, sir. General borrowing cost. Sir, what is general borrowings? We are not made these borrowings for this particular asset. So, like for example, we issue debentures. From debentures, some amount is used for qualifying asset. We taken deposits. From deposits, some amount is used for qualifying asset. Like that, 3 or 4 different loans. Different borrowings are there. We used amount from those for this asset. Those are called general borrowings, not exclusively made for this asset. Okay. Now the standard says in case of general borrowings, first you need to calculate the weighted average capitalization rate. If more than one type of general borrowings is there, we need to calculate weighted average capitalization rate. One average rate you find out. How to find out weighted average capitalization rate? Very simple. Weighted average borrowing cost on outstanding general borrowings. General borrowings, you calculate the interest, outstanding interest on the general borrowings divided by total outstanding general borrowings. You calculate the interest on each general borrowing, make a total, divided by total outstanding general borrowings. You will get the weighted average capitalization rate. Once you got this weighted average capitalization rate, whatever the expenditure you are spending on the qualifying asset from the general borrowings, take that expenditure. On that you apply this weighted average capitalization rate into time weight. What is the expenditure you are spending on the qualifying asset? Expenditure into weighted average capitalization rate into time. Here the important point is interest is calculated separately for each expenditure you are spending. From the date on which such expenditure is incurred within the period of capitalization. Sir, important, sir. In case of specific borrowings, you are not seeing date. Just from the commencement date, you are calculating. But in case of general borrowings, every time how much amount you spend for the qualifying asset, from that day onwards, you need to calculate the interest. That means interest is calculated separately for each expenditure you are spending on the qualifying asset. Hello? So you understand? In case of general borrowings, how to calculate borrowing cost? Tell me. First you need to calculate weighted average capitalization rate. How to get weighted average capitalization rate? Borrowing cost for the outstanding, borrowing cost on the general borrowings divided by outstanding general borrowings. One rate will come, common rate. Borrowing cost is equal to expenditure on qualifying asset into weighted average capitalization rate into time weight. When you consider the time weight, in case of general borrowings, how much amount you are spending for the qualifying asset? For each spending, each expenditure, will you calculate interest separately or for the overall amount? Each one you need to calculate separately, because these are general borrowings, not specific borrowings. Therefore, on which date you are spending for the asset, from that date only interest will start accrues. So that's why interest is calculated separately for each expenditure you are spending. Hello? That's the important point here. Of course, I'm going to solve some questions. These are the concept questions here. For example, let me take one beautiful example on general borrowings. Sir, look at this general borrowings, everybody. Look at this example. With this, I think you will get the best understanding. Suppose, sir, there is a company, they have the borrowings. On 1/4/2024, look at the borrowings. These are general borrowings. Term loan, how much? Rate of interest? Bank loan, 13%. Debentures, 9%. Total borrowings, 300. We are constructing a building. Construction commenced on 1/4/2024. Construction completed, 1 year it taken. That means it's a qualifying asset. Okay. For the construction funds utilized, how the funds are utilized, sir? On 1/4/2024, how much utilized? 60. On 1/9/2024, 80. On 1/1/2025, 40. How much is the borrowing cost to be capitalized? First of all, tell me the given borrowings are which borrowings? General borrowings. I told you in case of general borrowings, first we need to calculate weighted average capitalization rate. How to calculate? Simple. Take the interest of each one. These borrowings are made on 1/4/2024. That means at the beginning. So therefore, interest you calculate first. How calculated, sir? See this. Term loan, amount, rate of interest, 120 into 11% for 12 months. How much, sir? 13.2 came. 120 into 11%. 13.2. How many months I need to take? 12 months we need to take, because the borrowings are made from the beginning. On 1/4/2024 only the borrowings are made. Second, bank loan, 90 into 13%. How much? 11.7. Debentures, 90 into 9%. How much? So therefore total interest, total outstanding borrowings, 300. 120, 90, 90. So 33 divided by 300. 11% is the weighted average capitalization rate. Now, so weighted average capitalization rate, I got it. Now look at the funds spending. First, how much spend? 60. When spend? 1/4/2024. So calculate interest. Expenditure 60 into weighted average capitalization rate 11% into how many months? 12 months, because expenditure spent on 1/4/2024. You are capitalizing on, calculating on 31st March 2025. So therefore, each expenditure you need to calculate interest. 60 into 11% into, so 12 by 12. How much? 6.6 crores. This is the interest, first interest. Next, how much we spend? 80. When we spend? 1/9/2024. Correct? Second time we spend 80 into 11% into how many months interest? 7 months interest we need to take, because this expenditure made on 1/9/2024. How much came? 5.13. And come to the last one, 1/1/2025 we spent 40. So 40 into 11% into 3 by 12. How much? 1.1. So total 12.83 crores. So the total interest to be capitalized 12.8. You understand? But here I will tell you one beautiful thing, sir. Listen. Suppose here these borrowings are made on 1/4/2024, right? Suppose these debentures borrowed on 1/7/2024. Then what happens? Tell me. See, suppose instead of on 1/4/2024, these two are borrowed on 1/4/2024. Suppose this is borrowed on 1/7/2024. The moment debentures is borrowed on 1/7/2024, what you are going to do is, see this. when you are calculating the interest here, when you are calculating the this one weighted average capitalization rate, you don't take 90. Instead, 90 into 9 months only you take it, because these general borrowings are made on which date? 1/7/2024. That means they are there in the business only for 9 months. So when you are calculating the weighted average capitalization rate, you take only for 9 months. That means you take it only for 67.5%. Accordingly, your answer will change. You understand? Important. Instead of beginning, if this is happens. Okay. Suppose suppose you see sir, same example, different example. This time there is a company, sir, they have made a specific borrowing. How much is the specific borrowing? 30. When they have taken? 1/4/2011. General borrowings 3, term loan, bank loan, debentures, date, amount, rate given. How the funds utilized also given. On 1/4/2011, 70 utilized. Obviously first they will use from specific, remaining from general. Next 80 general borrowings, next general borrowing. Even if they don't mention as, sir, first utilization shall happen from specific borrowings. Now in this case, commencement, construction, end, this is the year. Now we need to calculate how much amount of the borrowing cost to be capitalized. Now in this case, you see first specific borrowings is there, important. Tell me, how much is the specific borrowings? 40. In case of specific borrowings, how to calculate the interest borrowing cost? 40 into 11%. What is the commencement date? 1/4/2011. So therefore 12 months interest we need to take, correct? So therefore in case of specific borrowings, 40, 11%, 12/12, 4.4 crores. Now come to general borrowings, the most important. For example, in case of general borrowings, first I need to calculate weighted average. How to calculate weighted average rate? Here, borrowings, see this, for example 90 into 12% for total 12 months, because borrowings are made on 1/4/2011, this one, correct? Second one, 60 into 14% for 12 months. Last one, debentures, you take it, see this, 9 months only you should take it. Important. You understand why only 9 months here? Because the borrowings is taken on 1/7/2011. So therefore when you are considering for the weighted average, you should consider only 9 months average. So 22.2. So 22.2 crores is the interest total, this one. See here also you take here, when you consider the outstanding borrowings, 90, 60, don't consider 50. 50 into 9/12 you need to take, because these borrowings are came into the picture on 1/7. You understand what I am saying? You see here 37.5. This is where most of the students are doing mistake. They will take direct amount. In case of general borrowings, sir, you see when the borrowings are taken, from that day only proportionately you take it when you calculate weighted average rate. Here also interest corresponding, only 9 months we have to take. Are you understanding? How much weighted average rate came? 11.84. 11.84 came. Apply this 11.84 here, you will get the interest. So this is the amount to be capitalized. You understand? That's it, sir. So this is the amount, sir, amount of this one. And relating to borrowing cost, sir, I think So relating to this borrowing cost, sir, some questions are there. I think same questions just now we solved, no, sir. Similar type of questions easily you can solve, sir. Same pattern like general borrowing, specific borrowings. So in case of general borrowings, we need to take the weighted average rate. Accordingly, we need to do it. Okay. So that's it. Okay. So relating to Ind AS 23 borrowing cost, I told you I'm going to cover this point, exchange differences from foreign currency borrowings to the extent recorded as adjustment to interest cost. Actually, examples of borrowing cost. What is included in borrowing cost? Generally, we know interest is the borrowing cost. But there is a special point in Ind AS 23 which says any exchange difference arising from foreign currency borrowings, any exchange differences, in that exchange difference to the extent recorded as adjustment interest cost will also be considered as borrowing cost. Sir, what is this, sir? Let me explain you with one simple example. Suppose there is a company A Limited, which is an Indian company, A Limited. This company went for foreign loan, foreign currency loan they have taken outside India. How much they have taken? $10,000 they have taken. Rate of interest is 5% per annum. Date on which loan taken is 1/4/2025. On that day, exchange rate is $1 is equal to 45 rupees. That means if I convert this $10,000 into Indian rupees, 4,50,000. $10,000 into 45 rupees. 4,50,000 is the amount. Suppose, sir, you are an Indian company, right? Suppose if you borrow in India, what is the rate of interest? 11%. But you went outside, so 5% is the interest. Okay. Now you see exchange rate at the end become $1 is equal to 48. Sir, these exchange rates will keep on changing, no, sir. Exchange rate means rate between two currencies. $1 is equal to 45 rupees. At the end, $1 may become 48. Maybe less than that also. 45, less than 45 also. Whatever. Now the standard says on this $10,000 loan, exchange difference come na? The difference between the opening rate and closing rate. For example, 45 has become 48. That means 3 rupees difference came na? That means 3 rupees into $10,000, 30,000, your loan amount increased na? That is called exchange difference. Nothing but exchange loss. Exchange difference. There is a separate standard relating to it. Okay. So exchange difference, $10,000 into 48 minus 45. How much? 30,000. Generally, this exchange difference entirely will be transferred to P&L account. But the standard Ind AS 23 says, since this is borrowings, you may use this for qualifying asset. The standard says any borrowing cost directly related to acquisition, construction, production of qualifying asset is capitalized. Suppose if this foreign currency borrowings you used it for qualifying asset, how much interest you are going to capitalize it? See, normally on this $10,000, if I calculate the interest at the end of the year, what will be interest? Tell me. $10,000 into 5% interest into 48 rupees, because I am an Indian company, I have to convert into Indian rupees. 48 means exchange rate at the end. I am calculating interest at the end of the year. Therefore, my total interest will be 24. This is borrowing cost actually. This will be capitalized to qualifying asset. But the standard, one more thing they are allowing. They are saying that in this exchange difference, within this exchange difference, the amount which is treated as adjustment interest cost can also be treated as borrowing cost. What is this, sir? Suppose instead of borrowing outside India, if this $10,000 borrowed in India on 1/4/2025, that means 4,50,000 if it is borrowed in India, how much interest you are going to pay? 11%. So 4,50,000 into 11%, 49. That means the borrowing cost is 49,500, being an Indian company, but you are paying 25,000, 24,000. So how much you are missing capitalization? 25,500. That will be treated as adjustment to interest cost. The difference between interest in India, the interest outside India, that difference is called adjustment to interest cost. That adjustment to interest cost from this exchange difference will be treated as borrowing cost. That means from this 30,000, 25,500 will be treated as borrowing cost. Remaining only will go to P&L account as a normal exchange difference. That means they are giving benefit of capitalization to an Indian company. Absolute benefit. Suppose if they have not written this point, what happens? Tell me. This entire 30,000 will go to P&L account like a normal exchange difference. And borrowing cost to be capitalized is only 24,000. But by allowing this difference also, they are allowing a capitalization of 49,500 as if the amount is entirely borrowed in India. So being an Indian company, if I borrow in India, my borrowing cost is 49,500. Actually, that should be allowed for capitalization for the qualifying asset. That's why now they are treating it as the exchange difference. In this exchange difference, whatever the adjustment to interest cost, that will be treated as adjustment to interest cost. Do you appreciate this point? Very good point actually. Now you understand. So what is the total amount of borrowing cost to be capitalized in this case? 24 plus 25,500 total 49,500, which is exactly the amount borrowed in India, interest on amount borrowed in India. So therefore this is the concept, sir. This is one point I want to tell you. See, the meaning of this point is that now you read it, exchange difference from foreign currency borrowings to the extent regarded as adjustment to interest cost. So in our example, what is the extent difference? 30,000 arising from foreign currency borrowings. But whether entire exchange difference will be treated as borrowing cost? No, only to the extent treated as adjustment to interest cost. What is adjustment to interest cost? The difference between interest in India, interest outside India. That, sir, what if, my question, sir, what if for example exchange difference is 30, adjustment to interest cost is 35, then only 30,000 will be considered as borrowing cost. Only 30,000, because exchange difference maximum 30, sir, adjustment to interest cost came 35, sir, so we will allow 30,000 as a borrow. That means the maximum should be this one, exchange difference. Okay, that's it, sir. This is one point I want to clarify, because when I am discussing Ind AS 23 I have missed this. Now I have covered it. Okay, the next chapter we are going to cover is accounting for business combinations and restructuring, sir. Ind AS 103, one of the very important chapters in CFR paper. See, business combination and consolidation of financial statements both are interlinked, sir. First you need to learn business combination and then consolidation will follow it. Without having proper knowledge of business combination, it is very difficult to understand consolidation of financial statements. Okay. Now, before we are going to start and understanding the accounting treatment of business combination, there are certain basics you need to understand very well. Okay. Let me explain you that basics very well. See, before starting of this chapter I have given one table. This table is one of the most crucial table. Sir, what is this table is all about? It is about relationship between companies. Okay. Suppose, sir, there are two companies, S Limited, Infosys Limited. Now please remember them, because throughout the concept explanation I am going to use these company names. Okay, there are two companies, S Limited, Infosys Limited. Suppose Infosys Limited issued 10,000 equity shares. Okay, in this 10,000 equity shares, 1,000 equity shares are purchased by S Limited. So S Limited purchased 1,000 equity shares of Infosys Limited. S Limited point of view, this is investment in shares of Infosys Limited. How much is the percentage of investment? 10%. So it is a normal investment. How the accounting will be done? As per Ind AS 109. So it's a normal investment, sir. Suppose, sir, in Infosys Limited 10,000 equity shares, S Limited purchased 6,000 equity shares. Then what is the percentage? 60%. Any speciality here? The moment you acquired more than 50% in a company, you are getting control. So here S Limited purchasing 60% of the equity shares of Infosys Limited means here parent subsidiary relationship will also come into the picture. S Limited will be called as parent company or holding company. Infosys is called subsidiary company. So basically what is business combination? When one company is having control over another company. One company is having control over another company, that situation is called business combination. One aspect of business combination I am explaining you, easy way. Of course I am going to explore another way also. So first try to understand. So if I invest in a company more than 50%, obviously parent subsidiary relationship coming into the picture, that will be called as business combination. Now here S Limited, Infosys Limited. S Limited is purchasing equity shares of Infosys Limited. So S Limited is called a purchasing company. S Limited is called purchasing company, also known as acquirer. Acquirer, who is acquiring the Infosys Limited. Control we are acquiring. That's why we are calling it acquirer. Infosys Limited, which is selling. So it's a selling company or acquiring company, we call it as. Now, Ind AS 103, we are focusing on the accounting treatment of purchasing company, acquirer company. We are not bothered about accounting treatment in the books of acquiree. Ind AS 103 focuses on the accounting treatment of acquirer, purchasing company. So tell me in my example, who is the purchasing company? S Limited. So Ind AS 103 gives accounting treatment for S Limited, acquirer. In the context of consolidation, what is that? I am going to explain it. Okay. Sir, you are S Limited, sir. Imagine you purchased more than 50% in Infosys Limited, suppose 60%. So you are the parent company, S Limited is the parent company, Infosys is the subsidiary company. Now business combination happened. After business combination happened, as a S Limited, I am going to prepare two types of financial statements. S Limited will prepare its own financial statements. Call them as standalone financial statements. Generally, every year, every company will prepare its own financial statements. Right? We call them as standalone financial statements. Here, S Limited will prepare its financial statements. And when S Limited is preparing its financial statements, in the balance sheet, it will show investment in Infosys Limited as an asset. So the accounting for investment in Infosys Limited, the subsidiary, in the standalone financial statements is dealt by Ind AS 27. There is a standard called Ind AS 27 which will provide the accounting treatment for investments in subsidiary company in the standalone financial statements. So see, I am S Limited, I am a parent company. I prepare my own financial statements at the end of the year. When I prepare my own financial statements, in my balance sheet, I will show asset side investment in subsidiary company as my asset. How the accounting of that investment will be done? By following Ind AS 27. Generally, when I make investment, what is the entry, sir? Investment to cash or bank. So investment in equity shares of Infosys Limited to bank account I will write. Where this accounting is applicable? Where? Standalone financial statements. You understand this? So tell me, once business combination happens, as a parent company, I prepare first standalone financial statements. Standalone financial statements, irrespective of business combination, every company will prepare every year. But what is my specialty as an S Limited? Now I am a parent company of one subsidiary. So anyway, I'm going to prepare my own financial statements every year. In my financial statements, I'm going to show investment in my subsidiary as a asset. And how the accounting will be done? As per Ind AS 27. Now the most important thing, as a parent company, I need to prepare consolidated financial statements also. Sir, what is this consolidated financial statements? See, I am one company. Now I have subsidiary also. So my company, parent along with its subsidiary, how my performance, how my financial position is. So I need to prepare financial statements for the group. Being a parent company, as per law, it is required. I mean, it is as per law, it is required to prepare consolidated financial statements. So, because as a group, how we are performing? As a group, what is the financial position? For example, you see, I am S Limited. You are Infosys Limited. We both are two separate companies. You prepare your financial statements, I prepare my financial statements. But I acquired 60% shares in your company. Now you are my subsidiary. So at the end of the year, as a parent company, I have the responsibility to prepare financial statements for the group also. That is called consolidated financial statements. So consolidated financial statements is S Limited plus Infosys Limited. Because now subsidiary company assets, my assets. Your resources, my resources. So we together, how we are performing, that I want to prepare. That's why consolidated financial statements. So what is the basic difference between standalone and consolidated? Standalone financial statements exclusively for that company assets, that company liabilities. But your investment in other company will be there. As a parent company, your investment in subsidiary will be there. And that will be accounted as per Ind AS 27 in the standalone financial statements. First thing. Second, as a parent company, you need to prepare financial statement for the group also, because you are now individually you are one company, but as a group you are added with subsidiary also. So how you are performing as a group? What is the financial position as a group? So for that purpose, they are mandatorily required to prepare consolidated financial statements. So you see, standalone financial statements, I am focusing only on the S Limited parent company, but in CFS I am focusing on the S plus Infosys. Now the most important thing is, when I prepare consolidated financial statements for my company parent along with subsidiary, for day one means on the acquisition date. On what date I acquired subsidiary company, on that day, the very first day, as a parent plus subsidiary, I prepare consolidated financial statements for day one on acquisition date. For example, I acquired subsidiary company on 1st June 2025. So on 1st June 2025, as a parent company along with my subsidiary, I need to prepare consolidated financial statements. For that, you need to apply Ind AS 103. So Ind AS 103, when I will apply, it will be applied for preparation of consolidated financial statements on day one, acquisition date. On the date of acquisition, as a parent company along with my subsidiaries, I need to prepare financial statements. For that, I need to apply Ind AS 103. The accounting for consolidation will be done as per Ind AS 103. This is what we are going to cover in this chapter, Ind AS 103. Sir, as a parent company, you said on day one, on acquisition date, you prepare consolidated financial statement. For that, the accounting is covered in Ind AS 103. Yes. Every year, as a parent company, I need to prepare consolidated financial statements, like normal financial statement, like standalone financial statement. As a parent company, every year and I need to prepare consolidated financial statements. Once the initial acquisition date over, every year I am going to prepare the financial statements. Those are called consolidated financial statements at the end of the year, and for that I am going to apply Ind AS 110. There is a separate standard which talks about consolidation at the end of the year. That means once the consolidation over on day one, for day one apply Ind AS 103. Every year end Ind AS 110. That is the next chapter, consolidation of financial statements at the year end. So first of all, I know majority of the students are missing this. Very simple. So what we are learning in Ind AS 103? Consolidation on day one. What we are going to learn in Ind AS 110? Consolidation at the end of every year. On acquisition date, as a parent company, you need to prepare consolidated financial statements. For that, the accounting will be done as per Ind AS 103. So therefore, CFS in day 1 is covered in Ind AS 103. CFS every year end covered in Ind AS 110. You understand my discussion so far? First of all, tell me, when business combination will happen? When one company acquires more than 50% shares in another company, that is one of the possibility of business combination. Okay? And when you acquire more than 50% in any company, after that you need to prepare two sets of financial statements. One is normal. What is that? Standalone financial statements. In standalone financial statements, investment in subsidiary will be dealt as per 27, Ind AS 27. Now, as a parent company, now you have a subsidiary also. You need to prepare consolidated financial statements. You need to prepare consolidated financial statements for on the acquisition date, day 1. For that, you need to apply Ind AS 103. And every year you need to prepare consolidated financial statements of the group. For that, Ind AS 110. That's it. So therefore, in this chapter we are going to cover 103. That means we are learning consolidation on day 1. Consolidation on day 1. Consolidation on day 1. That means acquisition date consolidation procedure we are learning in this chapter. Consolidation at the end of the every year. Next chapter, consolidation chapter, Ind AS 110. Okay. Now, important. So, when you acquire more than 50% in any company, that will be your subsidiary. Suppose if you acquire in any company 20%, 20% up to 50%, minimum 20 up to 50. So see this. Suppose for example, S Limited is a company, Infosys another company. Now S Limited acquires 20% or more, but up to 50%. This is called, then this relationship is called investing associate company. Here Infosys will become my associate company. I am investing company. If I am having minimum 20% but up to 50%. This is called significant influence. See, actually, if you have more than 50%, it is called control. Minimum 20 up to 50, it is called significant influence. So when your company is having minimum 20 up to 50% in any company, then usually the relationship is associate company, investing associate company relationship will come. Now here important. So now suppose you are S Limited, suppose you invested 20% or more up to 50% in Infosys Limited. Now investment in associate company, two types of financial statements will be prepared by S Limited. Normal, standalone financial statement. Every company will prepare standalone financial statements. I told you in standalone financial statements, balance sheet, asset side, we need to show investment in associate company. That will be done as per Ind AS 27. There is a standard Ind AS 27 which talks about investment in associate company. Like this is the same applicable for investment in subsidiary also. In standalone financial statements, my investment accounting will be done as per Ind AS 27. Same. Here also in standalone financial statements, my investment in associate company will be done as per Ind AS 27. And also, if I have associate company, at the end of the year, I need to prepare CFS also. Day 1 CFS is required only for business combination, not for this one. This is not a business combination. Please understand. So therefore, CFS, as a S Limited, now I will prepare CFS at the end of the year, including my associate company. For that, I need to apply Ind AS 28. So consolidation of associate company separate standard, Ind AS 28. Ind AS 28. You understand this combination? So tell me, when associate relationship will come? When you have 20% or more up to 50%. Then as an investor, you prepare CFS, first SFS, standalone financial statements. In your standalone financial statements, your investment in associate, how the accounting will be done? Ind AS 27. And you will prepare CFS at the end of every year. For preparation of CFS, Ind AS 28. Now one more relationship, joint arrangement. Joint arrangement. See, I am explaining each one. Parent, subsidiary. investment, associate. Next, joint arrangement relationship. Joint arrangement, sometimes two business entities together they will take up some ventures, they will do some projects, right? These joint arrangements are two types, can be classified into two categories. One is joint operations, another one is joint venture. Important. Joint arrangements are two types, sir. One is joint operation, another one is joint venture. Suppose if your company is having a joint operation, you prepare SFS only. Standalone financial statements, you will show this joint operations accounting. For that, there is a separate standard, Ind AS 111 for joint operations accounting. No need to prepare CFS here. Consolidated financial statements will not be applicable in case of joint operations. Next, joint venture. Suppose if you are having a joint venture, so when you prepare standalone financial statements, in that we need to show the accounting for this joint venture by following Ind AS 27. Whatever the investment you have in this joint venture, this will be done as per Ind AS 27. So if you see, Ind AS 27 is commonly applicable in the SFS, standalone financial statements. Investment in investment in subsidiary, investment in associate, investment in joint venture. In all these three cases, when you are preparing standalone financial statements, you need to follow Ind AS 27. Suppose if you are having a joint venture, you need to prepare CFS also, consolidated financial statements. For accounting of investment in joint venture in CFS will be done as per Ind AS 28. Okay. So tell me, so far whatever the discussion I have made, in which cases I need to prepare CFS? When I am going to prepare consolidated financial statements, when I am having subsidiary, first thing. Second, when I am having associate. Third, when I am having joint venture. In all these three cases, I have to prepare CFS. Tell me, consolidation of subsidiary I need to follow Ind AS on day 1, Ind AS 103. At the end of every year, Ind AS 110. For associate consolidation, Ind AS 28. For joint venture consolidation, Ind AS 28. When I am having investment in subsidiary, in my standalone financial statements, accounting for investment will be done as per Ind AS 27. When I am having associate investment, that investment will be accounted in my standalone financial statement by following Ind AS 27. And when I am having joint venture, I am preparing my standalone financial statements. In that, the accounting for joint venture will be done as per Ind AS 27. So Ind AS 27 is applicable in standalone financial statements for accounting of my investment in subsidiary, associate, joint venture. Right? So in summary, what you have to remember, very, very important, sir. In summary, see, actually this table I have given here is the main summary. This you need to remember. If you know this table, I think you will understand these two chapters very well, business combination, consolidation. Okay, sir, see this. Suppose if you are having less than 20% investment in a company, less than 20% in a company, if you are having, that is called normal investment. If one company is having less than 20% investment in any company, it's a normal investment. One thing done. Suppose if you are having 20% to up to 50%, then tell me, you will get what? Associate company. The company in which you have this investment, this limits investment, then that will be your associate company. So when you have investment in associate company, so tell me, when you prepare SFS, standalone financial statements, this investment is accounted as per Ind AS 27. And when you prepare CFS, the consolidation procedure will be done as per Ind AS 28. Suppose if you are having more than 50% investment in any company, that will become your subsidiary. So you prepare in SFS. In SFS, the accounting for investment in subsidiary company will be done as per Ind AS 27. The most important aspect is this. The speciality of this subsidiary business combination is consolidation will be done on the date of acquisition at the end of the year. So consolidation on day 1 when you do, so for that you need to follow Ind AS 103, and every year normal consolidation will be done as per Ind AS 110. In this chapter we are going to focus on which standard? Ind AS 103. This is the thing. And when you have joint arrangements are classified into 2 categories: joint operations, joint venture. Your investment in joint operations will be accounted only in SFS, not in CFS. So that too, which standard is applicable? Ind AS 111. And if you have a joint venture, your investment in joint venture in standalone financial statements will be done as per Ind AS 27. In CFS 28, accounting will be done. Okay. So this table is that much important table, sir. So the conclusions, can you tell? Hello? Do you have the clarity now? Now tell me, I am going to ask only 2 questions, you have to tell me. Suppose business combination happened. Business combination. So there is a parent company, subsidiary company. So as a parent company, I prepare SFS, standalone financial statements. In that I will show investment in subsidiary. This investment in subsidiary, I have to account it as per which standard? 27. Done. Now as a parent company, shall I require to prepare consolidated financial statements on the acquisition date also? Yes. Yes, in case of subsidiary. In case of business combination, I have to prepare consolidated financial statements on acquisition date. For that, the accounting will be done 103. So 103 basically gives accounting treatment for consolidation procedure on which date? Acquisition date. So on the date of acquisition, how the consolidation will be done by the parent along with its subsidiary, the procedure is explained in Ind AS 103. That is what we are going to learn it. So as a parent, every year I have to prepare consolidated financial statements. For that I need to follow Ind AS 110. Okay. Okay, sir. Now see, first Ind AS 27. Ind AS 27 talks about investment. Investment in where? Investment in subsidiary, associate, joint venture in standalone financial statements by the investor. Correct? So as a company, if I invest in any company, so normal, it can be more than 50% to 20% to 50%, or it can be my joint venture. When I prepare my standalone financial statements, how the accounting will be done? As per Ind AS 27. Now Ind AS 27 says your investment will be shown at either cost or fair value. Either cost or fair value. That depends. If you investment will you show at cost or will you show at fair value? Okay. So this is the only point you need to remember. When you are preparing standalone financial statements, your investment in subsidiaries, associates, joint ventures will be shown as per Ind AS 27 either at cost or fair value. And any income you received, any dividend income received from these investments will be recognized in P&L in standalone financial statements. Like normally when you make any investment in a company, when you invest in shares of a company, you are going to receive what? Dividend. That dividend is your income. That will be created to P&L account. In standalone financial statement. I am talking about only standalone. I am not talking about CFS. So okay. So this is the thing, sir. So you understand this table, sir? So in this chapter, what is the thing we are going to learn? Consolidation on day 1. Consolidation on day 1. For that I need to apply 103. Okay. Very good. So what is business combination? What is business combination? Important. See, the standard says business combination means when you acquire control over any business. When you acquire control over a business, it is called business combination. See, business combination is basically one company having control over the business of another company. One company is having control over the business of another company is called business combination generally. Now the questionnaire here, two important terms. One is control, another one is business. Sir, how this control is achieved? How this control is achieved? Tell me. I already explained one thing. How control will be achieved in another company? By having more than 50%. When you have more than 50% in a company, that will be your subsidiary. That means you are exercising control. Hello. So one of the best ways to have a business combination is having more than 50% shares in a company. Because what is business combination? When you have control over the business of another company. When we say you have a control, when you have more than 50% shares in a company. So this is very, very important, sir. Next 5 minutes important. Please concentrate. Control over a business can be acquired mainly in two ways. There are two ways to acquire control in a company. One way is acquisition of more than 50% equity shares. When you acquire more than 50% shares in a company, you will have a control. And when you acquire more than 50% shares in a company, you will get to, that company will become your subsidiary. Okay. Now my question is, come on, tell me. Suppose I am S Limited. There is Infosys Limited. Okay. Now in this company, I acquired 60% shares. After this, whether Infosys Limited company will continue or will be liquidated? Continue. Because I acquired only 60% shares in this company will continue. That means in this combination, in this situation, when I acquire more than 50%, subsidiary company continues to exist. It will not be liquidated. And here control is obtained through shareholding. Tell me, what are the accounting standards applicable for my accounting for investment in subsidiary? In Ind AS 27 is applicable for investment in subsidiary where? SFS of the acquirer. Ind AS 103 is applicable for first time recognition of business combination in CFS. That means day one consolidation. Parent along with subsidiary. At the end of the year, normal CFS at the end of every year, Ind AS 110. This is one way to acquire the control. Important. There is another way to acquire a control in a company, that is acquisition of net assets. Important, guys. When you acquire net assets of any company, automatically you are acquiring control. Now suppose, for example, same example I will continue, sir. Suppose S Limited, Infosys Limited is there. I am not purchasing any shares, but this Infosys Limited net assets I am purchasing. This company net assets I am taking. That means Infosys Limited is selling net assets to S Limited. Obviously, when it's sell its net assets, this company can't be existed. It will be liquidated. How can you continue without assets and liabilities? Is it possible? And which company is going to sell its entire business to another company? Only with an intention of liquidation. So therefore here Infosys Limited is selling its net assets to subsidiary S Limited. With what intention any company will sell its entire net assets to another company? Generally, they don't want to continue their business. So their business will be continued by another company. So therefore, sometimes I can acquire control through acquisition of net assets also. When I acquire control through acquisition of net assets, that other company will be liquidated. Therefore, after my investment, that company will not be existed. Therefore, the parent subsidiary relationship will not come. Sir, parent subsidiary relationship when will come, sir? Only when you have a subsidiary. Here, when I acquire that net assets of another company, that company is going to liquidate, na? So it is not a subsidiary for me, it is no more existence. Therefore, here I am not required to prepare CFS at the end of every year in respect of this company, because CFS at the end of the year will be prepared only when I have a parent company, subsidiary company. But here this company is going to be liquidated, na? So CFS I can't prepare at the end of the year. So CFS on day one is also not required to be prepared. Sir, that means when I acquire control through net assets, that company is going to liquidate it. That company net assets are coming to my business. So therefore, how I am going to do the accounting? In standalone financial statements of the acquirer company, I need to account it as per Ind AS 103. Beautiful point. You understand this carefully. See, come on, once again. I am saying business. What is business combination? When you acquire more than 50% shares in another. What is business combination? When you acquire control over the business of another business. How control is achieved? Two ways. I told. One way is more than 50% shares, equity shares in a company. Tell me, when you acquire more than 50% shares in another company, where another company will continue or liquidated? Continue. That means parent subsidiary relationship is there. Therefore, I have to prepare CFS on day 1, CFS at the end of the year. By following CFS on day 1, 27. Now CFS on day 1, 103. CFS at the end of the year, 110. But when I acquire control through acquisition of net assets, I am not acquiring shares. I am acquiring another company net assets. That company is going to liquidate. Therefore, parent subsidiary relationship will come. It will come only when I have a subsidiary. That other company is no more in existence. Therefore, CFS on day 1, CFS at the end of the year, not required. But how the net assets coming from that company is going to be incorporated in your books? By following Ind AS 103 in the standalone financial statements of the acquirer. Hey, you understood? Important pa. See this. Acquisition of net assets. Business purchased and seller liquidated. See, I am purchasing the business, that company is liquidated. I am not acquiring shares pa. Suppose if I acquire shares, that company will continue. If you purchase shares of another company, whether other company will be liquidated? No. Going to continue. See this. Selling company is liquidated after sale of net assets. Acquirer purchases assets and liabilities directly, not shares. Ind AS 103 applies only in where? Separate financial statements of the acquirer. No subsidiary exists, hence no consolidation of financial statements is required. Now, my question is, tell me, when you acquire control through acquisition of net assets, consolidated financial statement is not required. Why? Because consolidation is required only when there is a parent subsidiary relationship. In this case, there is no subsidiary here, there is no parent here. Because when I call parent, if I have a subsidiary, here that company I am acquiring is going to liquidate. So therefore that company is no more in existence. But that company net assets are coming to my business. Correct? So that incorporation procedure is dealt in SFS of acquirer company as per 103. Generally SFS, the investment is accounted as per Ind AS 27. That is investment in subsidiary associate. Subsidiary, but there is no subsidiary here. So you have to be very careful. When you are reading the question, you read carefully. Here one company is acquiring another company. Is it acquiring shares or is it acquiring net assets? What's the difference? Tell me. If I am acquiring more than 50% shares in another company, parent subsidiary, so therefore consolidation on day 1 I have to do as per Ind AS 103. I have to prepare separate consolidated financial statement, separate set of financial statements, consolidated financial statements I need to prepare. But suppose for example when I acquire control through acquisition of net assets, parent subsidiary relationship is not there. But how I am going to do the accounting for the net assets I am acquiring? Ind AS 103 only, but where? Separate financial statement. No need to prepare consolidated financial statements. Why? Parent subsidiary relationship is not there. You understand this crux? This is where most of the students are confusing. So I have given a clarity. So when you are solving the questions, you have to be very careful. How I am acquiring it? Whether that other company is selling its net assets to me, so therefore I am acquiring their net assets, their business is going to be liquidated. Therefore, I am not required to prepare any consolidated financial statement. No separate consolidated financial statement required because parent subsidiary relationship is not there. So in my standalone financial statement itself, I have to incorporate the net assets by following the procedure as per Ind AS 103. So that's it. So how many ways to acquire the control? 2 ways. One, more than 50%. Second, acquisition of net asset. What is the difference? When you acquire more than 50%, the other company will continue. It will not be liquidated. So parent subsidiary is there. So consolidation will be done on day 1 at the end of the year. Consolidation on day 1 will be done as per Ind AS 1. So consolidated set you need to prepare separately. Standalone financial statements as well as consolidated you need to prepare separately. In this case, another way, acquisition of net assets. When you acquire net assets, that other company is going to be liquidated. Therefore, shall I require to prepare consolidated financial statements? No. But how I am going to incorporate the net assets of the other company which I am acquiring? In SFS only, by following 103. Okay. So this is business combination, sir. So I think you understand how, when this business combination will arise, when you have a control. Control can be achieved in two ways. Now, what is business? Because here two things, control over business. They said, what is business? They said business means it should have some inputs, process, output. These three things should be there to call it as a business. So according to Ind AS 103, business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods or services to the customers, generating investment income or generating other income. That means every business should have three elements. First, input should be there. That means that business should have the resources, economic resources. That means, suppose for example, I am acquiring Infosys Limited. I am S Limited, I am acquiring Infosys. Whether Infosys Limited is having a business or not, I have to check whether they have inputs. That means whether they have non-current assets like PPs, intangible assets, ROU assets, return on investment, ROU, right of use assets, intellectual property rights, intellectual property like brand, license, patents, access to materials rights, employees and workforce. Every business should have the inputs. Next, process. They should have some systems, rules, methods to convert these inputs into outputs, like management, strategic management process, operational process, resource management process, organized workforce, all these things. And finally, they should be capable of generating what? Outputs. That means goods, services, investment. So business is nothing but inputs plus process. Then obviously you are going to create outputs. So as per Ind AS 103, control over business. But I have to see whether that will be called as business or not. To call it as a business, they should have inputs. That means they should have resources. They should have proper system. And they should be capable of generating outputs. Then only it will be a business. That means the standard is not accepting any nonsense. They are clearly saying that business should be there. Not some dummy thing. They should not have any inputs, any process outputs they are unable to generate. You cannot call this as business. So serious things they are talking about. That's it, pa. I think we have completed the basic structure of this one. Okay. Now, so overall, whatever I have discussed so far is a very, very important. Now I am going to explain you the main thing of this chapter. What is the main thing of this chapter? What is the main thing? Ind AS 103. Ind AS 103 talks about consolidation procedure on day 1. Day 1 consolidation procedure. Consolidation will be done by whom? Acquirer. Acquirer, that means parent company in our language. Acquirer, the company which is acquiring the business holding. Because see, control can be acquired through shares, through net assets. So when you acquire through net assets, we don't call it you parent. That's why they use the word acquirer. Here acquirer means the company which is acquiring the control over another business. So first of all, you have to see, is there a business combination or is there or not? How business combination is achieved? Having more than 50% share capital or having acquire net assets of the other company. Okay. Now, day 1 consolidation procedure. How we are going to do the consolidation on day 1? Okay. We are going to see. See, there is a procedure for consolidation. Accounting for business combination as per Ind AS 103. So I am going to explain you the basic procedure for consolidation. On which date? Which date consolidation procedure? Day 1, acquisition date consolidation procedure I am explaining. Okay. Okay. Now I am going to explain you the consolidation procedure on day 1. On day 1, how consolidation will be done? See, actually, for consolidation, normal basic consolidation, on day 1, we will follow acquisition method. This method is called acquisition method. Accounting for business combination in consolidated financial statements of acquirer company on acquisition date is provided in Ind AS 103. See, you know, there are different ways they are going to solve business consolidation answer. But now I am going to give you some steps for consolidation. And if you follow these steps, I can give you guarantee you can solve consolidation question quite easily. Business combination on day one quite easily. Right? So I am going to explain everything in a detailed manner. See step by step, sir. First step number one. Step number one. Identify the acquirer company. Identify the acquirer company. Which company is acquiring the other company business? Which company is acquiring control over another business? Identify the acquirer. In my example, S Limited acquiring control over Infosys Limited. So always identify the acquirer. Sir, how to identify the acquirer? Acquirer is the entity which pays purchase consideration. Acquirer is the entity which pays purchase consideration. Sir, tell me, when you are buying something, you have to pay something in return. That means, if I am acquiring control over another company, definitely I have to pay something in return, right? That is called purchase consideration. So PC calculation is one of the important calculation in business combination. I am acquiring more than 50% shares in a company. I have to pay something to their shareholders. I am acquiring net assets of that company. Will they give their net assets freely? No, I have to pay. So therefore, the party who pays the purchase consideration is called acquirer. So it is the entity which obtains control over the business of acquiring company. And usually the company which pays the purchase consideration is what? Acquirer. So acquirer company is the company which pays PC. But there is one exception, that is reverse acquisition. Very, very important. We are going to discuss the concept of reverse acquisition. So reverse acquisition is the exception, sir. In case of reverse acquisition, generally who is acquirer? Who is paying PC? But in reverse acquisition, the company, the party who pays PC will not be considered as acquirer. That is called reverse acquisition. Actually reverse. How this happens, why reverse acquisition, we are going to discuss it. So first step, identify the acquirer company. Second step, determining the date of acquisition. Sir, on what date you acquired that other company? Suppose being a parent company, on what date you acquired subsidiary company? Date of acquisition. So identify the date of acquisition. The date on which the acquirer obtains control of the acquiring. Suppose generally this date of acquisition will be ascertained through, if there is a written agreement is there. From that written agreement we can get it. Suppose if there is no written agreement, then generally acquisition date depends upon the situation, circumstances. Sometimes the acquisition requires government approval. If government approval is required, the date the government is given the approval, that date will be the date of acquisition. Okay. So first two steps, okay. So tell me, what is the first step? Identify the acquirer. Who is acquirer? The company which pays the PC. What is the exception? Reverse acquisition. What is the step number 2? Determination of date of acquisition. What is the date of acquisition? The date you obtain the control or agreed date of control, if there is an agreement. Suppose sometimes government approval is required, then the date the government has given approval, that date will be the date of acquisition. And the most important step, step number 3, please concentrate now onwards. First two steps anybody can do. Identify the acquirer, date of acquisition, that is readily available from the question itself. Now the most important steps will start now. Everybody please focus. First of all, we are learning what? We are learning what? Ind AS 103. Ind AS 103 talks about business combination accounting on which date? Day 1. Day 1 consolidation accounting. We are learning. Right? What is the first step? Acquirer. Second step, date of acquisition. Third step, purchase consideration determination. PC determination. First of all, what is this PC, sir? Suppose I am S Limited, sir. I am acquiring control of Infosys Limited. For that I am going to pay PC. So PC is nothing but the amount which I am going to pay to the owners of the acquiry company. This company Infosys Limited, I am going to pay consideration. Whatever amount I am going to pay to them for acquiring their business, to obtaining control over their business, that is called PC. And this PC will be calculated on date of acquisition at a fair value. Ind AS 103 says purchase consideration is calculated at what value? Fair value. And that too on what date? Date of acquisition. So that's why last session also I told you Ind AS likes fair value. So that's why here also fair value. So purchase consideration is calculated at fair value. Now see, purchase consideration can be anything. How to get purchase consideration? Simple. Whatever you are paying, suppose you are paying cash, take it. You are paying assets, you are giving assets to them, take it. But at what value? Fair value of the assets given. Suppose you are giving equity shares to other company, you are giving your equity shares. Suppose I am S Limited, I am acquiring Infosys Limited by issuing my shares, fair value. That will also be included. Debentures, suppose if I am issuing debentures to acquire control, that will also be added. Deferred consideration, important. Deferred consideration. Deferred consideration means consideration I am going to pay in future, not now. I am going to pay in future some amount to the other company for acquisition of control. That is deferred consideration. When it comes to deferred consideration, important sir, the standard says you need to convert into present value and include it in the PC. Deferred consideration will be converted into present value. For example, I am S Limited, I am acquiring Infosys Limited, I am going to pay 10 lakhs after 5 years. So this 10 lakhs I am going to pay after 5 years, right? Convert them into present value, include in the PC. That means today I am going to create a provision for that 5 lakhs at present value. Every year I am going to unwind the remaining amount. Like how, sir? For example, you see here, suppose 2 years after acquisition I am going to pay 10 lakhs. I am acquiring today, but I am going to pay 10 lakhs when? After 2 years. So therefore discount rate 10%. Convert this 10 lakhs into present value now. So 10 lakhs into 1 by 1 plus 1 whole power 2. You know that formula. 1 divided by 1 plus r whole power n. Like that one formula is there to convert into present value. So by using that I converted. So what is the present value I got? 8,26,446. This will be included in the PC. So generally provision for deferred compensation. Provision I am going to create for this. Now every year, first at the end of the first year, on this 8,26,446 interest 10% I am going to apply. This is called unwinding of discount. For example, you see, after 2 years I am going to pay how much? 10 lakhs. What is the today's value? 8,26,446. Whatever the difference is there, that I am going to unwind over the next 2 years. Like how, sir? How this unwinding will be done? Simple. On this 8,26,446 I am going to apply 10%. That means 82,645. Interest to provision for deferred compensation. Next year also interest to deferred provision for deferred compensation. Next year, second year interest is calculated on 8,26,446 plus 82,645. So therefore by the end of the second year the provision will become 10 lakhs. You understanding, guys? This is called unwinding of discount. So therefore when you are calculating PC, tell me deferred compensation will be calculated at what value? Deferred compensation, deferred consideration will be calculated at a present value. What is deferred consideration? Paid in future, not now. So convert into present value. What about the remaining gap? Unwind over the next period, over the period. If whenever you are going to pay it, for that period you need to unwind it. What is the entry? You are going to create provision, provision for deferred compensation. As an acquirer in my books I am going to create a provision because I need to pay this, and every year I need to unwind the discount. For that, what is the entry? Interest to provision. Interest to provision. Okay. And there is something called contingent consideration. What is this? contingent consideration. What is contingent consideration? The consideration which I am going to pay, which depends upon the future events. Future events. If that happens, I will pay. If this happens, I don't pay, like that. That is called contingent consideration. So sometimes, for example, if I am acquiring any business, I told them that I am going to pay this much only if this condition satisfied. In future, I am going to pay only if this benefits come. Like that, the payment depends upon the future contingencies, conditions. That is called contingent consideration. Even this contingent consideration will also be included in the PC at fair value. Even contingent consideration will also be included. What is the difference between deferred consideration and contingent consideration? Deferred consideration I am going to pay in future, definitely. Contingent consideration, which I am going to pay subject to conditions. If that condition satisfies, then only I will pay. Otherwise, I don't pay. That is called contingent consideration. But when you are calculating PC on day 1, acquisition date, you need to include this contingent consideration also. Not at present value, but at a fair value. Deferred compensation will be calculated at a present value. So you understand how the PC will be calculated? Come on, tell me. First of all, what is PC? PC means the amount which is paid by acquirer. To whom? Acquiree. For acquiring control. So PC is nothing but the amount paid to the owners of acquiring company to obtain control. And this PC is calculated on what date? Acquisition date. At what value? Fair value. Tell me how PC will be calculated first. Everything, whatever you are paying, add it. First, cash paid. Suppose if you give any assets, you need to take at what value? Fair value. Suppose if you issue shares, debentures, you need to take it at a fair value. Any deferred consideration at a present value. Okay? And contingent consideration at a fair value. For example, you see deferred consideration. Deferred consideration is the part of purchase consideration that is payable by the acquirer at future date after acquisition. It is always valued at a present value. And every year end unwinding of discount is applied to be done, is required to be done. So what are the entries generally in respect of this one? Deferred compensation, I need to create a provision for deferred consideration, and every year I need to unwind the discount. Unwinding of discount, what is the entry? Interest to provision. You understand that? Next, contingent consideration. What I told, what is contingent consideration? It is the payment to be paid by acquirer only on happening of certain future events, like the future performance of the acquired business. And it is fair value included in the PC. Okay? And one more important thing, important sir. Acquisition related cost. Sir, suppose when you are acquiring control over another company, you are going to incur some cost. Like for transaction cost, stamp duty, legal fees, professional fees, valuation fees, like that some cost will be incurred. For example, I am S Limited, sir, your Infosys Limited. I am acquiring your company control. For that some agreement will be written, na? Stamp duty, legal fees, all these things will be paid. Na? Whether this transaction cost will be included in PC? The standard says no. Transaction cost will not be included in PC. It is treated like a normal expenditure. So therefore you see, important, mark it. Sometimes in the question they deliberately will give you acquisition related cost, they will give you. If they have given any acquisition related cost, don't include in the PC. So see this, any cost incurred by acquirer in relation to business acquisition, that is transaction cost, such as stamp duty, legal fees, professional fees, valuation fees, etc. They are not included in the PC. They are recorded as expenses in P&L account. They are normally recorded. They are recorded as expenses in P&L account. Okay. So that's it, sir. I think we have completed step number 3. Hope you understand step number 3. Okay, that is step number 3. So can you recollect what are the steps so far we have covered? Step number 1, identify the acquirer. Step number 2, determination of date of acquisition. Step number 3, determination of PC. Purchase consideration is very, very important. PC is generally calculated at fair value on date of acquisition. Okay. Now, next step, step number 4, sir. Recognize and measure the identifiable assets and liabilities. Step number 4. To put it simply, net assets taken from the other company, acquiree company. the company which we are acquiring, control. From that company, the net assets we are taking, the net assets will be recorded. Because see, I am acquirer, sir. I am S Limited. You are Infosys Limited. I am acquiring control. That means from your company, whatever the assets, whatever the liabilities are there, now they are my resources. They are my resources. Suppose if I am having more than 50% shares in your company, that means I am enjoying control. So that means your resources, my resources, right? Your resources, my resources. So therefore, I have to identify, I have to recognize and measure the net assets from your company. Because consolidation means what, sir? As a group, parent company assets, subsidiary assets, parent liabilities, subsidiary liabilities. Together, we need to show how we are. Together, we need to show the financial position, performance. For example, I am having 1 lakh rupees with me. Now, if I invest in another company more than 50%, now that company is having, for example, 1 lakh worth of assets. Now my assets worth 2 lakhs. My 1 lakh, I am having 1 lakh worth of assets. I means my company. That other company where I have control, I can control the resources of that other company. That other company is having net assets of 1 lakh. So that 1 lakh is also my 1 lakh. So therefore, as a group, we are having now how much? 2 lakhs. That's the idea. Consolidation basic idea is that. As a group, what is the financial performance? What is the financial position? What are the resources we had? We want to show to the outside world, the shareholders, everybody like that. So that's why we need to identify from the company which we are acquiring, acquiry company, what are the assets, what are the liabilities, what are the net assets of that company we are acquiring. For consolidation purpose. For consolidation purpose. So firstly, identify the net assets of acquiry company taken over by the acquirer company. So as an acquirer company, in the acquiry company, what is the net assets? I have to identify. All taken over assets and liabilities of acquiry company are measured at fair values as on the date of acquisition. Again, fair value. Say this. Sir, they will run the show on fair value only. So you will not forget in examination, whenever you have a doubt, fair value. So when I am identifying the assets and liabilities of acquiry company, I have to take the assets and liabilities of acquiry company at what values? Fair values. Okay. Next, important, identifiable intangible assets not recorded in the acquiry books but meeting Ind AS 38 recognition criteria are recognized at fair value. Important, sir. Sir, in acquiry company, if there is any intangible asset, but they have not recognized that intangible asset because the recognition criteria not satisfied, that intangible asset can be recognized for consolidation purpose by acquirer company. See this, identifiable which asset? Intangible asset, and look at this wording, not recorded in the which books? Acquiry books. So acquiry books, that intangible asset is not recorded, but meeting Ind AS 38 recognition criteria. Ind AS 38 means intangible asset. Intangible asset recognition criteria met or recognized at fair value. That means in the acquiry books, important, in the acquiry books, intangible asset not recorded because Ind AS 38 recognition criteria not met. But as an acquirer, for me, if it is satisfies, the recognition criteria satisfies, I can recognize that intangible asset at fair value for consolidation purpose. That means even though intangible asset not recognized by the acquiry company because the recognition criteria not satisfied, that intangible asset can also be considered by the acquirer company for calculating the net assets. And that intangible asset will be considered at what value? Fair value. For example, that acquiry company is having one brand. Okay, that brand is not satisfying the recognition criteria. Therefore, that brand they have not recognized as intangible asset. Now that brand can be recognized as net assets taken from acquiry company for consolidation purpose by the acquirer company. That's why I put a star mark. Very, very important. Some examination questions they tested this point already. They will give you acquiry company brand value, intangible asset. They will tell you they have not recognized, but you have to take it for consolidation purpose, right? At what value? Fair value. And also, sir, important, another important point, any contingent liabilities of the acquiree are recognized as liabilities at fair value on the date of acquisition. Suppose in the acquiree company books, acquiree company, there are some contingent liabilities. Contingent liability means that is not a liability yet. In future it may become a liability. So contingent liabilities generally they will not recognize in the balance sheet, right? So any contingent liabilities are there in the acquiree company, that contingent liability will also be considered for consolidation, net assets of the acquiree company. At what value? Fair value. See this, contingent liabilities of acquiree are recognized as liabilities at fair value on the date of acquisition. And related indemnification assets are recognized up to the amount of such contingent liabilities. Sir, suppose to meet these contingent liabilities, if there is any asset is there, that is called indemnification asset. Whenever you have a liability, corresponding asset will be created. Na? If there is any asset is there, that can also be recognized. Next, important, any non-current assets held for sale are recognized at fair value less cost of disposal. Sir, any assets, non-current assets are there in the acquiree company which they want to sell it, consider those assets also. But at what value? Fair value less cost of disposal as per Ind AS 105. And any deferred tax assets and liabilities are there, they will also be considered. So tell me, what is step number 4? Recognition of net assets. Simply you remember recognition of net assets of the acquiree company. How net assets will be recognized? All assets will be taken, all liabilities will be taken. At what value? Fair value. And so what are the 3 special points? First, intangible asset not recognized by acquiree. Can that be considered? Yes. At what value? Fair value. Next, any contingent liabilities, can that be considered? Yes. Contingent liabilities can be considered as liabilities at fair value. And related indemnification cost can also be considered. Up to the amount of such contingent liabilities only we need to consider. For example, if there is a contingent liability of 10 lakhs, relating to that there is an asset 15 lakhs, indemnification asset, but you should not consider at 15 lakhs, you should consider only up to 10 lakhs. And also any non-current assets held for disposal in the acquiree company books, that will also be considered. At what value? Fair value less cost of sales. I think we have completed 4 important steps we have completed, sir. Very, very important. So 4 things we have completed. Okay. So can you recollect what are the 4 steps so far we completed? First, identify the acquirer. Who is acquirer? Who pays PC? Exception, reverse acquisition. Second step, date of acquisition. What is the date of acquisition? Generally, date of acquisition is the date which you obtain control. Or sometimes control can be acquired immediately, sometimes based on the agreement. Suppose if government approval is required, the date the government approval is given, that date is the date of acquisition. What is step number 3? Purchase consideration. Purchase consideration is the amount paid by acquirer to the shareholders of acquiree. At what? Fair value. PC is calculated on acquisition date at fair value. How PC will be calculated? Cash paid. Fair value of assets transferred. Fair value of the shares, debentures given. Present value of the deferred consideration. Even contingent consideration at fair value we need to consider. All these things will be added. Only thing you need to remember is deferred consideration will be taken at present value. And we need to unwind the discount. Okay. What is step number 4? Recognition of net assets of acquiree company. The most next step number 5. Important. Please listen to me carefully. Calculation of NCI, non-controlling interest. Calculation of NCI, non-controlling interest. Very important. You will enjoy it. Beautiful. Listen. What is this NCI, non-controlling interest? Sir, suppose look at this example, sir. S Limited acquiring 60% shares in Infosys Limited. That means what? Tell me. Parent subsidiary. Control is there. Yes, this is business combination. One of the business combination. And remember, by the way, NCI is not applicable or will not come in case business acquired through net assets. NCI will be calculated only when you acquire through shares. Or another situation, NCI is not applicable when you acquire 100% of the acquiring company. For example, here S Limited acquired 100% shares of Infosys. That means wholly owned subsidiary. When you are yourself is having 100% shares, NCI will not come. NCI means what? Non-controlling interest. See, simple. You are controlling 60%. That means remaining 40%. NCI, non-controlling interest. For example, Infosys Limited 10,000 shares are there. In that 6,000 shares S Limited purchase. That means I am having 60% control. What about remaining 4,000? Is having by other shareholders, na? That is called NCI. So NCI is basically nothing but other than controlling portion. Who is having how much? For example, we are having 60 means they are having 40%. Now, sir, why this is important, sir? Why I need to calculate NCI? See, listen, I will explain. Beautiful point. Sir, I am acquirer. In this case, S Limited. I am acquiring how much? 60%. That means, frankly speaking, in the acquiry company net assets, my share is only 60%. But for consolidation purpose, business combination purpose, I will show 100% of the assets, 100% of the liabilities of acquiry company. Even though I am spending only 60% on them. So the other shareholders will question, hey, you are having only 60%. Why you are showing 100% of the assets? In that assets, 40% belongs to us. They will say. That's why the standard says, hey boss, you are showing 100% of the assets and liabilities of the acquiry company for consolidation purpose on day 1. But 100% not belongs to you. In this example, 60% only belongs to you. Remaining 40% belongs to NCI. So calculate NCI and you will show in your balance sheet as a separate item after the shareholders fund. Correct? Because for consolidation you are incorporating 100%, but even though your investment is only 60% in this case, so remaining 40% belongs to others. That you have to calculate and you need to show in your books. That boss, NCI means even other shareholders also there. In this company they are having this much. So that you need to calculate and you need to show. That is the logic of NCI. You understand NCI? What is NCI? Non-controlling interest. Other than parent company share, whatever. That's why I said NCI is not applicable in 2 cases. When you are having 100%. Sir, when you are having 100%, 100% of the net assets of the acquiry company belongs to you only, na? For consolidation purpose. So therefore NCI will not come. Second, when you acquire through net assets, you are not acquiring shares, you are acquiring through net assets. So therefore when you are acquiring through net assets, the question of NCI will not arise. Sir, why it will not arise? Because when you acquire through net assets, I told parent subsidiary relationship is not there. That means in this, we don't prepare CFS. We will prepare only SFS. In that only we are going to incorporate it. And NCI will not arise. Are you understanding, guys? This is a pure subject I am explaining. Are you understanding? So, when NCI will be calculated? When you are having less than 100% shares in a company. More than 50, but less than 100. Obviously, remaining portion will be NCI. You understand the logic behind calculation of NCI? For example, I will give you logic. See this. Suppose, sir, you are S Limited, purchasing company, acquirer company, whatever you call. You are acquirer, this is acquiry, Infosys. Now, on day 1 when you are doing consolidation, what is the entry you are going to write as an acquirer? Tell me. Assets account debit. From the acquiry company, whatever the assets are there, acquiry company, that assets you are going to debit. For consolidation purpose I am telling consolidated financial statement purpose. Because consolidation means parent company assets, subsidiary assets. So from subsidiary whatever the assets are coming, I need to incorporate. How much? Total 100%. At what value? Fair value, which I recognized in step number 4. Similarly, liabilities also I am taking 100%. So that means assets, liabilities I am taking 100% means net assets I am taking 100%. Acquiry company net assets 100% I am taking, but I am having how much only? 60%. That's why I calculate NCI and I will recognize as separate item. So see this, 2 NCI I will write. See, assets, liabilities, I am paying PC. So PC is my liability, I will credit it. I am paying PC only for 60%. What about remaining 40%? NCI. So this is the basic entry will come for consolidation purpose. On business combination, entry means what? Assets account debit, 2 liabilities, 2 PC, 2 NCI. Difference will go to either goodwill or capital reserve. Difference will go to goodwill or capital reserve. I am going to explain goodwill or capital reserve also. But step number 5 we are focusing on NCI calculation. NCI calculation. Why NCI calculated, you understood? Because in the other company we are having not 100% shares, but in books we are showing 100% net assets for consolidation purpose. So remaining portion held by others we calculate and we will show as a separate item. So this is the thing. Now important, listen. Sir, okay. So what you said is NCI is the portion of the equity in subsidiary that is not owned directly or indirectly by the acquirer. The portion which is not owned by the acquirer is called NCI. It represents the ownership interest of the minority shareholders in the subsidiary. Majority, minority. Sir, if I am having 60%, if S Limited is having 60% means they are majority shareholders. Remaining 40% minority shareholders. So NCI is nothing but minority shareholders. NCI is nothing but minority shareholders. That's why in CA inter consolidation chapter when you are learning, there is a step called calculation of minority interest. But in Ind AS we don't call minority interest. We call it as NCI, non-controlling interest. Name is different. They call it as minority interest in normal standards, but in Indian accounting standard we call it as non-controlling interest. The most important part is, so we understood that we need to calculate NCI. Why we need to calculate NCI? Because we are having 60%, but 100% we are incorporating. That's why 40% belongs to NCI. Sir, how this will be calculated? Important, sir. Listen. Sir, there are 2 methods to calculate NCI. When you are solving, sir, this is the most important thing. There are 2 methods to calculate NCI. First method is fair value method. Always first preference will be given to this method only. Fair value method. If this is not available, there is a second preference also, that is PSNA method, proportionate share in net assets method. So tell me, what are the methods to calculate minority NCI? Fair value method, PSNA method. First preference, fair value method. Correct? First preference is fair value method. See, in fair value method, how NCI will be calculated? See this. In fair value method, how it will be calculated? Generally, sir, if fair value of NCI given in the question, we can consider directly. Sometimes in the question itself, they will give you fair value of NCI, take it directly. Suppose if it is not given, it has to be ascertained by following ways. One is NCI is equal to number of shares held by NCI into fair value per share of the acquiry. What is the fair value per share of the acquiry company? Multiply with the number of shares held by NCI. For example, in my example, Infosys Limited is having 10,000 shares. 6,000 shares are held by S Limited. That means NCI is having 4,000 shares. So 4,000 into fair value. Suppose you see here, 4,000 shares are held by NCI. 4,000 into what is the fair value of per share of the Infosys Limited? So multiply it. Suppose for example 4,000 fair value per share is 50. So 4,000 into 50. That is the NCI. One way to calculate. Another way is NCI is equal to, this is the most important thing. NCI is equal to PC, purchase consideration, which you already calculated in step number 3. PC into share of NCI divided by share of holding by the acquirer. Purchase consideration into share of NCI divided by share of holding by the acquirer. Sir, what is this, sir? Simple here. For example, you see, PC you calculated, sir, purchase consideration. As per step number 3, we calculated PC na. Suppose PC we got 150 lakhs. PC means who paid? Acquirer. Acquirer paid to acquiry. PC. Now, what is the percentage of holding? Acquirer company acquired. For example, 60%. So for 60% they paid 150 lakhs. Now I want NCI. Obviously, if parent company is having 60%, acquirer is having 60%, NCI will have how much? 40%. So therefore, how to calculate NCI? NCI is equal to, see this, 150 lakhs PC divided by 60 into 40. So 150 divided by 60 into 40. How much, sir? 100. Hello? This is NCI. So this method will also be used to calculate NCI. Yes. Fair value not given, then you follow this method. So tell me how to calculate NCI? Fair value method. If it is given, take it. Otherwise, number of shares held by NCI into fair value per share of the acquiring company. If fair value per share of the acquiring company available, take that fair value, multiply with number of shares held by NCI. You will get NCI. Otherwise, PC divided by acquirer holding into NCI holding. PC divided by acquirer, how much they have hold, into NCI holding. I am taking proportionately, sir, nothing but, for example, you see, here the logic is very simple. For 60%, 150 lakhs means 40% how much? 100. That means I am taking proportionately 150 into 40 divided by 60. Take this. This is the one method. Guys, important. Are you understanding? Sometimes if it is not possible to calculate under fair value method, or in the question clearly said that you need to follow PSNA method, proportionate share in net assets method. This is the second method. In PSNA method, how to calculate the NCI? Simple. Whatever the fair value of the net assets taken over of the acquiring company, which we already calculated in step number 4. Step number 4, we have recognized the net assets of the acquiring company at fair value. Multiply with NCI percentage. So in step number 4, whatever the net assets we acquired, identified the assets of the net assets of the acquiring company at fair value, multiply with NCI percentage. Automatically you will get what? NCI. And NCI will be shown separately in equity head of balance sheet under consolidated financial statements of acquirer company. See, when you are preparing consolidated financial statements, sir, this NCI will be shown. See this, how the presentation will be done. When you prepare consolidated balance sheet, equity and liabilities, equity, equity share capital, other equity, after that NCI will be shown. So NCI will be shown as a separate item in the consolidated balance sheet. Hello? So that's it. I think NCI calculation is done. So will you remember this? First of all, you understood the logic behind calculation of NCI. So when NCI will not arise, also explain. When NCI will not arise, 100% you acquired shares or you acquired through net assets, NCI will not arise. And how many methods are there? 2. Fair value, PSNA. Fair value method, if fair value of NCI given, take it. Not given, fair value per share of the acquiring company into number of shares by NCI. That is one method. Another method, PC divided by percentage of holding of acquirer into holding by the NCI proportionately. Or second method, PSNA. How to calculate under PSNA method? Fair value of the net assets of the acquiring company into percentage of holding. Percentage of holding. And this fair value of the net assets already taken in as per step number 4. So I think this is step number 5. So till now how many steps over? 5 steps. So tell me what are the 5 steps. First, identify the acquirer. Who is acquirer? Who pays PC? Exception, reverse acquisition. Step number 2, date of holding, date of acquisition. What is the date of acquisition? Date you acquire the control or written agreement if it is there. If for example government approval required, the date of approval. What is step number 3? PC, cash paid, fair value of assets transferred, fair value of the shares, debentures, other securities transferred, present value of the deferred consideration, fair value of the contingent consideration. Everything you add. Next, step number 4, identification of the net assets at fair value. In that, you take all the assets, liabilities at fair values. 3 important points. Any intangible assets they have not recognized because recognition criteria not satisfied, you recognize at fair value. Second thing, any contingent liabilities will be recognized as a liability at fair value. And indemnification asset also relating to this contingent liability will be recognized to the extent of the liability. and any non-current assets held for sale. Any non-current assets held for sale in the acquiring company will be taken at fair value less cost of disposal. Right? Step number 5, NCA. This is the step. Okay. So 5 steps we completed. Now next sixth step, sir. Sixth step once over na sir. 7th step is entry. 8th step is preparation of consolidated balance sheet. The preparation of financial statements, nothing but consolidated financial statements we have to prepare. Okay. Okay. So let me explain step number 6 also, sir. Very, very important step number 6. One of the most important steps in this entire procedure is step 6. What is step number 6, sir? Calculation of goodwill or gain on bargain purchase on acquisition date. Calculation of what? Goodwill or gain on bargain purchase. What is this calculation of goodwill or gain on bargain purchase on acquisition date? Let us discuss it. Sir, first of all, understand, sir, this goodwill or gain on bargain purchase, how we are going to calculate it? First take PC, which we calculated as per step 3, PC. For that you add NCI, non-controlling interest you add, NCI, which you calculated as per step 5. From that you reduce net assets of the acquiring company which you acquired at fair value on the date of acquisition, which you already calculated as per step number 4. Deduct it. The difference is goodwill or gain on purchase. Suppose if the difference is positive, goodwill, negative, gain on bargain purchase. Okay. Sir, what is this, sir? We don't understand. Simple. Listen to me carefully. Sir, I am S Limited, sir. Listen to me, important. I am S Limited, sir. I acquired 100% equity shares of Infosys Limited, for example. And imagine, that means NCA will be there or not there? No, not there. I am having 100%. NCA will not be there. Suppose I paid PC. For acquiring this 100%, I paid PC of 100 lakhs. In return, the net assets I am getting is 80 lakhs. That means how much excess I paid? 20. Obviously, understand, I am paying you 100 lakhs and in return I am having control over your 80 lakhs assets. Fair value of your assets is 80 lakhs. That means I am paying excess 20 lakhs now. That excess is called goodwill. Why? Why I will spend more than what I am getting? If you have 80 lakhs assets but I am paying 100 lakhs means I feel your business is worth. In future your business is going to give me some additional benefits. That's why I am calling this as goodwill. Basically goodwill is what, sir? Intangible asset. So I am paying excess means I feel something valuable. That's why I am spending more. Otherwise, if I am getting 80 lakhs worth of assets, if I am getting control over 80 lakhs, why I will pay 100 lakhs? So this 20 lakhs is called goodwill. Imagine other reverse. For example, I am paying 100 lakhs PC for acquiring your 100%. But I am getting 110 lakhs of worth of assets in your company. So as a acquiree, you are having 110 lakhs of assets. I am giving you 100 lakhs and getting control over these assets. Right? So that means I am paying less or more? Less. Because I am getting 110, I am paying 100. So therefore, gain for me. So this is called gain on bargain purchase. I am bargaining better. That's why I got the gain. I said, I convinced you, hey, you are having 110 lakhs asset, but I am giving you 100 lakhs. I convinced you. That means it's a gain for me, na? That's why the standard says gain on bargain purchase. Basically, this gain on bargain purchase is called capital reserve. It will be transferred to capital reserve in OCI. Other comprehensive income, it will go to capital reserve. That's why generally some books, they don't use this gain on bargain purchase actually. They will directly show capital reserve. So gain on bargain purchase, obviously it will be shown in OCI capital reserve. Okay, that point also I have given here. See this. Gain on bargain purchase should be recognized in OCI and accumulated in equity as what? capital reserve. Okay. Sir, imagine, listen, important. Suppose now I am not acquiring 100%. Suppose I am having 70% in your company. I am having 70%. Imagine, important, listen to me. 70% in your company. See, for this 70%, suppose I am paying PC of 10 crores. I am paying PC of 10 crores. So 10 crores PC I am paying. What is the net assets of your company? 8 crores. Frankly speaking, in this 8 crores, my share is only 70%. So 8 crores into 70%, 5.6. So 10 crores I paid. I am getting control over net assets 5.6. How much excess I am paying? 4.4. This is called. But you should not follow this method to calculate. This is a wrong way to calculate. Okay. Sir, then how to calculate, sir? Simple. Take first PC. PC, how much you paid? 10 crores. This is only 70%. Na? Another 30% belongs to NCI, which you already calculated in step 5. Take it. Suppose 2.4 crores. Imagine 2.4 crores. So that means 100% of the business is acquired. What is the amount we spent? 12.4. We paid 10 crores. NCI share 2.4. So total 12.4. This 100% is compared with the 100% of the net assets of the acquiring company. What is the difference between these two? You understand? Here, my 70% PC, my 70% net assets I have taken, but this should not be done. When I am considering goodwill or capital reserve, I need to take first PC. As a acquirer, how much I am paying? 70%. In this example, 70% PC. Remaining 30% NCI also take. Now it will become 100% of the business. Compare with the net assets I am taking, 100%. Then whatever you will get is goodwill or capital reserve. Of course, here same answer you got it. But the procedure is this. This is how you need to calculate. You understand, guys? So tell me how to calculate goodwill or capital reserve. First, PC. Add NCI. As per step 5. We already calculated. Minus net assets. As per step number 4. Net assets already. Identify the net assets. Na? You will get what? Goodwill. You understand the logic? So see this procedure. So that's why I have given here. Take PC, add NCI, less net assets of the acquiring company. Then you will get gain or goodwill or gain on bargain purchase. Now here one important point I will mention. Sir, this goodwill whatever you got, na sir, this is called full goodwill, partial goodwill. When it will be called as full goodwill? When NCI is calculated as per fair value method, this goodwill is called full goodwill. When NCI is calculated as per PSNA method, this goodwill is called partial goodwill. So in business combination chapter, you will find sometimes full goodwill, partial goodwill. Don't confuse. What is this full goodwill? I will explain. See this full goodwill. When we call goodwill, we arrived as per step number 6 as full goodwill. When NCI used in step 6 is calculated as per fair value. How NCI is calculated? Which method we used? If we use fair value method, then whatever the goodwill we got in step number 6, that is goodwill is called full goodwill. When we call goodwill is partial goodwill, when NCI used in step 6 is calculated as per PSNA method. Sir, why sir? What is this full goodwill proportionate partial goodwill? Simple sir. Generally, goodwill will arise when sir? Yes, when the purchase consideration is in excess of net assets, goodwill will come, right? So in fair value method, generally how you are calculating the NCI? Based on this fair value only. Therefore, whatever the goodwill you got it's a full goodwill. Full goodwill means it belongs to both parent company, acquirer as well as NCI. That's why it is full goodwill. But in proportionate share in net assets method, PSNA method, I am not calculating NCI based on fair value. I am considering the net assets, fair value of the net assets of the acquiring company on the time applying. I am not considering the purchase consideration paid by acquirer company to calculate NCI. Therefore, this goodwill is a partial goodwill. It will not belongs to both of them. It will not include NCI share. You understand the logic? Full goodwill, partial goodwill. Full goodwill means NCI calculated as per fair value method. In fair value method, you calculated NCI share based on the purchase consideration of the acquirer company. So therefore, this goodwill belongs to both of them. But if you follow proportionate share in net assets method, you have not calculated based on the fair value. Therefore, the goodwill you got is only partial goodwill. Of course, not that much this one, but this is the thing. So you understand step number 6, sir? So tell me, sir, what is step number 6? Calculation of goodwill or gain on bargain purchase. Simply capital reserve. How to calculate? PC, which you calculate step number 3. Add NCI, step number 5, minus net assets as per step number 4. Difference positive came. Goodwill. Goodwill can be full, partial. When full? If NCI is calculated as per fair value method. If NCI is calculated as per PSNA method, partial goodwill. Okay, this is how you need to do. I think we have completed till step number 6. So accounting for business combination on day 1 till now, I think we have completed 6 steps. Correct? What is first step, sir? Acquirer. Identify the acquirer. Second step, date of acquisition. Third step, PC calculation. Fourth step, identification of net assets taken over from the acquiring company at fair value. 5, NCI. 6th, goodwill or gain on bargain purchase. 7th, entry. Accounting entry for business combination. Accounting entry for business combination on the date of acquisition by the acquirer. So your acquirer company, what is the entry you are going to write for this acquisition of acquiring company? See, from acquiring company, we are getting control over assets. So assets account will be debited. Correct? Taken over of the acquiring. Same manner, liabilities. Whatever liabilities of the acquiring company, that we will take it. Already we know we have taken the assets and liabilities in step number 4 at fair value. So same things, assets and liabilities, we will take it. And to NCI we will write. NCI we need to calculate and we need to show it as a separate item, I told you. Generally NCI will have what balance? Credit balance. Credit balance. That's why in balance sheet we will show it is after the equity. Separate item, separate line item. So why NCI calculated also I explained. Because you may not have 100% shares, but you are incorporating 100% net assets of the acquiring company. Therefore, minority shareholders share in the net assets of the acquiring company. That is NCI. So that's NCI is a kind of a liability for you, which you already calculated as per step number 5. So assets, liabilities, NCI. And in return you are paying what? PC, purchase consideration. Purchase consideration is your liability, so to PC. Okay, and the balance figure is either goodwill or gain on bargain purchase. Same as step number 6, sir. Step number 6, whatever we have done, same thing we put it in the entry. Generally, you know, understand business combination. Business combination entry is what? Assets. Which company assets? Acquiring. Because now we are adding acquiring company assets for consolidation purpose. Similarly, liabilities of acquiring company we will add. Okay? And you know this at what values? Fair values. This we already done in step number 4. So assets minus liabilities, net assets. Net assets we have incorporated. And these net assets 100% we incorporated. But in this the portion belongs to NCA. So NCA we recognized liability to NCA. This we already done in step number 5. So if you observe assets minus liabilities NCI, and we are paying what? PC, purchase consideration we are paying PC. So assets, liabilities, NCI, PC. The difference is either goodwill or yes, gain on bargain purchase. So assets and liabilities, net assets 100% I am incorporating. PC I am paying, suppose 60% PC, I acquired 60%, NCI 40%. See that's it. So 100% of the net assets, 60% is my liability PC, 40% belongs to NCI. Difference will go to goodwill or gain on bargain purchase. Okay, this is step number 7. You understand this entry? This entry will be written by whom? Acquirer, for preparation of consolidated financial statements. Acquirer, for consolidated financial statements, this entry they will write. Hello? And suppose if you are a acquirer who acquire acquiry company through net assets. If you acquire acquiry through net assets, not through shares, then you will not prepare consolidated financial statements. You will prepare only SFS. I told you. In that SFS, this entry will be incorporated. Now, see, entry number 7 is this entry. Now, what is step 8? Preparation of consolidated balance sheet or preparation of standalone financial statements if you acquire through net assets by giving effect of this entry. Now see, you are a parent, suppose you are acquirer. Acquiry company, these are the figures you need to incorporate. For example, acquirer assets, now acquiry assets will be added. Okay, this goodwill, if it is there, it will come in consolidated balance sheet. Suppose acquirer liabilities, now acquiry liabilities will be added. NCI will be shown. Consolidated financial statement. Suppose if you acquire through net assets, NCI will not come now. You understand? Link is there. Important. I explained already. PC. Next, once you write the entry, next entry is what? PC account debit to whatever PC you giving. PC can be given in the form of 2 cash or bank, 2 equity share capital. You may issue equity shares. 2, suppose sometimes shares will be issued at premium. You will write 2 securities premium because you are issuing PC in the form of shares. Shares can be issued at premium also, na? 2 debentures. Whatever PC you are giving, you will write it. Okay, so this entry, entire entry effect will be given. So consolidated balance sheet ready. That is last step, sir. See this. Preparation of consolidated balance sheet of acquirer after business combination. Start with acquirer assets, liabilities, equity, reserves at carrying value. Whatever the assets, liabilities, equity, reserves, share capital is there in the acquirer books. For that, incorporate the effect of business combination entry passed in step number 7. Whatever from the acquiry company we are getting, this is the entry. This we will incorporate. Automatically consolidated balance sheet ready. That's it. So consolidation is over. So we are learning Ind AS 103. Ind AS 103 provides accounting treatment for consolidation on day 1 acquisition date, and business combination happens through acquisition of control of business. Control can be acquired through 2 ways. One is having more than 50% shares. When you acquire more than 50% shares, the other company will not liquidate, it will continue. Therefore, you need to prepare CFS on day 1 by following Ind AS 103. CFS at the end of the year, Ind AS 110. Sometimes you acquire control through acquisition of net assets. When you acquire acquisition through net assets, that other company will be liquidated. So the question of consolidation will not arise. Therefore, in SFS itself, we need to give effect of this entry. You understand? That's the logic. So that's it. All the steps have been done, sir. So total how many steps? 8 steps. Follow these steps. And the unique point is, if you see the answers of any book, very unsystematic answers are there. The best part of my classes is that I have solved all the questions as per the theory I have discussed. For example, now I explained 8 steps. Every question I have solved accordingly, so that you can easily match the concept with the solving questions. That's the best part. So entire question bank I have solved like this. Of course, now I am going to solve some questions for you. So we have completed which method? Acquisition method. I told you now, this method is called acquisition method. Acquisition method. On day 1 consolidation we have completed. So let's solve some questions so that you will have an idea. Yeah. Come to study material questions, sir. First, question number 4. Question number 4, sir. See this question, everybody. Question number 4, important, problem number 4. Read the question carefully in exam also. On March 31st, 2021, P Limited acquired Q Limited. P Limited acquired Q by issue of 3 lakhs equity shares of rupees 10 that were trading at 16 on 31st March. The summarized balance sheets of companies as at 31st March 2021 before acquisition, before takeover, the balance sheets given: P Limited, Q Limited, book values as well as market value, and nothing but fair values given. Net assets, equity share capital, other equity. Show acquisition journal entry under Ind AS 103, summarized balance sheet after business combination. Also show necessary accounting in the books of acquiry. First of all, let's have 100% clarity of theory of what we have discussed. Let's try to apply it. Step by step I will go. Here, who is the acquirer? P, acquirer, no doubt. Date of acquisition? 31st March 2021. Right? Now, here you tell me how P is acquiring Q. Is it through equity shares? Equity shares, huh? No. Read the question. P Limited acquired Q Limited by issuing 3 lakh equity shares. That means we are giving PC in the form of equity shares. We are not acquiring Q Limited through shares. PC we are giving in the form of shares. Read. P Limited acquired Q Limited by issue of 3 lakh equity shares. That means acquirer company is giving 3 lakh equity shares to the shareholders of Q Limited. So this is PC. Where P is acquiring Q, sir, is there anywhere they said that Q Limited shares is taken over by P Limited? No, nowhere. So therefore this is acquisition of control through net assets. That's it. So acquisition of control through net assets. Because here P is not acquiring Q through shares. Nowhere mentioned. Read the question carefully. That's what I want every one of you. So therefore here control is acquired through net assets. Tell me, when you acquire acquisition through net assets, what I told you, parent subsidiary relationship will come? No. So where on day 1, okay, you will do this entire incorporation effect in which financial statement? Standalone financial statements of which company? P Limited. So P Limited books itself we are going to incorporate that entry number, step number 7. What is step number 7? Entry. Assets to liabilities. NCA will come? No, NCA will not come because you acquired through net assets. NCA will not come. So assets, liabilities to PC. Difference will go to goodwill or gain on bargain purchase. That's it. So acquisition journal entry they are asking. First of all, step number 1 done, step number 2 done, step number 3 PC. Can you tell me PC here? PC is given in the form of equity shares. 3 lakhs equity shares into, will you take 10 rupees market value 16? 16, because PC is calculated at fair value. Fair value of shares issued. So 3 lakhs into 16. How much? So see, PC is 48 lakhs. Correct? PC is 48 lakhs. So PC done 48 lakhs. So if you see problem number 1, acquirer is P Limited, date of acquisition 31st March 2021, calculation of PC 48 lakhs. What is step number 4? Can you tell me? Net assets at fair value. Q Limited acquiry, right? What is the net assets of acquiry company? 45 lakhs given directly. Market value is nothing but this one. Fair value of the net assets directly given 45 lakhs. So take it 45. What is step number 5? NCI. NCI will come, not come. Why? Acquisition through net assets. NCI will not come. What is step number 6? Goodwill or gain on bargain. Can you tell me goodwill or gain on bargain purchase here? How to calculate goodwill or gain on purchase? First you take PC. What is PC here? 48 lakhs. NCI 0. Minus net assets 45. So 48 minus 45. 3 lakhs extra you are paying is called goodwill. So 3 lakhs is the goodwill. Next, entry. What is the entry you will write? Assets, liabilities. Here directly net assets given. Net assets account. At what value? Fair value, 45 lakhs. To PC, you are paying 48. To PC. PC is your liability. So difference will go to goodwill. And this PC is given in the form of equity shares. So PC account debit to equity share capital. How many equity shares they are giving? 3 lakhs equity shares. See this. Each equity share face value 10. That means 3 lakhs into 10 will go to share capital. Remaining will go to securities premium. Because P Limited is issuing shares, na sir. As a issuer, when you issue shares above the face value, the difference will go to securities premium. So therefore PC to equity share capital to securities premium. Over, done. Step 7. Now step 8. What is step 8? Now you tell me now. P Limited, will it prepare consolidated balance sheet? No. It will prepare SFS. In that SFS only the effect will be given. Why? Why P Limited will not prepare CFS on day 1? Because here parent subsidiary is not there. Hey, here acquisition happened through net assets pa. So that's why, see here, individual books only they will write the entries. See, individual set of P Limited journal entries. This is what. And see, individual balance sheet of K Limited, not K. This is P. They will prepare individual balance sheet. They don't prepare consolidated financial statement separately. In individual balance sheet itself, they will give the effect. Now, how they will prepare? See this. How they will prepare? First, you take assets. Which company assets I will take first? Acquirer. Tell me, acquirer company assets. First, acquirer company assets. Book value we need to take. How much? 80 lakhs. Plus, now from Q Limited, fair value of the net assets how much? 45. So total assets of the company P Limited after acquisition is 1 crore 25 lakhs. You understanding, guys? P Limited assets you take at what value? Not fair value, at book value. Q Limited assets at fair value. Goodwill is now incorporated in P Limited books. How much goodwill? 3 lakhs. So total balance sheet 1 crore 28. Liability side you come, equity and liabilities. In equity and liabilities, first I will show equity. In that equity share capital. Tell me now, what is the existing equity share capital of P Limited? 60 lakhs. Plus, for Q Limited, we are issuing 3 lakhs equity shares of 10 rupees each. That means 30 lakhs. So 60 plus 30, 90 lakhs is the share capital after acquisition. Correct? Existing 60, issued to the acquiree 30. Now, reserves and surplus, nothing but other equity. In P Limited, what is other equity? 20. Any other item will come? Securities premium. We issued shares above the face value, na? Hello? So securities premium will be added 18. That's it. Balance sheet is done. Do you have the clarity? This is whose books we have done. Look at how easily I have done it. This is the power of conceptual learning. When you learn something systematically, these problems will become easy. Now, I am asking one important question to you all. If you see the question, okay, P Limited books, acquisition entry, balance sheet, they have asked. They are also asking necessary accounting in the books of acquiry. Acquiry means? Q Limited. Q Limited books, what accounting you do? Will you follow Ind AS 103? No, Ind AS 103 is applicable only for acquirer, not acquiry. So Q Limited books, what accounting you will do? Common sense. Q Limited is selling their net assets to P. That means Q Limited will be liquidated. Therefore, you need to close the books of accounts of Q Limited. So Q Limited books, we need to close the books of accounts. How you are going to close the books of accounts of a company? Open realization account. Transfer all the assets and liabilities to realization. Whatever the PC come from P Limited, record in realization account. Close the realization account. You will get profit or loss. That will be given to equity shareholders. Whatever the PC received from P Limited, give it to equity shareholders, account will be closed. Normal, when partnership firm dissolved, what we will do? When a business is closing down, what we will do? All assets will be closed, all liabilities will be closed, any purchase consideration will be received, and partner's account will be settled. Same happens with company also. You are a Q Limited, you are selling your net assets to P Limited, so Q Limited books assets will be closed, liabilities will be closed, PC will be received from P Limited, shareholders, this PC will be transferred. Whatever the share capital, whatever the reserves and surplus there, give it to Q Limited share capital, Q Limited reserves and surplus will be given to Q Limited shareholders. Whatever the PC received, give it to them, their account will be closed. This is what we do in the books of company which is liquidating. Hello? See here. The company which is liquidating in the books of Q, accounts are closed through realization account. Accounts are closed through realization account. Actually, this is not given in Ind AS 103, but in the some of the questions they have mentioned this. So in examination, if at all they ask the accounting treatment of acquiry company, when acquisition, see this is applicable only when acquisition happen through net assets. Suppose if acquisition happen through share capital, will you close the books? No, because that company will continue. This will be happen only when the acquisition happen through net assets. Common sense. How you are going to close? I told you, na? Realization. See, all net assets transferred to realization. At what value? Book values this time. Because I am closing the books of Q Limited, na? So Q Limited point of view, you think. In Q Limited net assets, how much is there? 42 lakhs. Hello? Close it. 42 lakhs is there. See this, Q Limited, 42 lakhs. Okay. When you close the assets, what is the entry? Assets will be credited, realization account will be debited. So realization to net assets. And you receive PC. How much PC? 48 lakhs. PC you received from P Limited. In PC is received in the form of shares. So equity shares in K Limited to realization. Equity shares in P, actually P Limited to realization. Actually you can write two entries. First PC due, then PC received. They have written directly received entry. PC due entry, PC received entry also you can write. Okay. What is the entry you can write? PC due. For example, P Limited to realization. Then equity shares in P Limited to P Limited. That's it. So the net entry is what? Equity shares in P Limited to realization account. Okay. Actually, see here, actually I have done it. This is how you need to do. Realization to net assets, equity shares in P Limited to realization. Directly they have written. And now realization account will be closed. Tell me in realization account debit side how much debited? 42. Credited? 48. So how much is the profit? That will be given to equity shareholders. So realization to equity shareholders. See this 6 lakhs, 6 lakhs. So main purpose of opening realization account is what? To ascertain the profit or loss at the time of closing of books of accounts. So they got a profit of how much? 6 lakhs. Sir, when the business is closed, obviously any profit or loss will be given to owners only, na? That's why to equity shareholders. Correct? Equity shareholders are owners. So realization to equity shareholders, 6 lakhs, 6 lakhs. Now close the equity shareholders account. How you are going to close equity shareholders account? What belongs to equity shareholders in the company? Equity share capital, reserves and surplus. So transfer it. Equity share capital, other equity to equity shareholders. In Q Limited, you see what is the equity share capital of Q Limited? 25 lakhs. Correct? What is other equity? 17. So this 25 plus 17 will be transferred to equity shareholders. Now equity shareholders will be given this PC. PC is received in the form of equity shares. So see this, equity shareholders to equity shares in Q Limited, 48, 48. So their account will automatically gets closed. So if you prepare equity shareholders account here, it will get tally. See this, 25 lakhs equity share capital, other equity 17, realization profit 16. They got a PC of 48. That's it. Realization account 48 lakhs PC, 42 lakhs net assets we transferred. So 6 lakhs profit that is given to equity shareholders. That's it. Hello. You understand question number 4? So what is the specialty of problem 4? You understood? Here acquisition happened through net assets. NCA is not applicable. And we have incorporated the acquiring company business combination entry in SFS or CFS? SFS. And accordingly we have done it. You understand this? Now come to problem number 5. You look at problem number 5. In study material, sir, some beautiful questions are there. You look at problem number 5. You tell me. Same question. I am once again reading this question to you all. See this. On March 31st, 2021, P Limited acquired 100% shares of Q Limited. Remaining question is same exactly almost. Now I want every one of you to understand. These are the concepts. What is the difference between problem 4 and 5? In problem number 4, acquisition happened through net assets. But you look at here, P Limited acquired. Here acquisition happened through shareholding. Therefore, Q Limited will not liquidate. Therefore, Q Limited books will not be closed. So, what is the accounting treatment in the books of Q Limited? In the books of Q Limited, no entry will be recorded. Because Q Limited is not liquidated. No need to close the books of accounts like in problem number 4. You understood or not? What is the difference between 4th and 5th question? In 4th question, P Limited acquired Q Limited through net assets. Here acquired through shares, clearly given shares. Sir, when you acquire any company through shares, will that company continue or will it dissolve? Continue, na? So therefore Q Limited will continue. So therefore no need to close the books of accounts of Q Limited. Now you tell me P Limited books. So now P Limited will become a parent. We have a subsidiary. So on day 1, will you prepare consolidated financial statements or not? Yes. Day 1 consolidation by following Ind AS 103. So in problem number 4, will you prepare consolidated financial statements on day 1? No. There is no parent subsidiary. Therefore, the effect is given in SFS only. But here, parent subsidiary is there. My subsidiary is there. Q Limited is my subsidiary. P Limited is my parent. So I need to prepare consolidated financial statements. That's why in this question you see, in consolidated set of P Limited, consolidated balance sheet. Last problem you see, if you observe the headings also, individual balance sheet, individual set of P Limited. How many of you are you observing, sir? Effect same, sir. Next, everything is same. What is step number 1? Date of acquisition. Any change? What is the date of acquisition? March 31st, 2021. Second step. First step, acquirer. Who is acquirer? P. What is the date of acquisition? 31st March 2020. PC, same. 3 lakhs into 16. How much? 40? 48 lakhs. Fourth step, fair value of the net assets of the acquiry. How much? 45. Step number 5. NCI. Will NCI come? No. Why? 100% you acquired. So NCI is not there. NCI not there. Step number 6. Goodwill or capital reserve. How much? 48 lakhs PC. NCI 0. 48 minus 45. 3 lakhs is a goodwill. Same. Business combination entry. Net assets to PC. Difference is goodwill. Where? In consolidated financial statements. Not in the SFS. Suppose this investment, if you want to do the accounting in SFS, will you follow? 27. Ind AS 27, you follow it. Now you are getting the subject. This is the real concept. Say same balance sheet also will not change. In the individual books of P Limited, if you want to do the accounting, you will follow Ind AS 27. That they have given that also. Investment to equity share to securities premium. Of course, not required. So this is one question, sir. Sir, 4 and 5 you do again, sir, because both will give you main difference between these two things. Okay. Come to problem number 7. See this question. Problem 7. On 1st January 2021, date important. M Limited acquires 80% of the equity shares of P Limited. So this is acquisition through shares by issue of equity shares of paid up value of 100 lakhs. Market value 240. So will you take market value or paid up value? Market value. This is nothing but PC. So PC how much? 240. The identifiable assets are measured at 380. Liabilities assumed measured at 60. So 380 minus 60. 320 is what? Net assets. Step number 4. Recognition of net assets of acquiring company. NCI is measured at which method? Proportionate net assets value. PSNA method. In this question NCI will come. Yes, because you are having 80. So remaining 20% is NCI. Past journal entries. Now you tell me, in this question, read the question carefully. In examination, you follow the structure. Sir said what? Business combination. Here acquisition happening, net assets or shares. Shares 80%. Next, first thing. Steps. First step. Acquirer. Who is acquirer? Finished. Date of acquisition. 1st January 2021. Finish. Next 3. PC. Who pay PC? Acquirer. P Limited. P Limited is giving what? Share. PC given I think how much? 240 PC. So first 3 steps very easy na. Acquirer M only na. Date of acquisition January 1st. PC 240. Next net assets given I think how much? 380 minus 60. So 320. Next step number 5 NCI. Can you tell me NCI calculation? Which method I need to follow NCI? PSNA method. In PSNA method, how to calculate? Fair value of the net assets. Step number 4 into 20%. So 320 into 20%. See this. 64 lakhs. Then step number 6. Goodwill or gain on bargain purchase. How to calculate goodwill or gain on? First I need to take PC. PC how much? 240 for 80%. Add NCI 64. Total 304. Minus net assets 320. So how much came? Minus 16. What is this minus 16? Gain on bargain purchase. Gain on bargain purchase. Tell me the entry here. Assets account debit. How much worth of assets we are taking? 380. To liabilities 60. To NCI 64. To PC 240. Gain on bargain purchase 16, which is transferred to capital reserve. That's it. Any difficulty? No. Easy now. So I think once you've done step number 7, next step is what? Balance sheet. Sometimes in the question they don't ask consolidated balance sheet. They will ask you to calculate goodwill, capital reserve. Like that they will ask. So that means you have to do up to step number 6. Step number 6. Or directly step number 6 remaining working note. Depending upon what they have asked in the question, you have to frame yourself. What is the main answer? What is the working notes? You can do it. They will give you. But you should not forget the structure. Like when I am calculating goodwill or gain on bargain purchase, first PC, add NCI, minus net assets. So like that you have to calculate. So this is one question, sir. Next, Problem number 8. You see problem number 8. On March 31st, 2011, A Limited absorbed B Limited. That means A Limited is taking over B Limited. A Limited issued, not taking, issued PC 60,000 equity shares of 10 per value that were trading at 25. That means 60,000 into 25, you will get PC. The book value of B Limited net assets, book value of B Limited net assets 12 lakhs, equity share capital 5 lakhs, other equity 7 lakhs. Fair value of the net assets is 13. Will you take book value or fair value? Fair value. Okay, so you need to pass the journal entries complying Ind AS. Now first you have to tell me, what is your observation in this question? How the acquisition is happening? Through shares or through net assets? Net assets. That you need to identify, because we are not here acquiring shares. So A Limited is acquiring B Limited net assets. So therefore when you acquire through net assets, consolidation effect will be given in SFS by following Ind AS 103. Correct? What is step number 1? Identify the acquirer. Who is acquirer? A Limited. Second, date of acquisition 31st March 2011. Third, PC. PC is how much? 60,000 into 25. 15 lakhs. So this 15 lakhs is the PC. Step number 4. Net assets acquired. Fair value of net assets acquired. Will you take book value or net asset fair value? Fair value. How much? 13 lakhs. NCI will not arise. If acquisition happened through net assets, NCI will not arise. I told you. So NCI is nil. Next, goodwill or gain on bargain purchase. How to calculate? First, PC. How much is the PC? 15 lakhs. NCI nil. Less net assets 13. So how much excess? 2 lakhs. So goodwill. What is the entry? Net assets fair value, nothing but goodwill to PC. This PC is given in the form of equity shares. How many equity shares? 60,000 into 10 face value. See, when you are creating share capital, always first credit face value. Remaining will go to securities premium. That's it. This effect will be given in the acquirer standalone financial statements in the balance sheet. That means acquirer figures, now this effect. Then your books are ready. You understanding, guys? One problem I solved now, problem number 4. Same problem, first problem. So this is the thing, sir. Okay, now see problem number 14, sir. So very good question actually. C Limited acquires 60% shares in D Limited. So C acquired how much, sir? So acquisition is happening through shares for cash payment of 2 lakhs PC. Fair value of non-controlling interest is 1 lakh. That means NCI given. Fair value of NCI, how much? 1 lakh given in the question. Actually in this question, shall we require to calculate NCI? Yes, because acquirer is having 60. That means remaining 40 NCI on. We need to calculate, but they have given in the question. I told you when NCI is given in the question, we will take it. Fair value of NCI. The amount was determined with reference of market price of D's ordinary shares before the acquisition date. See, this amount of 1 lakh is determined based on the fair value market price. What they are asking, see here, calculate NCI and goodwill following fair value approach, proportionate share of identified net assets in acquire approach. That means on the acquisition date, the aggregate value of these identifiable net assets is 2 lakh 40, 3 lakhs, 3 lakh 30. Sir, here they are asking us to calculate two things, sir. One is NCI and then goodwill. Under fair value, under PSNA. Both the methods they are asking. But if you want to calculate NCI and PSNA method, I want net assets, fair value of net assets now. So that's why they are giving here identifiable net assets 2 lakh 40 one case, 3 lakh 30 another case. Okay, now you tell me, suppose if I calculate under fair value approach the NCI, okay, how much it is? Already they have given how much? 1 lakh. So therefore, if I calculate under fair value method, fair value of NCI is given, so we'll take directly 1 lakh. Hello? already given, no need to do anything. Now next PSNA method you write it. Come. In PSNA method, two situations they are given. One is 2,40,000, another one is 3,30,000. If the net assets of the acquiring company at fair value 2,40,000, how much is the NCI? 2,40,000 into 40%. 2,40,000 into 40%. How much? 96,000. Correct? Suppose if the net assets is 3,30,000, 3,30,000 into 40%, 1,32,000. So NCI is done. How simple? Fair value method they have given directly. PSNA method, two cases they have given. If net assets is 2,40,000, if net assets is 3,30,000. And two methods. Now they are asking goodwill also. Hello? Can you tell me how goodwill will be calculated here? Goodwill. Goodwill. For example, you see PC how much? 2 lakhs. Correct? NCI. If they follow fair value method, it is 1 lakh. Total 3 lakhs. What is the net assets? Net assets two situations now. One is 2,40,000, another one 3,30,000. So 2,40,000. How much? 60,000. Goodwill came. Hello. Suppose if I take this net assets 3,30,000, my answer will change na? Same PC 2 lakhs, NCI 1 lakh, net assets I need to take 3,30,000. So it will be minus 30. That means gain on bargain purchase. Gain on bargain purchase. But here you need to understand NCI is taken based on fair value. Therefore here whatever the goodwill came, this goodwill is called full goodwill. I told you. Suppose if NCI is not taken based on fair value, if NCI is taken on PSNA method, then what will be the goodwill? See this. Goodwill first you need to calculate. If NCI is based on PSNA. For example, PC 2 lakhs same. If net assets is this much, 96,000. Already we calculated na? If net assets is 2,40,000, 96,000. 2,40,000. So it will be 56,000. But here whatever the goodwill came, this is partial goodwill. Because here NCI is calculated based on proportionate share in net assets method. Suppose if net assets is 3,30,000, 1,32,000 is the NCI. So if I take this 2 lakhs PC, 1,32,000 minus 3,30,000, it will be 2,000. Guys, are you understanding? What I have done, you understood? See here, simple here, they have asked what? NCI calculation. Under which method? Fair value method, proportionate share in net assets method. In proportionate share in net assets method, two situations given. One is 2,40,000, another situation is 3,30,000. So here under fair value method they have given directly how much? 2 lakhs. 1 lakh is this one. So under PSNA method how much I can calculate here? 40%, here 40%. 2,40,000 into 40% means 96,000. 3,30,000 into 40% means 1,30,000. 32,000. So NCI done. NCI done. Now they are asking goodwill also. So if I want to calculate goodwill, first I need to take PC. PC is 60%. Already given. How much? 2 lakhs. For that I need to add NCI. See, when I am adding NCI, there are two possibilities here. Either I have to take NCI calculated as per fair value or PSNA. Suppose if I take NCI as per fair value, which is 1 lakh, so it will be 3 lakhs. From that I need to reduce net assets. What is the net assets of acquiring company? First one, 2,40,000. Two cases given na? 2,40,000. If I take 2,40,000 net assets, so 3 lakhs minus 2,40,000, 60. Now here the important point you need to understand is this 60,000 is called full goodwill. Why? I logic also explained. Because here NCI is also at fair value, this is also at fair value. So therefore whatever excess coming, this is the full goodwill belongs to both of them. Suppose if net assets is second situation, how much is the net assets? This one 3,30,000. So if I take 3,30,000, instead of goodwill I am getting what? Gain on bargain purchase. Gain on bargain purchase, which will go to capital reserve. This is goodwill I calculated if the NCI is taken on which basis? Fair value. Suppose instead of fair value, If goodwill is calculated, suppose PC 70%, 60%, as usually same. How much? 2 lakhs. Correct? Now for this I need to add NCI. Here NCI is calculated based on PSNA. Here first one 96,000. 96. So 2 lakh 96,000 minus net assets 2 lakh 40. This one 2 lakh 40. So therefore 56,000 is what? Goodwill. This is obviously partial goodwill. Second case, same. If net assets changes, NCA will also change. Na? This one 1 lakh 32. Very simple. 3 lakh 32 minus net assets 3 lakh 30,000. So goodwill, how much? Understood? This is problem number 14. So one beautiful question, we have solved it. Next, all other small questions based on the concept I have explained, if you solve, you can easily solve it. Okay, now see in workbook, see question number 1, very good question from the CMA workbook. Question number 1, see this question. On January 1st 2021, AK Limited acquired 60% stake in BK Limited. So business combination through shares. Company engaged in manufacturing machinery components. BK Limited has 1,05,000 equity shares of 10 each. And the quoted market price of the share was 14 per share on the acquisition date. Quoted market price means fair value, nothing but market price. Quoted market price. Fair value of BK Limited identifiable net assets also given. How much? 90 lakhs. So, as part of PC, AK Limited paid 52 lakhs in cash. Issued 55,000 equity shares at a market price of 27 per share. Nominal value 10 each. Agreed to an additional consideration of 15 lakhs payable if BK Limited cumulative profit for the next 3 years exceeds 15 lakhs. Contingent consideration. On the acquisition date, it was deemed probable that extra consideration would be paid and its fair value is assessed at 10 lakh 80. So we need to consider fair value of the contingent consideration for PC calculation. BK Limited incurred 1,53,000 acquisition related cost. Acquisition related cost we should not include in PC, I told you. NCI measured at fair value, they have given. How will AK Limited account for the acquisition of BK Limited under Ind AS 103? Provide detailed workings and pass necessary journal entries. Balance sheet not required, but necessary journal entries they are asking. I want every one of you to approach in a systematic manner based on the concept I told. First thing, step by step we will go. Step by step. What is step number 1? Acquirer. Who is acquirer? AK Limited. Done? So AK Limited acquirer. Second, date of acquisition. 1st June 2021. So 1st June 2021 is the date of acquisition. Done. What is step number 3? PC calculation. PC calculation. How PC will be calculated? Whatever we pay. First cash paid. How much? 52. Take 52. 52 lakhs. Because clearly given. Purchase consideration. 52 lakhs in cash. Second, 55,000 equity shares at a market price of 27 per share. 55,000 into 27. Fair value of shares issued. How much? 1 crore? 55,000 shares into 27. 14 lakhs. So 55,000 into 27, sir. 14 lakh 85,000. This is 52 lakhs cash. Plus, third point you see, agreed to an additional consideration of how much? Payable if BK Limited, if acquiring company cumulative profit for the next 3 years exceeds 1 crore 15. That means I told you contingent consideration. What is contingent consideration? Consideration which will be paid in future subject to conditions. What they are saying is, if my acquiring company earns profit, cumulative profits exceeding 1 crore 15 lakhs, we will pay extra 15 lakhs. That means this is contingent consideration. This contingent consideration, what is the fair value? 10 lakh 80. Don't take 15. Take the fair value of contingent consideration. I told you. So 10 lakh 80,000 you take it. How much? 77 lakh 65,000. That is PC. So PC is 77,65,000. So here the most important thing is contingent consideration, fair value you have to take it. Even shares issued also fair value you have to take it. Okay. And sir, will you take acquisition related cost? No, no, we should not take it. So step 3 done na? What is step number 4? Net assets. Given in the question itself, fair value of the identifiable net assets, how much given? See this, 90 lakhs they have given. So take it, 90. What is step number 5? NCI. NCI will come or not come? Will come, because we are acquiring. NCI is 35%. Can you tell me the NCI? NCI will be calculated based on fair value. See, in the question, if you clearly observe, they have given the fair value of the share of the acquiring company. If you listen to my discussion, I told you NCI will be calculated under fair value method, PSNA method. In fair value method, if it is given, we will take it. Otherwise, NCI is calculated like a number of shares held by NCI into fair value per share of the acquiring company. In the acquiring company, what is the fair value per share? 14. Sir, market value per share is 14. Number of shares held by NCI, how many? Actually, how many shares are there in BK Limited? 1,05,000. In that 1,05,000, 35%. How much? 36,750 into 14. 5,14,500 is the NCI. Because you listen to the concept here, in the acquiry B Limited, BK Limited, 35% is held by NCI. Market value, fair value per share given in the question itself. So you got it. What is step number 6? Goodwill or gain on bargain purchase. First you take PC. PC how much? 77,65,000. Add NCI 5,14,500 minus net assets 90 lakhs. Correct? See here 77,65,000 plus NCI 5,14,500 minus net assets step number 4 90. How much, sir? 7,25,500 minus negative. So it is gain on bargain purchase. Gain on bargain purchase. Last one, entry. What is the entry we will write? Net assets account debit 90. To cash PC, nothing but. Or to we will write to PC. PC we will write separately. PC to consideration. Here I have written directly. Cash, equity shares. Equity shares we have given 55,000 equity shares. Face value we need to credit to equity share capital. Any excess will go to securities premium. NCI will write profit on provision for contingent consideration. This is important. See this. How I have written this provision for contingent consideration. 10,80,000. And last one, gain on bargain purchase 7,20,500. We have to write it. You understand? Hello? Any difficulty here? No, same question. Actually, this type of question we already solved. So nothing great here. Okay. Next, one more question, sir. Question number 9. Previous year MQP questions. In that category, question number 9, sir. Satellite Planet Limited question. Okay, this question so many times they have repeated in MQP. So important from examination point of view. See this question carefully. See, on 1/4/2021, two company balance sheets given, sir. Satellite Limited, Planet Limited. Rupees in thousands, sir. Okay. Satellite Limited balance sheet at book values, fair values given. Planet Limited balance sheet given, just book values. What are the items given? Equity share capital, other equity, borrowings, trade payables, PPE, investment property, investments, current assets, contingent liabilities given. Okay. Next, market price of equity shares of Planet Limited, Satellite Limited 16-15 respectively. So market price of the shares of each company given. On the basis of above data, you are required to make necessary accounting for the following cases. What happened here? See, Planet Limited takes over Satellite Limited. Sir, Planet is taking over Satellite. Correct? And PC is settled by issue of 10 lakh 50,000 equity shares. Correct? 10,50,000 equity shares. Pass journal entries in the books of both the companies and redraft the balance sheet of Planet Limited after business combination. Now, I want every one of you to understand here. Who is acquirer? Planet. Here acquisition is happening through shares and net assets. Shares, tell me how much? Here acquisition is happening through net assets, not shares. Sir, Planet Limited is acquiring Set Limited by purchasing shares. No. PC is given in the form of shares. We are not acquiring through shares. Sir, first identify that, sir. See, this is similar to problem number 4 only. First problem I explained. Same problem. Little bit improved. That's it. So, here Planet Limited is acquiring Satellite Limited. How they are acquiring? Net assets. So, when acquisition happened through net assets, you know what to do. NCA will not come. And also effect will be given in the standalone financial statements. Correct? Okay. So, one by one we will go. First step, acquirer. Who is acquirer? Planet Limited. Next, date of acquisition 1/4/2021. First 2 steps, okay? Now PC calculation. PC, Planet Limited is giving what? Equity shares. How many equity shares? 10,50,000 equity shares. Purchase consideration is settled by issue of 10,50,000 equity shares. 10,50,000 equity shares into what is the market price? 16 rupees. See this. Market price of Planet Limited 16, Satellite Limited 15. So, Planet Limited is issuing shares na? 10,50,000. So, the market price of the share is 16. So, 10,50,000 into 16. How much is the PC? 1 crore 68 lakhs. Given. Done. Step number 4, sir. Net assets. What is the net assets from the Satellite Limited, acquiry company? See, this is acquirer. This is acquiry. From Satellite Limited, what is the net assets we are going to get? The net assets will be taken at what value? Fair value. Calculate one by one. First asset side. PP. How much you will take? 10,000 fair value. Next investment property 7,000. Investments fair value not given. So book value itself is fair value. Okay. Next current assets 3,200. I think these are the assets. Add these 4. 21,000 minus liabilities. Liability side borrowings 2,050. Trade payables 2,400. Contingent liabilities. Contingent liabilities. Yes. I told you even contingent liability is also be considered. At what value? Fair value. Important here I discussed in theory. Even acquiry company contingent liabilities will also be considered at fair value. Minus these things. 16,000. That's it. Fair value of net assets. You understand? Acquiry company assets liabilities at fair values. Take it. Including contingent liability. So 16,000 we got it. So contingent liability also should be considered. So step number 4 done. What is step number 5? NCI calculation. NCI, how you are going to calculate? NCI will not be applicable here because the acquisition happened through net assets. When I asked you, you have to tell NCI will not come here, sir, because acquisition happened through net assets. So NCI will not come. Now what is step number 6? Goodwill or gain on bargain purchase. Tell me. First PC. How much is the PC? 1 crore 68. Add NCI nil. Minus net assets 16,000. 16,000. Okay. Sir, this PC is in thousands or crores, sir. This is, I think, you convert this into thousands because every figure is in thousands, right? 16,800. Hello. Because I have taken in normal rupees, but every figure, this is in thousands, right? So therefore 16,800 minus 16. So how much excess we are paying? What is that? Goodwill. 8,000 means in lakhs, I mean in normal rupees it is 8 lakhs. Last entry, acquisition. Whatever the assets you are acquiring. See, you can write entry like this. See this. PP account debit 10,000, investment property 7,000, investment 1,000, current assets 3200, 2 liabilities, borrowings 2050, trade payables 2400, contingent liabilities 750, 2 PC. PC how much? 16,800. Balance difference will be goodwill. Goodwill 8,000 or 8 lakhs. And this PC is given in the form of equity share capital, securities premium. Because how many shares we are giving? 10 lakh 50. Each share face value 10, but we are giving it 16. So therefore that 6 rupees will go to securities premium. So therefore here when you write an entry for business this one combination, assets first you will write at fair value as per step number 4. Liabilities you write as per step number 4. 2 NCI is not there here, PC you write. Okay. And then difference is goodwill in this case came balancing figure, you take it. And later on this PC will be discharged in the form of equity share capital, in the form of securities premium. That's it. How easy it is. Now I am going to ask one important question here. You have to tell who is acquirer in this question. Planet. In Planet company, Planet, will you prepare CFS? No. You prepare SFS. In that SFS you will incorporate this. Why you don't prepare CFS? Net assets method. Subsidiary is not there. That company itself is not there. You understand, guys? See, that's why in the books of Planet Limited directly they have written. Summarized balance sheet also given after takeover. And also in the question if you see they are asking accounting in the books of Satellite also. Satellite Limited is what? Acquiry company. Tell me here Satellite Limited, what happens to Satellite Limited? They will be liquidated. So their books will be closed. I told you in problem number 4. How books will be closed? Realization account. Transfer all the assets, all the liabilities to realization account at book values. PC receive transfer to realization account. Close the realization account. Difference will be given to equity shareholders. Then equity share capital reserves and surplus will be transferred to equity shareholders. Discharge them. Whatever the PC received, give it to them. Their account will be closed. Actually, those are the entries they have written here. See this. Journal entries in the books of Planet Limited. This is not this. Satellite Limited. Journal. See this. First, all assets is transferred to realization account. Then all liabilities transferred to realization. Then PC also they have received. Close the realization account, transfer to equity shareholders. Equity shareholders share capital, other equities transferred. Whatever the PC received, give it to them. Their account will be closed. This is exactly same as problem number 4. If you see, problem number 4 itself is repeated. That means if you solve problem number 4, this is just a repetition of problem number 4. Just a repetition. And suppose if I prepare consolidated balance sheet, I mean SFS, what I will do, sir? Acquirer figures plus acquiree effect. That entry, business combination entry effect will be given. Like this. For example, property, plant, equipment. Planet Limited plus Satellite Limited. Goodwill 800. Investment property, acquirer, acquiree. Investments, acquirer, acquiree. Current assets, acquirer, acquiree. Share capital, existing share capital of acquirer plus how much PC is given. Both will be added. Other equity, including securities premium. Borrowings, acquirer, acquiree. Trade payables, acquirer, acquiree. Even liabilities, contingent liability also recognized. See this. Because we have considered the acquiree company contingent liability also, no? That will also come in the balance sheet. Because we acquired it. You understanding, sir? So whatever the acquiree company effect, assets, liabilities is coming, give the effect into the books of Planet Limited. This is only SFS, not CFS. So this is one question, sir. Wholesome question, you can say. All the points I have solved it. Okay. So this is basic consolidation we have completed. I mean basic business combination accounting we have completed, sir. So once and for all, can you tell me how many steps are there for business combination on day 1? How many steps? 8. Can you tell me one by one? First, acquirer. Identify the acquirer. Who is acquirer? Who pays PC? Exception? Reverse acquisition. Second, date of acquisition. Date of acquisition, generally control acquired or agreement. Government approval required, date of approval. Step 3, PC. PC is calculated on acquisition date at a fair value. Cash paid, fair value of assets transferred, fair value of shares, debentures, other securities given, present value of the deferred consideration, fair value of the contingent consideration will be added. Step number 4, net assets. In net assets, 3 important points are told. Intangible assets not recognized will be recognized. Contingent liabilities will be recognized at fair value, including indemnification assets up to the value, up to the amount of contingent liability. Non-current assets held for disposal will be recognized at a fair value less cost to disposal. Next, step number 5, NCI. NCI, 2 methods, fair value method, PSNA method. Fair value method, if it is given directly, take it. Otherwise, fair value of the acquiring company into number of shares held by NCI, or PC divided by share of acquirer into share of NCI, proportionately. PSNA method, fair value of the net assets taken into NCI share. Step 5, goodwill or gain on bargain purchase. PC, add NCI minus net assets. Goodwill can be full goodwill, partial goodwill. When we call it full goodwill? When NCI is taken at fair value. When NCI is taken at PSNA method, partial goodwill. Okay. And then step number 7, entry. Assets account debit at fair value, 2 liabilities at fair value, 2 NCI, 2 PC. Difference is goodwill or gain on bargain purchase. Then PC to equity share capital, 2 securities premium. If whatever you given in the form of PC. Last entry, consolidation. So this is the basic business combination accounting on day 1 we have completed, sir. Okay. Along with some questions, important questions, I have solved it. Basically, whatever the questions I discussed, based on that you can solve all other questions also. Very easy. Okay. Now next, in business combination, sir, step up acquisition concept is there. Then reverse acquisition concept is there. Then common control is there. 3 more areas are there. They are asking step up acquisition. They can ask reverse acquisition also. Common control also they can ask. So every thing is possible. Okay. But basic business combination accounting you should be perfect with. Once you are perfect in these 8 steps, remaining are just improvements. You will see. Okay. We will see. Okay. So we have completed basic business combination accounting, 8 steps, sir, along with the problems. Now next concept is step up acquisition, sir. In business combination, next concept, step up acquisition. Important, sir, step up acquisition. Already examination from this topic the questions were tested. We'll see those questions also. First, try to understand the step up acquisition concept. Sir, what is this step up acquisition? Sir, when one company acquiring the control of another company, not at a time, stepwise. For example, you see here, S Limited, one company is there. Infosys Limited, another company is there. S Limited on 1/4/2023 acquired 20% of Infosys Limited. 20% only. Now tell me, when we acquire 20%, what happens? Associate. Morning I told, associate. But there is no business combination here. To get the business combination, we should have control. Control means more than 50% or through acquisition through net assets. So here we are acquiring only 20% on 1/4/2023. Next on 1/4/2024, another 20% we acquired. Now we got how much? 40. Still no control, no business combination. Next on 1/4/2025, say this 1/4/2025, 15% was acquired, another 15%. So now it becomes how much? 55%. So now this is business combination. And here if you observe, we are acquiring control stepwise. That's why this is called step up acquisition. Okay. See here, on what date the control is acquired? 1/4/2025. 1/4/2025 is the acquisition date. We acquired control on that date because we are previously having 40%. Now another 15% is added. So now we got more than 50%. So in the above case, S Limited obtains control in Infosys Limited on 1/4/2025, that is more than 50%. This concept is called stepwise acquisition. So stepwise acquisition means what? Acquirer sometimes obtains control of acquiree in which it already held equity interest. Already you have some equity interest. Now you acquired control. For example, on 31st March 2025, entity A holds 35% NCI, non-controlling equity interest. That means we are having only 35%. That means NCI. In 2026, we acquire another 40%. So this is a business combination achieved in stages or a step acquisition. Okay, done. Now, what is the accounting treatment, sir? Anyway, we acquired control. So there is a business combination. What is the accounting treatment for step up acquisition? Same steps. How many steps? 8 steps. What is the first step? Acquirer. Same acquirer. Who is the acquirer in our example? S Limited. S Limited is the acquirer. Same. Step number 1, same. Step number 2. Date of acquisition will differ. Now tell me here in this example, what is the date of acquisition? 1/4/2025, the date which you obtain the control. Earlier, you don't have control. You have investment, but you don't have control. So, in case of step up acquisition, date of acquisition is the date on which you obtain control. You got the control. So, in this example, date of acquisition is when you crosses 50%. When you cross 50% voting shareholding, then that day will be considered as date of acquisition. Correct? So step number 2 is different. Generally, in business combination, we directly acquire control. So that will be the date of acquisition. But in step up acquisition, the moment you crosses 50%, that will be the date of acquisition. What is step number 3? PC. Same PC calculation. Same, but important. Listen. Sir, you tell me, sir, here, acquirer company, first 20% acquired na, next 20% acquired na. That means here now 15% acquired. Total how much acquired? 55%. Will you consider whatever you paid for all these 3 cases, or will you consider only 15%? All the cases have to consider. But already this 20% I paid PC. Latest PC paid this one. So in the question they will give you the latest PC. And previous ones, whatever amount you paid, na sir, you have to take the fair value of those PCs. Fair value of the PC of the already acquired. We need to consider. And we need to add to the latest PC. Then you will get the total PC. Important, once again I am telling. Important. In step up acquisition, how PC will be calculated, sir? Latest acquisition PC. As usual, we will take it. Like how we calculate it? Take it. Previously held investments, PC will be considered fair value. Don't take book values, previously held PCs. Previously held PCs convert into fair value. So that's why here I have written, see this. How purchase consideration will be calculated? PC as calculated in step 3 of basic business combination. Basic business combination, how PC is calculated, we know. Cash paid, fair value of assets transferred, fair value of shares given, all those things. And the most important thing is fair value of previously held investment in acquiree before acquisition date. Before acquisition date, that means before control, whatever the investments already you have, those investments, fair value, you take it. Then you will get the total PC. For that means you see here. Suppose you acquired 15%. Okay, latest one 15%, right? In the example, latest one 15%. Suppose this one you paid 100 PC calculated. Old investments 20%. Take fair values. What is the fair value? We calculated 133.33, 133.33. Based on that, you have to take it. For example, latest fair value, they have given 100 lakhs, sir. The fair value of this PC, 100 lakhs given. For 15%. For 20%, how much it is? Take it. 133.33, 133.33. you will get the total PC. You understand? So tell me how to calculate PC in step up acquisition. Latest PC plus fair value of the old PCs. Step 4. What is step number 4 generally? Recognition of net assets. At what value? Same, no difference. Step 5. NCI, same NCI. Step 6. Goodwill or gain on bargain purchase, same, no difference. Next, step number 7. Entry. Tell me entry. Assets to liabilities to NCI to PC. Difference is goodwill or gain on bargain purchase. Here the difference is when you are writing business combination entry in case of step up acquisition, assets we will write as usual at fair value. Liabilities of acquiring company we will write. To PC also we will write. But the important point here is whatever the investment we had previously, that investment carrying amount we will take it, we will credit it, because in our books already investment is there, na? Investment, because it's a normal investment. Before acquiring controlling interest, whatever the investment is there, it's a normal. So that investment, previously held investment in acquiring company, book value you credit it, close it. And whatever the gain on remeasurement of previously held investment, we have remeasured the previously held investment, na? In that whatever the gain, that gain you transfer it to P&L account. Okay? And PC, normal PC we will write it. Once again I am telling sir, in case of step up acquisition, what we are going to do is step up acquisition, entry, acquiring company assets at fair value, liabilities at fair value, PC, normal. Apart from that, here already whatever the investments we had, cancel it at book value. Previously held investments, gain on remeasurement, we remeasured to fair value, na? We got gain, na? Transfer it to P&L account. That's it, over. Whatever cash you, fair value of shares you have issued, PC, nothing but that we will take it. So what is the difference between basic business combination accounting, step up acquisition? 3 steps. There is a difference. What are those 3 steps? Acquisition date, PC calculation, entry. Acquisition date, when the control came, that means more than 50% process. Next, PC calculation, PC as calculated basic as per step 3, basic business combination plus fair value of previously held investment. Step number 7, when you are writing entry, whatever the investments you have already in the acquiring company, that will be cancelled. At what value? Carrying amount. And any gain on remeasurement of the previously held investment will be transferred to P&L account. Because now you are having control. It will become your subsidiary. You are having control in that company. So whatever investment previously you had, that will be closed at carrying amount, and any gain on transfer will be transferred to P&L account, gain on remeasurement. Okay? So this is what gain on loss on remeasurement of previously held investment in acquiring company will be transferred to P&L account. And finally we will prepare consolidated balance sheet. So this is what they have given, sir. See this. In business combination achieved in stages, the acquirer shall remeasure its previously held equity interest in the acquiry at the acquisition date at fair value and recognize the resulting gain or loss, if any, to P&L account or OCI as appropriate. Important. So in case of step up acquisition, whatever the investments we had, that will be remeasured to fair value. In that process, any gain or loss came, that gain or loss will be transferred to P&L account. Or sir, logically if you see, sir, for example, I have investment, sir, 1 lakh rupees. See this, 1 lakh investment in Infosys Limited, acquiring. Now I remeasured now at fair value. It came 1 lakh 10. That means my investment value increased, na? How much increase? 10,000. That is my gain, na? Same manner, loss can also become. If investment value decreases, it's a loss. So any gain or loss on remeasurement, that will also be transferred to P&L or OCI. You understood? And here acquisition date is the date on which control is obtained. While calculating PC, add back fair value of previously held investment in acquiry before acquisition date. Now if the acquirer held, see this, if acquirer held 20% or more, this point is also very important point, sir. If acquirer held 20% or more equity interest in the acquiry before obtaining control, that is acquiry was an associate, the acquirer's share of accumulated OCI of the associate shall be derecognized on the date of acquisition of control and transferred either to consolidated P&L or retained earnings depending upon the nature of OCI. For example, sir, we are having previously 20% investment. 20% investment means associate. So in case of associate, there is separate standards, I told you, for accounting, Ind AS 28 like that. Now what they are telling is, suppose if associate has become your subsidiary, previously you are having associate, now you are having more than 50%, so it becomes your subsidiary. So whatever the investment you have, on this investment in associate, the associate company share, associate company reserves and surplus, whatever share you have, the profits of the associate company, whatever the share you have, that will be cancelled. Now see this, the acquirer share of accumulated OCI of the associate shall be derecognized. Generally associate company accounting, how it will be done, we have not yet discussed, but generally if you understand, in case if you have a associate company, whatever the profits are there in the associate company, in that profits my share, for example associate company is having a profits of 100 rupees in reserves and surplus, in that I am having 20%, that means my share is 20 rupees. That 20 rupees now I need to derecognize in the books of acquirer. For consolidation purpose I need to derecognize, because it is no more associate for me. Now I am getting what? Control. See, there is a difference between associate and subsidiary, sir. As long as it is my associate, I will take share in the profits, but once it becomes my subsidiary, assets, liabilities, everything I will take na. Hello. So that's why whatever my share in the associate company reserves, that I will be derecognized. Now that is what they have given here. So that's it, sir. So step up acquisition accounting treatment is almost same to basic business combination, only 3 steps there will be difference. You understand those 3 steps? One is date of acquisition, second one PC calculation, third one entry. Now most important thing you need to remember is, whenever there is a stepwise acquisition happened, previously held investments will be remeasured to fair value. Any gain or loss came, that will be transferred to P&L or OCI as the case may be. That's it. That's the only important point you need to remember. Hello. Now let's solve some questions relating to this, so that you will get a clarity of what I am talking about. June 2025 examination question, straight away I am going to solve, sir. Problem number 5, June 2025 latest examination question we are going to see. June 2025. See this question. Tista Limited. Very good question actually. This question came in June 2025, 14 marks. See this question. Tista Limited manufactures and sells cars. The company wants to enter into the two-wheeler business. Basically they are selling cars, sir. Now they want to enter into, therefore it acquires 30% interest in Mahananda Limited for 5 lakhs as at 1st February 2025. So that means 30% means no control, associate just. When first acquisition happened, 1st February 2025, and an additional 25% stake when 31st March 2025. That means second time another 25. So control came. This is called step acquisition. Correct? First acquisition 1st February, second acquisition 31st March for 5 lakhs at its fair value. Okay. Next, the summarized balance sheet of two companies given, Tista, Mahananda. Who is acquirer? Tista. Who is acquiree? Mahananda. Assets, non-current assets, property, plant, equipment, financial assets, investment in Mahananda Limited. Our previous investment 10 lakhs. Investment in corporate bonds by Mahananda 4 lakhs. Like that, current assets, financial assets, trade receivables, cash and cash equivalents total. Equity and liabilities, you see equity share capital, other equity. Non-current liabilities, long-term borrowings. Current liabilities, financial liabilities. In the trade payables given. Total equity and liabilities given. These are the balance sheet of Tista and Mahananda. Okay, on 31st March 2025. Next, you see the additional information. Mahananda Limited sells, important sir. Mahananda Limited means acquiry company. Acquiry company sells the motorcycles under the brand name Moving Star, which has a fair value of 3,50,000 on 31st March 2025. As this is a self-generated brand, therefore Mahananda Limited has not recognized the brand in the books of accounts. What is this? Intangible asset. See, Mahananda Limited means acquiry. Acquiry has one brand, self-generated brand. What is the brand name? Moving Star. What is the fair value of the brand? 3,50,000. See, this brand they have not recognized in the books. Why they have not recognized? Intangible asset, Ind AS 38 criteria not satisfied. But I told you, in business combination, step number 4, recognition of assets and liabilities. Acquiry company intangible assets, even though they have not recognized, we will recognize. At what value? Fair value. Therefore, 3,50,000 will be recognized for consolidation purpose. This point already we came. Next, for the purpose of acquisition, see this. Fair value of the following assets of Mahananda Limited are estimated as under. So fair value of the assets of the Mahananda Limited given, sir. Property, plant, equipment 7,50,000. Investment in corporate bonds 5 lakhs. Okay. Book value of other assets and liabilities of Mahananda Limited represents their fair value. See, if fair value given, we will take it. Fair value doesn't given, book value itself is the fair value. Next, what they are asking, pass necessary journal entries to give effect to the business combination in accordance with Ind AS 103 at the acquisition date. At the acquisition date, see this. That means day 1 at the end of the year, day 1. So day 1, they are asking entries to give the effect of what? Business combination. That means we need to follow Ind AS 103 given. Also prepare balance sheet after the business combination. Once the business combination is over, they are asking balance sheet. NCI is measured by the entity at what value? Fair value. Provide working notes, ignore deferred tax implication. Ignore deferred tax. So this is the question they have given. First you have to tell me some basics. Here who is acquirer? Tista. Acquisition happening through shares or net assets? Shares. Common sense, shares. When acquisition happen through shares, on day 1 the acquirer have to prepare what? Consolidated financial statements. Correct? Same. Here this question is belongs to step acquisition. Hello? Tell me, what is the first step? Identify the acquirer. Who is the acquirer? Tista. Take it. So take Tista is the acquirer. Now what is step number 2? Date of acquisition. Can you tell me date of acquisition here? 31st March 2025. 1st February 2025. 31st March. Because 1st February you are having only 30%. Control not crosses. Control crosses on 31st March 2025. So therefore date of acquisition is this. 1st February 2025. This is. So date of acquisition is this. Important. Step number 2 done. Important. Most important is what? PC calculation. Now how to calculate PC? Latest acquisition 25%. How much we paid? This is at fair value. So PC, latest PC paid plus fair value of the previously held investment. Previously held investment 30%, na? 5 lakhs. But this is not fair value. We need to convert this into fair value. So, see, simple logic. For 25% latest you paid 5 lakhs. For 25%, 5 lakhs is the fair value. For 30, how much it is now? 6 lakhs. That's it. Previously held investment. See this. Fair value of previously held investment. Important. This is the only thing in this question. Entire question. Remaining everything is easy. If you follow the concept what I taught in the class. See here 5 lakhs is the latest for 25% na. Your previously held investment is 30%. Make it for 30. So for 5 lakhs, 25, for 30 it is 6 lakhs now. So that means the previously held investment fair value now is how much? 6 lakhs. That means how much is the gain? 1 lakh. Gain on previously held investment. That will go to P&L account. See this. P&L account 1 lakh. Last business combination entry. I will write 1 lakh. Correct? So previously held investment also I have written it. So therefore what is the total PC? 11 lakhs. Done. You understood? What is step number 4? Net assets acquired. Important. Here net assets acquired, you calculate it. Mahananda Limited, what are the assets? First property, plant, equipment. You will take what value? Fair value. Given. How much? 7 lakh 50. Take 7 lakh 50. So take 7 lakh 50. Next. Investment in corporate bonds. Fair value given 5 lakhs. Take 5 lakhs. Next. Trade receivables 50. Take it. Any other asset? Yes, intangible asset. Important. In the additional information they have given, even intangible asset will also be recognized. At what value? Take 3 lakh 50 also. That is total assets. Minus liabilities. Trade payables. Correct? Any other liability? That's it. Tell me how much came? That's it. See this. 15 lakhs is the net asset stake. So PP 7 lakh 50. Fair value given. Take it. Investment in corporate bonds 5 lakhs. Fair value given. Take it. Trade receivables. Book value itself is the fair value. This is most important. Self-generated point 3 lakh 50. These type of points you can write in examination only when you listen to the classes carefully. Self-generated goodwill is an intangible asset. They have not recognized. We have to recognize it at fair value. Trade payables, this one. So 15 lakhs is what? Net assets. So you understood? What is step number 5? NCI. Tell me NCI. How you are going to calculate NCI? NCI generally will be calculated by fair value. Why? Because in the question clearly mentioned. See this. NCI is measured by the entity at fair value. Tell me what is the NCI amount? NCI. Simple, sir. PC you paid how much? Total 11 lakhs. This is for how much? 25, 30, 55%. How much is for 45? 9 lakhs. Because in the question they have not given fair value of the shares of the acquiring company. So there is another method available for us based on the PC. So how much is the PC we are paying? 11 lakhs. This PC is at what value? Fair value. So proportionately. See 11 lakhs is for 55%. Na? How much is for 45? Proportionately you take it. How much? That's it, 9 lakhs. Hello? You understood NCI? What is step number 6? Goodwill. You have to tell me now, goodwill. First we will take PC. PC how much? 11 lakhs. Add NCI. 9 lakhs. Total 20 lakhs. Minus net asset step number 4. 15 lakhs. 5 lakhs is the goodwill. That's it. Over. See this. So PC, NCI, net assets. Last business combination entry. Business combination entry in the books of Testa Limited. Testa Limited for consolidated financial statement. What is the entry? First assets. What assets we are taking? PPE, investment in corporate bonds, trade receivables, intangible assets. 4 assets. Already we have written in step number 4 na? These assets. So write it. PPE, investment in corporate bonds, trade receivables, brand, that intangible asset. And liabilities. Which liabilities we are taking? Trade payables. Now the most important I told. What I told? Here previously held investment. Investment in Mahananda Limited. Previously held investment I need to calculate at what value? Fair value. Sorry, previously held investment I need to cancel at a carrying amount. So in my books, what is my investment carrying amount, sir? 10 lakhs. See this, Mahananda Limited. So that they have cancelled it. Okay. Hello. And gain on gain on remeasurement of previously held investment. Previously held investment 1 lakh gain came na, that will be transferred to P&L. And NCI. How much is the NCI? 9 lakhs. Difference how much came? Goodwill. I think it is automatically tallied. Correct? Sir, you understand this? So here, these are the assets we have taken. These are the liabilities we have taken. Already whatever investment we had previously, that we cancelled it at book value. Because see, I am cancelling investment in my books. So therefore, I have to cancel at carrying amount. Na? So investment in Mahananda Limited at carrying amount. And remeasurement gain. And NCI. Hello? Automatically tallies. Anything PC we need to pay. Actually, here, whatever we acquired, we have given in the form of, we are acquiring through net assets. No, not net assets. We are acquiring through shares only, na? Yes, we are acquiring through shares. Already 30% before acquired, we acquire now additional 25%. So PC total 11 lakhs. In that investment we cancelled, sir. Sir, actually here, the point you need to understand very simple, sir. What is my total PC, sir? 11 lakhs. 11 lakhs. This is at what value? Fair value. Actually, already in the books, what is the value of the investment? 10 lakhs. So therefore, overall gain is only 1 lakh. So that only we have recognized. And that too, see here, the point is these balance sheets are given on what date? 31st March 2025. That means already first investment 5 lakhs, second investment 5 lakhs. Total 10 lakhs is there. Total 10 lakhs is there. You understand? So total investment is cancelled. Because they have prepared normal, this is normal balance sheet of the company. I am preparing for consolidation, consolidated financial statements. So therefore, in my books, whatever the investment is there, now that investment, I have to cancel it. Total investment 10 lakhs I cancelled, only gain I have recognized. You understand the concept? That's it. So this is, and finally they have asked what, sir? Consolidated balance sheet. Balance sheet we will see, sir, important. Suppose if I prepare consolidated balance sheet of Testa Limited, first asset side you see, non-current assets. First PP is there, na? Hello? PP. Testa Limited already, what is the asset value? 13 lakh 50 plus Mahananda Limited 7 lakh 50 fair value. Both will be added. Goodwill will come. How much? 5 lakhs. Brand name, intangible asset is also there. Give the effect of this incorporation entry, sir. And then financial assets, investment in corporate bonds. Investment in corporate bonds, if you see, fair value is there in the Mahananda Limited. How much? 5 lakhs. Take it. Current assets, financial asset, trade receivables. Trade receivables, if you see, 80,000, 50,000. Add both of them. 80,000 acquirer, 50,000 both of them, 1 lakh 30. Cash and cash equivalents, 5 lakh 20. Not there in the acquiry. Total. Equity and liability side, equity share capital. What is the equity? When you consider equity share capital, you will consider only of which company? Acquirer. Hello? 5 lakhs. Equity. And we are not giving any PC in the form of equity shares. Is Testa Limited is giving any equity shares? No. Next, other equity you see, 15 lakhs plus 1 lakh. What is this 1 lakh? Gain on remeasurement of previously held investment. So total it is 16. NCI 9 lakhs. Non-current liabilities is there. Long-term borrowings 4 lakhs. Current liabilities, financial liability, trade payables 5 lakh 50, 1 lakh 50. Total 7 lakhs. That's it. So this is how the accounting will be done, sir. Consolidated balance sheet will be prepared. You understand this? Sir, why I have cancelled this investment? Anybody have idea? Why I cancelled this investment? Because before I am getting business combination, whatever the investment is there, that already there in the books. So that I have to cancel it. So in the books, because see, the logically if you see, I am taking assets, liabilities, okay, 100%. I will calculate NCI. See, if you see NCI is how much here? No, 9 lakhs, but it is I think 45%. 45% only, no, sir. 45%. Therefore, the PC I will pay, oh, my share is only 55%, literally speaking. So 45% I already recognized it, na? And net assets I have recognized 100%. Therefore, already in my books, whatever the investment is there, so that I have to cancel it. Only the gain or loss, I have to recognize it. Here, that's what, 5 lakhs, 6 lakhs, total 11 lakhs came. So fair value gain on remeasurement, I have considered it. So instead of generally in business combination, normal entry we will write to PC. In that PC place, we are writing investment. Investment. Correct only, na, sir? That's it. See, this is one question, sir, we have completed relating to step acquisition. Sir, in step up acquisition, sir, in this question, this Testa Mahananda Limited, some whatever we solved, sir, here whatever the investment we had, this investment was cancelled because this is the PC actually. Till now in my books investment. Now since we got the control now business combination, against this acquisition, this investment was cancelled. But this investment is cancelled at what value? Fair book carrying amount. That's why extra 1 lakh is recognized. Gain on remeasurement and it is transferred to P&L account. Okay, this is the logic I have explained. And you know these questions, see, understand this is marathon revision only. You have to solve the questions to the extent possible. I am solving the questions, but you have to practice it. Practice is the important thing. In examination directly you cannot solve these balance sheets, they will not come. So you have to sit, read the question, and you have to alone solve it in a rough paper. Then only you will get all these concepts. Okay. So in business combination we have completed accounting for basic business combination, 8 steps, and also step up acquisition we have completed. Now next one, reverse acquisition. Okay. Sir, what is this reverse acquisition? Listen to me very carefully. I am going to explain it in the easiest manner. See, you know, in business combination steps, what is the first step? Identify the acquirer. How you are going to identify the acquirer? Who pays PC? Who pays PC? I told you exception, reverse acquisition. Now that reverse acquisition came into the picture. So the idea is very simple. The party who is paying PC, now he is not the acquirer. He will become acquiree. That's why it is called reverse acquisition. It is called reverse acquisition. So generally, how to identify the acquirer? Entity who pays PC. But the exception is reverse acquisition. See, let me explain you with one simple example, sir. Suppose there is a company A Limited, sir. There is a company B Limited. Two companies are there. This A Limited, 25,000 equity shares are there. In B Limited, 50,000 equity shares are there. Suppose A Limited is acquiring B Limited. Who is acquiring? A. By giving equity shares. In what ratio? 1:1 ratio. Now you tell me generally. A Limited is acquiring B Limited means who is the acquirer? A Limited. B Limited is acquiree. Legally see, A Limited is acquirer, B Limited is acquiree. But what happens, you tell me? Here A Limited is issuing how many shares to B Limited? 1:1 ratio. That means in B Limited how many shares are there? 50,000 shares are there. If I am acquiring B Limited, in B Limited 50,000 shares are there. I told them that we are going to issue shares 1:1 ratio. That means 50,000 shares we are going to give you. 1:1 ratio. Correct? So A Limited will issue how many shares? 50,000 shares. Now after that, in A Limited how many shares will be there? Already 25 plus issue to B 50. Total 75,000. Because A Limited already in their books 25,000 shares are there. Now for acquisition of B Limited they are issuing 50,000 shares. So the total shares will be, then total number of equity shares to the combined entity will be 75. You understand till this point? Hello? Who is acquirer? A Limited. Who is acquiree? A Limited is acquiring B Limited by what? Issuing shares. In what ratio? 1:1. In B Limited how many shares are there? 50,000. So A Limited is going to issue 50,000. After that, what are the number of shares in the combined in the entity? In the combined entity? 75. Now you tell me frankly, in this 75,000 equity shares, the shareholders of B Limited is there, na? B Limited shareholders, they are having how many shares? B Limited is having how many shares? 50,000. That means out of 75, 50,000 they had. That means two-third. That means 66.67%. Remaining 33% is owned by shareholders of A Limited. That means after acquisition, who is controlling whom? B is controlling A instead of A controlling B. That's why this is reverse acquisition. See, actually what happened here? A is acquiring B. So legally A is the acquirer, legal acquirer. B is the legal acquiree. But accounting point of view, you think once acquisition happened, in the combined entity 75,000 shares are there. In A Limited 75,000 shares are there. Sorry. In A Limited 75,000 shares are there. In that 75,000 shares, B Limited is having now 50,000 shares. Correct or wrong, sir? Because A Limited issued 50,000 shares to B Limited. So in B Limited is having 50,000 shares in A Limited. That means two-third control they had. That means who acquired who? B acquired A. That's why B Limited is now called accounting acquirer. A is called accounting acquiree. Who is legal acquirer? A. But accounting acquirer? B. Who is legal acquiree? B. Who is legal accounting acquiree? A. So they are calling this as a reverse acquisition, and now you need to do the accounting. As if accounting acquirer acquired accounting acquiree. As if B Limited acquired A Limited, how you are going to do the accounting? You need to do it. That is the reverse acquisition. So A Limited is accounting acquiree. B Limited is accounting acquirer. So company who actually pays the PC is the legal acquirer. But now they become accounting point of view acquiree. Company to whom PC is paid, basically they are legal acquiree. But now they become, since it obtains the control greater than 50% share in combined entity after business combination, that's why it is called accounting point of view acquirer. You understand the concept? One more example I will take and I will explain. For example, see this beautiful example. See, there are two companies again, A Limited, B Limited, sir. See this, everybody. B Limited is already having 60 shares. In their company, 60 shares are there. A Limited already having 100 shares. Now A Limited is acquiring B Limited, sir. A Limited issuing B Limited shareholders 2.5 shares for every 1 share. 2.5 shares for every 1 share. So here 60 is there, na? For 1 share 2.5 shares. So 60 into 2.5, 150 shares. Sir, for every 1 share A Limited is going to issue 2.5 shares, sir, to B Limited shareholders. So 60 into 2.5, sir, 150. Already in A Limited how many shares, sir? 100. Total shares 250. This 150 plus 100, 250. In this 250, how many shares are held by B Limited? 150. So 150 divided by 250. Correct? 60%. Remaining 40%, A Limited shareholders they are having. Sir, you got it? Actually, who is acquiring? A, acquiring B. But after acquisition, if you see, who is having control? B Limited is having control over A Limited. Because the A Limited already 100 shares are there. Now they are issuing 150, total 250. In this 250, B Limited shareholders got 150 shares. So 150 divided by 250 means 60% they got it. That means A Limited shareholders have got only 40% only, na? That means who is controlling whom? B Limited is controlling A Limited. That's why this is called reverse acquisition. Okay. Now, who is accounting a point of view acquirer? B Limited. In my example, B Limited. So we need to do the accounting in the books of B Limited as if he is the acquirer. So we need to apply Ind AS 103 for accounting acquirer. Okay. Got it? Suppose if I do the accounting, normal business combination, how many steps? 8 steps. Same steps. We will see. One. First step, acquirer. You know who is acquirer here? Accounting acquirer is the acquirer, not legal acquirer. Don't see legal acquirer, only see the accounting acquirer. Who is the accounting acquirer in my example? B Limited. First step done. Identify the acquirer. So this is what, till now I explained this only. Identify the acquirer, step number 1. Who pays PC is the acquirer, but exception is reverse acquisition. You understand why? Because our point of view, acquirer business combination means the party who obtains control over other party. Here ultimately who is having control? B Limited. So that's why B Limited is the accounting acquirer. Legal acquirer we don't bother, only accounting acquirer. Step number 1. What is step number 2? Date of acquisition, same. On what date A Limited acquire B Limited, that date is the date of acquisition. The most important step is PC. Come on, sir. Sir, common sense. Tell me, sir. Who will pay PC to whom? A Limited will pay PC to B Limited. But we are telling B Limited is the accounting acquirer. So actually legal acquirer will pay PC to legal acquiry. In my example, A Limited will pay PC to B Limited. But I am doing accounting assuming B Limited is my acquirer. Actually B Limited will pay any PC? No. That's why we don't calculate PC. We will calculate deemed PC or notional PC. What is deemed PC? If B Limited acquires A Limited, how much PC they will pay? You understood? Hey, logically correct only, na? If A Limited is acquiring B Limited, okay, A Limited will pay PC. But I am telling A Limited is not acquirer, B Limited is acquirer. Actually, in practice, B Limited will pay any PC to A Limited. No, that's why purchase consideration will not be there. That's why we calculate deemed or notional PC. Deemed PC means we will assume if B Limited is acquiring A Limited, how much PC they will pay. You understood or not? If B Limited acquires A Limited, how much PC they will pay? That's it. That is called deemed PC. Okay. Now tell me how much PC they will pay? Deemed PC, how to calculate? There is a formula, sir. Of course, logically also I can explain. First, see this formula. The formula is very simple. Actual number of shares in equity share capital of accounting acquirer before business combination. Sir, before business combination, accounting acquirer means B Limited. How many shares are there? In my example, 60. In this example, 60 only, na sir? 60. Hello? 60 shares. Okay. So first take it. Before business combination, accounting acquirer books, how many shares are there? Divided by what is the stake of accounting acquirer in combined entity? In combined entity, what is their share? 60%. Combined entity. 60% they got it in a combined entity. That means after A Limited acquiring B Limited, in the combined entity they got 60%. Hello? Minus Actual number of shares in equity share capital of accounting acquirer before business combination 60. So 60 divided by 60% into minus 60. 60 divided by 60%, how much? 100. Minus 60, how many? 40. Into fair value per share of the accounting acquirer. What is the fair value per share of the accounting acquirer? Take it. Suppose the fair value per share is, let us assume 40. So multiply with 40. So PC is 1600. Logically, if you think this is correct, why? See, simple. Sir, if B Limited is the acquirer, already in B Limited, before business combination, how many shares are there? 60. Now in the combined entity, they got how much? 60%. That means 60 divided by 60% I will got 100. 100. So in the combined entity, I should have 100. But already how much I had? 60. Therefore 40 I will issue now. If B Limited is the acquirer, common sense here. If you are the company which is issuing the shares, already in your company 60 shares are there. In the combined entity, your percentage is 60%. That means 60 into 100 divided by 60 means 100, na? That means overall shares of the company should be 100. In that already how many you have? 60. You issued 60. That means how many now you will issue? 40 into fair value per share. Then you will get the deemed PC, na? If B Limited is acquiring A Limited, they are going to issue 40 shares. Because in B Limited books already 60 shares are there. For 60% it will be 100 shares. So therefore the total number of shares in the total number of shares B Limited should have after business combination should be 100. Already they are issued 60. Therefore 40 shares now they will issue to A Limited. That is the assumption. So 40 into 40 rupees. Therefore 1600 is the deemed PC. Sir, what is this, sir? How complicated? Not complicated here, very common sense. See, understand the purpose. What is the subject? Here, it is not just I am acquiring one company. No, here you need to see the intention also. Here, A Limited, B Limited, they know this. They are doing this willingly. Don't be under the impression that A Limited is acquiring B Limited. In the combined entity, B Limited is having control. They don't know all these things. They know all these things. They will do this deliberately. Actually, I think I have given the reason also somewhere. Yeah, see. Reverse acquisition occurs when legal acquirer becomes the accounting acquirer. The entity that discharges the PC is the legal acquirer, but not the accounting acquirer. The entity whose equity is acquired becomes the accounting acquirer, even though legally it is the acquiring. For example, reverse acquisition often happens when a private company wants to become a public company without registering its own shares and therefore gets acquired by public company by exchanging shares. Sir, when a private company wants to become a public company without registering its own shares, therefore what it will do, it gets acquired by a public company by exchange of shares. When you are acquired by a public company, automatically you will also become public company. Sir, when you are acquired by a public company, you will also get public company, deemed public company. So with that intention they are doing this. So usually this kind of reverse acquisitions will happen when a private company wants to convert into public company. So obviously, for example, a public company takeovers the private company, this private company will also become the public company. Without, and in the combined entity they want to dominate, they want to control, still there. So they want to control it, but they want to become a public company because of its advantages and all, correct? But see, nothing, nevertheless, in the question they will tell you, reverse acquisition question means mostly they will give you, this is the reverse acquisition happened like that, they will tell you, okay? So the bottom line you need to remember is, in case of reverse acquisition, what happens? Legal acquirer doesn't matter. Accounting point of view acquirer matter. From his point of view, we need to do the accounting. Hello? So tell me, first step, identify the acquirer. Who is the acquirer in case of reverse acquisition? Accounting acquirer. Step number 2, date of acquisition. Same. Step number 3, deemed PC. Deemed. Why deemed PC? Because accounting acquirer is not the actual acquirer, But we are assuming if he is the acquirer, how much PC will be given to accounting acquiry? How much PC he will give? Simple. How many number of actual shares are there in his books before business combination divided by what is his percentage of holding in the combined entity. Then we will get the total shares minus already shares he had. The remaining shares will be issued to the other company. See, my company is having 60 shares here, but if I acquire 60% in the combined entity, the number of shares should be 100. Already 60 is there. How many shares I have to issue now? 40. So 60 plus 40, 100 into 60, 100, 100 minus 40, 60. So 40 shares I need to issue at 40 rupees fair value. You understand this? That's it. Okay. Step number 4. Net assets taken over. At what value? Fair value. Which company net assets will take? Accounting acquiry. In our example, A Limited. B Limited is acquirer. All net assets of accounting acquiry. Oh, taken. A Limited. A. Simply think here. B Limited, in our example, is now the acquirer. A Limited is the acquiry. That's it. NCI will not applicable here. Already this much complication. Then NCI calculation also. Next, gain on, goodwill or gain on bargain purchase. Generally, how we calculate goodwill or gain on bargain purchase? First, we will take PC, add NCI minus net assets. Here, PC is not there. Deemed PC is there. NCI is not there. So, deemed PC or notional PC minus net assets. Which company net assets? A Limited. A Limited is accounting acquiry. That's it. Business combination entry, same. Assets, liabilities, NCI not there, PC. Difference is goodwill or gain on bargain purchase. Finally, we will prepare consolidated balance sheet. Here comes the main thing. When you prepare the consolidated balance sheet, accounting acquirer figures, book values plus accounting acquiry figures at fair value. Incorporation effect. Assets, liabilities, goodwill, all these things we will incorporate. PC, all these we will incorporate. But when you are taking the number of shares, presentation purpose, number of shares will be presented from accounting acquiry point of view only. That means legal acquirer. When you present the number of shares, A Limited point of view, number of shares only we need to present it. So, and one more important thing, sir, in reverse acquisition, when you write the name, sir, balance sheet heading, in consolidated balance sheet, name will be written of the legal acquirer. That means A Limited. We need to write consolidated balance sheet of A Limited, legal acquirer. So, balance sheet heading will be given legal acquirer. Accounting is doing accounting acquirer point of view for business combination. And also number of shares issued in equity share capital of the combined entity will be written of original legal shares. For example, 100 shares of A Limited plus 150 shares issued to B Limited. Total 250 shares only we need to write. See, these are the things which is there in the Ind AS. You have to understand. Of course, I know it is a little bit, complicated, reverse acquisition. But if you understand the purpose, it is very easy. To the extent possible, I am making it very simple for you. So, you don't think all these things, simple steps. What is reverse acquisition? Are telling. Generally, who is paying PC is the acquirer. Now here, that is not the case. Why? Because sometimes in the combined entity, the acquiry, the legal acquiry will have the controlling interest. So obviously in effect, the legal acquiry is becoming accounting point of view acquirer. Therefore, the standard says we need to do the accounting business combination from his point of view only. So that's why you calculate deemed PC. Important step, deemed PC. So step number 4, same. Step number 5, not there, NCA. Step number 6, same. Step number 7, business combination, same. Step number 8, little bit modifications in the presentation. When you write the name, you write legal acquirer name only, balance sheet of A Limited. When you present number of shares, legal acquirer point of view, originally legal shares. In my example, A Limited, first example you say, 100 shares plus 150 shares. Correct only na? In this example. Legal acquirer point of view, if you see 100 shares plus 150 total 250. This only be presented. Even though accounting acquirer point of view, you are doing the accounting, but presentation in the balance sheet for share capital, number of shares will be presented from accounting legal acquirer point of view. Okay. Remaining thing is same, sir. Remaining thing is same. And you won't get this concept at single time, sir. I am telling you, reverse acquisition concept, you have to concentrate. Okay. Little bit tough only, but not difficult. Of course, in our books, one question is there, one or two questions only there in the reverse acquisition. So I think if you know theory, this much theory I have given in the book, and after that, if you can able to study, do those questions, I think it will be more than enough. Now you see steps for acquiring the reverse acquisition. Steps. What is the first step? Acquirer. Who is the acquirer here? Accounting acquirer. What is the date of acquisition? Same. Date on which you got the control. Third step, deemed PC. You know how to calculate. This formula is very, very important in examination. Deemed PC, you will get the marks. Net assets, same. But net assets will be taken off which company? Accounting acquiry. A limited, nothing but. NCI, not applicable. Goodwill or gain on bargain purchase, deemed PC or notional PC minus net assets taken off. Now same accounting, this is also same. Okay. That's it, sir. This is reverse acquisition concept. Now relating to reverse acquisition, there is one question, sir. Okay. So relating to reverse acquisition, sir, one question is there in study material, problem number 17. See this question, sir. Reverse acquisition takes place as H Limited acquires 100% equity shares of S Limited on 31st March 2021. See, in the question itself, he is saying reverse acquisition takes place. So no need to scratch your head. They have given in the question itself. Who is acquiring whom? H acquiring 100% shares of S. Okay. From the following data, pass journal entries and prepare consolidated separate balance sheet in the books of H Limited. Okay. H Limited, S Limited, sir. Non-current assets, current assets total, equity shares, capital, H 100 shares, S 80 shares. Other equity, non-current liabilities, current liabilities total. H Limited and S Limited shares are quoted at 2050 respectively on 31st March 2021. So at the end, the quoted share prices of H and S, how much, sir? 2050. H Limited market price 20, S Limited 50. H Limited issues, now see this. H Limited issues shares in exchange ratio based on quoted price. Sir, H is acquiring S, na sir? H will give you PC. In PC is given in the form of shares. The shares are given in what ratio? Based on quoted price. 2050. Actually, market price is 2050. Fair value of NC, that means non-current assets, of H 2400, S 3200. Only non-current assets fair value given in the question. First of all, this is a question of what? Reverse acquisition. Tell me steps one by one. What is the first step? Acquirer. Legally, who is the acquirer? H. So they are saying reverse acquisition happened. That means accounting acquirer? Yes. Accounting? Yes. How, sir? See this. First of all, if you see the question carefully, H Limited is the legally acquirer. In the question they clearly said. So S Limited is the legally acquiring. But what happened? You see, H Limited, number of shares to be issued to S Limited. How many shares they are giving to S Limited? Based on exchange ratio. 2050. Correct? Actually, how many shares are there? How many shares are there? 80 shares are there in S Limited. 80 shares. Now H Limited is going to issue shares. What is the exchange ratio? 2:5. Correct? 2:5. So that means for every 2 shares, 5 will be given. Correct? Or else you can do like this. Number of shares in S Limited, how many? 80 into what is the fair value? 50. Their company fair value is 50 na. That means 80 into 50. 4,000 is the total market value of the S Limited shares. Divided by market value of H Limited, issuer company, 20. 200 shares will be given. Because issuer point of view, what is their market value? 20 rupees na. Your company market value of shares 4,000. So 4,000 divided by 20. I need to give 200 shares. Correct? Ah. So tell me, H Limited books already how many shares are there? 100. Now how many shares they are giving to? Yes, 200. That means total number of shares after acquisition of S how many? 300 na. 100 shares already there in H. 200 shares they are issuing to S for acquisition. So total 300 shares after acquisition. In this 300, how many shares are held by S? Shareholders of S? 200. That means 2/3. How many shares are held by shareholders of H Limited? 1/3. That means who is controlling? S Limited is controlling H Limited. Sir, common sense, sir. Who is controlling, sir? S Limited is controlling, sir. Because after acquisition in H Limited 300 shares are there. In that 300, shareholders of S Limited is having 200 shares. 200, yes. That means 2/3 they are controlling. Now, definitely this is what? Reverse acquisition. That's why I am saying S Limited now will become accounting acquirer. H Limited will become accounting acquirer. That's it. So identify the acquirer. Who is the acquirer here? S Limited. You understand the concept? So S Limited shareholders are having control over the combined entity. So hence it is a case of reverse acquisition. First step done. You understood step number 1. What is step number 2? Date of acquisition. What is the date of acquisition here? 31st March 2021. Given 31st March 2021. Can you tell me deemed PC here? How to calculate deemed PC? Deemed PC means what? If S Limited is acquiring H Limited, how much PC will be given? That is deemed PC. How to calculate? First you take the actual number of shares in S Limited. In S Limited before business acquisition, how many shares are there? 80. Divided by what is the share in the combined entity? 2/3. That means 66.67. So 80 divided by 66.67. 119.9, the 120 minus 80. That means how many shares? 40. Into what is the fair value per share? What is the fair value per share? In the accounting acquirer point of view. Accounting acquirer point of view, fair value. How much? 50. So 40 into 50, how much? 2000 is the PC. You understand this? This is the main. So if S Limited is acquiring H Limited, how many shares they will give? Simple. Number of shares already held 80 divided by 66.67, that will be 120 minus 80 into fair value of the accounting acquirer. Tell me, logically it is correct or not? Yes. Now step number 4, recognition of net assets. Taken from which company? Accounting acquiree. Who is accounting acquiree? H. So H Limited point of view, assets, fair value. What are the assets is there in H Limited, sir? Non-current assets, how much is there? No, fair value given 2,400 we need to take. Important, that's why. You have to read the question carefully, that's why. In the question they have given fair value, so 2,400. Current assets, 1,000. Next, liabilities. Non-current liabilities 700, current liabilities 800. So total 1900. Very simple. NCI will not applicable. Step number 6, goodwill or tell me what is the deemed PC here? 2000. Net assets 1900. So goodwill how much? 100. Are you following? Next, journal entry for business combination. Same na? Non-current assets to same here. 2400 assets, current assets, non-current liabilities, current liabilities, PC. But difference will go to goodwill. PC to equity share capital. Hello? PC to share capital. Last step is what, sir? consolidated balance sheet. Now you see consolidated balance sheet carefully, very, very important. See here, when I am preparing the consolidated balance sheet, I told you heading will be given legal acquirer. Who is legal acquirer? H. That's why you see consolidated balance sheet in the books of H Limited they have written. Heading. First we are going to focus on the consolidated balance sheet. When you preparing consolidated balance sheet, acquirer, accounting acquirer book values plus accounting acquiry fair values. We will add one by one. First you will take, what is the first asset? Non-current asset. Tell me, in S Limited, what is the asset value? Non-current assets. 3000. Plus H Limited, 2400. Total 5400. See this. Sir, accounting point of view, acquirer S Limited. S Limited books book value you have to take. Even though in the books they have given the fair value of S Limited also. Non-current assets fair value given, but don't consider it. Acquirer only book values. Acquiry fair value. Here who is acquirer? Accounting acquirer S. Who is accounting acquiry? H. So therefore book values of S, fair values of the H. So that's why 3000 plus 2400. Guys, 5400. Next, goodwill. How much came goodwill? 100 came. Step number 6, goodwill came na? So write this goodwill. 100. Financial assets, investments. I think financial assets is not there. Not there in the books of S. Okay. So that will not come in the consolidated balance sheet. This is separate individual balance sheet of H. That is separate. First I am focusing on consolidated balance sheet. Okay. Current assets you tell me. Current assets S Limited how much is there? 1000. From H 1000. Total 2000. So take 2000. I think total assets 7500. Now come to equity and liabilities. This is very, very important, sir. Sir, when you see the equity and liabilities, equity share capital. I told you when you are presenting equity share capital, you need to present legal shares. Legal acquirer point of view. That means H Limited point of view, shares we need to present. Correct? Actually in the books, how many shares will be there? Tell me. H Limited, how many shares are there before business combination? 100. How many shares they have issued to S? 200. We calculated, na? How many shares they have issued? 200. See this. Sir, H, legal acquirer, accounting acquiry point of view, think when you are presenting the shares, in H already 100 shares are there, na? Plus H when acquiring S, how many shares they are issuing? 200. Total 300. That will be presented. That is what, see this, 300 shares of H Limited. Okay. But look at the amount. Look at the amount. Amount point of view, if you see, what is the carrying amount of S Limited? How much is the carrying amount of S Limited? S Limited books 80 shares means 800. 800 plus how many shares deemed PC? 2000. Total 2800. You understand? 2800, how we got it? Accounting acquirer S. S already how much is the share capital? 80. That means 800 plus deemed PC 2000. Total? That's it. Number of shares is presented legally 300 shares, but amount is presented like this. Here they have given, actually if you see, they have given note also. Equity structure, that is number of shares reflects the legal parent of H Limited. Although amount of equity is the carrying value of S plus purchase consideration by issue of shares. See, put a star mark also. See this, they have given clearly. When they are presenting number of shares, legal shares they presented legally. But when they have written the amount, S limited share capital plus deemed PC, they have added it. Hello? And also note they have given, see this, there is a mismatch between the number of shares and the balance sheet amount if nominal value is considered. This is maintained in the standard without any explanation. For example, sir, what happens is, instead of 2800, if I consider 3000 here, based on these 3 shares, balance sheet will not tally. You are understanding? Here, instead of 2800, legal shares 300 na, 300 into 10. If I consider 3000, balance sheet will not tally. That is what they have given. That's why there is a mismatch. Number of shares 300 legally, but share capital 2800 they are showing. There is a mismatch. They are only saying, see, I am not saying, see this, in the original study material itself, this is there. There is a mismatch between the number of shares and the balance sheet amount if nominal value is considered. If I consider the nominal value, instead of 2800, if I consider the nominal value for 300 shares, there is a mismatch. So this is, see, superb. This is maintained in the standard without any explanation. Standard itself has not explained this properly. That's why there is no clarity. That's why there is ambiguity here. So as far as I know, you follow what is there in the study material. Don't become researcher. First of all, you are understanding what we are doing. We are doing consolidation. So in the consolidation, number of shares legally you present, but share capital you present based on accounting acquirer point of view. Remaining same. Next, other equity. What will be the other equity? Other equity 1600. Take it. 1600 sir, other equity. Printing mistake here, 1600. Non-current liabilities, S limited plus non-current liabilities 1200 plus 700, total 1900. Add both the companies here. Current liabilities 400 plus 800, total 1200. That's it. Balance sheet tallied. This is the combined entity balance sheet. Okay. Suppose if I prepare separate balance sheet, separate non-current assets S limited 2000, H limited they are asking, sorry. Tell me non-current assets of H limited 2000. 2000. Take it. Investment 2000. Given na? In the separate balance sheet, they have presented investment in S limited. How much we invested in S limited, sir? 200 shares we have given na? We, I think, purchase consideration 2000. Current assets 1000. Equity share capital 3000. Because number of shares into nominal value. Here they have considered it. Other equity 500. Non-current liability 700. Current liability 800. Total 5000. So this is one kind of historical monument in the study material. This kind of Kalakandalu will be there. So many. But I think this is a good problem only. Only problem is this balance sheet share capital, this one. But they have explained it here. They said that there is ambiguity here. Standard itself has not explained this properly. That's why they have presented this. And I have also covered this point. I don't think so that they are going to test it. But if at all, in CMA what happens now, sometimes they will exactly copy paste the questions. CMA Inter, one time it happened. What happened now? In CMA Inter corporate accounting paper, there is a cash flow statement like that, one chapter is there. That cash flow statement chapter, one question is there from the study material. The same exact question they have tested in the examination. The problem is, actually that question is not as per the Indian accounting standard. That question is actually copied from US tax books, US books, US accounting books, they copied it. There the accounting treatment is little bit different from our accounting treatment. But to my surprise, even in the suggested answers also, they have taken the same answer. They have not changed it. That means they are expecting me to learn US accounting also. You know, because The same question if they copy paste na, they don't see all these things. That's why. Suppose if they copy paste this question in the examination, definitely they will take the same answer. They don't all, they expect you to write this note also. They expect you to take here 2800. No argument, because they say you are a professional. You have to be professional. That's it. We have given a book, whatever is there in the book that you prepare and you have to write. Even the topics which we have not covered, if we ask in the examination, you have to write, because you are a professional. That is what they are expecting from you. So they have answers for everything. You don't have questions for everything. Whatever the questions you have, they can give you definitely good answers. The answers which you cannot reply. So this is the question. I attempted this question. I don't think so, but you practice this once. Hope you understand this question. Yeah. I think this is the only question available in respect of reverse acquisition, sir. I don't think so much questions are available. That's it. So in business combination chapter, we have completed basic business combination accounting, step up acquisition, reverse acquisition. So we are left with one more topic called common control transactions. That is also important. So far we done acquisition method. Now next common control, we are going to do pooling of interest method. If common control is over, then this chapter is done. So out of these 4, they can ask one thing. 1 or 2 questions, 14 marks question, 1 on 4 marks question, MCQs they will come. So around 20 marks they can test from this. Okay. So in business combination, so far we have covered basic business combination accounting treatment, step up acquisition, and reverse acquisition. Next topic is common control transactions. Business combination in case of common control transactions. This is also one of the important areas in business combination. So far, if you remember the method, which method we have discussed for accounting in business combination? Acquisition method. Now that method is going to change in case of common control transactions. Now the method we are going to discuss is pooling of interest method. What is that? Pooling of interest method. So in case of common control transactions, we will apply pooling of interest method. We will apply pooling of interest method. Let us see first of all what is this common control transactions is all about. If you observe the name itself, you can say that common control. That means before business combination, after business combination, control is in the hands of same parties. The controlling shareholders are same. The controlling parties are same. If that situation happens, that is called common control. Okay. Suppose for example, there are two, let's say for example, there is a company A Limited, there is a company B Limited. Now both of them wants to merge and form as AB Limited. Okay. Suppose in A Limited shareholders will be there, B Limited also shareholders will be there. Suppose the shareholders are, for example, S, H, M. These 3 are shareholders. In B also same, S, H, M. In combined entity also S, H, M are the shareholders. Now you see this. Who is controlling these companies before business combination? SHM. After SHM. That means the business is in the control of the same parties before, after. This situation is called common control. Common control. Now actually this type of thing is called a merger. Two entities formed as one entity, generally it is merger, and it is merger in the nature of common control. So what is business combination in case of common control? A business combination is called common control when all combining entities are controlled by same parties both before and after the combination. I mean, I can give you one more beautiful example. This is in respect of demerger. Actually, this is called merger. Two entities formed as one new entity. There can be demerger also, I will tell you. For example, sir, there is a company X Limited. Important, listen to me, there is a question also in the study material. I am going to solve it. There is a company X Limited, sir. In this company, there are two departments. department A, department B. Okay, department A, department B. Suppose they want to form this department B as a separate company. Suppose they want to form this as department B limited. They want to form this as a separate company. Now here this is called demerger. This is called basically demerger. This is called resulting company. This is called resulting company. Now in X Limited, whoever be the shareholders are there, same shareholders will be there in this company also. This is called demerger in the nature of common control. So you have to see whether this is a common control or not. Simple point, who is controlling the company before and after. If the parties are same, then it is a common control. Suppose if the parties are different, then that is merger in the nature of acquisition. We will apply normal accounting. Like suppose for example, in this case, A Limited, B Limited formed as AB Limited, right? Suppose S, H, M are shareholders. Suppose here in the new company, X, Y, Z are shareholders, and that means shareholders are different. This is called merger in the nature of acquisition. Then acquisition method, 8 steps I discussed now, we will apply that. That means acquisition method we will apply. If parties are same, the controlling parties are same, that is called common control. In case of common control, I told you pooling of interest method we will apply. Of course, I am going to explain what is that method is all about, but first I am giving you brief idea about what is this common control. You understand this demerger. In these two departments, one of the department has become a separate company. That company is also controlled by the same parties before and after. Therefore, these type of things are called basically common control transactions. Okay. Now, the most important thing is, tell me what you observe in case of this common control transaction, whether actually acquisition is taking place, whether actually one business is taking another business. No, they are saying this is mere a corporate restructuring. This is not a actual acquisition. That's why they are saying that you should not follow acquisition method. You should follow pooling of interest method. So that's why the control should be continuous, not temporary, not transitory. It is not, see, actual business acquisition. It is a corporate restructuring. A, B, they want to do business together. A, B Limited, same shareholders. So there is no business acquisition there. See, now here important, sir. In this example, can you tell me, A Limited, B Limited formed as AB Limited, right? Who is acquirer? No. Acquirer means AB Limited. Who is acquiring the business? Who is acquiree? A Limited, B Limited. Acquirer, acquiree. Acquirer, who is acquiring the business? AB Limited, new company. Whose business is acquired? A Limited, B Limited. But in case of common control transactions, we don't call them as acquirer, acquiring. We will call them as transfer or transferee. Who is transferee here? AB Limited is called transferee, which will continue after corporate restructuring. These two are called transferor, who is transferring their business. Sir, the entity which is transferring business is called transferor. The entity to whom the business is transferred is called transferee. Here the transferee is AB Limited. Transferor or A Limited, B Limited. Okay. So in case of common control transaction, don't call them as acquirer, acquiree. Call them as transfer or transferee. Transfer or transferee. Logic you know, because there is no acquisition taking place here. So you cannot technically call them as acquirer, acquiree. I am not acquiring any business. That's fine. So Ind AS 103 deals with accounting for business combination under common control. The most important, all business combinations under common control are accounted for using pooling of interest method. So we will apply pooling of interest method for accounting. In case of common control transaction, acquirer is called transferee. Acquiree is called transferor. Transferor. Okay. Now steps. Generally in acquisition method, how many steps are there? 8 steps. Here also same, but I will tell you the modifications. Listen to me very, very carefully. See, the concept I am explaining you is uniformity. Right from the beginning, if you observe, every time for business combination accounting, 8 steps, step by step, so that you should not forget it. First step, what is first step? Identify the acquirer. Here acquirer place transferee. Transferee, we will write transferee. So identify the acquirer company. Same step, same as accounting for business combination. In case of in place of acquirer, we call him as transferee company. Okay, step 1 easy. Generally, who is the acquirer? The entity who pays PC. Exception, reverse acquisition. Step 2, what is step 2? Date of acquisition. Correct? Same, determine the date of acquisition, same as accounting for business combination. On what date business is acquired? Generally, it is the date the control is transferred. If there is a written agreement, according to that agreement, or government approval required, the date of approval. Third step, PC, same PC calculation, same as accounting for business combination. Cash transferred, fair value of assets transferred, shares transferred, debentures transferred, present value of deferred consideration, contingent consideration, fair value, everything we will add, same. The most important is step number 4. Step number 4, there will be a change. What is generally step number 4, sir? Net assets of the acquiring company at fair value. But in case of pooling of interest method, guys, in case of common control, remember, acquiring company net assets including reserves we will take at their book values. Acquiring company, that means transferor company, assets, liabilities including reserves will be taken at book values, carrying amounts, nothing but. Fair value will not arise. Generally, when we take the assets, liabilities, we are taking at fair value, but here not fair value, book values. I think very easy. So if at all there is a question from common control, don't forget this. So see this, recognition and measurement of identifiable assets and liabilities. All assets, liabilities including reserves. All assets, liabilities including reserves of which companies? Transferor shall be recorded at the same carrying amount. Shall be recorded at the same carrying amount. That means you should not take fair values. Fair values not allowed under common control. Why? Because in case of common control, what is the assumption? There is no business acquisition. This is just a corporate restructuring, they are saying. When there is no business acquisition, we don't consider fair value. Just see, control is in the hands of the same parties, right? Therefore, see here in this example, A Limited, B Limited, assets, liabilities will come to AB Limited at their book values only, because the parties are same, na? So just they are doing business with a different name. Previously A Limited, B Limited, now AB Limited, just name changed. Will you allow fair value? No, that's why book values only we will allow. Including reserves, you should not forget it. Reserves also we will take it. Generally, in case of assets, net assets, we don't take reserves, but here assets, liabilities including reserves we will take it. Step number 4 is the most important step. Done. What is step number 5? NCI. In case of this, NCI will not arise. Common control NCI concept will not arise. Step 6. What is step 6? Goodwill or capital reserve. How to calculate goodwill or capital reserve? PC. Add NCI minus net assets. PC already we calculated in step number 3. So take it PC. NCI not there. Less net assets including reserves taken, which is already calculated in step number 4. So in step number 4 you already calculated na net assets including reserves minus it. So you will get one amount that will be capital reserve. That means here goodwill generally will not arise in case of common control transactions. Generally positive or negative, we will call it as what? Goodwill gain on bargain purchase, which is nothing but capital reserve. Actually here, if you look at the original standard, the question of goodwill will not arise. Here whether you got loss or profit, it will be adjusted to capital reserve only. Actually here there is no business acquisition, this is corporate restructuring, right? So this we will call it as gain on restructuring or loss on restructuring. Gain on restructuring, loss on restructuring. But in study material, one problem they solved, they have considered goodwill. I will tell you later on. But pure concept if you want, So I am telling you this is capital reserve. It can be gain or it can be loss. Hello? When we will get gain? When PC is less than the net assets. When we will get loss? When PC is more than the net assets we take. Common sense. Next entry number 7. Step 7, entry. What is entry? Normal. Assets will be debited, liabilities will be created, reserves will be created at their book values. Assets will be debited, book values, liabilities will be created at book value, because in step number 4 we have taken assets, liabilities including reserves, everything at book values only, na? So assets will be taken at book value, liabilities will be taken at book values, reserves will be taken at book value, and purchase consideration PC. Difference will go to capital reserve. See this, either loss on restructuring or gain on restructuring. Generally in acquisition method, goodwill, capital reserve, gain on bargain purchase, but here loss on restructuring, gain on restructuring. Strictly this is the concept, but sometimes study material sums will take goodwill. Okay, so this is step number 7, and last step, consolidated balance sheet. How to prepare consolidated balance sheet? Acquirer company. Acquirer company means here transferee. Transferee company figures at carrying amount and give the effect of this entry. Transferee company plus transferor company. Assets will be added, liabilities will be added, reserves will be added. Goodwill, loss or gain will be adjusted. That means we will give effect to this step number 7 entry. You will get the consolidated balance sheet like normally we are doing. So start with the acquirer. Acquirer means transferee here. Acquirer assets, liabilities, equity at their carrying amount. Always remember, I am telling, keep on telling. Acquirer book values, acquiree fair values in case of acquisition method. In case of pooling of interest method, even acquiree also book value. Acquire means transferor company. Incorporate the effect of business combination entry passed in step number 7. Okay, so very simple, sir. So you understood, sir? Common control. So when we say business combination is under common control, when the entities controlled by same parties before and after business combination. Okay, and when there is a common control, will you call this as acquisition? No, we call it as corporate restructuring. So we will follow which method? Pooling of interest method. Why the name is pooling of interest method? Because see, there is a genuine pooling of resources here. A limited, B limited, now they formed as one new entity with the same set of control. So therefore, pooling of interest, we are pooling the resources of pooling the interest of two companies, two or more entities. That's why this method is pooling of interest method. This is not an acquisition method. That means they are not considering this as a pure business acquisition, rather this is a corporate restructuring. Tell me, in case of common control, will you call them as acquirer, acquiree? No, names will be different. Acquirer is called transferee. Acquiree is called transferor. Transferor is transferring its business. So can you tell me the 8 steps? First step, identify the acquirer. Acquirer means transferee. First step same. Second, date of acquisition same. Third step PC same. Fourth, important step, fourth, net assets of the transfer company will be at book values. What we will take? Assets, liabilities, including reserves we will take it. Step number 5, NCI is not applicable. Step number 6, we will take PC from that net assets as per step number 4. So you will get either gain or loss, that will be transferred to capital reserve. And next, business combination entry. Assets at book value, liabilities created at book value, reserves will be taken, and PC we will write. Difference will be either loss or gain. Nothing but loss on restructuring, gain on restructuring, which will be adjusted to capital reserve. That's it. This is the steps. And last step, business consolidated balance sheet, we will prepare it. So this is the theory relating to common control. Let's see some questions. Okay, relating to common control, let's see some questions. Problem number 20 in study material, sir. DATA limited question, important question. See this. DA limited, TA limited were amalgamated to form a new company, Data Limited, on 31st March 2021, who issued requisite number of equity shares of rupees 10 to take over the business of DA and TA. You have to tell me, sir, here DA, TA, two companies, they formed as new company Data Limited. Who is here the acquirer in general? Who is acquiring? Data Limited. New company is acquiring. Who is the acquiree? DA, TA. Correct? In general, Data Limited is acquiring the business of DA, TA. In return, PC will be paid now. PC what? How they are paying? Requisite number of equity shares of 10 to take over the business. Requisite number. They are not specifying how much, but they are telling requisite number of shares will be given for taking over your business. Abstract of balance sheet of companies on 31st March 2021 in rupees given in lakhs. So both the companies balance sheets, three companies DA, TA, Data balance sheets given. See this PPE 7,500, 8,000. Add both 15,500. Correct? Financial assets 800, 500, 1,300. Current assets 4,700, 6,500, 11,200. Equity share capital 6,000, 8,000, 14,000. Other equity 3, 3, 6. Borrowings 2,000, 3,000, 5,000. So by this you can easily say that they are merging simply the assets and liabilities. That means this is definitely pooling of interest, common control method, common control. That's why they are doing this now. In case of acquisition method, we will take fair values of assets and liabilities. So their past journal entries in the books of DA, TA, Data Limited. So they're asking journal entries in the books of DA, TA, Data and show balance sheet abstract after merger. Now first of all you tell me, in this case, two entities DA and TA, correct? DA Limited, TA Limited. These two entities are forming as Data Limited. Merger happening, merger, simple merger. So can I say like this? Shareholders, shareholders, shareholders. So simple corporate restructuring is happening. If you look at, they are simply adding assets and liabilities. So definitely it's a pooling of interest, common control transaction. So in case of common control transaction, Data Limited is called transferee. Correct? DA and TA is called transferor companies. Now first we are going to focus on which company? Transferee. Transferor, anyway they are going to be liquidated because their business will be taken over by the new company. So their books we will see later. First we will focus on the Data Limited new company. So here this question is belongs to common control. Everybody see this. The combining entities or businesses are ultimately controlled by same party or parties both before and after the business combination. So it is a business combination under common control and pooling of interest method is allowed, followed. Pooling of interest method will be followed. Now you have to tell me here step by step. What is first step now? First step. Identify the acquirer. Who is acquirer? Data Limited. Data Limited is the acquirer. So we don't call him as acquirer, we will call him as transferee. See this, transferee, Data Limited. Transferor, DA, TA. First you identify whether this question belongs to common control or not. Yes, it's a common control question. On what basis you are saying, sir? Simply they are adding the assets and liabilities on book values. So that indicates it's just a restructuring happening. Okay. What is step number 2? Date of acquisition. What is the date of acquisition, sir? 31st March 2021. 31st March 2021. What is step number 3, sir? PC calculation. This is the most important here. Can you tell me how much is the PC paid by new company transferee to the transferor company? See here they are saying requisite number of equity shares of 10. But how much is the requisite? We don't know. Therefore, what we are going to do is we are going to calculate the net assets. See, generally when I take any business, how much PC I will pay? How much worth of assets I am taking from you? Based on that I will give PC if nothing is mentioned. So in this question, requisite number of equity shares will be given, they are saying. But this requisite number of shares will be calculated based on what amount? That's why I am going to calculate net assets. So that's why I calculated the, see, calculation of PC here. Total PC is nothing but net assets including reserves taken over of transfer company. Remember, sir, whenever in the question they have not given purchase consideration. Okay, the assumption is net assets taken including reserves will be the total PC. So in this case, from DA limited, TA limited, whatever be the net assets including reserves we are taking, that will be the PC. But once you get the total PC, this total PC is split between data, DA and TA, because two companies are there. PC will be paid to both of them, na? So therefore, this once you calculate the PC, distribute this PC in the ratio of their net assets. So total PC is calculated net assets including reserves. Hey, remember, important. Total PC, how you are going to calculate net assets including reserves? Because simple, you are taking everything from that company. Corporate restructuring is happening. So net assets is calculated and reserves will be added. You will get total PC. Once you get the total PC, split between these two companies. How much will be given to DA? How much will be given to TA? That will be split based on the net assets. So if you take the calculator and tell me, in this question DA and TA, what are the assets? Tell me PPE. Book values only. How much? 7,500. TA 8,000. Correct? Financial assets 800, 500. Current assets 4,700, 6,500. Minus borrowings 2,000, 3,000. Right? Borrowings, sir, 2,000, 3,000. Current liabilities 2,000, 1,000. So what are the net assets? 9,000, 11,000. You see, calculate. Net assets 9,000, 11,000. From less other equity, including reserves. I told you, including reserves means reserves should also be deducted. Including reserves means don't add, please. Including reserve doesn't mean reserves will be added. Reserves generally will have the credit balances, right? Like liability side. Other equity also you deduct. How much we got? 6,000, 8,000. So total PC is these two. 6,000 plus 8,000, 14,000 will be the PC. So PC will be 14,000. This is the unique sum. Mark it as important. In this question, PC how to calculate, sir? Net assets including reserves, you have to take it. Once you got this PC will split between two companies, because here there are two transfer companies, na? DA and TA. For both of them, we need to split. On what basis you split? Based on net assets. So here net assets already calculated 9,000, 11,000. So 14,000 into 9,000 divided by 20,000. Correct? 9 plus 11, 20 na, sir. Split between these two. 9 is to 11, 9 is to 11, sir. 14,000 into 9,000 divided by 20,000. How much, sir? 6,300. This is the PC payable to DA limited. PC payable to TA limited, 14,000 into 11,000 divided by 20,000. 7,700. Ratio is, I told you, na? Distribute PC in the ratio of their net assets, not reserves. So that means this one you have to take it. This one you have to take it. Okay? When you distribute the PC, distribute based on the net assets. When you are calculating the total PC, you have to take reserves also. So that's the important point here. Because, sir, what is the logic here? See, logic is, DA and TA, two separate companies, they are forming as DA data limited under the common control. That means just the name has been changed. Control is in the hands of the same parties. So therefore, if you think possibly the new company is getting what? New company is literally getting everything, including reserves. But when I distribute the PC, net asset should be the base. When I calculate PC, I will take everything, including reserves. But when I distribute between DA and TA, profit set aside only based on their original net assets, we will distribute the PC. That's the idea. Okay? So step 3 you understood? This is the most important step in this question, sir. This question. What is step number 4, sir? Same, recognition and measurement of net assets. And I told you net assets will be taken at what value? Book value. Same, already we calculated here. Same thing. PP, fixed assets. In purchase consideration step, I already done it now. See this, recognition and measurement of net assets of DA. PP, financial assets, current assets, borrowings, current liabilities. So these are the assets we have taken. Same, like net assets we calculated na, sir, here. Book value of assets and liabilities. Step number 4. You understood or not? Step number 5, NCI will not arise. Step number 6, gain or loss on restructuring. Now you tell me what is the PC here? DA 6300. DA 6300 PC. What is the net assets we are taking? 9000. So 6300 minus 9000. Loss. Second, this one TA you see 7700 PC. Net assets 11000. Gain. I think it will become 0 if you see carefully. Here I have calculated, see this. Total PC 14,000, sir. Total net assets including reserves, how much we have taken? 14,000. This one. Sir, here we have to reduce this. I forgot it here. We need to reduce this other equity also. Correct? Because I told you in theory in step number 4, all assets and liabilities including reserves. So I forgot it here. But I think in purchase consideration calculation we already deducted 6,000, 8,000 already we got it. 6 plus 8 how much, sir? 14. So that's why 14, 14. So there is no gain, no loss. Here PC and net assets both are same value. See here, please understand, the most important thing is PC calculation. Don't confuse with PC calculation. PC calculation is net assets including reserves. Distribution of PC will be done based on original net assets. Okay? And this one, gain or loss on complete restructuring, nil we got. You can do individually also, you will get nil only. Overall. Last entry, tell me the entry. Assets will be debited. What are the assets? PPE, financial assets, current assets. Everything at what value? Book value. So for example, PPE 15,500, correct? So this 7,500, 8,000, 15,500. Like that. Financial assets 1,300. Current assets 11,200. Liabilities, borrowings 5,000. Borrowings 5,000. Current liabilities 3,000. Including reserves, other equity, total other equity, reserves on 6,000. PC 14,000. So no loss, no gain. Then PC is discharged in the form of equity shares. PC to equity share capital. Correct? Now let us prepare the balance sheet after the merger. Data limited balance sheet after merger. Tell me, suppose balance sheet, particulars, note number, amount in lakhs. Asset side, first non-current assets. In that first we will take PP. PP how much? 15,500. Take it. Financial assets next. 1,300. Take it. Current assets 11,200. Come to equity and liability side. Equity share capital 14,000. Purchase consideration nothing but. Other equity 6,000. Non-current liabilities borrowings. Borrowings how much? 5,000. Current liabilities 3,000. Balance sheet tally 28,000. Same, simple. I don't think so much simpler question will come. This is a very simple question. There is no complication here. The only complicated point is what? PC. PC calculation, distribution in the form of net assets. But when you are calculating including reserves, that's the point only you need to remember. In this question, till now we have done on whose books, sir? Transferee, nothing but data. Data limited books we have done it using pooling of interest method. Okay. Now they are also asking DA limited, TA limited books. Actually tell me, Ind AS 103 is applicable for acquirer. Only acquirer. Acquirer books it is not applicable. Ind AS 103. I told you already. Ind AS 103 focusing only in the books of acquirer. That means in this case transferee. That means DA, data limited. DA and TA, what will happen to them? They will close. Here I am taking their business, they are merging into new company, therefore their businesses will be liquidated, business assets and liabilities transferred to new company. So we already discussed, when the business is closing down, what we need to do? We need to close the books of accounts by realization account. we will transfer all the assets to realization, liabilities to realization, PC will be received, that will be transferred to realization account, equity shareholders, equity share capital reserves and surplus will be transferred to equity shareholders, this PC will be given to them, their accounts will be settled. Like in the last session I have solved one question also, problem number 4 I think, when acquisition happened through net assets method. Hello? Same here also, you see DA company. For example, I will do it. See this. First go to DA Limited. Tell me, DA Limited books, what are the assets they had? PPE, financial assets, current assets. Close it by transferring to realization account. So realization account debit to assets. PPE, financial assets, corporate assets. How much? 13,000. Hello? Then liabilities you transfer. What are the liabilities in DA Limited? Borrowings, current liabilities. 2,000, 2,000, 4,000. Correct? Check it. Borrowings 2,000, current liabilities 2,000. Close them by transferring to realization account. Then PC received. PC received. DA Limited is going to receive PC from Data Limited because we have transferred our business. How much is the PC? 6,300. Already we calculated. 6,300 is the PC to Data. Correct? Say this 6,300. What is the entry when we receive PC? DA Limited books. PC is received in the form of equity shares. So equity shares in Data Limited account debit to realization account. 6,300, 6,300. So if I close the realization account, you see, realization account is debited with 13,000, credited with 4,000, and purchase consideration 6,300. So what's the difference? 2,700. 2,700 that will be given to shareholders, equity shareholders. So equity shareholders to realization. Hello? Realization account when you close, either you will get profit or you will get loss. That profit or loss will be transferred to equity shareholders only. See here, assets we are transferring 13,000 sir. Liabilities we are transferring 4,000 worth. So 13 minus 4, 9,000 worth of net assets we are transferring. But we are receiving 6,300 PC. That means 2,700 was loss. Loss on realization. That's why it is debited to shareholders. See this. Equity shareholders to realization. Next, settle equity shareholders account. How to settle it? First, whatever the amount due to shareholders, transfer it. Equity share capital, other equity. What is the equity share capital in DA? 6,000. What is the other equity? 3,000. It will be given to equity shareholders because it belongs to equity shareholders only, na? See, you purely think from the point of view of DA Limited. DA Limited is now closing because it is transferring its business to Data Limited. For that, it is receiving PC. So, DA Limited, what they will do is they will close the books. That's why all the assets is transferred to realization, all the liabilities is transferred to realization, PC received. Now equity shareholders account will be settled. How? Whatever equity share capital, other equity belongs to them, transfer it. Then whatever the PC we received, that we will give it to them. Equity shareholders to equity shares in DA Limited. So that their account will be closed. If you want, you can check it also. Equity shareholders account, you see. First realization loss, 2,700 debited. Then equity share capital, other equity, 9,000 credited. So finally PC is given to them, their account is settled. So therefore in DA Limited books, all closed, all assets closed, all liabilities closed, all shareholders account also settled. Now you tell me this, whether you have done this accounting as per Ind AS 103. No, this is not Ind AS 103. I already told you. Ind AS 103 is applicable only in the books of acquirer. In our example, transferee, in this case, transferee books, pooling of interest method. So this is common practice for the books of transferor. That means whoever is liquidating, this is how we need to do it. And same manner DA Limited books. Similarly, TA Limited books will be closed. See, TA Limited also same. First their assets will be transferred to realization, liabilities will be transferred to realization, PC received, then realization account will be closed, any profit or loss will be given to equity shareholders, then equity share capital, other equity will be given to equity shareholders, whatever the PC received, give it to them, their account will be closed. How many entries total? 6 entries. Have you understood? This is which question? Problem number 20. If you see in the question bank, similar to these questions, 1 or 2 questions are there. Same, this type of questions only. But you solve this question relating to common control. Okay. Next, one more question relating to common control I am going to solve, sir, which is problem number 19, study material problem number 19. See this question, very good question actually. Z Limited has 2 divisions, X and Y. 2 divisions are there in Z Limited. On 31st March 2021, division wise extract of balance sheet was division wise balance sheet given, sir. There are two divisions in a company, sir. Rupees in crores. Division X, division Y. PPE 350, 600. Provision for depreciation 300, 400. Current assets 300, 400. Equity share capital division X is there 50. Other equity 250 minus 150. Borrowings 360 division Y. Current liabilities division X and Y. So this is the balance sheet of which company? Z Limited. Z Limited, that to department wise, division wise balance sheet given. Okay. Next what happened, you see, Q Limited, a new company is formed. Q Limited, new company is formed to take over division Y. See this. This is called demerger. Because XY or belongs to one company only. In that one entire company is not transferred. Division Y is transferred to a separate company, or a new company is formed exclusively to take over this. So it's a resulting company, Q Limited, which is taking over division Y. By issue of purchase consideration 1 crore equity shares of rupees 10 at a premium of 15 per share. So PC is given 1 crore equity shares of rupees 10 at a premium of 15 per share to 1, the shareholders of Z Limited. See, PC is given to whom? The shareholders of Z Limited. Second, to Z Limited itself. Important. Actually, division Y formed as new company Q Limited. That means Q Limited is taking the business of Z Limited. For that, it has to pay consideration. One case they are saying the consideration is given directly to the shareholders of Z Limited. Because whoever the shareholders are there in Z Limited, the same shareholders will come to here also. So that's why we are giving shares to them. So when we give shares, they will become shareholders of this company. Correct? So can I say this is a common control? Yes. Because whoever the shareholders are there in Z Limited, the same shareholders will be there in the Q Limited also. This is if shares are given to the shareholders of Z Limited. Suppose if the shares are given to Z Limited itself directly, not to the shareholders of Z Limited, we are giving shares to Z Limited. That is second case they are saying. What they are asking, pass journal entries, prepare balance sheet after reconstruction in the books of both Z Limited and Q Limited based on 1 above and based on 2 above. That means if the shares are given to the shareholders of Z Limited, if the shares are given to Z Limited itself, they are asking in the books of Z Limited as well as Q Limited based on 1 and 2 above entries and balance sheet they are asking. Prepare, pass the journal entries and prepare the balance sheet of the company. First of all, you need to understand this question properly. Look at this diagram, sir. This I have done it in the class. So see this. The company is what, sir? Z Limited. In Z Limited, how many parties are there? How many divisions are there? 2 divisions, X and Y. Now this Y is formed as Q Limited. So now see this. This new company Q Limited is transferee because it is taking the business of Z Limited division Y. So Z Limited is called transferor. This is called transferee. Nothing but acquirer, acquiree. Correct? But this is a common control. Why? Because the shareholders of this company will be shareholders of this company only. Even Q Limited is also controlled by the same parties. So before, after, it is controlled by same. That's why it is a common control transaction. Sir, before business combination, division Y is in the hands of shareholders of Z Limited. Na? After forming as new company also, same shareholders will come. Hello? Because we are issuing shares to the shareholders of Z Limited. One case. Suppose if the shares, instead of issuing to the shareholders of Z Limited, if it is directly issued to Z Limited. This is case 2 they are asking. First I am going to solve this case. If shares are given directly to the shareholders of Z Limited. Now, tell me here, first of all, who is transferee? Q Limited. Q Limited. So, if shares are given to the shareholders of Z Limited, Q Limited books I am doing. This question belongs to common control. pooling of interest method will be followed. Correct or wrong? Correct. Pooling of interest method. Same shareholders. This is a demerger in the nature of pooling of interest. Demerger in the nature of pooling of interest method, or demerger in the nature of common control. Demerger in the nature of common control. This is actually demerger in the nature of common control. In the nature of common control. Steps to tell me. First step, transferee. Who is transferee? Q Limited. So transferee Q. Who is transferor? Z Limited division Y. Correct. First step done. Step 2. Date of acquisition given. See this. On which date this is happening? 31st March 2021. Done. PC. Tell me PC. PC clearly given in the question. See. New companies formed to take over division Y by issue of 1 crore equity shares of rupees 10 at a premium of 15. So 1 crore into 1 crore equity shares of 10 each, rupees 10 crores. But sir, here you need to understand, you have to ignore premium. In case of common control transactions, premium will be ignored. Shares, when we issue, we will consider only nominal value. I will show you. See, here, look at this in the original question. In the given problem, the consideration is settled by issue of equity shares at premium. Under pooling of interest method of accounting, only nominal value will be considered. The accounting of both the transferor and transferee will remain unaffected, ignoring the share premium altogether. So in pooling of interest method, sir, when you are considering the shares, even though equity shares are issued at premium, only nominal value will be considered. Don't consider premium. Okay. So that's why here PC, we have ignored premium, we have considered only nominal value of the shares issued. 1 crore shares of rupees 10 each. Next, what is step number 4, sir? Net assets. Assets and liabilities taken at what values? Including reserves. Including reserves. Here we are taking which company? Y. Division Y only we are taking. Division Y, what assets are they? Tell me. PPE 600 minus provision for depreciation 400. That means 200 we need to take. So see this. PPE minus provision for depreciation 200. Important. Transferee. So transferor. Division Y. Next asset. Current assets. How much is the book value? 400. Take it. Next. Equity share capital, nothing. Other equity is there, 150. Minus is there. Important. Guys, listen. Other equity, including reserves, we have to take. I told you. When you are taking the assets and liabilities, including reserves. Here, reserves is negative balance. 150. Minus 150 is there. Generally, if it is a positive balance, what we will do? We will less. So, now here we are having a negative balance, debit balance. That's why other equity is here. Positive, 150. I'm adding. Hello. So, other equity, 150. Total it will be 750. See, these are the small mistakes students will do. Generally, what they will do now, minus 150, they will just put like this, minus 150. What indirectly, instead of adding, what they are doing, deducting. That's the mistake they will do. Because here the reserves are having a debit balance, not credit balance. You understand this? Opposite. Next, borrowings, how much? 360. Current liabilities? 390. So, net assets taken, nil, including reserves. See this. Asset side, this one, including reserves 750, this was 750, so nil. Nothing came. Hello. Overall, if you see, nothing. Balance is 0. Of course, we'll incorporate assets and liabilities. But overall, if you see the net assets including reserves, it is nil balance. Everybody. Step number 4. NCI not applicable. Ignore. Next, step number 6, sir. Goodwill or gain or loss on restructuring. Here PC, how much we paid? 10 crores. Net assets? Nil. So, entire PC, 10 crores will be considered as loss on restructuring. Actually, in this question, I told you now, in study material, one of the question, instead of treating this as loss on restructuring, they are treating it as goodwill. So, here that is. Okay. Next, Step number 7, combination entry, business combination entry. What is the entry we will write? PPE account debit, current assets account debit, other equity account debit, to borrowings, to current liabilities, to PC. Difference obviously will be transferred to goodwill. Sir, assets, sir, one by one assets we see, we have already taken 200 PPE, current assets 400, other equity 150, borrowings 360, current liabilities 390. Correct? PC how much? 10. Goodwill 10. Balancing figure. You check it if it is not. See here, if I take PC, obviously balance figure should be there. So goodwill. Because net assets 0, sir, I am paying 10. Obviously this should be goodwill. Everybody. Now this PC I have given in the form of equity shares. Sir, I am doing in whose books this is? Transferee who? Q Limited books. Which method I am following? Pooling of interest method. This is common control. You should not forget it. Balance sheet if I prepare in Q Limited books. Tell me what items will come. This is a new company. Whatever we take from Z division Y, that will become. Correct? First asset side, non-current assets, PPE will come. How much? 200. Goodwill is there, na? This effect will be given to this entry. Current assets 400. Asset side. Equity and liability side, equity share capital 10. Other equity minus 150. Because other equity we have taken, na? This is negative figure. That will be continued. Non-current liabilities, borrowings. Borrowings how much? 360. Current liabilities 390. See this. Balance sheet tallied. So I have completed in the books of Q Limited. You understood or not? Now Z Limited books, what they will do, tell me. Z Limited, in their company, one department is now transferred to another company, demerged. Therefore, whatever assets and liabilities belongs to division Y, they will close it. Correct? So Z Limited books relating to division Y, close all the assets and liabilities. Tell me in division Y what liabilities are there first. Provision for depreciation relating to asset, that is having a credit balance, na? That will be debited. Provision for depreciation, how much is there? 400. Close it. Borrowings is there. How much? 360. Close it. Generally these are liabilities at credit balance. Debit them. Close it. Next, current liabilities 390. Debit. Similarly, assets you see. PP 600. I mean, before deducting provision for depreciation, because provision for depreciation I cancel separately, na? PP 600. Credit it. Next, current assets 400. Other equity 150. Other equity also we need to close, na? Other equity generally having which balance? Credit. Debit balance. In the books, division Y, other equity, how much is there? 150 minus 150 means debit balance. If I want to close it, credit. So automatically it becomes 0. You see, tallied. All the assets, all the liabilities I closed. Check it whether tallied or not. 400 plus 360 plus 390. Hello? 1150. 1150. Everybody. So that's it, sir. This is what Z Limited will do in their books. Have you applied here Ind AS 103? No, this is not Ind AS 103. This is just like closing the books. Like in the last problem also, DA Limited books we have done it now. When DA Limited transferred their business, what they have done? They transferred everything to realization. Same thing here. But here you need to understand, Z Limited is not transferring entire company. Only one department they are transferring. Therefore, entire company will not be liquidated. Only division Y related assets and liabilities we need to close. So that's why we closed all the assets, all the liabilities. Get a loss. That profit or loss I will transfer it to my P&L account. So here all assets, liabilities, other equities are closed. PC 10 crores is not accounted, being received by shareholders directly. You may ask, sir, Z Limited received PC, na sir? Z Limited not received. Who received? Shareholders of Z Limited. Therefore, Z Limited books that PC they won't record it for transferring this division Y. Common sense. Sir, clearly they said that Q Limited given shares to whom? Shareholders directly, not to Z Limited. So therefore, Z Limited books they will close division Y assets and liabilities. They don't record PC. You may get a doubt, sir, why PC is not recorded? PC is given to whom? shareholders, not to the Z Limited. Balance sheet, if I prepare Z Limited after reconstruction, what happens? Only X Limited, X division X figures will remaining. Division Y transferred, na sir, only division X. You see division X PP, how much is there? 350 minus provision for depreciation, 50. Current assets, 300 obviously, you see, current assets. Division Y you have to tell, division X you have to tell, current assets 300. Equity share capital, 50. Other equity, 250. Current liabilities, 50. That's it. This is the balance sheet remaining. Completed. This is one case. Suppose if the shares are directly given to Z Limited instead of shareholders, what happens? Tell me. First step by step we will go. Step by step we will do. If instead of giving to the shareholders of Z Limited, if shares are given directly to Z Limited, Q Limited books, first of all, accounting will change. Q Limited books, accounting will change? No, it will not change. Q Limited books, accounting remains same. Pooling of interest method, same steps. Sir, Q Limited, anyway, whether shares are given to the shareholders or shares are given to the Z Limited, that doesn't make any difference to them. Their books common. What is that? Steps. All the 8 steps we have done it na? Same manner we will do it, including balance sheet. Like how we have done it here. This one will do it. Because see, whether we give it to the shareholders of Z Limited or Z Limited directly, so transferee remains same, date of acquisition remains same, PC same, assets and liabilities taken over same, NCA will not come, goodwill or capital reserve same, business combination entry same. What difference it will make for them? Doesn't make any difference. So therefore Q Limited books it is not going to affect. Accounting is same. But Z Limited books you have to tell me. Come on, tell me. Now Z Limited books, they are receiving PC. So when that PC they have to incorporate now. How you are going to incorporate it? Tell me. Suppose you are Z Limited, you transferred one of your division to new company, demerger happened, they have given PC to you. They have given 1 crore shares of 10 rupees each to you. That means 10 crores PC you are receiving. What you will do as a company? As a company, what I have to do is, this 10 crores I have to treat it as my investment in new company. So that's why investment account they will debit, and this 10 crores they will transfer to restructuring. Profit, nothing but profit which is transferred to other equity. Think from company point of view, sir. Company has received 10 crores PC, sir, relating to sale of division Y. Division Y. So therefore, whatever the shares they received in the new company, that is their investment, na? So company books investment will be recorded, and this investment, for this investment they transferred their net assets. Overall, this is a gain for them, because the net asset they are transferring is 0. Because assets and liabilities, assets minus liabilities, if you do, it will become 0, na? But they are receiving 10. Therefore, it is a kind of a profit for them. That's why it is transferred to restructuring profit, which is ultimately transferred to other equity. So the basic difference is, if the shares are given to the shareholders, Z Limited books relating to PC, no entry, nothing. That's why just assets and liabilities are closed here. This one, first case. In the second case, if PC is received by Z Limited directly, we will record this 10 crores as investment. We invested in the Z. Sir, when one company issued shares to my name, that is my investment only, na, sir. I am the owner. So company books investment is there. But this investment, for this investment, you are spending nothing, because you given the business, but that value is 0. That's why it is entirely your profit. That's why it is transferred to restructuring profit, which is transferred to other equity. Beautiful point. Hello. Do you appreciate this point? You understand this? Now if I prepare Z Limited balance sheet after reconstruction, tell me what happens. Same balance sheet, X, division X figures I will take. One more extra thing is investment as well as this restructuring profit. So that's why if I prepare balance sheet, asset side, non-current assets, investment I have taken 10. And also equity and liability side, equity, other equity, I added that 10. So case 1, case 2, same balance sheet. The only difference is investment, purchase consideration. So, see, one of the beautiful questions, sir. I wish this type of questions they have to test in the examination, actually. So very good question they have given here. See, it is not that easy to understand this type of question. See, I made it very simple for you. I am directly going and explaining the crux of the problem. But if you do it alone, independently, it will take a lot of time to understand the crux. Sometimes you don't understand also. Okay? Honestly tell me, you understood or not? Yes. So this is one question, sir, relating to common control. Okay. Next area we are going to cover is internal reconstruction, sir. 7 marks usually they are asking from internal reconstruction, so easily you can get 7 marks. Follow me carefully. I am going to cover every point in internal reconstruction, and we are going to solve some questions also relating to internal reconstruction. Some previous exam questions I will solve so that you will understand the level of questions they are asking in the examination. First of all, let us try to understand what is this internal reconstruction is all about. Suppose, sir, tell me, when company has problems means companies keep on accumulating losses, companies suffering with losses. What is the options available to the company? Either it will liquidate, or the company is taken by some other company, business combination. Suppose if company selects, we don't want to liquidate, we want to continue, but our company should not be taken by any other company. We don't want to sell our company to any other. We want to continue our own. So when you have problems within the organization, problems in the sense, what are the problems a company had? Like for example, a company may have huge losses, accumulated losses. Company may have overcapitalization. Company may have overvalued assets. Company may have undervalued liabilities. Maybe company will have negative operating cash flows. So these are all the problems for a company, right? Now how to overcome these problems? Suppose if the losses are keep on accumulating, maybe the company will not survive for a long period of time. Maybe we have to liquidate, but we have not selected the option of liquidation. We want to continue, but not with these items, with these problems. So we want to eliminate all these problems from the organization without any external help or without any external takeover. So that process what we undertake is called internal reconstruction. For example, a person is suffering with a disease. What we will do, so the doctor will diagnose this, and he will prescribe the medicine, and he will administer the medicine into the body internally, and then that medicine will fights with the disease, virus, right? Similarly, the internal reconstruction is a process where a company wants to reorganize its capital structure. Okay, so what is internal reconstruction, sir? Existing company continue without being liquidated. So what happens in internal reconstruction? Very simple, your financial structure will be reconstructed. Okay, actually there are two types of reconstruction, sir. One is internal, another one is external reconstruction. External reconstruction is nothing but your company is taken by some other company, like what we have seen in business combination. This already we have covered it. So this is not the option we selected. The option is this. We want to continue, but we don't want to problems in the organization. I mean our balance sheet, our financial statements should look strong and healthy. Okay. So generally if you take a company, what are the problems the company had? These are the problems. Now we know we have these problems. What we do to overcome these problems? Because for example, if somebody is looking our balance sheet, P&L account, and if they see assets are overvalued, liabilities are undervalued, and losses are keep on accumulating, our reserves and surplus showing negative balance, so nobody interested to invest in our company, nobody wants to deal with our company. So right, so our balance sheet should look very strong and healthy. Whatever the problems we had, we want to eliminate them. So that's why the process we undertake is called internal reconstruction. So internal reconstruction is what? It's a reorganization of financial structure of the company. Our financial structure will be reorganized. Our financial structure will be reorganized. That process we undertake to reorganize the financial structure is called internal reconstruction. Okay. Now tell me, sir, suppose there is a company suffering with these problems. It has huge accumulated losses, overcapitalization of overvaluation of assets, overcapitalization. See, sometimes our capital is also overcapitalized. Maybe number of shares are more, maybe face value is more, maybe face value less. There could be capital problems also, capitalization problems, overvalued assets, undervalued liabilities, like this. Now tell me how you are going to overcome all these problems, all these weaknesses you have in the organization, how you are going to overcome? Definitely with the help of our stakeholders. Who are the stakeholders? Our shareholders, our creditors, our employees. With the help of all these peoples only it is possible. So that's why internal reconstruction is an arrangement. It is a kind of an arrangement made by companies whereby the claims of the shareholders, debenture holders, creditors and other liabilities are altered or reduced. Suppose shareholders know the position, right? They know that the company is suffering losses. They have to sacrifice something. Debenture holders knows that the company is not in a position to pay their liabilities. Company has some problems. They will also ready to sacrifice something. Like that creditors, like that everybody. So suppose if the company selects an option without liquidation, we want to continue, definitely company has to make some arrangements with these people, because these are the crucial players, I mean internal people. So company will make an arrangement. Now what they will, I mean, achieve with this arrangement, whatever sacrifices they will made, that will be transferred to a separate account called capital reduction account. That account we will use to write off the accumulated losses. Whatever the losses we had, we will write it off with that sacrifice, with that amount. And also any assets valued, overvalued, will be reduced to their proper values. I mean, will be valued at fair value. For that purpose, this amount will be utilized. And any liabilities will be shown will at a correct value. Therefore, whatever the problems we had, all these problems we will set right with the arrangement with the shareholders, debenture holders, creditors and other people of the organization. That entire process is called internal reconstruction. Internal reconstruction. So can you sum up what is internal reconstruction? So internal reconstruction means when our business is taken by some other company. No, we want to set right the company within. That process we undertake is called internal reconstruction. So we don't select the option of liquidation. We want to continue, but not with this financial statements, not with this position, because if this is the case, company would not survive for long period of time. So what is the reconstruct objective? What is the internal reconstruction? Reconstruction means a process where we will do revaluation of assets, reassess the liabilities, write off the past losses. It may involve reducing the share value or modifying the shareholders' rights. Of course, I am going to tell you to what we do, what are the different methods company will do the internal reconstruction. We have some methods, but first I am explaining the basic concept of internal reconstruction. So main object of internal reconstruction, I think you understood, right? So in internal reconstruction, what happens, sir? There is a reorganization of financial structure in the organization. Our financial structure will be reorganized. That reorganization process is called internal reconstruction. And in the process, we will make an arrangement with whom? Shareholders, debenture holders, creditors, other liabilities. With all of them, we will make an arrangement, and accordingly, whatever the sacrifices made by them, that will be transferred to a separate account, capital reduction or reconstruction account. That amount we will use to set off all these things. I mean, to overcome all these negatives. Okay, that is just theory, just for your understanding I explained, not that much important. Once you understand what is happening in internal reconstruction, next the most important is methods of internal reconstruction. Important, listen to me. Methods or scheme of internal reconstruction. Sir, every company, when they undertake internal reconstruction, generally in internal reconstruction, there are different ways an internal reconstruction will be done. A company can reconstruct its internal affairs in the following ways. Actually, there are 5 methods, or there are 5 ways a company can go for reconstruction. Reconstruction or internal reconstruction, both are same only in this case. What are the different ways? 5 ways I have given here. What is the first way? Alteration of share capital. Second, variation of shareholders' rights. Third, reduction of share capital. Fourth, compromises and arrangements. Fifth, surrender of shares. There are 5 methods. See, the object is to reorganize the financial structure. Financial structure means assets, liabilities, capital, everything. Now we want to reorganize them. So these are the 5 methods available to us. Alteration of share capital, variation of shareholders' rights, reduction of share capital, compromises or arrangement, and then surrender of shares. Let us discuss one by one. First, alteration of share capital. Alteration of share capital. Sir, if you see Companies Act, there is a section called section 61, which talks about alteration of share capital. When we call alteration of share capital, if any one of these things happens, that is called alteration of share capital. First, increase of authorized share capital. Company increases its authorized share capital, that is alteration of share capital. Next is subdivision of shares. Company dividing the shares into shares of smaller denomination, that is called alteration of share capital. Consolidation of shares. Consolidation of shares means consolidating shares into shares of larger denomination. Conversion of shares into stock, vice versa. Shares are converted into stock, stock is converted into shares. And last one, cancellation of unused shares. If any one of these 5 things happens, then only we call it as what? Alteration of share capital. So when a company resorted to reconstruction process, sir, any one of these things or combination of these things company will do. For example, company will go for subdivision of shares, company will go for consolidation of shares, company will go for conversion of shares into stock, company will go for cancellation of unissued shares, company may increase the authorized share capital. Sir, why company is doing this? That's what I told. Internal reconstruction is reorganization of organization's financial structure. Why we are doing reorganization? Because our company is suffering with some problems. What are the problems? You are suffering, maybe you are suffering with huge losses. Maybe your capital is not good. Over capitalization happened. Maybe your face value of the share is not proper. Number of shares not proper. Maybe you have overvalued assets, undervalued liabilities. See, these are all your problems, right? So to overcome these problems, what you do? Alteration of share capital may be one of the way. As a part of internal reconstruction, you go for this. Now first you see, increase of authorized share capital. Simple. What is authorized share capital? You know, sir. This is the registered capital, nominal capital of the company. This is the maximum capital a company can get. That is authorized share capital. Hello. Suppose whenever a company increases authorized share capital, any new entry we will write? No. Increase of authorized capital, we don't write any entry. When we write an entry, when shares are issued, when we go for public issue and the public subscribes the shares, send the application money, then we will write it. For example, on issue of new shares, bank account debit to share application and allotment we will write. And in share application and allotment account, we will transfer to share capital. But simply increasing the authorized share capital, there is no separate journal entry, we will record it. Sir, because authorized capital means what, sir? It's a registered capital. That's it. This capital you increases, nothing is received by the company. Therefore, whenever increase in the authorized capital happened, nothing will be recorded in the books. Only when you issue shares to the public, when public made an application for the shares, they will pay money along with application. Then you will record it. Bank account debit to share application and allotment, share application allotment account debit to share capital account, then share capital will be recorded in the books. So this is the first one. Second one, most important. What is that? Subdivision of shares. Important, guys, listen, in problems this is the most important thing. Subdivision, consolidation. Sir, what is subdivision, sir? dividing the shares into shares of smaller denomination. For example, you see here 1000 equity shares of 100 each. The company is having 1000 equity shares of 100 each. So total capital 1 lakh. Suppose company has done like this. They divided, okay, one share into 10 shares. So 100 rupees share, okay, they divided into 10 rupees share. That means one share 100, sir, we have made 10 shares. So one share is divided into 10 shares. So therefore number of shares will be 10,000. 1000 shares into 10, 10,000. But face value has become 10. Overall capital 1 lakh, 1 lakh, 1 lakh. This is called subdivision of shares. So in subdivision what happens? You remember face value will decrease. That's why I said subdivision of shares into shares of smaller denomination. 100 rupees share we divided into 10 shares of 10 rupees each. Therefore your number of shares will become 10,000 shares of rupees 10 each. Then in this case what is the entry you will write, tell me? Generally share capital shows which balance? Credit balance. So now you debit. Share capital account will be debited. Which capital? Old capital. What is your old capital? 1000 shares of 100 each. So this will be debited. Old number of shares into old face value. Now your new share capital. What is the new share capital? 10,000 shares into 10 rupees. New share capital will be created. Overall amount remains unchanged. Here 1 lakh only. Amount wise if you see 1 lakh only. But what is changing here? Number of shares to face value. Number of shares, face value. This could also be undertaken by the company as a part of internal reconstruction. Sir, why they are doing this, sir? Simple. To make shares more affordable or increase liquidity. For example, if your face value is 100 rupees, maybe the share is overpriced. Suppose if I make it 10, maybe it is more affordable. More people are ready to buy the shares of the company. That's why. So to make shares more affordable or to increase the liquidity, sometimes company may go for subdivision. You understand subdivision? So subdivision means shares divided into shares of smaller denomination. Overall capital remains unchanged. But what is decreasing here? Face value. Number of shares increasing, face value decreasing. Next, consolidation of shares, opposite. Suppose you see 10,000 equity shares of 10 each, 1 lakh rupees. Now in consolidation what company has done is they made 10 shares into 1 share. They made 10 shares into 1 share. So 10,000 divided by 10, it will be 1000. Obviously face value will become 100. Sir, 1 share 10 rupees means 10 shares it will be 100. Correct? Opposite, sir. Consolidation means clubbing. Here every 10 shares clubbed into 1 share. So therefore your face value will become 100, number of shares will become 1000. Overall capital remains same. This is called consolidation. Subdivision consolidation. You understand? What is the entry we will write? Same. Old share capital will be debited. New share capital will be created. Your old share capital face value 10. Your new share capital 100. Overall capital remains unchanged. But why company will go for consolidation? Simple. To align with the market trend. For example, here in subdivision you reduced the face value, right? To make it more affordable. At the same time, here the face value are increasing. Maybe you have undervalued your share. You have put a less face value. Now you realized that in market you have more value. Therefore you have increased the face value of the share. So maybe to align with the market trend, we will go for consolidation. This is also part of internal reconstruction. See, somehow we need to reorganize our financial structure, right? We need to set right. We need to look our balance sheet stronger and healthy. That's what we are doing it. So in every problem, almost in internal reconstruction, this subdivision consolidation will come into the picture. In every problem, they will majority of the problems, subdivision consolidation will be there. Hope you understood subdivision and consolidation. So what is consolidation? Consolidating the shares into shares of larger denomination, larger. So 10 has become 100. That means every 10 share has become 1 share. 10 into 10 rupees face value 100. Now I made 1 share into 100. That means overall capital remains unchanged. But every 10 shares is treated as 1 share. This is one thing. Next, conversion of shares into stock. Sir, what we are discussing? Methods of internal reconstruction. In that first method, alteration of share capital. In alteration of share capital, first one, increase of authorized share capital. Second, subdivision. Third, consolidation. Fourth, increase of shares, conversion of shares into stock. See, companies will go for conversion of share capital into share capital. So whenever we convert share capital into stock, what is the entry? Share capital will be debited, share stock will be created. Suppose for example, in case of share capital, 1 lakh share capital is there, number of shares into face value. Now we convert them into share stock. So vice versa can also happen. Suppose in the company we have share stock. Now we can convert into share capital. So shares are converted into stock is converted into shares. See, it is which stock? It is not inventory. Please understand. Shares means what? Generally, shares will be expressed number of shares into face value, right? But in case of stock, there is no division like that. One consolidated amount, we will call it as stock. So what is the advantage of having stock, sir? We can, suppose for example, in case of shares, we cannot issue shares in split, what is it, fractions. For example, can a company issue, for example, 110 shares? Maybe it cannot. Why? Because generally shares will be issued in lots. Maybe it is not possible. For example, every one lot is equal to 50 shares. Suppose company will give shares only in lots. So therefore 50 shares is one lot. But in case of stock, it is not like that. You can issue how much amount of the stock the subscriber wants, we can give it. So that is the advantage of converting into stock. So sometimes the company may convert its share capital into stock or may reconvert its stock into share capital. So that is also happens. That is also part of internal reconstruction. And last one, cancellation of unissued share capital. So any unissued share capital, suppose for example, there is an authorized capital of 10,000 shares, issued 9,000 shares. So unissued 1,000. So we want to cancel it. For cancellation, there is no separate entry recorded. Why? Because only when shares issued, we will record in the books. Then if you reverse it, we will record the reverse entry. But here shares are not yet issued, sir. That means no entry is recorded in the books. Therefore, the question of cancellation entry will not arise. Are you understanding, guys? No accounting entry is required. So this is the first method of internal reconstruction. So alteration of share capital. So in alteration of share capital, how many ways are there? 5. What are those? Increase of authorized share capital. When you increase authorized share capital, any entry will be recorded? No. Only when the shares are issued, entry will be recorded. Second, subdivision. In subdivision, what happens? Your face value per share decrease or increase? Decrease. Guchpetukondi. Subdivision, yes, small. Subdivision, yes, small. So subdividing the shares into shares of smaller value. Okay. Consolidation means, so multiple shares are treated as one share. So your number of shares will decrease, your face value will increase. And then conversion of shares into stock, and the last one, cancellation of unissued shares. This is the first method. Second method, variation of shareholders' rights. Sir, sometime as a part of internal reconstruction, what company will do is, company will vary the shareholders' rights. Suppose, see, if there is a company, this company issue different class of shares, right? With different rights. Suppose a company issued equity shares. If I purchase those equity shares, I will get rights. So suppose if company issued different class of equity shares, somebody purchased it, they will get different rights. In the aspects of dividend, voting rights, repayment of capital. So different rights, company can issue shares with a different class with different rights. Now they will be changed as a part of internal reconstruction. Now company as a part of internal reconstruction, what they can do is, they can change the rights of the shareholders. How? Suppose for example, for reducing the rate of dividend in case of preference shares. Suppose you purchased preference shares of a company. Initially they said 10% dividend will be given, 10%. Now as a part of internal reconstruction, they reduced it to 8%. For example, you are the preference shareholder, sir. Company, generally for preference shareholders, preference dividend will be paid na. That dividend is 10% as per the agreement. But now company, as a part of internal reconstruction, may ask the preference shareholders, this is the position of the company, please sacrifice something. Then preference shareholder said, okay, instead of 10% we will take only 8%. That means this is a change in the shareholders rights. Correct? So what is the entry we will write here? When we change the rate, when you decrease the rate from 10% to 8%, amount wise there is no change. Same preference share capital. For example, here old is 10% cumulative preference share capital. 10,000 preference shares of 10 each, 1 lakh. Now in place of this 10%, we will write 8%, which is new cumulative preference share capital, which is also 1 lakh. So 1 lakh only. But what is changing here? Only rate is changing. Another example is change from cumulative preference share capital to non-cumulative preference share capital. Suppose company issued preference shares. At the time of issue of preference shares, they said these are cumulative preference shares. Cumulative preference shares. Cumulative preference shares means the dividend will keep on accumulate until it is fully paid. That is called cumulative preference shares. So if you purchase cumulative preference shares, whatever the dividend relating to that preference shares is there, it is keep on accumulates until it is fully paid. Suppose now company, as a part of internal reconstruction, they want to change cumulative to non-cumulative. That means they are changing the rights of the shareholders. So what is the entry here? 10% cumulative preference share capital will be cancelled. In that place, 10% non-cumulative preference share capital we will write. In place of cumulative, non-cumulative will come. Amount wise it is same. So this is second method. So tell me, what is the second method of internal reconstruction? Variation of shareholders' rights. What is variation of shareholders' rights? Company will issue different class of shares, and these different class of shares will carry different rights to the shareholders. Rights in respect of dividend, voting rights, repayment of capital, like that the shares you purchase will give you some rights. As a part of internal reconstruction, now company want to modify those rights. How? For example, they may change the rate of dividend, or they may change the nature of preference shares, like cumulative may be converted into non-cumulative, like that. So these are called variation of shareholders' rights. So as a part of internal reconstruction, to make the reorganization of financial structure, company will go for this also. So second method you understood? The most important method out of all 5 is reduction of share capital. This is very, very important, guys. In problems this will come, so you have to focus it very clearly. Reduction of share capital. Reduction of share capital. Sir, what is this reduction of share capital? Actually, this is also as per the Companies Act. See, everything I am discussing as per Companies Act. Alteration of share capital, section 61 Companies Act. Variation of shareholders' rights, section 48 Companies Act. Now I am going to discuss reduction of share capital, which is also covered in Companies Act, section 66. What is this reduction of share capital, sir? See, actually in reduction of share capital, 4 cases will come, sir. I want every one of you to observe each case. Take your time. First one, suppose liability of shareholders is there. It was reduced or cancelled in respect of unpaid amount on shares. In respect of unpaid amount on shares. Sir, if you purchase shares of a company, you have to pay the amount, right? You have to pay the, whenever they call the amount, you have to make the payment, right? For example, company issued shares, face value of the share 10 rupees. Paid up 7.5. That means till now company called 7.5, you paid 7.5. So this is partly paid or fully paid? Partly paid, because 10 rupees face value, only 7.5 paid. So unpaid amount balance is there. How much is there? 2.5. And these are called partly paid up shares, right? Now company may say, listen, company may say that we are making this fully paid up share by making face value from 10 to 7.5. So here what happens, you see, previously your face value 10, now they make it 7.5. The moment they make 7.5, this will become what? Fully paid. That means you are not required to pay anything. You already paid 7.5, face value 7.5. So this is the first case. So the liability of shareholders is reduced in respect of which amount? Unpaid amount. Here what is the unpaid amount? 2.5. To the extent of this unpaid amount, I reduced it. Now here what is the entry will come, tell me. Entry. Already in your books how much is recorded share capital? 7.5 is recorded, because in books only we record paid up value. Already 7.5 share capital is created. Now after this also share capital will be 7.5. But what is changed here? Partly paid has become fully paid. So therefore, if you write the entry equity share capital to equity share capital, 7.5, 7.5. But the debited equity share capital is what? Partly paid up equity share capital. The credited equity share capital is called fully paid up share capital. This is one of the, this is called reduction of share capital. Of course, there are 4 ways we call it as reduction of share capital. This is one of the way. So therefore, in the problem, if you see, if any company is reducing, cancelling unpaid amount to make the shares fully paid, that is reduction of share capital. So if the face value is 10 rupees, shareholders already paid 7.5, 2.5 not paid. Now company is saying we cancelling 2.5. How? By reducing the face value from 100 to 7.5. So here face value changed. See this. The moment face value changed by decreased by unpaid amount, this has become fully paid. So therefore, what is the entry? Share capital to share capital. 7.5, 7.5. But the nature you observe, this is partly paid, this is fully paid. This is one case. Second case, excess paid up share capital is paid off or returned to the shareholders. What is that? Excess paid up share capital is paid off or returned. For example, company issued share, each share face value 10. You paid 10. Suppose you purchased one share of a company, you paid 10. That means these are fully paid. Now company is returning back 2 rupees to you. Why company is returning? Maybe company not required. Maybe company cannot effectively utilize these funds. So they thought, why unnecessarily take the amount, we keep it in the business. If you are not utilizing properly, return them. So what company has done? Company has returned this 2 rupees. So now paid up amount has become 8. Face value is also becoming 8. So they reduced the face value from 10 to 8, 2 rupees, and by returning this 2 rupees amount to the shareholders. So this is one of the way. You understood the this thing, sir? Hello? Here can you tell me the entries? Entry, what entry will write? What is the share capital already recorded in the books? 10. Now it become 8. So therefore old share capital 10, new share capital 8, remaining 2 rupees to shareholders. So therefore share capital 10, 2 share capital 8, 2 shareholders 2. Shareholders to bank 2 rupees, 2 rupees. That's it. Correct? See, share capital old 10, 2 share capital new 8, 2 shareholders 2 return, shareholders to bank. What's the difference between first one and second one? In first one we are not returning any amount. Whatever the paid up unpaid amount is there, that's just we are cancelling it. But in second case, the share is already fully paid, but we are now returning some amount. By returning the amount, we are reducing. That's the difference between these two. And in first 2 cases, have you observed any common point? What is that common point? Very good. Reducing the face value. In first case, second case, both the cases face value decreased. Here 10 has become 7.5. Here 10 has become 8. In both the cases, face value decreased. Next, third one, reduction in paid up value only. Important. Reduction in only paid up value. For example, suppose a company issued shares, sir. Each share face value 100. Paid up also 100. That means it is fully paid. Now as a part of internal reconstruction, company has reduced paid up value from 100 to 10. Face value remains unchanged. Face value remains unchanged. They said we are making 100 rupees paid up value to 10. That means as a shareholder you are sacrificing how much? 90 rupees. You paid 100 rupees to the company, but company now saying only 10 rupees you paid. That means 90 rupees you sacrificed for the company. Why you sacrificed? Because company financial position not great. Internal reconstruction, as a part of internal reconstruction, 90 rupees you sacrificed per share. Are you understanding? See, important here, face value not changing. First two cases face value changed. So here face value not changed, only paid up value changed. Fully paid has become partly paid. So therefore 100 rupees has become 10 rupees. That means in future you have to pay, company shareholder have to pay 90 rupees when company called. Your share is how much? Actually 100. You paid how much? 100. But now they are saying 10. That means 90 rupees you sacrificed. That means whenever they call, you have to pay it again. Are you understanding, guys? Because the face value 100, the paid up value 10 only. Na? This is partly paid has now become. That means you are sacrificing that 90 rupees, even though you already paid. Now you are saying, okay, you use it for company losses and all set of it, like that. We will, I told you now, this amount we transfer it to capital reduction account, like that. So what is the entry you will write here? In already books, how much is recorded? 100 capital. So share capital 100 to, what is the new share capital? New share capital? No. New share capital is also face value 100. So new share capital 10, right? So what we can write is simply how much ever paid up value we are reducing, share capital account debit to capital reduction account. See this, share capital 90. So already it is there in the books 100. So reduce it to 90. So debit share capital 90, capital reduction account 90. So it is transferred to capital reduction. Okay. And last one, both change in face value and paid up value. You see this? Suppose 100 rupees face value, paid also 100. Okay. Now they make this as 10 rupees face value, 10 rupees paid up, fully paid. That means here face value decreased, paid up value also decreased. Already in the books, paid up value how much recorded? 100. Now it will be 10. So therefore what is the entry? Simple, old share capital 100, new share capital 10, balance will go to capital reduction account. Capital reduction account. Correct? Sir, your old capital 100, sir. New capital 10, sir. So what is the difference, sir? 90. This will go to capital reduction account. So these four cases are covered in reduction of share capital. So as a part of internal reconstruction, company will go for the reduction of share capital also. So let me once again cover all these four cases. So please carefully observe. Whenever we are discussing reduction of share capital, two cases main, either there can be change in face value, there can be without change in face value. Face value may change or face value may not change. One by one. See, out of these four, if you ask me which one is very important, sir, C and D are most important. Mostly in problems, C and D will come. Mostly in problems, C and D will come. C and D. Okay. Now tell me once again, four cases. First case, liability of shareholders is reduced to the extent of unpaid amount on shares. Unpaid amount on shares. Suppose if 2.5 rupees is the unpaid amount, that 2.5 will be cancelled. How? By reducing the face value of the share. So what is the entry? Share capital to share capital 7.5, 7.5. But that is partly paid. This is fully paid. This is the first case. Literally amount wise there is no change. Only character change. You already paid 7.5. Now also 7.5 only. And second one, excess paid up share capital. Suppose for example 10 rupees face value, you paid 10, fully paid. Now company is saying no, we are making this 10 rupees to 8 rupees, so you paid fully. So that 2 rupees we will give return to you. So what is the entry we will write, sir? Share capital old will be cancelled. What is the old share capital? 10. What is the new share capital? 8. Make the remaining 2 rupees will be given to shareholders. And reduction in paid up value only. For example, 100 rupees share, 100 rupees paid up, fully paid. Now we make it as 10. Face value remains unchanged. So share capital to capital reduction account. That means this share capital 100 has become 10 by transferring to capital reduction account. And last one, face value, paid up value, both has been changed. So therefore here paid up value already 100 recorded. From onwards new capital 10 rupees. So 100 has become 10 means 90 rupees will be the amount which is transferred to capital reduction account. So these are the 4 cases will come in reduction of share capital. Sir, why they are doing all these things, the reduction of share capital? Because see, as I told you now, as a part of internal reconstruction, we want the reorganization of capital, financial structure. So this is also one of the accepted ways as per the Companies Act. Only if these things happen, we call it as what? Reduction of capital. Next two. So 3 methods we completed as a part of internal reconstruction. First method, alteration of share capital. Second method, variation of shareholders' rights. Third method, reduction of share capital. Fourth method, compromises and arrangements. See, company have some financial problems, no doubt about it. That's why we are going for internal reconstruction. Now we will have a scheme of compromises and arrangements with our shareholders, other outside liabilities. Suppose we will call the meeting. In that meeting, we explain the situation of the company. These are the problems the company had. We will explain it, and we will work it out some scheme. So that the shareholders and creditors, liability holders, they will made some sacrifices. They will reduce their, like in case of reduction of share capital, third case, they reduced 90 rupees na. Paid up value has been reduced by 9 rupees that we transfer to capital reduction account. Like that, they will make some sacrifices. Whenever sacrifices came, some gain came, some benefit came, positive came, that will be transferred to reduction account. Similarly, opposite will be debited to capital reduction account. So this will be created to capital reduction account, or we can call it as reconstruction account. And finally, this balance in this reconstruction account, whatever is there, we will use to set off everything, whatever the problems we had, losses, overvalued assets, undervalued liabilities, we will use to set off everything. Okay, so this is compromises and arrangements. So compromises and arrangement means at the time of internal reconstruction, definitely some compromises will be there, some arrangements will be made with the shareholders, outside liabilities, creditors, everything. So whatever the sacrifices they make, so that will be transferred to capital reduction account. Sir, some of the examples, sir, examples I will give. See this. Shareholders are there. For example, they give up their claims to reserves and surplus. Suppose shareholders said reserves and surplus, whatever is there, we will give it up. That means this entire reserves and surplus will go to capital reduction account. But the question is, sir, you said company is already facing a problems. Where is the question of reserves and surplus? Maybe this is very hypothetical. It will not be there, because a company which is going for internal reconstruction, they don't have profits now. So the question of reserves and surplus will not arise. Suppose if any reserves and surplus are there and the company is going for internal reconstruction, then shareholders may sacrifice their reserves and surplus to the company. Then this entire reserves and surplus you transfer it to capital reduction account. Next, this one, settlement of outside liabilities at lesser amount. Suppose our creditors, liability holders is there, debenture holders is there. We went to the debenture holders and explained the situation. They may accept liability settlement at a discount amount na. Suppose for example 10 lakhs is the liability, they give 1 lakh discount. That means we have to pay only 9 lakhs. Suppose for example you see liability 10 lakhs sir, we paid only 9 lakhs. That means how much gain we got? 1 lakh. That will be transferred to capital reduction account. So as a part of internal reconstruction, we ask our liability holders to sacrifice something, give us something. Maybe they will give concession in interest. Maybe they will give some discount, whatever they have given, that will be transferred to capital reduction account. Next, sale of assets at profit. As a part of internal reconstruction, sometimes we sell our assets at profit. So when you sell an asset, what is the entry? Bank to asset. Any profit or loss will be transferred to P&L account. But this is done as a part of internal reconstruction. Therefore, it is transferred to capital reduction or reconstruction account. So bank account debit to asset account, fixed asset. Suppose for example, bank account means sale value. Fixed asset will be created with book value, WDV. The difference will go to profit, which is transferred to capital reduction account. Suppose for increase in value of asset. See, as a part of internal reconstruction, some of the assets may be undervalued. We will increase them. So when you increase the asset, what is the entry? Asset to capital reduction. Next, sir, are you understanding what I am saying? As a part of internal reconstruction, we will make changes in the assets and liabilities. We will make changes in the capital also. So whatever changes, whatever the settlements will happen as a part of, sometimes we will settle the liabilities, we will sell the assets, assets value decreased, assets value increased, whatever, because we are set right everything, right, as a part of internal reconstruction. So everything, anything can happen. Next, this one important, sir. E is very, very important. E and F. Please concentrate. E. For preference dividend sacrificed by preference shareholders. Sir, tell me, if you are a preference shareholders, company will pay preference dividend to you. Suppose last 2 years dividend is in arrears, and you sacrificed that dividend to the company as a part of internal reconstruction. Hello? Suppose 10% preference dividend, sir. 10 lakhs is the preference share capital. So 10 lakhs into 10% means 1 lakh. Suppose 1 lakh dividend is pending. Company have to pay 1 lakh, na? But shareholder said, preference shareholder said, we are sacrificing this 1 lakh as a part of reconstruction. What is the entry will write generally? Suppose if the preference dividend is already there in the balance sheet as a liability, now that liability will be cancelled, the amount is transferred to capital reduction account. So preference dividend to capital reduction account. Suppose if dividend is not appearing in the balance sheet, no entry will be recorded. Generally, preference dividend, most of the times we don't record in the books. So if it is not there in the balance sheet, how can you cancel something which is not there in the books, sir? If dividend is not appearing in the books, what is the entry will write? No entry. Suppose if dividend is already appearing in the books, preference dividend, and they sacrificed it, then preference dividend to capital reduction account. You understand why I am transferring everything to capital reduction account? My main object is what? Whatever the total after everything, sacrifices made by everyone, whatever the balance is there in the capital reduction account, that will be used to set off everything. Next, arrears of preference dividend paid now. Suppose you paid the preference dividend to the preference shareholders. Suppose preference dividend not appearing in the balance sheet. Tell me, sir, preference dividend not appearing in the balance sheet, but you paid it as a part of internal reconstruction. What is the entry you will write? Something which is not there in the books. Generally, if preference dividend is already there in the books, when we pay it, preference dividend to bank we will write. Liability to bank. Suppose preference dividend is not there in the books, but you paid it as a part of internal reconstruction. Right? What is the entry you will write? Simple. Capital reduction account will be debited to preference shareholders to bank account I will write. You are not understanding the depth here. See, concept basics these are. To the preference shareholders we pay what? Preference dividend. That dividend, if it is already appearing in the books, if they sacrificed it for company as a part of internal reconstruction, entire preference dividend will be cancelled. That will be transferred to capital reduction account. Preference dividend to capital reduction. That is clear, huh? Because they sacrificed it, sir. The dividend cancelled, it is transferred to capital reduction account. If it is not there in the books, no entry will be recorded. Suppose if you pay preference dividend now to them, and if it is not appearing in the balance sheet, generally, sir, we don't record preference dividend in the books like a normal liability. It is an appropriation. So generally we do, if it is not there in the books as a part of balance sheet, but still you paid it as a part of internal reconstruction, then capital reduction to preference shareholders to bank, you will write it. Okay. That's it. So this is compromises and arrangements. So in compromises and arrangements, tell me, when as a part of internal reconstruction, if you settle any liability at less amount, what is the entry? Liability to bank or cash or bank. Remaining balance less amount will be transferred to reduction. Next, if you sell assets at profit, bank to asset, difference will go to capital reduction, credit. Whenever I am crediting to capital reduction account means it's a gain, positive balance. Increase in value of asset. Suppose as a part of internal reconstruction, if you increase any asset value, asset to capital reduction. Whatever the increase is there, that increase is credited to capital reduction. Okay. And if preference dividend is sacrificed by the preference shareholders, and if that preference dividend is not appearing in the books, no entry. If it is appearing in the books, preference dividend to capital reduction, because they sacrificed it, na. So preference dividend will be cancelled. Liability is cancelled. Capital reduction account is created. Next, suppose arrears of preference dividend, if you pay now, if it is not appearing in the books, capital reduction account debit to bank, because you are making the payment, right? So capital reduction account balance will be reduced. That's why capital reduction to bank, I mean preference shareholders to bank. Nothing but net effect is capital reduction to bank. You understand? Next is surrender of shares. Last method, important method, surrender of shares. This is also one of the important, sir. I will explain it in a very simple manner. Listen to me. What is this surrender of shares, sir? See, sir, sometimes as a part of internal reconstruction, shareholders may surrender their shares to the company. Surrendering means voluntarily they are giving the shares away back to the company. So company, what they will do is use these shares to settle the liabilities, or company may reissue them, or company may cancel these shares, so that company can get some funds or company burden will be reduced. You are understanding what I am saying? Share surrender means, suppose if I purchase shares in a company, I have some shares. Now as a part of internal reconstruction, what I can do sometimes is I can surrender the shares to the company back. That means I am giving away my shares to the company. Why I am giving away these shares to the company? Because I know the company is in problems. So what company will do? These surrendered shares they will use to settle the liabilities. These shares they will give to the liability holders, so that the company liability will be reduced now. Or these shares they will cancel it, or they will reissue it, so that company will get some funds. That is called surrender of shares. You understanding? Now see, whenever surrender of shares happen, see this, during surrender, suppose if a shareholder surrendered the shares, what is the entry company will write, sir, in the books? When shares are surrendered, share capital will be reduced. Company share capital will be reduced now. So share capital account debit to share surrender account they will credit. See this, share capital to share surrender account. Now suppose, important guys, this is when surrender happened. During the surrender, this is the entry. Share capital will be debited, because share capital generally shows credit balance. Now debit it. Share capital account debit to share surrender. Now utilized these surrendered shares to settle the liability. Tell me, when company utilized the surrendered shares to settle a liability, what is the entry company will write? When we settle a liability, what is the entry? Liability to bank. But here I am not paying amount. I am giving shares. I am giving shares. Whatever the shares surrendered, those surrendered shares I am giving to my liabilities. For example, debenture holders. So therefore, debentures to capital reduction account I will write. Debentures to capital reduction account. Now when company issued shares, in company book share capital has to be created na? So share surrender account debit to share capital account. Important. Please understand, when company utilized surrendered shares to settle a liability, two things important here. Most of the students what they will do na, they don't understand, they will mix both. You should not mix here. Settlement of liability is separate, issuing shares is separate. Use your common sense, sir. Suppose you are the debenture holder of the company. Company has to make the payment 10 lakhs. So company point of view, if you think debentures to capital reduction, why capital reduction account I will credit? Because this liability I am settling without paying anything. This liability I am settling by issuing what? Surrendered shares. So company point of view, nothing is going out. I am giving the shares to you. Which shares? Surrendered shares. Already some shares are held by the shareholders, they surrendered it. Those surrendered shares I am giving to you. So therefore company point of view, liability is cancelled without any amount. Therefore liabilities to capital reduction account. And now if I issue surrendered shares, means company point of view, shares issued na. When shares are issued, share capital has to be created. And during the surrender, you open share surrender account na. So this share surrender account will become share capital. So share surrender to share capital. Hello? So tell me, when surrendered shares are used to settle the liability, what is the entry? Liability to capital reduction. Why liability to capital reduction? Why capital reduction account is created? To bank you can write na. Yeah, company point of view, cash is not going out. That means company has settled a liability without spending anything. So it's a gain for us. That's why it is transferred to capital reduction. But how this liability is settled? By issuing shares. Which shares? Surrendered shares. So share surrender account debit to share capital. Company books. Already share surrender account is there na? Hello. This is when surrender shares are used to settle the liability. Suppose sometimes company will not use these shares to settle the liability. They will just cancel them. Unutilized shares were cancelled. When you cancel, what is the entry? Simple. Entire share surrender account is transferred to capital reduction account. Share surrendered to capital reduction. Because whatever the share capital surrendered by them, now it is a gain for us. kind of advantage for the organization. So it is transferred to capital reduction account. It is transferred to capital reduction account. So surrender happens. During the surrender, what is the entry? Share capital will be cancelled. Share surrender account will be created. When surrendered shares used to settle a liability, what is the entry? Liability to capital reduction, share surrender to share capital. When surrendered shares are cancelled, yes, share surrender to share capital reserve, capital reduction account. That's it. Important. Okay, you understand this? I think we have completed, sir. Now we have one example also, sir. Suppose you see this example. There is a company A Limited, sir. This company has a equity share capital 10,000 shares of 100 each. How much? 10 lakhs. They subdivided the shares into shares of 10 each. I told you what is subdivision. Subdivision means dividing the shares into multiple shares. Here already 100 rupees share. Now that share is divided into 10. That means one share is divided into 10 shares. That means after subdivision, how many shares will be there in the company? 10,000 into 10. 1 lakh shares will be there. Come on, yaar. 10,000 shares of 100 is 10 lakhs. Now they divide the shares into shares of 10 each. 100 share has become now 10. Correct? Number of shares will be 1 lakh. Face value will be 10. So total 10 lakhs. So because of the subdivision, what happens? Number of shares will increase, face value will decrease. Okay. What happened next? Ask their shareholders to surrender 50% of their shares. Now company is asking the shareholders to surrender 50% of their shares. Okay. Then issue 60% of the surrender shares to 15% debenture holders of 4 lakhs in full settlement of their claims. Out of the surrendered shares, 60% of the surrendered shares is used to settle a liability of 4 lakhs. To cancel the unissued surrendered shares. Remaining unissued surrendered shares will be cancelled. Now can you tell me here what are the entries we will write? First you see subdivision entry. Subdivision entry if I write, what is the entry? Equity share capital to equity share capital. Total 10 lakhs, 10 lakhs. But number wise if you see, 10,000 into 100 will be cancelled. 1 lakh into 10 will be now new share capital. Correct? So subdivision, equity share capital to equity share capital. Old is 10,000 into 100. New is 1 lakh into 10. So 10 lakhs, 10 lakhs. Everybody. Now, so therefore after subdivision, how many shares are there? 1 lakh. 1 lakh shares. In this 1 lakh, how much surrendered? That means 50,000 shares were surrendered. During the surrender, what is the entry? Share capital to share surrender. See this. Share capital to share surrender. So 1 lakh shares, 50%. 50,000 into 10. So 5 lakhs, 5 lakhs. Correct? Now out of this, 60% is used to settle the liability. How much liability? 4 lakhs. 4 lakhs liability to debenture holders. When surrendered shares are used to settle a liability, what is the entry? Liability to capital reduction. Next is share surrender to share capital. So therefore, liability to capital reduction, how much you will write? 4 lakhs. Share surrender to share capital, how much you will write? 60% shares you are issuing. Out of 50,000, 60% means 30,000. That means 3 lakhs. 30,000 into 10 rupees. 3 lakhs, 3 lakhs. Share surrender to share capital, 3 lakhs, 3 lakhs. Very, very important. See this. Settlement of liability. 15% debentures to capital reduction, 4 lakhs, 4 lakhs. Issue of surrendered shares. Share surrender to equity share capital, 3 lakhs, 3 lakhs. Beautiful point. See, majority of the students is struggling here. I don't know why. So please think common sense. When surrendered shares are utilized to settle a liability, settlement of liability, liability to capital reduction, we are issuing the shares, share surrender to share capital. Both has to be written separately. So I have written separately. Now remaining 40% unissued will be cancelled. So what is the entry? Share surrender to capital reduction. What is the remaining 40%? Out of 50,000, 20,000 shares. Correct? 40% means. So 20,000 into 10, 2 lakhs, 2 lakhs. Share surrender to share capital. How many of you understood surrender concept? Please raise your hand. Understood? This is one of the way. So therefore, all the 5 methods we have completed. Now see, important. Sir, out of all these 5 methods, whatever the entries, we will write it. Now we have capital reduction account 1 balance is there, na sir? One balance amount is there in capital reduction account. Generally capital reduction will have which balance? Credit balance, positive balance, credit. Now this balance will be used for following purposes. What we do this capital reduction account? We will write off the fictitious assets, intangible assets of the company. We will write down the overvalued fixed assets, current assets. We record new liability or provision, or expenses for reconstruction we will write off the accumulated losses. And I told you why we are going for internal reconstruction. Because company has some losses, overvalued assets, undervalued liabilities. All these problems we need to overcome, right? How we are going to overcome? By creating one account, capital reduction account. Whatever the sacrifices came, we will transfer to that capital reduction account. That capital reduction account balance now I am using for all these things. For example, I will write off the losses. For example, how to write off? Simple. Capital reduction to P&L account. P&L account debit balance will have a loss. Now I will credit P&L account, debit capital reduction account. For example, assets are overvalued. Now I need to separate it. Capital reduction account debit to assets. Like that, this amount in the capital reduction account, I am going to use it to write off any fictitious assets. For example, in our company balance sheet, fictitious assets are there. We will cancel them against this capital reduction account. So these fictitious assets no more appear in the balance sheet. Next, to write down the overvalued fixed assets or new liability or provision. For example, company wants to create a new liability. They will create a new liability. Liability if you create, you will credit liability. Debit will be given to capital reduction account. And expenses of reconstruction. So to undertake all this process, some expenses will be incurred, na? So that will be recorded. So that will also be capital reduction account debit to bank. We will write. And accumulated losses. Like this, we will prepare one account. See this. Once the entire internal reconstruction over entries, we will prepare an account like this. Capital reduction account. See this. In this capital reduction account, credit side you see, these are all what? Credit side, all the sacrifices, positives. Debit side, all the expenses. Finally, whatever the amount is there, we will use to set off those things like overvalued assets, write off of the losses, all these things. For example, you see share capital, reduction in paid up value. This is sacrificed by shareholders. We have written an entry na share capital to capital reduction account. That one. Debenture holders given discount. That is creditors given discount. Fixed assets increase in value. Whenever fixed assets increase in value, what is the entry I told? Asset to capital reduction. No capital reduction account is created. Like that, we will credit the positives. Debit side, we will use this capital reduction account to write off the losses, good intangible assets, preliminary expenses, fictitious asset, discount on issue of debentures, overvalued assets, fixed assets, current assets, any unrecorded liabilities paid, arrears of preference dividend not appearing in balance sheet we paid. So any expenses, reconstruction expenses we will pay, any new liability provision we created from capital reduction. Finally, whatever the balance is remaining in this capital reduction account, after separate everything, that is transferred to capital reserve account. Hello? Finally, after everything, whatever the balance is there in this capital reduction account, that will be transferred to capital reserve account. Okay? So this is the internal reconstruction theory, sir. So the most important thing is you have to remember when I am going to write all these things. When how much amount will be transferred to capital reduction account. So see this. Actually, finally, this capital reduction account, whatever is there, I am using it to set off everything. Losses, preliminary expenses, discount on issue of shares, underwriting commission, advertising suspense, reconstruction expenses, goodwill, patents, trademark, fixed assets, overvalued, other assets. So finally, whatever the balance came, that will be transferred to capital reserve account. So that means what you can say, sir, after executing this internal reconstruction process, my balance sheet looks strong. My balance sheet looks healthy. Why? I removed all the losses. I separate the assets, overvalued assets, undervalued liabilities. I make sure that the capital is properly, face values, number of shares properly adjusted. So with the sacrifices from the shareholders, creditors, I make sure that my balance sheet looks very strong. This entire process is called internal reconstruction process. Generally what they will do now, first they will prepare one scheme of internal reconstruction. In that scheme, they will write each and every point, what to do with whom, how much to be sacrificed by shareholders, debenture holders, how much they will give, assets what we need to do, liabilities what we need to do, how much expenses will incur, everything they will give. And generally this scheme, internal reconstruction scheme, they will go to the court and court will approve it. Okay. Now in the how questions will be asked, sir, they will give you one company balance sheet and they will tell you this company is going for internal reconstruction. As a part of internal reconstruction, they want to do this. They will give you 5 or 6 points. Now they will ask you to write the journal entries and also prepare the balance sheet after internal reconstruction. So you need to see whether alteration of share capital is happening, variation of shareholders' rights is happening, reduction of share capital is happening, compromises and arrangements is happening, and then surrender of shares is happening. I explained 5 methods. Accordingly, you need to write the entries. When you are writing an entry, when to credit capital reduction, when to debit capital reduction. Simple funda is what? When to credit capital reduction? Positive. Negative, if anything is there, liabilities, we expenses will debit. That's it. So, and finally this capital reduction account will use to set off all these things. Okay. So relating to internal reconstruction, let's solve some important questions, sir. In our study material, if you see, we have 3 questions. In that, first come to problem number 2. This question already came in December 2023 attempt, sir. Same question as it is. December 2023 attempt, they asked for 7 marks. Okay. So, see this question. Problem number 2. The following is the balance sheet of Saraswati Limited as on 31st March 2023. Asset side, you see, non-current assets, property, plant, equipment, non-current investment, current assets. Equity and liability side, equity, share capital, other equity, non-current liabilities, long-term borrowings, current liabilities, trade payables, short-term provisions. If you see the breakup, what are the share capital? 1 lakh equity shares of 100 each. 50,000, 12% preference shares of 100 each. Other equity, you see, retained earnings, debit balance of P&L account is there. Meaning, debit balance in P&L account means this company is suffering losses. Long-term borrowings, this company had debentures, 40,000, 10% debentures. Short-term provision for taxation. Investments is there. See, this is the balance sheet of which company? Saraswati Limited. When? 31st March 2023. So 31st March 2023, this is the balance sheet. Now, important, see this. The following scheme of reconstruction is duly approved and sanctioned by the appropriate authority. The moment you see in the examination scheme of reconstruction, you can identify that's an internal reconstruction question. So here clearly get the following scheme of reconstruction. As I told you, every company which is going for internal reconstruction, they will prepare one scheme. In that scheme, they will write what are the things they are going to undertake as a part of internal reconstruction. Hello? See this. What they want to do as a part of internal reconstruction, sir, first, all the existing equity shares are reduced to 40. They want to reduce the existing shares to 40. Okay. All preference shares are reduced to 60. They want to reduce all preference shares to 60. Okay. So let's one by one we will discuss it. First, you see, all the existing shares are reduced to 40. First of all, tell me, equity shares, what is the face value? 100. Fully paid. Now they want to reduce it to 40. So reduction of capital. 100 has become 40. So what is the entry? Equity share capital old 100. 2 equity share capital new 40. 2 capital reduction 60. They will write. Simple. See this. Equity share capital 100. Face value I am telling. Total amount if you see 10 lakhs. Not 10 lakh. I think 1 crore. Hello? 1 crore. Now they reduce it each share to 40 rupees. So therefore 40% is now. How much sacrificed? 60%. That means 60 lakhs. Very simple. Similarly, second thing, all preference shares are reduced to 60. Now come to preference share capital 100. Total 50 lakhs. So what is the entry? 12% preference share capital 100 rupees 50 lakhs to 12% preference share capital 60 rupees. So that means 60%. Correct? So 50 lakhs into 30%, 60%. How much? 60%. 30 lakhs. Remaining 20 lakhs will go to capital reduction account. Correct? See this 12% preference share capital to 12% preference share capital to capital reduction. Okay. Next. That means in reduction of capital we have discussed now 4 cases. Which case is this? Reduction of capital. Which case is this? Face value. Actually in the books already fully paid up shares. These are 100 we already recorded. Now they become 40-60. They become 40-60. So therefore face values remains unchanged. But here what is happening, sir? The paid up value of the company has been changed. Remaining they have sacrificed it. Remaining they have sacrificed it. Hello? See the next one. Rate of interest on debentures increased to 12%. Debenture holders surrender their debentures of rupees 100 each and exchange the same for fresh debentures of 70 each for every debenture held by them. See, rate of interest debentures increases, sir, 12%. One thing. Second, debenture holders surrender their debentures of 100 each and exchange the same for fresh debentures of 70 each. That means every debentures total 40 lakhs, sir. 100 rupees, 40,000 debentures. Now 40,000 into they will accept 70. That means 28 lakhs. That means how much they sacrificed? 12 lakhs. That will go to capital reduction account. Therefore, what is the entry? Old 10% debentures account debit 40 lakhs to 12% debentures 28 lakhs to capital reduction 12 lakhs. Correct? See this. 10% debentures to 12% debentures. Here rate changed. Remaining the sacrifice is transferred to capital reduction account. Okay. Next. This is also done. One of the creditor of the company to whom the company owes 20 lakhs decided to forego how much? 40% of his claim. That means it is transferred to capital reduction account. He is allotted 30,000 equity shares of 40 each in full satisfaction of his claim. Important, sir. Sir, one of the creditor amount owed is 20 lakhs, sir. He decided to give 40%. And remaining 60% he is allotted how much? 30,000 equity shares of 40 each in full settlement of his claim. Correct? So what is the entry we are going to write here? Creditors account debit to 20 lakhs. 20 lakhs into 40%? 8 lakhs. 2 equity share capital. How many equity shares, sir? 30,000 equity shares into 40. So how much? 12 lakhs. So you see this entry. Creditors 20. Correct? So we are issuing equity shares. 30,000 equity shares of 40 each. They sacrificed 8 lakhs. Balancing 40%. Next. What happened? Property, plant, equipment are written down by 30%. That means we need to reduce the property, plant, equipment by 30%. What is the entry? Capital reduction to PP. Capital reduction to PP. Current assets are to be revalued at 45 lakhs. Current assets, how much is there? Current assets 1 crore is there. Okay. Now they want to revalue it at 45. That means how much we need to reduce? 55. What is the entry? Capital reduction to current assets. Next, taxation liability of the company is settled at 1,50,000. So we settled the taxation liability at 1,50,000. Actually in books how much created provision? 1 lakh. So how much we need to increase? 50,000. So capital reduction account debit to provision for tax. 50,000, 50,000. Correct? Next, investments are to be written down to their market value, which is 9,50,000. Investments. Actually investments how much is there? 10 lakhs is there. Now they want to reduce it to 9,50,000. So 50,000 they want to reduce it. Capital reduction to investment. It is decided to write off the debit balance of P&L account in full. So once everything is over, whatever the balance is there, the entire P&L account will also be written off. So here if you see the entry, see here, I have written provision for tax. Hey, provision for tax we settled. Provision for tax is settled at 1,50,000 by mistake. Actually, provision how much is there? 1 lakh. We settled 1,50,000. That means provision for tax 1 lakh. To bank 1,50,000. So 50,000 is capital reduction. Correct. So this was. So provision for tax 1 lakh, capital reduction 50 to current asset, nothing but bank. Now similarly, investment value reduced to 50 na. So CR to investment. And finally, CR account debit to PP we have written off. Current asset we have written off. P&L account debit balance we have written off. So P&L account debit balance how much is there? 6 lakhs negative. That will also be written off. So finally, what is the balance left? 50. That is transferred to capital reserve account. Okay. See, this question they asked for 7 marks here. Balance sheet also not asked. Only journal entries. Only journal entries they have tested. Very simple now. You understand this? Next, one more question, sir. Problem number 3. Meghana Limited. This question is also repeated in the examination, sir. This question came in June 2024 attempt. June 2024 attempt. Already this question came, sir. Okay. See this question. The summarized balance sheet of Meghana Limited as on 31st March 2024 as follows. Asset side, property, plant, equipment, tangible assets, intangible assets, current assets, inventory, financial assets, trade receivables, loans and advances, equity and liabilities, equity, share capital, other equity, non-current liabilities, long-term borrowings, current liabilities, short-term borrowings, trade payables. If you look at the breakup, share capital, authorized, issued, fully paid. This is 5,000, sir, not these 2 zeros you have to strike it out. 5,000 equity shares of 100 each, 5 lakhs. 2,500 8% preference shares of 100 each. Other equity they have P&L account, debit balance, loss is there 10 lakhs. Long-term borrowings, debentures is there. Short-term borrowings, loan from directors, bank overdraft. Tangible assets, freehold property. Freehold property, plant. Intangible assets they have goodwill, trademark. Look at the scheme of internal reconstruction. What is the scheme of internal reconstruction here? The following scheme of internal reconstruction was framed, approved by the court, and all the concerned parties are and implemented. First, preference shares important to be written down to 25 each and equity shares to 20 each. Sir, here preference shares to be written down to 25, equity shares to 20. Actually, preference shares how much is there, sir? 100. Now they want to written down this to 25. So therefore, you see 100 they want to written down to 25. So 75 will go to capital reduction account. Correct? 75 will go to capital reduction account. Similarly, equity shares. How much is their equity shares? 100. So they want to write it down to 20. So how much they sacrifice? 80. That will go to capital reduction account. So therefore, if you write the entries here, you see first entry 8% preference share capital. Old preference share capital how much, sir? 100. New preference share capital will be 25. How much they sacrificed? 75. Will go to capital reduction account. Correct? Similarly, this is the preference. Equity share capital, you see. Equity share capital old 100. 5 lakhs. New 20. Sacrificed 80. If you want, you can see the number of shares also. 5,000 shares, sir. So 5,000 into 100. 5 lakhs. 5,000 into 20. 1 lakh. 5,000 into 80. 4 lakhs. So first 2 entries over. Next. This one is done. Next, what happened? Each class of shares is to convert it into shares of 100 each after reduction. Sir, that means once they reduced it, then they want to convert these shares into shares of 100 each after reduction. Right? Suppose you see here. Come to first preference share capital. Preference shares how many is there? 2,500. Look at this. Total preference shares 2500. 2500 each share originally. So total 2,50,000. Now 100 rupees share they reduce it to 25. So 2500 into 25 it will be 62,500. Now they want to make each share into 100. So if they make 100 each share, so 62,500 divided by 100, it will be 625. You see this, 625 into 100. So it will be 62,500. 62,500. Total it is same only. Total wise it is same. So in place of 25 they make it as 100. Accordingly the number of shares will be 625 only. Na? Everybody, you read it properly. What they have given. Each class of share is to be converted into shares of 100 after reduction. That means once we reduced, then they have done like this. Correct? So therefore 625, 62,500. So therefore what is the entry? If I write 8% preference share capital old 100 to 8% preference share capital 62,500. To capital reduction 1,87,500 which we already written. Now after that what they have done? 8% preference share capital 25 62,500 will become 8% preference shares of 100 62,500. That means what they have done? They have done subdivision consolidation. Correct? I mean they reduced the face value from 100 to 25 and then they make it 100. So this is the entries they have to write actually speaking. So preference share capital to preference share capital. This is old, this is again new. So this is 20, this is 100. Overall it will remains same. Similarly if you come to equity share capital, can you tell me equity share capital total shares? 5,000 into 100, originally 5 lakhs. Now they reduced this 100 to 20. So how much sacrificed? 4 lakhs will go to capital reduction account. Now they make this 20 into 100. So therefore 1 lakh divided by 100 means 1000 shares. So here what are the entries? First equity share capital to equity share capital. That means 5,000 shares into 100 5 lakhs, 5,000 shares into 20 1 lakh. So capital reduction will be transferred with 4 lakhs. After that this equity share capital 5,000 into 20 will become equity share capital of 1000 shares into 100. Sir, because you have to read the question carefully, sir. So here first shares preference share capital reduced from 100 to 25. Equity share capital reduced from 100 to 20. After that they made each share 100 rupees again. Each class of shares converted into shares of 100 each after reduction. That means here equity share capital 5 lakhs has become 1 lakh. This 1 lakh only terms changed. Please understand. Terms. 5,000 shares of 20 has become 1,000 shares of 100. Because in the clearly given now onwards the share value is 100 like that. You understand this? I think this is the most important thing in this question, sir. So this we explained. Okay. Next you see the second point. Debenture holders to take over freehold property. What is the book value? 2 lakhs. At a valuation of 2,50,000 in part payment of their holdings. Sir, debenture holders will take the freehold property, book value 2 lakhs, but they will take it at 2,50,000. Remaining freehold property is to be valued at 6 lakhs. Tell me, sir, total freehold property how much? 4 lakhs. Freehold property total 4 lakhs. Given na sir, 4 lakhs. In this 4 lakhs, how much? 2 lakhs worth of book value taken by debenture holders. But they are taking it. That means 50,000 increase in value of asset. So what is the entry? Freehold property to capital reduction. Remaining freehold property revalued at 6 lakhs. Out of 4 lakhs, if they take 2 lakhs book value, what is the remaining? 2 lakhs. But now it is valued at 6 lakhs. So how much increase? 4 lakhs. So freehold property, another 4 lakhs will be increased. Correct? So therefore, if I write here, see this, freehold property, I have done the little bit analysis. This is the book value, right? 4 lakhs is the book value. 2 lakhs they taken away at 2,50,000. So therefore the entry is freehold property to capital reduction. 50,000, 50,000 I need to increase. And this I have given for debenture holders, right? So their liability is reduced by this 2,50,000. So debenture holders to freehold property, 2,50,000, 2,50,000. You understood, guys? Remaining 2 lakhs is valued at 6 lakhs. So freehold property to capital reduction. So here 2 lakhs is taken at 2,50,000. So first increase this 50,000 to asset to capital reduction. Then settle the liability. They are taking it. So this is the entry. Actually, see these two. Freehold property to capital reduction 50-50. Debentures to freehold property 2,50,000, 2,50,000. Remaining balance freehold property to capital reduction 4 lakhs, 4 lakhs. Hello, are you all understanding? Next, loan from directors to be waived off in full. Loan from directors will be waived off. How much, sir? Loan waived off. That means they will not. We are not required to pay anything. So therefore, loan to capital reduction. Loan to capital reduction. Next, stock of 50,000 is to be written off and 12,500 is to be provided for bad debts. Stock we reduce mean asset value we are decreasing. So what is the entry? Capital reduction to stock. And we are creating a provision, capital reduction to provision. Hello? Simple, sir. When liability is increasing, sir, capital reduction account will be debited. Similarly, when asset is decreasing, capital reduction account will be debited. Simple. And P&L account balance, trademark, goodwill, loans and advances are to be written off. Finally, this P&L account debit balance, trademark, goodwill, loans and advances, whatever is there will also be written off. So therefore, you see here, loan. Finally, this capital reduction account balance, we will set off loans and advances, P&L account, provision for doubtful debts, already inventories, goodwill, trademark. So finally, how much balance left? 1 lakh. That will be transferred to capital reduction account. Okay, that's it. So in this question, what is the most important thing, sir? First point. And then freehold property point also important point. So this question they tested in June 2024. And previous exam questions, 2 questions I solved. Same whatever is there in the study material, they repeated it, sir. Actually, June 2025 question, if you observe, June 2025 question, which is exactly similar to question we solved, problem number 3 now. Meghana Limited sum is there, sir. Same question they repeated actually. Same question, nothing change there. Small changes will be there, but majority question is absolutely same. That's it, sir. So my thing is that internal reconstruction you have very less number of problems, that too only repeated. So in study material 3 problems, examination 2 problems, total 5 problems. In this 5 problems repeated. So effectively see you have 4 problems only, 3 or 4 problems. You solve all these 3 or 4 problems, that is more than sufficient. Okay, so this is internal reconstruction. 7 marks pakka will come if you focus. Okay, next term I'm going to discuss value added statement concept, sir. Surely you will get one 7 marks question from this value added statement. That's been the trend. This will come in recent developments of financial reporting chapter. Recent developments of financial reporting chapter is there. In that chapter, problem 7 marks problem generally will be asked from value added statement. Value added statement, economic value added statement, market value added statement. Actually 3 things are there. Okay, from this they can ask any one. Sometimes economic value added, market value added, they are mixing and they are asking. One question also asked previously, I am going to solve that examination question also. Now in that recent developments of accounting chapter, except this value added statement, remaining all theory concepts. So if you love theory, if you want to read the theory, you can, but this is one of the practical areas. And here this value added statement, how it will be prepared, some formats are there, some formulas are there. If you can remember, I think easily you can solve this question. Easily you will get 7 marks. Okay. First of all, I am going to discuss this value added statement. What is this value added statement? Let us discuss it. Sir, tell me, traditionally how the performance of a business will be measured? By preparing P&L account. Generally we will prepare P&L account of a company or P&L account of a business From that we will know the profit or loss. Based on that we will judge the performance. That's a traditional way of ascertaining the performance of a business. But there are different other ways also to measure the performance of an entity. One of the way is value added statement. Value added statement. Value added statement is basically nothing but how much value you created through your business and how this value you created is been distributed to different parties connected with the company. That we will prepare in the form of a statement. That statement is called value added statement. So it indicates the value, the net value or the wealth created by the business during the period. And not only how much value you created, this created value, how you are going to distribute it to the employees. See, they who are the parties? Employees, government, providers of finance, and then reinvestment in the business. 4 aspects are there in the distribution, 4 parties. How much value you created, and that value you created, how you are going to distribute it between the parties. That we will show in the form of a statement. That statement is called value added statement. Actually, in value added statement, two parts. First part, statement showing value creation, how much value you created. Second part, distribution. Value created, one part, distribution, another part. It is like a fund flow statement. You know fund flow statement? What is fund flow statement? Generally, fund flow statement is nothing but what are the sources of your funds, how you applied your funds. Sources of application of funds. How much funds have been gathered, how much funds have flown to the organization, for which purposes you spend the funds. That will be shown in the form of statement. That is a fund flow statement. Now, similarly, it is similar to that. How much value you created and how this value created has been distributed to the different stakeholders of the organization. Now here the most important thing is the format. You need to remember this format. If you remember this format, I think this game is over. Simple. They will give you the data. That data you need to write it in the form of a format. So look at this format, sir. Value added statement format. Okay. First, I told you first thing is about what, sir? Value added. How much value you created. Second, distribution of value added. Okay. So first part, how much value you created. Second part, how this value created has been distributed between the parties. Particulars, rupees. First take sales. Sales or turnover. Any other operating income, any other income, operating income, take it. Add or less change in stock of finished goods and work in progress. Important this one. Any change in the stock of work in progress, finished goods, you have to add or less. Okay. If the change, now, what is this change in stock of finished goods and work in progress, sir? The difference between the opening and closing balances, nothing but the difference between the opening and closing. The difference between the opening and closing of finished goods to work in progress. For example, my finished goods opening balance 10 lakhs, sir. My closing balance, for example, 20 lakhs, sir. So tell me how much increase, sir? 10 lakhs. Add. So add it like that. Suppose, for example, opening balance 10, closing 5. Decrease na 5 lakhs minus. So add or less the change in opening stock and finished goods and work in progress. It is like when you prepare a trading account, sir, trading account. You remember trading account? In your lower levels you have prepared. In trading account, debit side opening stock, credit side closing stock you are showing now. The difference between opening and closing is affecting your GP, gross profit. Same manner. That's why the difference between opening and closing I am directly adjusting to the sales, because it is going to impact my profits. So tell me, in the value added statement, what is the first thing we take? Sales. For that, any other operating income, if any, add. Minus, add or less, change in stock of opening and finished goods and work in progress. Finished goods, work in progress, opening, closing difference is there, na? That is called change. That change. So you will get the total value of output. From this you need to minus, see this, minus bought in materials and services. See, to generate this output, what are the materials, what are the services you brought to the business? You need to minus it. Bought in materials and services. Okay. So what are the, generally tell me, what materials we will use? Raw materials. Any raw material consumed, purchased. Any stores consumables we will use for manufacturing. Power and fuel. For manufacturing we will use power and fuel, na? Minus it. Any packing materials to pack the output, I mean pack the materials we produced, goods produced, packing material. Repairs and maintenance. For machineries and all we will do repairs and maintenance. And then printing and stationery expenses. Rent, rates, taxes we will pay. Factory rent, any taxes paid to the government, taxes, rents, insurance we taken for the assets, any professional charges, auditors remuneration. Suppose if I went for audit, they will pay me audit fees, na? Auditor, being a professional chartered accountant, so professional charges, audit remuneration, any traveling and convenience, any advertisement and selling expenses, any other admin expenses, any other bought in services. So what are all the materials? See this here, materials and services you bought, purchased, nothing but, to generate this output, minus it. This is the total bought in cost. So this is A, total output, total value of output. This is B, total bought in cost. A minus B is nothing but value added. Guys, important. So what items are taken here? Raw material consumed, purchased, stores and consumables, power and fuels, packing, repairs and maintenance, printing and stationery, rent, rates, taxes, insurance, professional charges, audit remuneration, traveling, conveyance, advertising and selling expenses, other admin cost, any other bought in services. And trust me, I will show the questions also. Same items will be repeated. This is the thing. Okay. This is total value added. Now what is the second statement I told? Distribution. Now distribution is very, very important, sir. See, when it comes to distribution, there are 4 categories. First is employees. Employees, sir. Distribution to employees. First one you see, distribution to employees. Tell me, sir, to employees generally what we distribute? Salaries, wages, bonus, incentives, gratuity, employer PF contribution, ESI, employee state insurance, staff welfare expenses. Whatever is there, you write it. Make a total. This is total to employees. This is what we distributed to all the employees. Hello? Next, government. Tell me what we distribute from business side to government. Income tax. Normal rates and taxes will come here. See here. Normal rent, rates, taxes will come here. When I said government, here income tax, GST, customs duty, other taxes, excise, any property taxes will be considered here. Total. This is what we distribute to the government. Okay. Next to providers of capital. Providers of capital means? Providers of capital means shareholders or creditors who give, I mean lenders, providers of finance, nothing but. See here capital means not only share capital, even debt capital, debt in the form of debt also we will consider. So generally to providers of capital we will pay what? Interest, dividend. See this, interest. Suppose if you take debentures, interest you pay, na? That is what we distribute. Interest on debentures, interest on loans, bank loans, borrowings, dividend. From shareholders they will give share capital, we will give dividend, na? That dividend. Suppose preference shareholders also we will give preference dividend. That is. So to the providers of capital what you distribute? Interest or dividend? This one, interest or dividend. Take it here, make a total. Last one, reinvested in the business. This is where most of the students are doing mistake. Please be careful. Reinvested in business. Sir, how much amount you reinvested in your business? Surprising things will come here. Reinvested in business, depreciation will come. Depreciation is part of reinvestment. How many of you know this? Because what is depreciation? Depreciation is nothing but loss in value of asset. Every year you are providing depreciation means literally this asset value every year you are depreciating. So once the life of this asset is over, you want to replace it with another asset, right? So depreciation is kind of reinvestment in the business only. Generally the concept of depreciation, actually now we don't have such concepts like sinking fund, depreciation replacement reserves. That concepts are not there, but basically depreciation, whatever we created in the books, to that extent we will set the funds aside and we will use it to replace the asset. So that's why this depreciation, amortization means depreciation for intangible assets is called amortization. Normal tangible assets we call it as depreciation. For intangible assets we call it as amortization. So any depreciation, any amortization, okay, it's a part of reinvestment. And also any retained earnings, important. Any retained earnings means surplus profits. Any profits you earned during the year, any retained earnings. So that will be any transfer to reserves, we transfer to reserves. And most important things, sir, put a star mark here, loss on sale of fixed assets. So when you sell a fixed asset, you got a loss in a, sir, that loss is also reinvested in the business. So therefore you need to take a total of this. So reinvestment in business, tell me what items will come: depreciation, amortization, retained earnings, transfer to reserves, loss on sale of fixed assets. Important, because you need to remember this format. You will get marks and total. Then you add all the value distributed, you will get the same amount. So whatever the value you created, na sir, this value created, it should be equal to the value distributed. So created, distributed. So this is the value added statement. Actually, you know, they say in instead of traditional P&L account, this will be much useful to the users, because as a business enterprise, how much value you created, and how much you distributed to the society, how much you distributed to your employees, how much you distributed to the government, how much you distributed to the providers of capital. But if I see the P&L account, I don't get all these things, right? I will know overall profits and losses, but that's why the chapter name is what? Recent developments in financial reporting. This is one of the recent development in financial reporting. Many organizations, they are reporting like this, so that users will get an idea, okay, this organization has created this much value and they have distributed this much to the stakeholders. Okay, you remember this. So this is value added statement, sir. Now relating to value added statement, look at this question, sir. In study material we have one question relating to this. Important, based on this question already one time examination question came. Okay, so MQP is also so many times this question is there. Everybody please see this question. Following are the balances in the account statement of X Limited for the year ending 31st March 2025, rupees in thousands, sir. So what they're asking, see this, clearly they given prepare value added statement for the company for the year 21-22. So they're asking value added statement. So what items are there? Turnover, that means sales, plant and machinery net, loss on sale of machinery, depreciation on plant and machinery, dividends to ordinary shareholders, like that some items given, right? Tell me now, first we are going to prepare what? Value added. How much value has been added? So we're starting with what? Sales. So how much is the sales? 4,600. Take it, 4,600. Any other operating income? Nothing. Nothing. Nothing is there. You check it actually. See, while reading the question itself in examination hall, with pencil you mark it down. How much will go to employees, how much will go to government, so that you can quickly solve the question like that. Okay. Next, what about inventory? Any change in inventories of finished goods and work in progress? Yes, you see here, total stock of all material work in progress. Opening stock, how much is there? Closing, how much is there? So increase how much? So add. See this. Generation of value added. First take turnover, 4,600. Okay. Then add increase in stock of materials, work in progress, finished goods. 80 has been added. So 4,680. Nothing, remaining items not, other operating income is not there. So 4,680. From this, what I need to do? Bought in materials and services I need to deduct. Look at the bought in materials and services one by one, you tell me. Raw material purchased we'll consider, correct? So 1250. Next, printing and stationery 44. Auditors remuneration 56. Rent, rates, taxes 330. Other expenses 170. That's it. Huh? Income tax will come in distribution to the government. See, bought in materials and services means to generate this output, what materials, what services we consumed for the business. So therefore, here cost of bought in materials and services, if you observe what they have taken, see this, raw material purchased 1250, printing and stationery 44, auditors remuneration 56, rent, rates, taxes 330, other expenses 170, total 1850. So 4680 minus 1850, it will be 2830. This is called value added. Value added. Guys, in examination I know majority of the students will take distribution aspects in value added. That is wrong. Here you see, I will tell you. See, suppose you take loss on sale of machinery will come in distribution. Where? Reinvestment. I reinvested in business. I told the loss on sale of fixed assets. Depreciation will come in distribution. Where? Reinvestment. Dividend to shareholders, providers of capital. Providers of capital. In distribution it will come. Correct? Next, retained profits for the year also will come in distribution. Providers to the capital. Reinvestment. No. Retained profits will go to providers of capital. Correct? Reinvestment. Yes. Yeah. Reinvestment. Retained earnings. Correct. So similarly, interest will go to providers of capital. Income tax will go to government, distribution. Hello? Wages and salaries will also distribution to employees. Employee state insurance is also employees, distribution. PF also distribution. So distribution items should go to distribution only. So once I created the value, now distribution, sir. First employees. Tell me what items will go to employees, sir. See this, wages and salary, employee state insurance, PF. 3 items are there. 654, 70, 56. See this. 654, 70, 56. Next to government. What items will go to government? Tell me. Income tax. How much? 552. See this. Income tax. Only income tax is there. 552. Next to providers of capital. What items will go to providers of capital? Interest. What is the interest here? Interest on borrowings. How much? 80. Any dividend? Nothing. That's it. The dividend is there. How much? Yeah, dividend to ordinary shareholders 292. These 2 items will come here. See this, interest on borrowings, dividend. Next, last one, reinvested in business. This is important. Reinvested in business, depreciation will come. Depreciation you take it. Suppose depreciation 400 and also yes, loss on sale of fixed assets, this one, and also retained profits. Retained profits don't take opening balance. How much is the retained profits for the year? 576 you have to take it, important. See this, 576. Most students, some students they are including opening balance also. No, because we are creating value added statement for the year. Loss on sale of machinery, depreciation, retained profits. I think these 3, correct? Any other item is there? Nothing. So you add all these distributions, you will get how much? 2830. Correct? Check it once. 780 employees. Government 552. Providers of capital 372. This is 976 plus 150. 2830. Correct. Hello? So therefore, this is how the value added statement will be done. So you understand how the value added statement will be prepared? So 2 aspects, value created, value distributed. Don't mix both of them. Distribution will go shown only in distribution. Okay, this is the only question from study material, sir. And one more question, sir. You see, December 2023 examination, 7 marks they have tested. I think same type of question. You see this, similar to exactly study material question. See this question. From the following information provided by Sun Limited, prepare value added statement for the year 22-23. So this question tested in December 2023, sir. 7 marks. So tell me how you are going to do it. First we need to take sales 2400. Correct? Any other operating income? Nothing. What about the change in inventories? See, opening stock how much? 160. Closing 200. So difference is 40. Increase. So we need to add. So 2400 plus 40. 2400 plus 40. So 2440. Now cost of bought in materials and services. What are the cost of bought in materials and services? Raw materials purchased, printing and stationery, auditors remuneration, rent rates, taxes, other expenses. These 6 items: raw material purchased, stationery, remuneration, rent and taxes, other expenses. 5 items. See this: raw materials, printing and stationery, rent and tax, other expenses, audit remuneration. So 1090 total. So this one 2440 minus 1090. So it will be 1350 is the value added from distribution, from there to distribution. When it comes to distribution, first employees, what we distribute, tell me? Wages and salaries. See this: wages and salaries, employees, state insurance, PF. 3 things will be added. Next, government income tax. Next, providers of capital, dividend on ordinary shares we will give, and also interest on borrowings. These 2 things will come. Retained earnings will come in reinvestment. See this: interest to dividend. Reinvestment in business, what you take? Depreciation will take. Yes, depreciation will be take. Any loss on sale of fixed asset? Nothing. But it is there. What is that? Retained earnings, opening plus current year, or only current year? Only current year. Profit for the year, how much? 205. Take it. That's it. See, this question they have asked for 7 marks. Imagine. What is there the difficulty? Just you remember the format, you reproduce it. So 7 out of 7 you will get it. Okay. So this is value added statement, sir. Very simple. And similarly in December 2024 also, look at how simple question they asked. 7 marks. Same question. 1 minute you can complete this. For example, sales you take it 1000. Okay. Opening stock, closing stock difference 60, 90, 30 will be added. Hello. So sales plus this one 1030. Now cost of bought in materials, purchase of materials will take it 1. Printing and stationery, auditors fees, rent, taxes, these 3 we will take it. Correct? See this: cost of purchase of material, printing and stationery, auditor fees, rent rates, other expenses. Now distribution. When it comes to distribution, what items you will distribute? First, employees, you will pay wages and salaries. Correct? Only item I think, wages and salaries. And government you pay taxes, they given clearly taxes. And providers of finance we will pay interest, dividend. 2 things: interest to dividend. See this. And reinvestment in business, when you what depreciation we will take it 1, and then retained earnings. Correct? Retained earnings for the year 165. These 2 will be considered as this one. See how easy questions they are asking. This is December 2024 attempt they tested for 7 marks. Imagine. Easy questions. So this is value added statement. Hope you got the value added statement. Now once the value added statement is over, sir, next thing I am going to discuss is economic value added. This is also one of the frequently testing areas, sir. Either value added or economic value added they will test. Sir, what is this economic value added statement? See, this economic value added is also one of the recent financial reporting. Actually, this is developed by Stewart and Co. Stern, Stewart and Co. Okay. The also known as Stern Value Management. This economic value added statement will tell you what is the true economic profit generated by the business. What is that? true economic profit generated by the company. Actually, this Stewart and Co, they developed one formula, sir. Based on this formula, we need to calculate EVA. You need to remember some formulas. I am going to tell you now two important formulas. You have to remember them. 2 or 3 important formulas, and here FM also will play important role. You already learned SFM. So in SFM some formulas you might have learned. Those formulas also very useful here. Now first try to understand the formulas. Formula number 1, I mean you need to remember one by one link up is there. EVA. They say EVA is equal to NOPAT, that is net operating profit after tax, minus in brackets weighted average cost of capital into capital. Which capital? This is operating capital. Here capital means debt plus equity both, not just equity. Debt plus equity both we have to take it. So tell me what is EVA formula? NOPAT minus WACC, weighted average cost of capital into capital. Now we need to understand. So here 3 things are there. NOPAT, WACC, capital. I need to understand. First to come to NOPAT. Sir, what is NOPAT, sir? NOPAT is net operating profit after tax or before tax? After tax. How you are going to get it? Simple. EBIT, earnings before interest and tax. EBIT into 1 minus tax. That means from earnings before interest and tax, if I reduce the tax, I will get whatever amount I will get, that is called net operating profit after tax. Sir, after tax I want, sir, take EBIT, earnings before interest and tax. Your company earnings before interest and tax. From that reduce tax, you will get EBIT. I mean, you get NOPAT. So this is the first one, easy one. Okay. So NOPAT, okay, easy. What about capital? Third thing you see, capital. Here I told you already, capital means equity plus debt. Both you have to take it, not just equity. Now equity debt will come freely, na? There will be some cost. That is called KE. KE means cost of equity. KD means cost of debt. KE, KD. Cost of equity, cost of debt. Now see, this cost of equity, cost of debt will be in percentages. For example, cost of equity 10%, cost of debt 12%. But here the important point is, when you are considering the cost of debt, after tax you should consider. That means, suppose for example, company issued 10% debentures. 10% is the cost of debt. From this 10%, tax expense minus 30%. For example, 30% is the tax rate, right? So 30% you deduct it. Then you will get what? 7%. This is cost of debt. Guys, important guys. When you are considering the cost of debt, you should consider after tax minus post tax rate. You have to take it because interest will give you tax savings. That's why. So cost of debt is 7%. Sir, if I pay interest is my expenses, sir, cost, sir, I am getting tax advantage, na, sir. So that's why after tax, net of tax, I have to take it. So cost of debt. You understand? So tell me, EVA formula? NOPAT minus weighted average cost of capital into capital. NOPAT is equal to EBIT into 1 minus tax. Capital is equal to? No. Capital is equal to capital plus debt. On capital, the cost is KE. Cost KE. We should not call that is capital. Capital is capital. So equity debt on that cost KE KD. Correct? When you are considering KD, cost of debt, you should consider pre-tax or post-tax. Post-tax amount you take. In examination they will give you pre-tax generally. So from that you reduce the tax rate, you will get it post-tax. Okay. Now important. So this KE KD, this KE KD, sir. Yeah. What is the role of this KE KD? I will tell you. WACC we need to find out, weighted average cost of capital. How to find out weighted average cost of capital? See this is the formula, important, remember. Weighted average cost of capital is equal to KE. Take first cost of equity. KE into equity divided by capital plus KD into debt divided by capital. That means proportionate. In the total capital means equity plus debt. Take KE, cost of equity, proportionately take it. I mean E divided by C. E means equity divided by capital. KD, but when you're taking KD, post tax. D divided by C, debt divided by C. Proportionately you take it. You will get one rate, na? That is called WACC, weighted average cost of capital. This weighted average cost of capital you need to apply on the capital. Then you will get this amount. This amount you will get it. From that, no PAT I will reduce. Then I will get EVA. Okay. So the summary is this. EVA is equal to no PAT minus WACC into capital. No PAT is equal to EBIT minus EBIT into 1 minus tax. WACC is equal to KE into cost of equity into equity divided by C. Proportionately KD into D divided by capital. Capital is equal to E plus T. Now here the most important twist is sometimes they won't give you KE. KE is not given in the question. But in order to arrive WACC I need KE, definitely I need. Hello? KE definitely I need. So if KE is not given in the question, there is one model called CAPM model. Yes, capital asset pricing model. By using that model I need to find out KE. In examination questions they are giving that. They are not giving KE. So when if in the question KE is not available, na, find out by using this model. The formula is, see this. The formula is RE is equal to RF plus beta brackets RM minus RF. This is the formula you need to remember. Sir, what is this formula? Once again, can you tell? Yes, see this. RE, that means rate of equity, is equal to RF. RF means risk-free rate. Risk-free rate plus beta. Beta means systematic risk. All this given in the question, sir. RF, see, don't ask me what is risk-free rate, what is beta. That is not the subject here. We are not bothered about what is beta. SFM, you learn it. So beta, RF, here the only thing is you need to remember what is it is. And use the knowledge of SFM here. So I am just reminding you the formula, that's it. Our main focus is on the learning EVA, not learning the formulas in depth. Please try to remember, that's it. That is more than sufficient here. One or two formulas I think easily you can remember, sir. So RF, that means risk-free rate, plus beta in brackets RM. RM means market return minus RF again, risk-free rate. Now see, important point. The difference between market rate and risk-free rate is called equity risk premium. Sometimes they will give you equity risk premium directly. That means they will give you this difference. So therefore in that case you multiply with beta, you multiply with the RF, automatically you will get the RE. Hello? So can you tell me the formula for when KE is not given in the question? You need to find out by which model? CFA model. What is the formula? RE is equal to RF plus beta in brackets RM minus RF. Difference between RM minus RF is called risk premium, equity risk premium. Okay, I think I covered all the important points. That's it. I think more than that not required. So this is economic value. So according to Stewart and Co, any company's true economic profit is how much you are earning, no PAT, minus how much capital you invested in the business. What is the average rate of return? WACC means average rate, nothing but. So if you are earning more than this, that is called EVA. That is the economic value you created. According to them, that is the true profit of any organization. And it was well appreciated by so many. That's why they have given this in the theory in our books. So relating to this, let me solve one important question, sir. June 2024 question will solve. June 2024 attempt. Yeah. Question number 2 you see. June 2024 7 marks question. You see this question they have tested for 7 marks. I know majority of the students they have not done it. But how easy it is once you know the formulas, these are all nothing. See this question. Saurav Limited provide you the following data based on which you are required to calculate what? EVA. We need to calculate EVA. Look at the information given in the question. Equity share capital given 42 crores equity shares of 10 each, 420. 15% preference share capital given 1.4 crore equity shares of 100 each, 140. 15% debentures given 1120 crores. Income tax rate 30%. Beta given, beta. Beta will be useful in calculating KE by CAPM model. Market rate of return given, RM given. How much? 15.5. Equity market risk premium given 9%. What is this equity market risk? RM minus RF, difference directly given. That means what is missing here? RF. RM they are given. Difference between RM, RF given. RF not given. But I can find out now. Because equity risk premium is equal to RM minus RF. I know equity risk premium. I know RM. So RF is the balancing figure. So that's one. Here the important thing is financial leverage given. For this your knowledge, FM knowledge is required. Tell me the formula of financial leverage. EBIT divided by EBIT, EBT, EBIT divided by EBT. Can I write like this? EBIT divided by EBIT minus tax. EBIT minus interest. That formula. EBIT divided by EBIT minus 1. Because see in this question they given financial leverage means NOPAT. How we need to find out NOPAT na? To find out NOPAT I want EBIT. EBIT minus tax. But in the question EBIT is not available. You see. So therefore I need to use this financial leverage to find out the EBIT. And then land and building held as investment. Why, if land and building is held as investment, what we need to do? We need to deduct from the capital, because this is held as investment means this is an outside investment. It is not part of our capital. See, generally capital means what I told? Equity plus debt, which is equal to assets minus liabilities. Suppose you invested in land and building and you are treating this as investment. That means the funds are going out now. So therefore it is not part of net assets. It is not part of capital. That's why from equity, in this question if you see equity share capital, preference share capital, debentures, these three I will add. From that 140 I will minus, because this 140 went outside. See, capital means the amount which should be there in the business. Hello. But see here land and building held as see that means 7 marks. How many twists they are giving? But easy only once you know the formulas. Okay. Come on, let's solve this question, sir. I want EVA. Tell me the formula. NOPAT minus WACC into capital. First NOPAT. NOPAT is equal to EBIT into 1 minus tax. EBIT I don't know, but I can find out through financial leverage. So financial leverage is equal to EBIT divided by EBIT minus I. That formula I will use. See this. See this. EBIT divided by EBIT minus I. And I know I. I means interest. Hello? Can I find out interest? Calculate interest on debentures. 1120 into 15%. 168. Hello? So 168. Financial leverage 1.5 times. So you need to ascertain EBIT as the balancing figure. You know all these things, sir. EBIT 168. I think if you solve this, you will get 504. EBIT is 504. Mathematically, I think I expect everybody knows how to solve this. 504. You got it. From this, I need to reduce tax 30%. 504 minus 30%. 352.8. That is EB. NOPAT. So first one I got it. Next I want WACC. WACC is very, very important. WACC is nothing but KE, cost of equity. Here KE directly given, not given. So we need to find out CAPM model. CAPM model, what is the formula? RF plus beta into RM minus RF. This RM minus RF they have given. That is called equity risk premium. So equity risk premium is equal to RM minus RF. But I want RF. So therefore I ascertained RF. See this. RF is equal to RM minus equity risk premium. Sir, you understand this? See here. Equity risk premium is equal to RM minus RF. Suppose if I want RF, what I will do? RF is equal to RM minus equity risk premium. That's what I have done. So how much I got it? 15.5 minus 9. So 6.5. So therefore RF is 6.5 plus beta 1.5. Difference 9. Directly given. Equity risk premium. So I got 20%. So WAC KE I got, not WAC. KE. Now cost of preference share capital 15%. Preference share capital is also part of capital. This KP they call it as. Cost of debt KD. How much? 15% minus tax. I have to do it. Correct? So 10.5. So now I got cost of equity, cost of preference shares, cost of debt. Now I need to find out WAC. How to find out it? Simple. First cost of equity 20% into what is the total capital? Add these three 420, 140, 1120. 1680. See, when you are ascertaining WAC, don't reduce. Because I am taking the original figures. 420 divided by 1006. See, this is the total capital in equity plus debt. This is equity proportionately. Same preference shares 15%. Cost of preference 1680 140 plus debt 10.5 into it. So I will got 13.25. You understand this? WAC I got it. So now I know NOPAT WAC. So I want capital employed. So when it comes to capital employed, I need to take operating capital employed. See, equity plus preference plus debt minus investment in land. Because these are not part of the operating capital. So I got 1540. Correct? 1680 minus 140, sir. I got 1540. So therefore, you can substitute this here. 352.8, 13.25 into 1540. So I got 148.75 is the answer. 148.75. See this 148.75. Look at the suggested answer given by CMA Institute. They given in 3 lines. But tell me frankly, which students will understand by looking at this? How much working we have done. So that's why it is important to understand the subject in deep. So if you see the suggested answers, you won't get it. Suppose if you want to learn this answer, you don't get now directly. How will you know financial leverage is equal to EBIT divided by EBIT minus 1 minus I? I am challenging you, 70 to 80% of the students doesn't know this. Very difficult. And how will I know the land and building have to reduce from the capital? So all these twist points will come only when they give elaborate answers. But CMA Institute is not giving elaborate answers. I don't know why. I'm very hard to understand. Sometimes they are not giving answers incomplete. They are giving only summary. But in the classroom I have solved in detail for the benefit of the students. So that's why important. So you understand this? So in this question, tell me what are the new things you learned? Financial leverage formula. Financial leverage is equal to EBIT divided by EBIT minus I. CAPM model. CAPM model RF plus beta into RM minus RF. RF not given, but by equity risk premium they given. Based on that I ascertained. RM I know. So RF is ascertained as balancing figure. And another new point is land and buildings, if it is held as investment, we need to deduct it to arrive the operating capital employed. Hello sir, you understood? Next one more question I will solve, sir. June 2025 question. Question number 6. June attempt. There is one question. Yeah. Come to this question. Very good question actually. In this question, sir, this question came in June 2025, sir. The speciality of this question is they have asked both EVA as well as MVA, market value added also. I am going to explain MVA. First we are going to see the EVA. See this question. Brahmaputra Limited is interested in calculating EVA. You are provided the following information. So what are the information they have given, sir? Share price at the beginning of the year is 200 per share. And the face value of the share is 10. Last year EVA was 250. Last year economic value added 250. From the trend of the share price, it is likely that an increase EVA from 26 to 50% leads to 25% increase in the share price. Any increase up to 25% leads to no change, and an increase beyond 50% leads to 30% increase in the share price as compared to that of the beginning of the year. So this paragraph is actually talking about MVA calculation information. I am going to explain it. There was no issue of fresh equity during there. Look at this table information. 12% debt capital given, equity share capital given, reserves and surplus given, capital employed they themselves given, capital employed. Actually these three they added, that is capital employed. Debt to equity, reserves and surplus. Even reserves and surplus is also part of capital. Risk-free rate given. What is this risk-free rate? RF. Hello? RF. Beta given. Market rate given. So I can ascertain KE. Operating profit after tax given. They have given no PAT directly after tax. Tax rate given. I think we can ascertain EVA directly, easily. Hello? So in this case, how you are going to find out? Tell me. EVA is equal to no PAT minus WACC into capital employed. No PAT, tell me how much? 2100 directly given. Operating profit after tax. Now I want WACC. WACC, if I want, first I want to know the cost of equity. KE given or not given? We need to find out by using CFR model. Apply CFR model. If I apply CFR model, see this RF. How much is the RF? Plus beta 1.5. RM 15%. RF 6%. So therefore 19.5 is the cost of equity. Correct? Cost of debt 12%. This is before tax. Minus 30% tax. How much? 8.4. So I know cost of equity, cost of debt. So can I ascertain WACC? Yes. So cost of equity into equity. How much is the total equity? See, when you consider total equity, equity share capital plus reserves and surplus. Both you have to take it. 8,000. Hello. 19.5 into 8,000 divided by 10,000. Plus cost of debt 8.4 into what is the debt capital? 2,000 divided by 10,000. So how much you got it, sir? 17.28%. 17.28. You got this WACC, So I think capital also easily we can know. Capital 10,000 crores into WACC. No PAT already given. So 372 crores is the answer. I think this question is a direct question relating to EVA. Nothing, no hiccups. Simply we can do it. Sir, you understand how this WACC is done? You are understanding WACC proportionately how I am taking this? Proportionately we have to do. This is how you need to do it. I think this formula, if you don't know, Nana sir, gone. KE formula, CAPM model, you don't know, na, you are unable to do it. That's the. And also, when you consider cost of debt minus tax, always remember that in exams. Okay. Now I am going to explain market value added statement. So I told you three statements, sir. One is value added, another one is economic value added, third one is market value added. Sir, what is this market value added? See. This market value added is nothing but what is the market value of your business minus how much capital invested by the shareholders. How much capital is invested in the business? What is the market value of your firm? The difference is nothing but market value added. Market value added is nothing but how much wealth created by the company for its investors, purely from investors' point of view, how much wealth is created. It is nothing but the difference between the market value of the company. What is the market value of the company? Minus the capital invested by the investors. So the easy formula is MVA is equal to V minus K. V minus K. V means market value. K means total capital invested. For easy purpose I have written like this. Market value minus capital invested. This is the formula. So easy na? So tell me market value added. Market value added formula. V minus K. What is V? Market value of the firm. K means total capital invested. Suppose this question they have asked, this one also. You see here, market value added also they have given. What is the market value added of this company? See this. You read this paragraph. If you see, what is the share price at the beginning of the year? 200. What is the face value of the share? 10. Last year EVA? 250. From the trend of this price, from the trend of share price, it is likely that an increase of EVA from 26 to 50% leads to 25% increase in the share price. Sir, in the beginning the share price of the company is 200. Share price is 200. Face value 10. So therefore this 200 is what, sir? Market price of the share. Correct? So how many shares are there in the company? Total share capital 500 crores. Face value 10. That means 50 crore shares are there. So 50 into 200. How much, sir? 10,000 crores is the market value of the firm at the beginning. Sir, market value means number of shares into market price per the share. Market price per the share 200 given. Number of shares 500 divided by 10, 50 crores. So 50 crores into 200, 10,000 crores at the beginning. I want at the end because I need to market value minus capital invested. But they're saying that the market price at the end depends upon the EVA increase. If EVA increases from 26 to 50%, how much market price will increase? 25% will increase. Suppose any increase up to 25% will not increase the market price. Suppose if the increase is beyond 50% up to 30%, there will be increase in the share price. Now you tell me, EVA in the beginning given how much? 250. Now we calculated EVA. How much we got it? 372. Sir, at the beginning 200, sir. At the end 372. How much increase, sir? 172. EVA at the beginning 200, at the end 372. How much increase? 172 divided by 200 into 100. How much percentage? 86%. Correct. So increase in EVA 122. Oh no, what is the EVA we got it? 372 minus at the beginning 250. How much increase? 122. 122. 122 divided by 250. 48.8. That means increase in EVA 48.8. In the question they are saying if the increase is from 26 to up to 50, share price will increase by 25%. So 200 plus 25%. 250. Now 250 into 50 crores. Because during there is no fresh issue of shares given. So how much? That is the market value of the firm at the end, 12,500. Because the market price, see how beautifully they linked the question. EVA at the beginning 250, at the end 372. So 122 increase. So the percentage, the increase is 48%. Now they said if the increase is between 26 to 50, share price will increase by 25%. So therefore see, share price increases by 25%. So it will be 250 at the end. So what is the market value? 50 crore shares into 250, 12,500 is the market value. From this I need to reduce capital invested. How much is the capital invested in the business? Equity only we need to take. Only investor's point of view means here we should not consider debt. So 8,000 crores. Hello? See this 8,000 crores. Equity share capital only we need to take. So how much we got it? 4,500 is the market value added. So MVA is 4,500 crores. So you understand how we got it? So this is the market value added. So market value added is market value of the firm minus capital invested. When it comes to capital invested by shareholders, not debt. But in EVA calculation we consider debt also. There is a difference. This is purely from investor's point of view. Hello? So this is how the question will be solved, sir. That's it, sir. I think we got this. EVA related questions, important questions I solved, sir. Remaining and all plain questions only they will give you. Remaining I think you can practice it once. Actually relating to EVA and MBA, one more question is also there. This question also similar to the questions we solved already. Easily everything is given in the question itself. EBIT given, interest given, everything is given. So based on that you can solve it. So you solve this question, sir. Okay? Remaining questions. Most important questions I covered it. So we covered value added, we covered EVA, we covered MVA. All the three covered. From this I think I can expect one question, 7 marks question, you can get it. One MCQs also if luck goes well.